Namaskaram, ladies and gentlemen. Welcome to the official marathon of CA Inter Auditing and Ethics for May 2026 attempt. So, it will be almost a 9 to 10 hour marathon, which we are going to upload this time. And the things which I wanted to tell you, something which you guys need to hear before the marathon is that let's have a strategy. First of all, before marathon, I thought of saying this in the same video itself. That is, lot of CA Inter students, which I have seen personally myself, that they follow basically a kind of a wrong strategy towards auditing, and that is the reason why they are unable to complete their lecture, not the lectures, complete their portions in the 1.5 day revision. They would have revised it multiple times earlier, but in the 1.5 day, they are unable to revise everything. So for that reason, I came up with a strategy, and there are a lot of students who are already asking me, sir, what is the ABC analysis for CA Inter May 2026, what chapters we should study, what chapters we should skip, and all these things. So, but for all of this, I have only one answer which I need to tell you right now itself, and that is, let's have a prioritization basis. For whatever chapters you have studied, there will be like many kind of students. Some students may have prepared decently well now. If you would have studied 100% chapters, go with it. That's the best approach. If you have already covered 100% chapters and you are decently strong in it, then do multiple revisions and go with that. But there are also some students who are asking me, sir, we have both the groups left. The time period is very less for them. How to crack auditing? Because we at least need to get only 50 marks in auditing. Like that they are asking me. So I thought of giving a strategy for everyone. This is going to work strategy. This is going to be a strategy that's going to work, and that's going to give you a return on investment for the time which you are spending in the preparation. Because like we always say, studying 80% chapters and revising it multiple times and making sure you are strong in that is much better than studying 100% chapters in a vague format. First of all, understand that. So let's focus on the strategy. So I would say it's not an ABC analysis or anything, but it's a practical analysis. Based on my experience, I'm saying this. Based on the past trends in the examination, I'm saying this. So if you are someone who is writing CA Inter Audit May 2026, listen to this video, and this is going to change your life. So first, let's spend some 5-10 minutes on the strategy, and then we'll move on with the marathon as well, right? So first of all, the number one thing which I need to tell you, the strategy for examination along with marathon. If you want directly to marathon, you can skip on to that. The timestamps may be in the description, or it's automatically updated, right? Yeah. First of all, if you see, first chapter we need to prioritize is obviously, this is our priority chapters. Chapters priority, that is in the same order itself you study. Chapter number 1. Yes. Like the most priority chapter is chapter number 2, but I'm giving a set. This set you have to study, that format leper chapters, how many marks we are going to get. That is also we need to have an average idea, right? So chapter number 1, you are definitely going to get how many marks? Minimum 5 marks. Normally 5 to 6 mark comes, average 4 to 5. So average we are taking 5 marks in that. Then you have to study chapter number 2. This is the most important chapter for me. If you ask me, this is the most important chapter, and that's the weightage is 10 marks minimum. 10 marks is a weightage which I believe is going to come for this attempt. 10 marks. And this chapter in our revised audit book, there are only 10 pages. So for one page, 1 mark. Minimum is what I'm saying. Not normally 12 will come, but still I'm saying 10. So chapter number 1, 5 marks. Chapter number 2, 10 marks. Then our focus will be on chapter number 6. It's a very easy chapter. Chapter number 6 also you will get 5 marks. Then there is chapter number 11. 11 also you may get on an average, you can say 10 marks, because normally sometimes 14 marks will come. September 25 something, I believe it was 13-14 marks was there. So average you can take it as say 10 marks, because even though 11 10 marks will not come, but still at least 6 7 marks may come, or 2 12 marks may come. So on an average you can take, for this is your first set which you need to study, and average definitely you can guarantee it, max to max 2 or 3 marks up or down. Max to max 10 plus 10, 20 plus 5, 30 marks you are getting minimum. This is minimum what I am saying, minimum 28 to 35. Normally 35, 32 you will get from this. And just see how many pages you studied based on the revised audit book, whatever book which we are using. Revised audit book, chapter number 1 is you are having around say 10 pages, 10 pages. Chapter number 2 also 10 pages. Chapter number 6 from 5 pages. 11 you are having 14 pages. Just see 20 plus 14, 34 plus 5, 39 pages you are studying, and you are getting 30 marks. So these 4 chapters, 1, 2, 6 and 11 should be your core. You should study 100% of these chapters. Whatever questions come from these chapters, this is your A category, to be honest. It's not like A category, so don't take it as A category. We are not categorizing, just understand things. So, I think one issue happened. Okay, I believe it is visible. So, side portion, I think some issue was there. Yeah, whatever. So, I'll just write it onto the side. That is almost chapter number from 1 you are getting almost 10 pages, chapter number 2 are 10 pages, chapter number 6 is just 5 pages, and chapter number this is 14 pages. So almost in 39 pages you are getting this much marks. That is a beauty, right? 39 pages, 30 marks. So your first focus is make sure 100% coverage, everything, even a minute MCQ towards or a 5-mark descriptive question, whatever comes from this chapter, I need to get full marks. 5 out of 5 or MCQ, whatever, full marks. So this is your first. Then second, let me tell you, we'll focus on the next level. Next level is basically chapter number 3. I would say, people would say chapter number 3 skip, but I believe how can someone learn auditing in CA Inter by skipping chapter number 3? If you are skipping chapter number 3, the problem is that, okay, this is a bit hard and technical to understand and learn, I understood. But without chapter number 3, without the internal controller, without the test of controller, without substantive analytical procedure, without SA 330 and 315, how the hell someone is going to understand what is in chapter number 4, what is in chapter number 7, what is in chapter number 8 or 9 or all the other chapters? The 3 is the core. Without SA 315 and 330 on 320 materiality, there is no auditing practically. Right? Your risk assessment procedure, further audit procedure, materiality. The core 3 standards are coming under chapter number 3. So 3 should be given that priority, even though the weightage is low comparatively towards the load of the subject. You got to give it that level of a weightage, level of an importance, because this is a core concept. Without understanding chapter number 3, without understanding the concept, you cannot properly do it in chapter number 4 or further things. Because without understanding what the hell is 315 and 330, how will someone understand the other topics in entire CA Inter, right? So I would say 3. This is my personal priority. If you believe in me, trust in me, go with it. And if you don't know chapter number 3, I have a revision video in my channel, and plus this marathon also, like if you need detail, it is there. And marathon also quickly we are brushing up every concept of chapter number 3. So must watch 3, because 3 you should definitely watch. And 3, if you understand all the concepts, 3 is going to be easy. Just do some extra hard work on 3, because that's going to give you that benefit. Not only from 3, your 4, your other chapters will get easier. Because with the 3, if you understand what is 315, 330, 320, everything. Okay. Yeah. I've done a beautiful revision on 3. So please watch it, this marathon itself. Yeah. So chapter number 3, you are going to get an average weightage of around minimum to minimum 12 marks. This is, I am talking about the minimum marks. I am not talking about the inflated value or anything. Chapter number 3, you are going to get minimum, what is the marks? 12 marks, minimum, chapter number 3. Then obviously I would say chapter number 4, definitely 16 marks. Either sometimes chapter number 3 may go to 13 and 6 may, number 4 sometimes may go to 18, 20 also, some situations. So 3, 4, then obviously your 7, obviously your 8 includes Caro also. Okay, 7th chapter you are gonna get an average weightage of, say, you can put it 10 marks, sometimes 7, 8, but we are ready, we have put lowest marks in 3 and 4, so our average 10 marks. Chapter number 8 is gonna give you on an average, I would minimum to minimum 12 or not 12. Let's put it, because here we have put chapter number 3 and 4 we have put only lesser amount. So 8 average, this is another block. This is another block what I'm saying. This block you are going to get around, say, 13 marks minimum. So what is the marks coming? 13 plus 12, 25. 25. 25 plus 10, 35. 35 plus 10, 45. 45 plus 6, 51. 51 marks you are going to get. And this is enough for you to pass practically. If you just want to pass or want to have 40, 45 marks, practically these two block. This is block number 1, A, not B, anything, but first priority for this, because if I say ABC, will come up with something. I don't want to use that word. So that is what I'm saying. This is your block number 1 and this is your block number 2. Try to cover this. Have I missed any chapters? 1, 2, 3, 4, 5 is there. Okay, 5 and that is another 6, 7, 8. Yeah. So this is your second block. Then third block, I would say you have 3 options. Basically, what is the third block is, this third block is going to give you that exemption or like 70 plus 80 plus. If you're someone who wanted an exemption or 50 plus, like 55, 60, 70, 80, that then you have to definitely cover this as well. Don't go without this. And I would say, if you are writing only one group, or if you have other subjects also decently completed, this block also definitely you need to study, because this is going to be a high weightage block. That is bank. Bank is going to definitely give you minimum to, on an average, some attempts it goes very low, but average 8 marks we can say from bank. But bank's problem is that sometimes its drawing power, provisioning and all these things may come in the MCQ. So it kind of like a will be complicated. So that is why, because different entity and financial statement comes in MCQ, but still, even if you don't study also, you'll be able to answer decently well financial statements, MCQ part. But bank, if you don't know the calculations of drawing power, this provisioning, NP and all these things, then it will be a bit complication. So I would advise bank, and we have done a beautiful revision for bank in marathon as well as in my YouTube channel also. If you go, you can see there. So bank on drawing power calculation, practical questions are also been solved. So please give importance to bank. At least if you are not studying bank, okay, please study the calculation part, the drawing power part and the provisioning part. NPA provisioning part will be there, right? That and asset classification, income recognition, provisioning. These part just study bank. Minimum. So minimum bank is going to give you 8 marks. Then comes audited financial statement, audit of financial statements. Where does it went? Audit of financial statements and the different entity. This is going to give you definitely financial statements. You know, it's the biggest chapter. Sometimes on an average we can put it as 18. Some attempts at 20, 22 it will go. Sometimes 16 it will go. Average you put it 18. Different entities you can put it as say 10 or 12. You'll put it as say 10 average. So 10 plus 18 plus this much marks you are going to get from this. So, but here I will give you an approach. If you are someone who is writing only one group, if you have time, definitely don't think that sir has said only study this much. No, I'm saying this is a priority you need to study. For exam day revision also, this is a priority you need to do. And exam day morning and audit, I always say do 2 revisions in examination. 2 revisions means 1.5 daily. You have to do your first revision. You have to complete by almost till 8 o'clock or 9 o'clock in the exam day morning. That is 90% of your time you do your first revision. But in at least that last 4 or 5 hours before the examination, do one more revision of your weaker concepts, weaker questions. Please do it. That when you are doing your first revision, like first revision on examination, after your costing exam, when you are writing auditing, when you are doing your revision, when you are trying to recall whatever questions are not, you are unable to recall, please mark those questions. Like put a flag, like you will get the sticky flag, put it outside, or in a paper. Okay, this question I am not unable, or page number, at least write in a separate rough paper. So exam day morning, whatever are your weak concepts, you can do one more revision. Please do it, because audit, whatever you study 1.5 day before, there is a big chance that you may lose that out of your mind, right? So just do a one more revision of brushing up of tougher concepts will be good. And before entering exam hall, that last say 15 minutes to before your exam, right? Almost 1 o'clock to 1:15, that time, close like you will be finishing your first and 2 revisions done. Then just revisit all the pages once more. Don't read anything. Don't revise anything. Don't recall anything. Take your book, just quickly, pages, you show it to your eyes once. So that when you are writing your paper, if there may be something which you would have forgot, but you may remember that. That's for that purpose. So keep these 3 things in mind. So don't consider sir saying that this is the thing you need to do. No, it's not like that. First priority, second priority, and third priority. And one more suggestion I can give you. If you are someone who has really good amount of time, study all of that, 100%. It's not about time. If you want to get good marks, you need to study, 100% safe. You need to study everything. But if you're someone, a bank, try to study properly, because bank, it's just one's understanding is enough, because there is nothing to memorize in bank. Only 3-4 questions are there in bank to memorize. All the other things are just understanding concepts. When NPA this happens, what to do, this happens, what to do. That is for agricultural advances, what provisioning should be done, like that, or state government guaranteed advances, what to do. That is only the understanding part is the bank. So bank, just watch this marathon video is there, or anywhere, just watch, revise, understand bank, it's enough. Then AFS and different entity, I would always advise one thing. If you have time, study perfectly. If you don't have time, I'll give you an advice. At least use the 3-pointer technique, which I say, 3-pointer techniques. Don't skip these chapters. Don't skip this chapter and go to anyone. If you're writing single group or both the group, don't skip it. I'll give you technique. Bank, you have to definitely study it, because practical questions may come. But these 2 chapters, if you have time, study in detail. But if time is not there, I'll say something called 3-pointer technique, which I've said multiple times to my students. That is, If you are planning to skip any chapter, don't skip it completely. At least study 2 points minimum. Per answer, 2 to 3 points minimum. It's a very small, right? Very single. I'm giving you a very simple solution, right? At least study 2 to 3 points. Minimum 2 points. Or possible 3 points per every question. So that, because financial statements in a lot of points are repeated here and there. Different entity also. Check the fixed asset register with the fixed assets with the fixed asset register. Investment with the investment register. This point is common in 3, 4, 5 cases in different entity. So identify the similar points. At least study that and go. 3 points per every question. So that when a question comes for 5 marks, at least you will get 2 or 3. So out of this, you may get at least 5 to 10 marks. Minimum 5. That may be the result difference between 55 and 61. Or 55 and 60. Sorry. Calculation max, I'm going a bit weak, right? Yeah. So use the 2 to 3 pointer technique at least. If possible, try to study everything. Else, at least use this much. But bank definitely you need to cover. Okay, different entity is practically easy, bro. If you have not studied different entity or financial statements, keep one day and try studying it. It is actually very easy chapter. Only thing is a bit lengthy. That's it. Okay. So this is our strategy for the upcoming May 2026 attempt, and be it any attempt. This is a strategy for auditing. You don't attempt to the strategy may not change. That's just prediction. I'm not predicting anything. This is based on the trend we are saying. I'm not predicting like this chapter or this question will come. I cannot predict that. How can I predict, right? So let's go with the practical approach. It is the capacity, like a calculated risk taking approach, and that is this approach. So go with this. This is your first unit. This 100% coverage for this first block. 100%. No way you are going to leave anything. No single line. That way you have to cover this chapter because only 30 pages, bro. And 39 pages and 30 marks. Do multiple revisions and get this 30. You just need this 30 out of 30. Nearly just 10 marks lesser than pass. If you just study this 100% and 1 or 2 chapters from here, pass is safe. But practically ICA won't give you that kind of a marks. But still, these 2 blocks you will be passed. 100%. You will pass. But this 100% coverage you not know. This at least the main questions and main areas and that. But still, yeah, this also almost 90 to 95% coverage is needed because that's how it does. So this is our strategy, and now watch the marathon from chapter number 1 to chapter number whatever it is. So chapter number 1, nature, scope and objectives of audit. So basically what is audit? Everyone knows what is actually audit. Audit is just by example. I'll just give you one example. For example, there is one girlfriend and a boyfriend. Let's take, since I'm a man, let's go with the man's favor. I'm just saying for a hypothetical example, don't consider anything bad. Don't come up with any political correctness and all those things. This is just for understanding. It's for fun. So imagine I'm a man and not me, someone else. A man, the girlfriend is calling the boy, the man, and she called her so much at night and he is not picking up the phone. So next day when they meet, girlfriend obviously, and I'm not talking about every girlfriend, but some girlfriend, understand, just for understanding, may check his phone, right? Whether he has texted anyone else, what. I mean, the guy is saying that I slept after the job. The guy is saying like that. But the girlfriend will check his phone, right? Okay, check his phone and no messages to some other girls, nothing is there. But next day also he is doing the same mistake. So after 3, 4, 5 days, the girl will start getting too suspicious. And what happens? Sometimes there will be like bestie kind of a guy for the girl, like best friend will be there. So she will be sharing it to the best. This is hypothetical example. She will be sharing it to the best friend. And the best friend now acts as a spy. He is now acting as a spy to check whether this guy, the main man who is in love, is doing some mischievous stuff. So here understand, here the girl is there, the man is there, and the spy is there. Similarly, in auditing when it comes, shareholder will be there. Shareholder is the girl. Shareholder has money. Shareholder's money, the management is running the business. So management is the boy. Management is the guy, the man. So shareholder is the girl, management is the man. So shareholder just has to know whether man is doing some mischievous stuff, whether the management is doing some mischievous stuff. To check that, the shareholder will appoint, that is the girl will appoint a spy, the shareholder will appoint a spy called the auditor. And auditor has to check whether everything management is doing is correct. So just understand. So meaning is that audit is an independent examination of the financial information of an entity, whether profit oriented or not, irrespective of its size or legal form, to an expressing an opinion. What do you mean by financial independent examination? Auditor should not be related to the company in any way. And financial information means financial statement items, basically amounts, any rupee, all the things related to that. Financial information. So of an entity, whether that entity can be profit oriented or not, that is profit oriented entities or non-profit oriented entities, irrespective of its size. It can be bigger company, smaller company, whatever it is. legal form. It can be a company, partnership, proprietorship, whatever it is. Then why are you doing that examination? To express an opinion thereof. Done. Then what do you mean by independence? Independence means the judgment of a person should not be subordinate to the wishes of who appointed him. It simply means you are a food reviewer. You are going to review a food. Normally, you went to a restaurant which is not even related to anything, random restaurant. You had food. Obviously, you can review because you are not related to that restaurant owner in any way. So there is, you can review, no problem. But at the same time, second case, your brother or your wife started a restaurant. You are a famous food blogger. But if you go that place and if you review that food because your wife's restaurant or brother's restaurant, what will happen? Everyone will say you are biased. You are biased. So same thing is actually happening with auditor also. If auditor has any relatives or any relationship, if he is holding share, anything in the company, he should not do the audit. If he does the audit, everyone will say he is dependent. So because of that reason, there is something called independence. Independence. That is auditors. Imagine I am having 10,000 shares in Reliance and I am going to audit Reliance. Even if I find a fraud, will I report? No, if I report, my share value will go down. My money also will go down. So that is what we call independence. Auditor should be independent. So first, how will auditor ensure that the financial statements will not mislead anybody? Simple, account finds. That is, account should be drawn up with the reference to the entries in the books of accounts. All the accounts in the financial statements item, basically check whether everything is equal to books of accounts. Account should be equal to books of accounts. Very easy. Then second point, whether financial statement amounts are classified, described and disclosed in conformity with accounting standards. Very easy. Items in the financial statements, whether ASs are properly followed. Any item coming in financial statements, whether the accounting standard related to that is followed. PPE, all those things. Information contained in the statements is clear. He has to check. Then none of the entries in the books of account has been omitted. Books of accounts, whatever entries are, same thing should come in the financial statement. Nothing should be missed. So auditor has to check all of these things. When auditor checks all of these things, he can say financial statement is clean. Everything is perfect. So that there are users of financial statements, people who uses the financial statements. So they should not be misled. If auditor did some mistake, he never checked something, then financial statement will be wrong. And public will trust that financial statement and he may invest his money in the company and money may go. So that is what we call financial statement will not mislead anybody. So they may ask you questions like that. Be aware of that. Not directly like this. Sometimes they may indirectly also ask. Then entries in the books of accounts are supported by sufficient appropriate audit evidence. Any entry in the books of accounts, proper audit evidence should be there. For sale invoice should be there. Purchase invoice should be there. Expense, vouchers or bill should be there. Like that. For asset purchase bill should be there. Auditor has to check everything. Then statement of account presents a true and fair view of the operational result. P&L will present a result of operational result and assets and liabilities balance sheet will present it. Done. Then this is very easy. What is the relationship with auditing and all the other subjects? Very easy. This auditing and accounting law, very easy. You can read it. Then objectives of auditing. First standard essay 200. Why are we doing audit? What are the objectives of audit? Why are we doing audit? To get a reasonable assurance about whether financial statements are free from material misstatement due to fraud or error. We have to check. First, what is our duty? Management will prepare financial statements and give to us. We have to check everything in financial statements and we need to get a reasonable assurance. First of all, we need to get that assurance that financial statements don't have any material misstatements. What do you mean by material misstatements? Important misstatements. Any misstatement, any mistake which may affect the user's decision. That is called material misstatements. Okay. Then once we got the reasonable assurance, we need to report as per the financial statements based on our opinion. Then reasonable versus absolute. Reasonable means a decent level of assurance which we get. Absolute means 100% of assurance. Like see, your mom's love. Mom's love means that whatever you do, that love will be there. So it is called absolute assurance. Then your wife's love. Wife's love, you can call it as a reasonable assurance. Like if you did something, if you have a wife and you went into some affair with some other lady, what will happen? The wife will go. So 100% you cannot say that love will be there. So there we are saying a reasonable assurance. Then girlfriend's love is called some limited assurance. We don't know 100%, right? I'm just saying it. All these are for hypothetical examples. Don't take it seriously. Okay. So auditor will always give only reasonable assurance. We cannot give absolute assurance because of the inherent limitations. I'll tell you that. Then scope of audit means, what do you mean by scope? Everyone studies scope of audit. What is scope? First understand that because in exam, sometimes they may not ask this sentence. Scope of audit. So you will feel like, okay, this question I have not studied. That question may be scope of audit, but they may ask a different line there. So that is how you need to train your mind. So scope means what are the things you cover in the audit, included in the audit. So that is what is included in the audit. You will cover all aspects of the entity, cover all aspects that is related to financial statements only. You don't have to cover what are entities next future business plan or what products entity is going to launch in the future. That and all you don't need to cover. You need to cover whether financial anything that is related to the financial statement in your hand. If that info is related to financial statement, you can cover. So cover all aspects related to financial statements. Then reliability and sufficiency of information. You have to check whether the data, the financial statements and the invoices and all the documents they gave you for checking, all those things are reliable. First of all, you can trust it. You have to make sure. Then see whether it is sufficient for your audit purposes. Simple. Then proper disclosure of financial information. All the things which need proper disclosure has been properly disclosed in the financial statements. Three things only you have to check in auditing. Then in financial statements, management will make a lot of judgments. You have to, like accounting policies and all, you have to see whether it is correct. Then these are the three things included in auditing. So when you learn, draw a circle and write the 3 points inside. So what are the things included will come. Then what are the things excluded will come. See, I'll show it to you from my memorization batch notes. These notes I'm giving it to for you to for free. Go and take it from the channel. So scope of audit, what are the things included, then what are the things excluded. Excluded means entity is not expected to perform duty falling outside his domain. Auditor's duty is there, like checking the financial statements. If there is land and building, you don't know what is the actual value. You are not an expert in that. For that, hire a registered valuer, ask the company to do it if you have some doubt. So anything that is outside your domain is auditing and accounting. Anything that is outside this domain, you don't have to perform that. Then auditor is not an expert in authentication of documents. They gave you a sale bill. Normally in the first glance when you see, no problem is there. You trusted the sale bill, you did the audit. But sometimes in future you came to know that sale bill is fraud. But it's not a problem because you are not an expert in authenticating document. So okay. Then audit is not an official investigation into alleged wrongdoing. Like police will enter one office and if one door is locked, one accountant room is locked or some file room is locked, police will kick it and open because that is investigation. But audit is not like that. You don't have the power to kick the door open and get in. No, you can ask, sir, what is inside the room? Can you please open? If they're saying no, okay, bye. You cannot do any other things. Okay. So these are the 3 things excluded. These are the 3 things included. Done and dusted. Then we'll go with scope is done. Then what is the thing? Audit, how it is different from investigation, read it very easy. Then inherent limitations of auditing. I told you auditor can give only reasonable assurance because of inherent limitations. There are certain limitations in auditing. Because of that, you cannot give absolute assurance. What are those limitations? First is nature of financial reporting. Financial reporting means, see, in the financial statements that you are checking, management has made a lot of judgments inside that. How can you say whether one judgment is correct or not? You can check and say, but you cannot be 100% sure. Example, an asset's useful life. Company purchased, management purchased an AC. The useful life of the AC, actual useful life, we itself know 15 years one AC will run. But management is saying the useful life of the AC is only 10 years. They may have their own assumptions in saying like that. How can you say that is wrong? You cannot say that is wrong. They may, if you tell management, bro, the AC will run for 15 years, why are you showing it 10 years? They may show it like that for getting more depreciation in the current year. But when we ask management, will give us some reason. Sometimes they may be doing some fraud, we don't know. So that is the nature of financial reporting. In the financial statements, lot of these kinds of judgments will be there. Like inventory valuation, with which method they are using. Normally, when you see the company, LIFO is better, but they are using FIFO. That is their judgment. So similarly, lot of judgments like this will be there. So because of that, so financial statement has a lot of judgments. So because of that, you cannot say the financial statement is 100% correct, all the judgments are correct, even if you check everything properly, because there is no evidence for any judgment. So understand, because of the nature of financial reporting, you cannot say, you cannot give an absolute assurance. Then next is nature of audit procedures. In auditing, imagine you are auditing Flipkart. Per day, 1 lakh transaction may be happening in Flipkart. So 365 days, some 36 crore transaction may be happening. So 36 crore sales bill will be there in the electronic format. How can you check that much bill? Not possible, right? So you will be using sampling techniques. So when you're checking by sample, how can you say other bills are correct? 100%. You can give only reasonable assurance. So because of the testing techniques, auditor does not test all the transactions, and that is what we call a practical limitation. Understand it. So they may ask what are the practical limitations, like that perfectly they may ask. So this question you have to study it full. You have to study these 4 points. Then management may not provide complete information requested by the auditor. Sometimes when we ask the thing, they may not give it. So we cannot say everything is correct. No, we cannot force them also. We can just ask them. We don't have any option. We can just complain to TCWG maximum. Then management may consist of dishonest and unscrupulous people will be there. They may conduct a fraud and they may carefully identify it, carefully conceal it because it is their company. They may have super ways to conceal it, hide it without us being identifying that. So because of that reason, even if you do a detailed checking, you cannot be 100% sure. That is why you are not giving absolute assurance. Then that is audit procedure cannot detect all of these things properly. Then last thing is transaction with the related parties. How will you know who is the related party of that company? Whatever they say, then that only you can understand. So because of that reason, so because of these 4 things, we cannot give a 100% guarantee that our audit procedures are perfect enough. So because of that, we cannot give absolute assurance. Then not in the nature of investigation. Since it's not in the nature of investigation, we cannot kick doors open and do all the detailed checking like that. Then timeliness of financial information decreases, timeliness of financial reporting, and decrease in relevance of information over time. It means normally, if I'm auditing one company, last year I did the audit, current year also I'm doing the audit. I'm auditing boAt, earphone company boAt. So last year I did a competitor analysis, like for identifying their going concern and all these things. I did one competitor analysis last year, checking boAt with the JBL. Last year I did that. Then current year, sometimes I may not do it, I may not redo it again because last year I did it, or I checked last year all the internal controls of boAt detailed. So current year I ask management, any new internal control, management will say no. So I'll check, why should I check it again? Everything was checked last year properly. So I'm relying on last year data, but sometimes some new internal control would have come in the current year, or sometimes some change would have happened in the internal control. That is, timeliness of information decreases over time. Last year's that info is valid only for last year. Current year, the value of that info is gone. Last year, boAt's JBL was the competitor. I did the analysis. But current year, JBL is gone. Noise is the competitor. So that info don't have value. So because of that reason, we cannot give absolute assurance. Then future events, we cannot predict future. So even if we check everything detail and we are giving perfect, tomorrow sometimes another fraud would have been hidden in the company. We may not know. Or tomorrow some issue may happen and company may go into liquidation. So because of these 5 reasons, we cannot say auditing is completely free. We cannot give an absolute assurance. Keep that in mind. Then next, benefits of auditing. Very easy. The mnemonic is Himo here, Deva share. Auditing will provide a high quality information, HI. When you do the auditing, high quality information will come. Then MO, auditing act as a moral check on employees. So employees will not do fraud because they are afraid auditor will catch it. Himo here, HE, helpful to the government authorities. It is very helpful to the government authorities. Else, how will government know what is the actual tax figure? No. Company may do some manipulations. Then relied upon by the lenders and bankers. When you go to bank to take a loan, they will ask you audited financial statement. They will only trust that. Then HIMO, HER. HIMO means high quality information. MO, moral check on employees. HE, helpful to the government. RE, relayed by the lenders. Then HIMO here, DEVA, DEVA. You can detect a fraud and error by auditing. DEVA, various controls. We can check whether all the internal controls in companies are operating perfectly. So DEVA, DEVA. Then shareholders are not coming to the company every day. So they don't know what is actually happening inside the company. So they appoint auditor and trust auditor. Then audit is mandatory or voluntary. Mandatory for companies, voluntary for other people. And tax audit is mandatory depending upon the turnover limits. Who appoints auditor? Partnership firm partners, companies, AGM shareholders, government companies, C&AG. Assurance engagement. Assurance engagement means auditor. Don't think that auditor does only auditing. No. Auditor does lot of things. He will do auditing. He will do consulting. He will do tax filing. He will do the litigation assessments. All these things he will do. Then he will give consulting. Then he will do, some auditors may do accounting. Auditors not chartered accountants. So in all the work done by the auditor, in whatever work we are signing, We are signing and seal we are putting. So it basically means there we are giving some assurance. We have checked everything detail and we are giving assurance. Auditing is like that. We are giving reasonable assurance. There are other engagements which like review, like it's less than auditing. That kind of a thing is there. Like if auditing is this much, review will be same things we will be doing, but less in less checking fashion. So review will give only limited assurance inside. But there also assurance we are giving. Some level of confidence we are giving. Ah, this is correct. So in those cases, that is what we call a assurance engagement, where we are giving some assurance. In tax filing, we are not giving any assurance. Or in consulting, we are not giving any assurance. So engagement means work. So whichever work where we give some assurance is called the assurance engagement. Okay. Then, so what are the elements of assurance engagement? For the time being, let's take audit or review. In auditing, what are the elements of assurance engagement? First is practitioner. That is a chartered accountant in practice. CA in practice is needed. What are the things covering under assurance engagement? First, practitioner. Then whom do you need for auditing? Responsible party, the client you needed for auditing. Then whom do you need? You need the financial statements. That is what you're auditing. That is a subject matter you are auditing. Then intended users, for whom you are auditing, for government, the public, and all these people. So intended users are there. Then suitable criteria. In auditing, you will be checking things with some standards and all these things, whether the company has followed the standard properly, the rules, right? That is called suitable criteria. Benchmarks used to evaluate the subject matter. Subject matter is financial statement. Benchmark is some standards, not as like accounting standard and all these things. You will check whether the financial statement is following the accounting standard. That is whether the subject matter is following the benchmark. Then sufficient appropriate audit evidence to conclude whether you have when you do a proper audit, for reaching the conclusion, you need audit evidences, right? So that is the audit evidence should be sufficient, that the proper quantity should be there, and it should be appropriate, that the proper quality should also be there. Then written assurance report. Once you finish auditing, you will give a written audit report. Then audit versus review. Audit is some sort of a detailed examination, but review is less detailed. Similar to audit, but we may not be going that detailed like audit. So in auditing, since we are going a bit more detailed, we will give reasonable assurance, and in review, we will only give limited assurances. Both audit and review are related on historical financial statements. Historical means normally after 31st March, you prepare financial statement, and that is for the previous history, old months, right? So audit and review you are doing for the previous months. Whatever, like you are doing auditing in April. Okay, you are doing it for financial statements of the previous year, right? Same thing. Audit and review you are doing like review, like 6 months of review you are doing. 6 months of financial statements company will prepare and give it to you. You are checking a 6-month review. Then this is very easy. Then historical, like prospective financial information. This is future financial information. When you go to a bank to take some loan, bank will say, bank will first ask last 3 years audited financial statements. You will give. Then bank will ask, what is your future? What are the things the company is going to do in future? How your future will be? What are the sales you are expecting? What is the profit you are expecting? So we have to make a financial statements for the next 2, 3, 4 years. This is like a prediction based on current year and based on our future plans. We'll make a future financial statements. Like it will look something like this. P&L will make everything. P&L and balance sheet. Current year, what is the data? Future years, we will make it. It's like whatever is the current year, we may put a 10% increase in everything, or depending upon our expectations. So this here, understand, here we are preparing it for the future. So that is called a prospective financial information, projected financial statements. So in projected financial statements, financial information is based on the assumptions about events that may occur in the future. What may occur in the future based on the assumptions we are making it, and the possible actions by the entity. So here it is assumption. Next year we will get more customers because next year we will get funding. Based on assumptions we are doing things. So next year's marketing expenditure will put something high, then more sales because more marketing, more sales. Like that you will do it based on assumptions. These assumptions can be correct and cannot also be correct. Can be wrong also. So here auditor is, see, in assurance report, practitioner obtains audit evidence that management's assumptions are not unreasonable. In normal auditing, what are we doing? It has already happened. The financial statement, sales, everything has already happened previous. So you can check the thing has already happened. So you are checking and giving a reasonable assurance. But here, the thing has not happened. You are predicting next year sales will be like this. The management is making some assumptions, and based on assumptions, they are preparing financial statements. So what you need to do is, it is your duty to make sure that management's assumptions are not unreasonable. That is, they are reasonable. You are not checking whether a sale is correct or not. No, how can you check? The sale has not yet happened, or purchase has not yet happened, or expense has not yet happened. So you cannot check it basically. But only thing you can check there is whether management's assumptions in making that figure is correct. So here you are checking management's assumption. This word is very important. Keep in mind, management's assumptions are not unreasonable. This sentence you have to perfectly remember. So this thing, then this sentence. Then here we are checking whether assumptions are reasonable or not. Management order. Okay. Then practitioner will give a report. Here basically we cannot do any detailed auditing or like this. We'll just check the projected financial statements and we'll say management's assumptions reasonable, and we'll say. Then the assurance which we give here is called a moderate level of assurance, because we cannot give a reasonable assurance here. Then audit is a reasonable assurance engagement. Review is a limited assurance engagement. Examination of prospective financial information is we are checking whether management's assumptions are reasonable. We are not giving any reasonable assurance or nothing like that. Then quality of auditor, very easy read. Then different standards on auditing and different other standards, which I will show it to you. Where is the chart notes? Yeah, chart notes are here. Where is the standards? So basically, guys, understand. These are the different standards. Engagement standards. That means what are the standards applicable for different types of work which the auditor is doing. I told you, when auditor is auditing, what are the rules for that? The rule is called the standards on auditing. When auditor is doing the review, then he is not following standards on auditing because he is doing review now. So review has certain other rules. That is called the standards on review engagement. When I'm doing a review, engagement means work. When I'm doing review work, I will follow this standards on review engagement. When I'm giving some, here also I'm giving assurance, here also I'm giving assurance. There are other cases also where I'll give some assurance. That is other assurance engagement, which is other than review and audit. For that, there are certain other standards, other rules which we need to follow. That is standards on assurance engagement. Then there are other works where we won't give any assurance, like some consulting or some tax filing and all. So there we are giving there are also certain rules which we need to follow. That is standards on related services. So this is it, simpler. You only need to understand that much. Then study one name and one sentence per standard, all these things. Then why are standards needed? Very easy. You can just read it, simple. Now we'll go to not to chapter number 2, to chapter number 11. Why? I will tell you now, because there is something which you guys need to get the clarity in auditing. Just wait with me 1 minute. I'll show it to you. This is one thing which everyone who is attempting the next attempt need to understand. Guys, see how our syllabus is structured. Chapter number 1, where we are learning about what is auditing, how it is done, what is assurance, and basics of auditing. Then second chapter, before second chapter, study the 11th chapter. In 11th chapter, we are learning the rules, like how, like till the auditor is appointed, how, like when the client comes and talks to the auditor, then auditor is thinking about appointing and all these things. Then till the client is appointed, that is coming under 11th chapter. So firstly, we are learning about basics. So first, pre-engagement stage, before entering into the stage, we are learning about accepting the audit, reviving the audit proposal. These things are covered in the chapter number 11, before auditor gets appointed. It's a flow. I'm giving you the flow. First chapter we learned basics, 11th chapter we learned all the things before he gets appointed, that till the moment he gets appointed. Then chapter number 2 we are learning, okay, first steps, what are the things he will do in first steps in auditing, strategy, planning, program, all these things. Then after that, detailed, like once strategy, plan and program, everything is done, then the further audit procedures, like how the detailed checking everything is happening, is said in the chapter number 3 and 4. 3 all the techniques, procedures. 4 sampling methods he uses is called sampling, analytical procedure, everything. 3 and 4. Once that is done, so auditing flows. Just then second chapter we are learning about planning and all these things, planning, then strategy, plan, program, everything we learn basics. Then comes the execution stage. The first stage was before engagement, then the planning stage, then comes the execution stage, auditing stage, where we learn about test of control, 3rd and 4th chapter. Then after that comes, once auditing is almost going to finish, then comes a reviewing stage and documentation stage, that is 6th chapter, which you need to do along with auditing. Then 7th chapter, it is a review, completion and review, are almost going to finish auditing. So there you look at evaluation of uncorrected misstatements, 450, then subsequent event if anything is there. Going concern issue, going concern you may check before starting auditing, but during the auditing only you will get detailed info. So you will recheck it after the completion phase. 570. Then written representations you need to obtain, analytical review, all these things. Then once that is done, then almost auditing is completed. Then comes the 8th chapter where the reporting stage happens. So basically the standards chapter is given in a flow. You need to study it in this format. Okay, so now we'll go to chapter number 11. 11 we will do it now. Yes, ethics and terms of audit engagement. Literally very easy here. SQC1 and SA 220 is the core area which we need to focus, and the threats to independence. What is actually affecting the independence? So meaning of ethics, basically very easy. What is your behavior and all these things. The need for ethics, just read and leave. Then principle based approach or rules based approach. It can be a question. Principle based approach and rule based approach means, rule based means you have to follow the rules. As an auditor, you have to follow the standards on auditing, all the rules. But there are certain people who will follow all the rules. But rule, it's not only with the rules you cannot be a really good auditor. Based on some principles also, you should have some moral principles also. So that is what we call principle based approach. Rule based approach means someone who's only following the rule. Principle based approach means following the moral principles also. So you should have a combination of the two. So basically, when you're following the principles, obviously you'll follow the rules. So that is what we call principle based approach, where you are following your moral principles. And rule based approach means when you're blindly following only the rules. So as an auditor, you should have a combination of both. Ethical guidance may follow on both of these things. The principle based approach means it requires the compliance with the spirit of ethics. Inside your mind, basically some spirit of ethics will be there. You are a chartered accountant, right? So based on that, what is the ethics? Then it requires the accountants to exercise professional judgment in every situation based on their knowledge, skill and expertise. We are learning this much book and all these things. We have proper knowledge. When you do a lot of audits, you'll get experience, skill and all these things. So based on that, in some situations, sometimes you have to go beyond the rule also. But that can be based on your principle. So you should, morally, you should have that principle in you. Then rule-based approach means you're strictly following the rules, clearly established all the standards and all these things. Then it is a narrow outlook and spirit of ethics may be overlooked. So when some chartered accountant is like, he's only following the rules. So in certain situations, sometimes the spirit of ethics, the moral thing may be overlooked. You may ignore it. So that is why we are saying we should have a, basically this is what we need to have, principle based approach, but rules also we need to follow. Then comes the fundamental principles of professional ethics. What are the principles? Like when people say ethical auditor, ethics, what are the things coming inside it? Number one is called integrity. You should be straightforward and honest. So whatever I've highlighted, that is an important area. So keep that in mind. So straightforward and honest. As an auditor, you should be straightforward. You should be honest. When you identify a fraud, have the guts to stand up, man up and say that a fraud has happened. Simple. Then he shall not knowingly be associated with any reports or returns where he believes that information contained is materially false or misleading statement. Any fraud, anything management has done, you identified that. Then when you told the management say, sir, this 10,000 rupees, 10,000, 2 lakh rupees, you take it and please don't report it. You should not do that. You should be straightforward and honest. You should never be associated with any, associated means you should not sign any reports that are fake. And then basically objectivity. What is objectivity? You should not be influenced, uninfluential. Whatever management says, whatever, you should only follow what do you think. You should be uninfluential. That is, you should be free from conflict of interest. You should be, that is, your judgment should not be because of any bias. When management is saying they will give you some money, no, you should be unbiased. Then conflict of interest or undue influence. Okay. Then professional competence and due care. You should attain. This is one important thing is there. Some MCQ they may ask and may trap you here. Understand? Professional competence and due care means you should have the skills and knowledge and all these things. So now the world of AI is coming. So you should yourself update in all the AI tools required for auditing and all those things. So you should attain and maintain the knowledge. Wait, here till here everyone knows. At the level required to ensure the client receives a competent service. You cannot say, I have all the knowledge, but it's not like that. The thing is, you should be able to give the client a good service. For that, what knowledge you need, that is what you need to update it about. For example, you are saying you are updated in all the knowledge. Imagine some old chartered accountants may be there right now. They have all the knowledge. But bro, when a client is coming nowadays, when a client is coming, you have all the AI tools and all these things. So now when a client comes, client's requirement will be finished auditing in 1 month. Basically, you can do that with all the AI tools. Others are doing that. But you are basically a traditional chartered accountant. You're saying you have all the knowledge, but It's not like that knowledge is not what matters. That knowledge matters. Plus, you should be able to give competent service to the client. So for that, you need the AI knowledge and all the skills also. You need to update to give the client what they require. Okay. So here, sometimes this one sentence without this MCQ they may ask, which is correct. Without, sometimes they may give attend and maintain professional knowledge and skill which is required by the ICAI or required by the what the auditor's judgment is. No, the thing is required at the what the client requires. So keep that in mind for MCQ. Then comes the confidentiality. That is respect to the confidentiality of information. You should keep the information confidential. You are auditing Mama, and during the auditing, somehow unknowingly you came to know about Mama new product which they are going to launch 3 months after. And you got the formulations also you got from someone else. So, and imagine you are going to your home and telling your wife. What happens? Wife may tell this on another, when wife's friends are coming, she may tell it to them for some show off. But sometimes that one friend may be working in another like minimalist or wow, another company. They may launch this product before Mamaearth now. And sometimes because of that simple one mistake, Mamaearth business may also go down. So auditor should be confidential. He should not reveal anything to anyone. What info he get from auditing that client, keep it confidential. Shut your mouth. Right? It simple. So but when the law comes, you can do that. Like some court or some issue comes, you can reveal that, no problem. Confidential information can be disclosed when it is required by the law. There you can disclose it, and it should be authorized by the client also. The client should also permit that. Then professional behavior means you should follow all the rules and regulations and laws, and don't do anything that may damage the reputation of the profession. Imagine there is a chartered accountant. He is like super. He entered into a fight in some area. He entered into a fight with some locals, or he did something. He was drunk and he slept on the road. So tomorrow the news will come. Chartered accountant did this, right? Like that. Right? So the entire profession, it is a damage. So don't do anything like that. Then comes the IOPCP. That is a mnemonic for this. IOPCP. Bigger super mnemonics are coming for other chapters. Tough questions. We have made superb mnemonics which you will never forget. Just watch my Caro revision. Caro revision here or in my YouTube channel. You can go and watch Caro revision. Awesomely done. Lot like in my Power Prep batch also. Enquire the students. It's so good. You will never forget Caro. You will never forget financial statements. All those things. Then please do that. So third chapter, which my students love it, because we teach in that fashion. So the next comes the independence of the auditors. Independence we already learned. So what do you mean by independence of mind and appearance? Independence of mind means in your mind you should be independent. In your independence of appearance means others should think that you are independent. So two things. That is, for the third party, you should appear independent. For example, you are auditing one company and with that client, you went to some Bali, you and that client, and you took some photo and put it on the internet. Imagine that is like some boat, Aman Gupta. You put it on some internet. So the people will understand you are the auditor and you are that guy is your very close friend and you may have shares in the company, all those things. So your independence is compromised. No, you should not do that. So in your appearance to the outside people also, you should look independent. That is, avoid the facts and circumstances that a third party would reasonably conclude the firm or the members' integrity, objectivity, skepticism. Then comes the threat to independence. This guy, you know, right? Saif Ali Khan. So S raised to square. So two things are there: self-interest threat, self-review threat. A means advocacy threat. I means intimidation threat. F means familiarity threat. So what do you mean by each of those? So means self-interest threat. One second, guys. Let me see. One chart was there. I'll show it from the chart. So it is very easy. You know all of these things, but simple. I'll just re-explain all of these things again. Where is the second chapter? This chapter. Okay. Ethics and terms of engagement, fundamental principles of professional ethics, IOPCP, everything is there. Then threats to independence. If a CA has any of these issues, if any one issue is there, one threat is there, then he is not independent. So he should not do that audit. For example, first threat is self-interest threat. That chartered accountant is having interest in the company. Auditor is interested in getting money from the client. Financial interest is something, indirect or indirect, that is called a self-interest threat. Self-review threat, I cook and I review. You are cooking some food and you itself are reviewing itself. That is called a self-review threat. Example, in your audit team, your one chartered accountant was there and he was working in that company. Your partner, he was working in that company in the last year. Previous year, he was working in that company. So he did all the some accounting and all the basic stuff he has done. So, and he was a part of management also, believe. And current year, he resigned from the company and joined your audit firm. And you are auditing that last year's financial statements of that company. So basically, you are auditing what work done by your partner itself, like your team member itself. Because I was a previous working there and now I'm doing here the same audit of that company. That should not happen. Self-review. So when that happens, what is the problem? Last year I would have done some fraud or mistakes in that company. So current year, when I itself am auditing that or my partner is auditing that, even if I found out, I will not reveal it. So that is a problem. So auditor himself is reviewing any work he did for the same client in the previous year, or member of the audit team was a employee of that client in the previous year. So their self-review threat comes. Then advocacy threat means auditor is promoting the client like a client's advocate. It's not like auditor is a LLB advocate. No. That is not what we are meaning here. What do normally advocates do in the court? Whatever happens, they are supporting the client. Even if a client who has done 10 murder, when the court goes, he will also have an advocate who is supporting him. So that point is what we are thinking here. It's not like auditor is becoming an advocate. No. Here the thing is, auditor is promoting the client. And when he is promoting too much, that others will see auditor is acting like a client's advocate. Example, imagine I audited one Reliance last year, and current year I am auditing Reliance. And I'm going to all of my friends and telling them, bro, Reliance, I'm auditing Reliance. Reliance is a super company. Invest your money in there. You're promoting Reliance shares there. Or take a work in Reliance. Reliance is so good. Like that, you're promoting Reliance too much. Or Reliance has some tax assessment issue. You are appearing for Reliance. And there, what are you doing? You are promoting Reliance too much. You are saying, Reliance, sir, I have audited Reliance. Reliance is superb company, no problem, no fraud. Like that, you are promoting. That is what we call advocacy threat. You are promoting a client's interest. Then comes the intimidation threat. Intimidation threat means client is threatening the auditor. The client is threatening the auditor. Like, if you don't give the opinion, I will remove you current year. I will never pay you the fees. Like that. Then familiarity threat. Familiarity threat means auditor becomes too close or friendly or anything with the client. That is what we call familiarity threat. Imagine client was a awesome looking girl and I am the auditor. When I go there, not me, just hypothetical example. So when I go there, if the client is like acting and sometimes I may become too close with her, I may become a really good friend. Last 3 years, I am auditing that company. So last 2 years, like our relationship, our friendship has built. So now current year, if I audited and found out some fraud, still I will not report because she is a very good friend of mine. So becoming too familiar can be any sort of familiarity. So that is what we call familiarity threat. So to reduce these threats, to reduce and comply with the fundamental principles. Imagine current year, Reliance is coming to me and asking for me to do the audit. In my auditing partner, imagine my partner in the CFM, he is having 10 lakh worth of shares in Reliance. So our team is basically not independent. So what can the auditor do? Auditor, it's like auditor cannot do the audit, but there is some safeguards which he can do to remove that threat, to eliminate that threat. That is what we call safeguard. That is, I'll tell my CF partner, bro, we cannot do the auditing, but Reliance is a very good company. I wish I would have done the audit. So can you do one thing? Can you sell off those shares? When he sold those shares, now what happens? Now we are independent. Share point. So now we are independent. Then we can do the audit. That is what we call applying a safeguard. Or sometimes in my audit team, there is like, imagine we don't have any other relationship with Reliance, no share, nothing. In my audit team, one article was there. One article was having the shares inside that company. That basically audit team should be independent. He is having some shares in that company. So what I will tell him, bro, do one thing. I'll remove this article from my audit team and I'll put some other article. I'll remove him from my firm or like team. So now we are independent again. So that is what we call reducing threats by applying the safeguard. So for public's confidence, auditor should always be independent. So before taking any work, see whether threats of independence, the same thing is there in your book. I'm not cooking up anything. No. Before taking the work, see whether threat to independence exists. If the threat exists, desist from that task. That is, don't accept that task. Or eliminate the threat and put the safeguard and then you can accept. Then safeguard measures has to be recorded. Audit documentation, you have to record it. Then if auditor is unable to implement any safeguard, then don't accept that work. Done. That's it. Next is what we call professional skepticism. It means attitude that includes a questioning mind. During audit, you should have a questioning mind like a possessive girlfriend or a boyfriend. They have a questioning mind. Imagine there's a possessive girlfriend. It can go vice versa, boyfriend or girlfriend. Possessive girlfriend. If a boy is talking to some girl, immediately she'll say, who is that? Who is that? Why are you talking to that girl? Well, what is the reason? Questioning it, right? That is what we call a questioning mind. Whom do you message right now? What is the notification coming in your phone? Everything. So auditor should also be like that. So when you are doing the auditing, whenever you found something suspicious, 1% doubt, immediately ask and clarify it. That is questioning mind, question everything. Plus, this is one professional skepticism. Plus, this also you need for professional skepticism. That is being alert to conditions that may indicate a misstatement. You should be alert. Okay, when you are vouching sales, what may be something, mind should always be alert. If you identify something suspicious, to identify that something suspicious, you should be alert. Like this possessive girlfriend should be alert. She is always alert to find something that is done by her boyfriend, vice versa. Okay, I'm still saying it again and again, so no one should feel bad. Yeah, so this is same thing. When you read it, you'll understand. Like here, self-interest, auditor could benefit from the financial interest in the audit client. The same thing. Then what are the financial interest? So you can take the mnemonic. Digun is a person, like Assamese, this name is there. Digun closed the POCO phone. Digun, DI, direct financial interest, guarantee G, UN. Digun close the potential POCO phone. Okay, done. Then self-review threat, or auditor is reviewing any judgment or conclusion reached in the previous audit or non-audit engagement. Then two things, very easy. Advocacy, auditor is promoting client out of opinion to a point where people think that his objectivity is getting compromised. Intimidation, auditor is deterred or it is prevented from acting objectively with adequate degree of professional skepticism because they are threatening them. Familiarity, auditor becomes too sympathetic to the client's interest. It can happen with these three things. Then safeguard, what I said, for public's confidence, you should be independent all the time. Before taking any work, see whether any threats to independence exist. Then if threat exists, desist from the task, eliminate it or put the safeguard. These are the key words I'm saying. So try to learn it with the keywords. Rather than trying to memorize it exact sentence entire thing. No. Study the keyword. Like before taking any work, see whether any threats to independence exist. Done. That sentence is done. Then if the threat exists, then desist from the task or eliminate the threat or put the safeguard to reduce the threat. Done. That is how you need to learn auditing. Don't memorize everything exactly line by line. If threat exists, then safeguard should be, all the safeguards should be recorded as an evidence. It should be documented. Then if unable to get the put the safeguard, then don't accept the work. Done. Then professional skepticism, I told you. Then comes the maintaining professional skepticism throughout the audit is necessary if auditor has to reduce this following risk. That is, to reduce these risks, auditor has to maintain professional skepticism throughout the audit. To reduce the risk from your boyfriend going with some other girl, you should maintain professional skepticism. So when you maintain professional skepticism, you can prevent your boyfriend or girlfriend going to another partner, right? I'm just saying hypothetically, don't take anything seriously. So similarly, when auditor has professional skepticism, when the questioning mind, these kinds of issues will not occur. So what is a mnemonic? Don't overuse Royal Enfield. So when you overuse Royal Enfield, what happens? The engine will get heated up and boom, gone. Like I went from Kerala to Kashmir on a bike, so I know that. Don't overuse Royal Enfield. If you use it for 100 kilometers, the engine will be like that hot, right? So don't overuse Royal Enfield. That is a mnemonic. Don't means don't. Nothing is there. Don't, I just put it. Overuse. Over, two words are there. Two. So first over is overlooking unusual circumstances. If you don't have questioning mind, overlooking means ignoring. You may not notice unusual things. Sales, there is some unusual pattern is there. You may miss it. So you have to have, when you have professional skepticism, you will not miss it. Overlooking unusual circumstances. First over. Second over generalizing when drawing conclusions from observations, audit observation. We are using sampling. And normally in one case, actual sample size should be like, imagine 500 samples. But you are using only 50 samples. So based on 50 samples, you are thinking, everything, 50 samples are corrected. And you are thinking entire 10,000 invoices are also correct. You are over generalizing it. Don't do that. If you ever have professional skepticism, you will not do that. That is 2 over. Overlooking unusual circumstances, over generalizing observations. Over generalizing conclusions, when drawing conclusions. 2 things. Over use, using inappropriate assumptions in determining the audit nature, timing, and extent of audit procedures. Using inappropriate assumptions. Your assumptions are wrong. For one check case, you should use, imagine analytical procedure, but you are using test of details there. Or in one case, you should use test of details, but you are using analytical procedure there. What is test of details? What is analytical procedure? Tell me. Difference. I don't need the definition. What is that? Tell me. At least 70% of students don't know what is actually analytical procedure. So watch it. 3rd chapter is coming. You will get the conceptual clarity. 100% I'm guaranteeing you. Conceptual clarity. 3rd chapter will never be tough for you. This is my guarantee because I'm giving mnemonics, everything. So stay connected for that. Then don't overuse Royal Enfield. RE. RE square is there. 2 RE. Auditor may accept the records and document as genuine unless he has reason to believe the contrary. Normally, when management gives a document, he can accept it as genuine unless he has some doubt. So when he is maintaining professional skepticism, he'll always be aware of that. Then auditor is required to consider the reliability of information. Simple. So don't overuse Royal Enfield, RE. Don't just chumma given. Then then use Royal Enfield, RE. Done. RE square. Done. Then audit engagements and terms of engagement, SA 210. So before entering into audit, you, that is auditor, and the client will enter into an agreement. That is what we call terms of engagement. Before doing any work, we need agreement, right? Else tomorrow someone may come and say something. We need agreement for everything. So in that agreement, what are the things are coming? That is what we are learning in 210. So what are the preconditions for auditing? Before entering into agreement, auditor has to check whether these conditions are there. If these things are not there, then don't do the audit properly. Don't do the audit. So as per SA 210, the preconditions for an audit may be defined and used by the management of an acceptable financial reporting framework. Just leave that. Then in order to establish whether preconditions for audit are present, auditor has to look at these things. Whether if these things are there, then precondition for audit is done. First, to determine whether the financial reporting framework management is doing is acceptable. So precondition. So he need to check whether the financial reporting framework is acceptable. So before starting the audit, make sure management has the proper financial reporting framework they have followed, like the accounting standard, schedule 7, all these things, format, everything is correct. You have to check. Then obtain the agreement of the management that they acknowledge and understand their responsibility. It's management responsibility to prepare financial statements. So get an agreement from management that they understand this responsibility, that is for preparing the financial statements for internal controls, and to provide the auditor with all access to all information for auditing, additional information which auditor requested, and unrestricted access to the employees and all these things for him to ask, do the inquiry and all. So simple. So first of all, check all these things. Then what happens if preconditions for an audit is not present? If these preconditions are not present, discuss with the management. Bro, this problem is there. Like that, discuss it with the management. And unless required by the law, auditor shall not accept. That is, if the precondition is not there, don't accept the audit. Unless required by the law. If law is there, okay, you have to do that. Unless, don't accept the audit. Then agreement on audit engagement. These are the things that are covering in that agreement. One engagement letter you and management are going to write. You will sign, management will sign. What are the things coming inside that? Objective and scope of audit. Objective we discussed in the first chapter. Scope also discussed. Those two things will come. Responsibility of auditor, responsibility of management. What is the applicable financial reporting framework? What is the form and content of audit report which you are giving, or other reports along with that? Those things also you will mention here. Then next, what is next? Then limitation, before starting audit, if they put any limitation on your work, that there's limitation on the scope, which means scope we learned cover all aspects of entity. Management is saying you cannot do the physical inventory verification, or you cannot send external confirmation like that. If they're saying anything, don't accept the work before starting the audit if they're saying something like that. Then request from entity to change the terms. They may ask you to change the terms. This terms of engagement you entered and you started auditing. Now in some situations they may ask you to change it. If there is a change in the circumstances affecting the need for service. Circumstance, if there is any change, that is, they mistakenly thought they need to do the audit, but sometimes they need only a review. There's a change in the circumstances. So something like that, if it comes, then need for the service, they're thinking about, like you are doing audit, but actually what they wanted was a review. So then you will change the terms. Like they mistakenly thought audit was needed, but after 1 week they understood they only need a review. In that case, you can change the terms. Then a misunderstanding is there regarding nature of audit, like audit and review, same thing. Then restriction on scope if it is put. Then all these things you can read. Then what should the auditor consider before agreeing to the change the engagement? This is very easy. You can read and understand. Then comes the most important topics, SQC1 and SA220. Very, 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 very important. So guys, understand. SQC1 means SQC1 and SA220. Both of them are related to quality control. Controlling the quality. Like when the auditor is doing the audit, he should properly follow the standards. He should issue proper reports in good format and do the things. He should get proper audit evidences. He should do proper audit procedures which are right in the circumstances. All these things, if he's doing everything properly, then we can say the audit is having a good quality. Similarly, not only audit, other work also are done by the auditor, like consulting and all these things. Quality should be ensured on that also. So there are certain rules for quality. That is, if for the quality, to ensure the quality of auditing, the rules for quality, rules for controlling the quality of auditing is what we call SA 220. Only auditing we are doing there. Only the rules for auditing quality control is there in SA 220. Same thing, if the auditor needs, for other works which auditor are doing, the rules to control the quality of other work is what we call SQC1. This is quality control for the firms that does the auditing, review, and other assurance engagements and related services. Whatever work auditor is doing, these rules he'll have to follow, because SQC1 means controlling the quality of his work. So how there are certain things which is mentioned which we will understand. So SQC1 means quality control on all the work done by the auditor. SA220 means quality control on only on the audit done by the auditor. See, this you will understand. Imagine this is a CA firm. What are the works done there? As audit, consulting, and tax, startup advisory, fund associate, fund allocation, all the some fund advisory, whatever is. So this is a CA firm. To ensure the quality of all these works, SQC1 is there. And SA220 ensure quality only regarding auditing. SA220. Hope you got it. So what are the elements of system of quality control? Simple: leadership, responsibility, ethical, and all these things. So leadership responsibility. So understand, guys, first of all, auditor need to, the CA firm need to establish, now we are talking about quality control for the entire firm. Establish the policies and procedures designed to promote an internal culture that quality is essential. CA firm, the chartered accountants need to establish a policies for the firm. That is, in our firm, these are the rules you need to follow. These rules basically will ensure the quality. For example, after auditing, when audit report is signed, there should be some person who need to read the entire audit report for finding spelling mistakes, errors, checking all these things, so that the quality of report is good. Then once auditing is finished, there we will just recheck the entire auditing procedures once more, whether we have done everything properly. So that will ensure the quality, not only for auditing, for all the other works. So that for that we need to first of all establish a rule set inside the firm itself. That is called the policies and procedures, and we need to promote an internal culture. So we need to tell, CS need to tell it to their juniors and all the assistants in the firm, we are emphasizing too much on quality. So for every work you are doing, you have to follow this quality control rules. So similarly, when you do this for 1-2 years, your firm, everyone will focus on quality. That is creating that kind of an internal culture. Everyone, when they're doing work, they'll follow the quality. Then the responsibility for quality control in the firm lies with the managing partners or the CEO. Who is the CEO of that firm or who is the managing partner? They have the responsibility for quality. So first establish policies and procedures to promote an internal culture. Then CEO and managing partner have the responsibility. Then operational responsibility means CEO has the firm's the top person, top chartered accountant has the responsibility. But he is very busy man. He don't have time for all of this. So he will give this responsibility to one senior article or some senior staff in the company. He will ask, okay, Ramya, do all the quality control, checking everything. When every work is finished, before giving it to the client, check the quality. So she has the responsibility. That is, operational responsibility of quality checking is assigned to some person. So auditor has to make sure that that person has the proper skills and knowledge and everything, experience only. That is written here. Then ethical requirements, auditor has to follow the independence. Like there should be proper policies and procedures and to comply with the independence. Then basically you have to look at the fundamental principles of professional ethics also. Integrity, objectivity, everything is followed and you have to check. So as an auditor, you have to make sure all the other chartered accountants, partners in the CFM, engagement team members, first of all, tell them, like, see, independence. First of all, communicate these are the independence rules. Everything, tell it to the articles and all first. If you have share in the company or auditing, you are not independent. So then only they will say whether they have share or not, right? So first of all, communicate what do you mean by independence, everything to the articles and all the people. First of all, communicate. Then once communication, that is communicate independence to all the personnel first. Then identify and evaluate the circumstances that creates a threat to independence. Then eliminate it by applying the safeguards. So first of all, tell what does mean by independence and which all situations you are not independent. Tell all of this to your articles first. Once the telling is done, then before beginning every, not only audit, every other work, make sure whichever work independence is required, make sure there is a proper checking of all the articles and everything, whether they are independent or not. That is, you have to identify the circumstances that creates threat, like whether they're holding in a share or whether their family is working in the client company, anything like that. Then these are all things easy. So whether there is any breach towards independence, whether someone is not following independence or some issue is there in the independence, like one audit team is going to audit one company and one member in the audit team is having shares in the company. if something like that is there, immediately that should be that person, that engagement partner who has responsibility for auditing, he should tell it to the main CEO guy. So that you have to create a system like that. So engagement partner should notify the person that this independence is not there, something like one member of audit team is having some share, independence affected, so shall I change him and put another person, or shall I ask him to sell the share, something like that. Then all breaches of independence should be properly notified to the firm. You have to create policies to tell your articles that, like, if you are if you're not independent in any case, you have to tell it to the management. You have to create policies like that, rules like that inside the firm. And at least annually, you have to obtain one written confirmation of compliance from all the personnel, whether they have properly followed independence and all. Then accepting the continuance of client relationship and specific engagement. So before accepting any work, these are rules which you need to follow. So before accepting any engagement, not only audit, any engagement, because this is quality control for all the things, right? You have to check the ICC, integrity of the client. Baiju came to asking you to do the audit. Will you accept? No, because the integrity of the client is not there. The client is not straightforward or honest. He has done, people's money is gone. So before accepting audit, check whether there is an integrity of the client. Then once client integrity, okay. Next thing you have to check is competence of your team. Imagine I am a fresher chartered accountant and I started practice. Tomorrow Tata is coming to me and asking me to audit. I can audit, but the problem is I don't have the experience, or I don't have the proper team members to do the auditing of a company like Tata, because I'm just started only. So that is, I don't have the competence. So before accepting any work, be it audit, whatever the work is, before accepting any work, check whether you have the competence to do it. Then comes the compliance with ethical requirements. Whether your ethical requirements means independence and this IOPCP, independent, integrity, objectivity, and all those things. Check all of that. If those three are there, then you are ready to go. Not only that, then firm should obtain such kind of these kinds of informations as it not only this, other informations also, as it considered necessary before accepting an engagement with a new client. Before new client is coming and giving new engagement. So before accepting that work, engagement means work. Before accepting that work, check all of these things plus other information which you need. Then, and when deciding whether to continue an existing engagement with an existing client, he's coming and doing the, asking you to do the existing engagement. Last year you did the audit, current year also he is asking you to do the audit. Before that also, so you know that person, but still you have to recheck this, all these things again. Then before accepting a new engagement from an existing client, my existing client, last year I did the review of that guy, current year he is asking me to do the audit of him. So he's an existing client, but the work he is giving is new. Last year review, current year audit. So before accepting the work, check all these things again. Three things highly important. Read, understand this. Separately, they may ask a question. Then comes the how to evaluate the integrity of a client. Very, very important. How to evaluate the integrity of a client. One question they may ask. Here, integrity is written. How will you know whether that client is straightforward and honest? So for that, you have to evaluate its integrity by following these rules. What are the rules? See, this is a mnemonic. Rana and Leela both have an aggressive attitude. That means, I'll say, in your college or school, there you would have seen some boy, at least one boy will be like this in the class, who is like a chocolate boy. He goes and talks to every girl. He's like a girl's boy. He may not have any relationship or all, but he's just cool with everyone. And whenever he sees a cute girl, he'll go and propose with that girl. So what he did, so you're seeing, just visualize this. So your mnemonic will be set in your brain. Imagine one girl is coming, and this boy, you can relate to that boy, whoever was in your class. This boy is going, that girl's name is Rana, and he is going, Rana, I love you. He's saying like that, Rana, I love you. So Rana is immediately saying, what the hell, man, look at yourself, who are you? Like, they're blaming. You don't have an attitude, you are not like this thing, they may be blaming on him. So Rana shows an aggressive attitude. So this boy is like, oh, okay, but he's cool with it. Okay, fine. Then when he turns, another girl he's seeing, that is Leela. Then Leela. Leela. Like he's Leela, you're looking too good. I love you. He's saying like that. So that is Leela. Leela is also shouted at him. So now he is coming back to one boy, boy is asking, what are you doing? Like, then this guy is saying, both Rana and Leela both have aggressive attitude. Both have aggressive attitude. Rana and Leela both have aggressive attitude. That is this mnemonic. Simple. See, Rana and Leela both have aggressive attitude. See, Rana means, first of all, identify the business reputation. Before, how will you check the integrity? Check first the business reputation. Then look at the nature of the client's operation. What business he is doing, how is he doing. If you are auditing Mama Earth, they are doing D2C business. So check all the nature of the client. They are selling online. That is the nature of their operation. Then they are manufacturing or not, all those things. So Rena, reputation, nature of the operation. Then Rena and Leela. Leela means you have to check the indications of an inappropriate limitation on the scope of work. Client is saying to you, before accepting the work, he is saying, sir, you can do all the audit procedure except you cannot send external confirmation. So they are putting a limitation. So if you got any indication that the client is putting limitation, his integrity is gone. So see before any indication of limitation, LI, limitations on work. Then next LI is Leela. Indication that the client is involved in money laundering, LA, Leela. Money laundering. So Rana and Leela, reputation, nature of the client's operation, indication. So I put a car also. This is indicator. The orange is indicator. So indication that Leela, indication that limitation. They are putting any limitation on the scope of your work, or another indication that they may be involved in laundering, money laundering, the client is involved. So all these things, so when you get all these things, client's integrity is gone. Then Rana and Leela both have aggressive attitude. Aggressive means whether client is aggressively concerned in maintaining low fees. He's saying, sir, do the proper audit, but I'll only pay you 30,000. The client aggressively low. You told us, sir, the fees is 2 lakhs, and the client is making aggressively low, not just low. Aggressively he is putting it down. He's saying, I'll only pay you 30,000. The client is concerned with that, so his integrity is gone. So it is aggressive attitude, aggressively trying to maintain the fees low, aggressive fees. Then next, information concerning the attitude of the client or the principal owners, like aggressive interpretation of interpreters or internal control environment. What is the attitude of the owner or the management? They are telling, we don't need good internal controls. There are a lot of business owners you would have seen who is not educated and all. So in their company, they don't believe in this accounting and all these things. So they will not put internal controls and all. So see what is the client's attitude towards all these internal controls and all. Attitude. So both Rana and Leela both have aggressively trying to maintain the fees, and what is their attitude towards internal control and all. Client's attitude, aggressive attitude. PA means proposed appointment. Proposed appointment of your firm and non-reappointment of previous firm. Last year audit was or work was done. Why this client removed that previous chartered accountant and now coming to you? What is the reason? What is the reason for proposed appointment of your firm and not considering the old firm? That thing also you have to consider. Oh, my battery is gone. 1 second. Okay, done. Then withdrawal from the engage. If there is any conflict of interest between the firm and the client, we are having any fight with the firm and the client, then if it is not resolved properly, then firm obtains. Sorry. If there is any conflict of interest between the firm and the client, you should solve it before accepting the work. And where the firm gets any information that would have caused the firm to decline the engagement, if the information has obtained earlier, then do this. That is, we accepted the audit and started the audit. But during the audit, we got some info. If we have got this info earlier, before accepting the work, we would have, this date we accepted the audit and started the audit. And this date we got some info that if we would have got this info before accepting the work, we would have not accepted the work. Like management is a fraud, like that info, then you have to do this. That is, then you have to withdraw from the engagement. So first to see whether there is any responsibility to report to the person who made your appointment, who appointed you, whether there is a requirement to tell this to him, and then what is the possibility of withdrawing. If you would have known this earlier, you would have not accepted the work, right? So what is the possibility of withdrawing? Simple. Then human resources. Firm should establish proper policies and procedures. See whether proper HR policies are there in the company. You have to make sure that is there is proper interviews are done, proper employees are hired based on skills only, not on the basis of some money given or something. If some companies are there where if you pay some bribe to HR, they will hire you. No, you have to check all those policies. Proper competent people are coming and all. Then engagement performance, very easy you read. Then last comes the engagement quality control review. That is, once the work is done, one senior CA in the firm will be there. Sometimes he may be senior CA inside the firm, or some senior CA who is outside the firm, some other senior CA. Once one audit team or one other work team, when they finish any work, to check its quality, someone called the engagement quality control reviewer, that is a senior CA, will come and just check the work done by this engagement team to make sure whether they have properly done all the procedures and all these things. So that is called engagement quality control review. It is mandatory for all the listed entities. It is mandatory, and other companies and all, the firm itself can decide for which are companies, which are work we need engagement quality control review. And if there is a difference of opinion, that is quality control reviewer come and saying this engagement team has not done the work properly like that. But engagement team is saying we have done all the work properly, proper procedures, everything was done. But quality control reviewer is saying no, this guy has not done everything properly. So difference of opinion is happening between them. They are saying in this situation you would have used this like that. So in that case, what you should do? The report should only be issued after resolving this dispute. Then after a resolution of the differences between both of them. If the report is not resolved, if the issue is not resolved by doing all the procedure, then it should be resolved by following the procedure of the firm. That is by consulting with some other practitioner or not. Both of them are having fight. And so before issuing this final report, we need to solve this fight. But they are not solving. Now what to do? Now you can consult some other senior person and see what opinion he is suggesting. Then report depending according to that. Or sometimes some other procedure will be inside of the firm also. Depending on that also you can solve it. Then assembly of engagement file. The assembly of engagement file should be completed in not more than 60 days after the date of audit report. Once audit report is done, within 60 days you have to finish off the entire engagement file, the entire audit file, documentation procedures where everything is kept. That file you should, once you finish the audit report, everything is done. But within the next 60 days, you have to arrange everything properly and just put it in a file and keep it properly. Then, like that, then this and all is easy, you know that. Then this engagement file should be retained for at least 7 years. So that is the, this audit documentation and engagement file is basically auditor's property. If he wish, he can give a copy of that to someone else. It's his wish, all this. Monitoring is easy. Then SA 220 quality control, similar things. But here we are looking at quality control only on audit only. Audit's quality control. So understand, leadership responsibility for quality on audits. There we said quality control for entire firm. Leadership responsibilities with the main managing partners or the CEO of the firm. But leadership responsibility for quality on audits, it is only with the engagement partner, who is the main CA who is signing that audit report. It is only with the engagement partner. The engagement partner has a responsibility for the overall quality on each audit. Then the importance of audit quality on, that is performing the work that complies with standards. Very easy. Abil is performing the work with the quality, easy mnemonic. Ability to raise concern without fear. You should make sure that to increase the audit quality, the leader should make sure that every article, everyone in my team, they can raise their doubts, concerns, everything without fear. That is, I should not shout at them whenever they are asking a doubt. So I should make sure my articles don't have any fear to raise their concern. Then only my audit quality will improve. First, ability to raise concern without fear. Abil is performing. Is means issuing the audit report that are appropriate in the circumstances. Make sure in which all circumstances, which all audit report is appropriate, give it like that. For example, you have not got the audit evidence. So give a modified opinion. You got all the audit evidence, everything is proper. Give an unmodified opinion. So in that circumstances, that opinion is better. So which opinion, depending on the circumstances, you have to issue. Abil is performing the work. Performing the work that complies with the professional legal standards, you have to do it. Then with the quality control policies and procedures. Done. Then relevant ethics is the same things. Then this and all is same. You have to check the integrity, competence, ICC. One more C is there here. Simple. Then assignment of engagement team. Then engagement performance. Engagement part. So these and all are easy. That is why I'm moving forward. When you read yourself, you will understand. Then engagement performance. I'm hoping you have the book with you. Then engagement performance means engagement partner has a responsibility for this. Engagement partner has a responsibility for performing the work, performing the audit. What is the responsibility? He has a responsibility that DSP Arun is a police and he is a DYSP, that is DSP. DSP Arun consulted with the doctor Sai. There is Arun is a DSP, Sai is a doctor. So DSP Arun has some fever or some issue and consulted with the doctor Sai. Sai means basically this is Sai, sufficient appropriate audit evidence. I just put this one spelling. Okay. He has a responsibility for, that is engagement partner has a responsibility for direction, supervision and performancing of the work. DSP of the engagement. Then DSP Arun, AR, auditor's report being appropriate in the circumstances. He has a responsibility to issue the correct audit report in the correct circumstance. DSP Arun, UN nothing is there. Then review of audit documentation, doctor. Review of audit documentation. So no, DSP Arun consulted. Consulted means ensure appropriate consultation on different on contentious matters. Not only with the people in the team, with outside members also. If during the audit you have a bigger doubt or anything, make sure it is properly talked, consulted with some senior CS, and then it is properly solved. Make sure that. Then DSP Arun consulted with the doctor side, review of the audit documentation before issue of audit report. Before issuing the audit report, make sure, check all the audit documentation once more. Doctor, TOR, nothing is there. Then SI, that is ensure sufficient appropriate audit evidence is obtained. So DSP means direct, supervise and perform the engagement. Engagement partner has responsibility for that. Then Arun, ensure proper audit report is issued in appropriate circumstance. Then consult, appropriate consultation in difficult matters. Then doc, review the audit documentation before giving audit report. Then SI, sufficient, make sure you got audit evidence, all the audit evidence before finalizing. Then here also engagement quality control is reviews there. Same thing, whatever I've said, mandatory for listed entities, other firms you can decide. Firm can decide. Other works. Monitoring is easy. Then last point, this is very easy. Done. So hope you got really good info. So now, like I told you with the question sheet, go towards the question sheet immediately. And whatever mnemonics and all we learned, try to recall it from here. Don't go to the third chapter now. Pause it. Try to recall whatever we have studied. Then see, 11th chapter, if you take this question sheet, I have mentioned everything. See, principle based approach means what? Like simple mnemonics like this, this is not mnemonic, this is just if your mindlet is not coming, then look at here rather than looking at the book. Then fundamental principles mnemonic, then this one, then safe mnemonic we have kept. Don't overuse Royal Enfield, everything. Then here also some mnemonics are to be added. Like I've shown you earlier, like the Rena and Leela and all those things. Yeah, so I had a thing for that. Okay, let me see. Question sheet, I added it. Something they added question sheet. Here see. 11th chapters, everything was added. See, this indicate terms of engagement, recurring audit, proper mnemonic. Oh, I never showed. This we missed. 1 second, guys. Let me go and see once. We missed something. We missed something literally bad. One important area. Sorry. I need to recollect. I need to get that. Before, where is it? Yeah, this one. Terms of engagement in recurring audits. So I told you this term of engagement, that is engagement letter, you have to sign that before entering into audit. But you in recurring audit, that is last year you did the audit, before that year also you did the audit, current year also you are doing the audit. So last year you signed the engagement letter. So current year, if you want, you don't have to sign the engagement letter. Like same engagement last year, it is already there. Same thing, you don't have to re-sign it again, current year. So without engagement letter, you can move forward. But there are certain circumstances, that is what is said here. There are certain circumstances in which new engagement letter becomes mandatory. Even though it's a recurring audit, still if these issues are there, you have to issue new engagement letter. See, what is it? Here, indicator. This one car and thing we have connected with the indicator. So any indication that entity misunderstands the objective and scope of the audit. Then a change is there in the senior management, or change in ownership, change in the nature and size of business, change in the legal regulatory framework, change in the financial reporting framework adopted, change in other reporting requirements. So here it should be a significant change. Significant change in ownership, other area normal change, ownership and nature and size. Then done. So this mnemonic is also there. So now we'll go to the second chapter. So flow is corrected. So what did we learn till now? First chapter we learned about the basics of audit. Second chapter we learned about till the auditor's appointment, till the auditor gets appointed. Till there we learned. A auditor signing the engagement letter. Till there we learned. Now we are going to learn about the strategy, plan and program. So we'll go with chapter number 2 now. Audit, strategy, planning and program. Very easy. 20 minutes later we'll finish it. Where is it? Chapter number 2. Inherent risk, we do it. Chapter number 2, that is audit, strategy, planning and program. So now, before starting the audit, like we started the audit, like 11th chapter we signed the audit engagement letter. So now we started the audit. So before doing anything, like imagine you are going to study, you will have a plan, right? So similarly, we also need to follow a planning process. So guys, understand. I will show it to you. Memorization batch. Where is the third chapter? SQC1, SA220, everything is there. And this one chart, please use this chart for revising SQC1, SA220. That is, everything is properly in short, summarized way. When you study from your book, after that you can look at this and recall. Every mnemonic, everything is properly written in my Telegram channel. It is there. Then flow of auditing. Then chapter number 2, that is strategy, plan and program. So there is something called Don't think that audit plan and audit planning are the same. No. Audit, lot of people mistake it. Planning is what we call the entire, like strategy plan plus program is what we call the planning process. So planning, first of all, we need to know about the benefits of planning and then the nature of planning. Then first, inside that planning process, we will have preliminary engagement activity, planning activity. Inside the planning activity, we have strategy, audit plan. Inside the strategy, we learn about benefits of strategy, factors to be considered for by auditor for establishing strategy. Inside that, we have these 5 questions. Then we have audit program, the advantages and disadvantages, and periodic review. Done. This is the concept of this chapter. So every chapter you need to have a flow like this. Then only when a question comes, you will know from which topic. Like imagine this question came. Your mind like audit strategy, audit strategy is there, and inside that here it is, and mnemonic it is like this. So it is very easy for you to remember. So guys, understand. So planning. This is not planning. The entire planning process. What is the benefits of that? It is called a DO disco. This girl entered into, like, she is riding a DO and going for a disco. This girl is riding a DO and going for a disco. Mind it should come. So DO. What are the benefits of planning? When you plan, it helps to devote the attention to devote appropriate attention to important audit areas. Auditor, when plan only, he will know what are the important audit areas. So he can devote appropriate attention to that. He can give. Then identify and resolve potential problems on timely basis. When he plan, he can know what are the potential problems that can occur, chance. He can identify that and then he can resolve that on potential timely basis. Then he can organize and manage the audit engagement so that it is performed in efficient manner. So DIO, DISCO, direction and supervision of engagement team members. When he plans, he can give proper direction to engagement team members, give them proper instructions and all. Depending upon their skill, all these things, he can give the info. Then DISCO, selecting the proper engagement team member based on their skills and requirement. Your job is a detailed audit. So you need some, imagine it's a very big audit. So there you need highly qualified, highly knowledgeable, experienced members as your team members. So from your entire articles, pick those members. Like that you can pick. Then proper coordination of work. So DISCO, devote appropriate attention to important audit area, identify and resolve potential problems, organize and manage the engagement. DI, direct and supervise the engagement team member, selecting the proper engagement team member, then coordinating the work. Done. The nature of audit planning. Nature of audit planning means the planning. Normally, when does an auditor gets appointed? So for a financial year 24-25, this is the financial year. Auditor, when will he be appointed? Tell me. If you have taken audit classes, tell me. Is it in September? Like not September. Basically, the AGM held in 2024, whatever AGM is held, or AGM held at 2025. At this AGM. Understand. The AGM held at, so basically almost September month AGM will be held. That is September 2024. So auditor is almost appointed almost 6 months before the audit start, like before the financial year end. Okay, understand. So the moment he gets appointed, he need to start the planning. So when the previous audit is completed, from that date he'll start the planning for the next year's audit, and that will be completed till the whenever next year audit is completed, till then the planning will be there. So what are the matters he need to consider in planning? He need to consider what are the analytical procedures. See the mnemonic, you know this, right? Appadi podu. This is a visual from that song. So APODI, podu, nothing is there. A means what are the analytical procedure to be used as risk assessment procedures. You will learn this more in chapter number 3. Then what is the performance of other audit risk assessment procedure? Then obtaining a general understanding of the legal regulatory framework. Then D, determination of materiality, involvement of expert. Done. Then what is the planning process? Planning process. Till you have not entered into audit strategy plan. No. What is the planning process? So first planning process is preliminary engagement activity. Before accepting engagement, you have to check these things, right? We learned chapter number 11, same thing. So perform the procedure regarding client relationship, whether all the things like whether his integrity, all these things are correct. Evaluating the compliance with ethical requirements, we check whether independence and all these things. Then understanding the terms of engagement, the auditor responsibility, management responsibility, everything. Then he will, after understanding this, he will sign the audit report. Then once that is done, then next is the planning activity, that is establishing the audit strategy and audit plan. So now, what are the preliminary engagement activities? Like this one, continuance of client relationship, same thing we learned earlier. Then same things. Then evaluating client's independence and all, it's very easy. Then comes the planning activity, that is strategy, plan and program. So understand, you from your school group or your college group, like from your CA classes, you are going to a Goa trip. So what is the first thing you will have? A basic strategy, right? Inside that strategy, okay, what are we going by bus or by train or by car or whatever it is? Then who is going to drive the car? On what date we are going? What is the budget? So these are the basic things. Who are people? Who all are coming for the trip? This is a basic thing. First thing, when you plan for a trip, this is the basic thing you will first of all do. This is called a strategy. Similarly, before starting audit, also certain strategy is there. That is strategy. Once strategy is done, then what is the next thing you will plan? You need to have an audit plan. Once strategy is done, Goa trip strategy is done, then you will have a plan for the Goa trip. In the plan, you will think, okay, in Goa, which all places to visit? First, you'll have an entire list of places which you need to visit. Kalangat Beach, Anjuna Beach, Baga Beach, all these things we have a place. Bagator Beach, Dudhsagar waterfalls, all these things you will have a thing. That is called audit plan. So strategy was only this much. Plan is a bit more detailed. Then comes the program. That is your proper itinerary. Monday morning, 6 a.m. wake up. 6 to 10, you have to get ready, have the breakfast. Then 10 to 12 at Dudhsagar waterfall. 12 to 3 at one beach. 3 to 4 at another beach. Like that, you'll have an itinerary. That is detailed instruction is called audit program. So guys, understand. Where is the sheet? I'll show it to you. So this is audit strategy. It includes basically what is the scope of audit. Audit inside audit, what is the basically the scope? What are the things you are going to cover in audit? What is the timing of audit? On what date, what time you are going to do? Basically, what date you will start audit, almost by what date you will finish the audit, everything. Then what are the focus areas, risky areas and all these things. Then comes the audit plan. In the plan, you will plan what are the list of audit procedures you need to do. It's a bit more detailed. List of procedures you need to use. Who will perform what work, like that. Then once that is done, next comes the audit program. It is a detailed instructions given to the article. The CA will have a audit strategies first. Then once that is there, then plan will be made. Then after that, who will perform what work we know from here. So imagine an article named Arun is assigned to check the fixed assets. So how should he check the fixed assets? Step by step, everything will be given. Go to the company. First of all, ask the list of fixed assets, get the fixed asset register. Then after that, go to the factory and examine the physical assets. Like that, step 1, step 2, step 3. Like that, detailed instructions will be given. That is called audit program. So hope you got it. Then what is the benefit of establishing an audit strategy? Benefits and first of all, you will know which resources, what resources are needed for auditing, deployed for specific audit areas. In which all areas, which all resources are required. Resource means human can be a resource, money can be a resource, like these kinds of laptop and all these things can be a resource. What resources are needed for what audit areas? When you plan only, you will know that. When you plan to Goa trip only, you will know what things to carry, like sunshade, sunglasses you have to carry, all these things. Then amount of resources, how much resources you need, how much sunglasses you need. Similarly, in auditing, how much staff you need, how much calculators you need, how much laptop you need, amount. Once that is done, then when these resources are to be deployed, during what stage of audit, what resources. In the initial stage of auditing, what resources are needed, interim stage of auditing, what resources are needed, like that. Then how these resources are going to be managed, how the articles, everything will be managed. There will be senior staff to check them. So all these things, these are the things you will understand. These are the basic benefits of strategy. Then what are the factors to be considered taken to consideration by auditor for establishing audit strategy? First, what are the characteristics of the engagement? Annie, this girl is called Annie. Applicable financial reporting framework. Then you need to know the nature of business segments. What business segments? You are going to audit Reliance or you are going to audit Nike. Nike will have different business segment. Nike footwear is a segment. Nike clothing is a segment. Like that, different segment will be there. Then industry specific reporting requirements, if there is any. You are going to audit a bank. Bank has RBI's reporting requirements. So similarly, any industry has any specific requirement you will see. Then expected use of audit evidence obtained in previous audits. Last year you did the audit, you got some evidence. Can I use it in current year? So these are the characteristics of the engagement. Then comes the ascertaining the reporting objectives of the engagement to plan the timing of audit. So some instances are, this is an important question. Some instances are, this is a mnemonic, pictographic mnemonic. Everywhere we cannot use normal mnemonic because then we'll have to have a mnemonic to remember the mnemonics. So better have something like this. So next is first is TT. TT means timetable. What is entity's timetable for reporting? Then comes the timetable for reporting means on which date we need to finish the reporting, like that. Then comes the organization of meetings, OM, O and M. Organization of meetings to discuss the nature, timing and action of audit work. Then comes the TT, type and typing of reports. Type and timing of reports to be issued. These 2 points are related to management. This 1 point is related to engagement team. So understand, discuss with the management what all reports are needed, at what time they are needed. Audit report they did, obviously. Some imagine during the audit you may be checking the internal controls also. So report on the internal controls may be required. So what are the different types of report needed, at what time they are needed? By this date, we are having the AGM at this date. So before at least 30 days or 25 days before that audit report should be needed. Like that, they may tell you the timing. Then discuss with the management the expected communication on status of audit work. Tell the management, bro, every week we'll have a meeting. During the audit period, every week we'll have a meeting and discuss how much audit procedure was done, like that. Then nature and communication, timing of communication between engagement team members. During a bigger audit, some engagement team members, they may not be even seeing each other. Same audit team, one member may be in factory, another member may be in office, doing the audit together. So every 3 days, we'll have a review meeting of what work you did. Like that, something will be there. So what is the nature on how you are going to do that meeting? Is it a Zoom call or is it a physical meeting? Or timing, at what time? Every Wednesday or every Wednesday and Saturday, we are having a meeting. During the audit, 2 months of auditing. Then that is it. Then these are easy. What are the factor auditor considers in directing engagement team effort? Volume of transaction, industry development, very easy. VIX. So if the volume of transactions, they will check. Industry developments, that may affect. That is, what are the factors he will consider in directing the engagement team efforts? That is which area should our audit team focus more? I'm auditing one company. Should I focus on sales more? Should I focus on assets more? What will the auditor see to determine that? Auditor will look at these factors to determine that. He'll see what is the volume of transactions. If the volume of sales, the volume of transaction is high. So there, it's a more people are needed, more engagement team members are needed there, like that. Then if significant industry development is there, depending on that, then changes in the financial reporting framework, other significant relevant developments. VIX, VICS, simple. Then these two are very easy. Then development of an audit plan. Contents of audit plan is easy. Relationship in strategy. Strategy is a bit more smaller, plan is a bit more bigger. See, audit strategy is broader and I'll see it from here. It's a broad overall approach, audit strategy. Then plan will address the various matters identified in the audit strategy. Strategy is just a broad approach. And whatever you identify in strategy you identified risky areas, sales, assets. Okay, who will audit that? So based on strategy, you are preparing the plan. That is, plan will address the matter you identified in the strategy. You identified in risky areas in strategy, and in plan, you will plan who will audit that area, like that. Then scope or timing and directions. Audit strategy will determine the scope of audit, timing of audit, and direction of audit. And plan will say how the strategy is going to be implemented. How are we going to implement the strategy? Then plan is more detailed than strategy. Both are closely interrelated. If strategy changes, plan also changes, like that. Then changes to planning is very easy. Then these are easy. Proper documentation of, you have to document strategy plan and any changes made to the strategy plan and documentation. Now comes the audit program. It's a series of instructions given to the articles to how to do the audit. That is series of steps. That is called a program. So evolving one audit program is not practical for all the business, because imagine I am auditing boat. Boat is a manufacturing company in India. So I'll tell you what these EA firms do. They will have a basic audit program, and they will use this program for all the audits. Same program they will use audit for all the audits. That should not be done. That is, one audit program is not practical for all businesses. When imagine I am auditing boat. Boat is a manufacturing company. They are manufacturing their products now in India. So my audit program for boat will be tailored in that way. Check the manufacturing, check the work in progress, like that will be mentioned. But I cannot use that same audit strategy, same audit program to audit Zomato. In Zomato, stock itself is not there. So audit program should be changed there, right? So one audit program may not be practical for all businesses. But if I'm auditing Zomato's audit program, I can use it if I'm auditing Swiggy also. Or boat's audit program, I can use it for other company which has a similar noise or JBL, like that. Okay. Then assistant should keep an open mind. Even though to an article, I'm giving audit program and asking him follow this blindly. He should follow that blindly, but there may be some situations which are beyond the strategy. You would have given instructions, but during the audit, he found out some fraud. So there he may need to do some extra detailed checking. So there he cannot say, oh, program it is not that I will not do. No. If he should keep an open mind. If some situation extra comes, he need to do that extra work. He need to use his judgment also. But whatever is there in the program, he need to follow that. Plus extra, if there is needed, he need to do that. He need to tell it to his senior. Sir, I have found out something like this, what should I do? He need to report everything. He don't think like I'll only do what it is said. No, assistant should keep an open mind. So whatever I'm saying is written inside this. So when you read, you'll understand. Then to start with, when we start the audit, auditor will give a basic audit program to the article. Then during the audit, auditor may alter this audit program. That is, initially we will give to start with, we will give a small normal program which will ensure a minimum essential work. It is called a standard program we'll give. And as experience is gained throughout auditing, the program may be altered. So if any work originally provides to be unnecessary, it can be removed from the program. Assistant in the job should be keeping an open mind beyond what is the program given to him. He should be instructed to note and report the significant matters coming to his notice. Then periodic review of audit program. Last year I made a program. Imagine current year also I'm using it same. Bro, business would have changed from last year to current year. The business would have grown or business would have gone down. Their policies would have changed. So basically, you should have a basic periodic review of the program. Like during the audit also, you can do a periodic review. Imagine audit is for 2 months. After 1 month, just to see whether the program, everything is properly correct and all, whether we are following in the right path. That is called a periodic review. Else what will happen? Sometimes company would have changed their policy and your audit program is old now. And you are following that, so entire audit will be conducted as negligently conducted. Simple, same thing. There should be a proper periodic review to assess whether the program is adequate now. You have to check that. If this is not done, any change in the business policy may not be adequately known. You will not know that. So work done may be carried on an obsolete program and whole audit will be conducted as negligently conducted. The utility of the program is simple. Then audit program not only lists the task to be carried out and also like relevant instruction. So as long as the program is not officially changed by the principal, every assistant should blindly follow that program. Example, article 1 during auditing understood that some extra procedures or this program is bad. Article understood this audit program is like irrelevant during audit. But he should, even though he understood like that, he can tell it to his seniors. But till the chartered accountant, till the engagement partner makes a change in the program, he has to follow that program. So understand this, guys. This can be an MCQ. Like in a question, article during the audit understood, like article to keep an open mind, we learned. So during the audit, article found out some situations where he should by keeping his open mind, he understood this audit program is irrelevant. Some extra procedures are needed. So what should he do? Like he's not performing the things in audit program. He is doing some other procedure. He is thinking like that. What should he do? So in the answer it will be written, since assistant is keeping an open mind, he can follow that. Bro, he can follow that. After following what is there in the program, then he can extra if he needed, he can follow. So basically without he should mandatorily follow what is there in the program. If he wants something, he can do it. So that is what you have to keep this for an MCQ purposes. Okay. And then how to construct an audit program. When constructing an audit program, what are the things you need to consider? Constructing a program, like tell me, for this we are using a different method for memorization. In a computer, what all things will be there? If you wanted to buy a PC for your home, what all things will you buy? Nothing is there in your home. Imagine. First you will buy the monitor. Then you will buy the CPU. Monitor, CPU. Then you will buy keyboard. Then you will buy mouse. Without this, you cannot use the computer, right? Then to put this computer, you need a table. You will not put it on the floor. So table is needed. Now for you to sit, a chair is needed. So this question we are remembering like this. First computer, then CPU. Like that you remember. So in computer monitor, we have written S&L. That is a scope and limitation. When you create an audit program, you should stay within the scope and limitation of the assignment. What is the scope? What are the things you are going to cover? What is the limitation? What are the things which you cannot cover? Based on that only you have to make a program. Don't make a program which is beyond this. Okay. So scope and limitation you have to cover. Then it should be a written audit program, WAP. It's not like a mental plan. No, you should be a written audit program. So scope and limitation, written audit program. Done. Then monitor and CPU is done. Then comes the keyboard is another important part. Without mouse, with the keyboard, you can do all this things. So that is expect evidences that are reasonably available. When you are making a program, make sure you plan it in a way, whatever audit evidence which you can reasonably get, whatever audit evidence you needed, and which is practical, whatever you can get. So make a program to get that audit evidence only. Like some audit evidence which you will never get. You are making a program in step. You are making instructions to get something which you will never get. No. Evidences that you can reasonably available. First you identify that, then make program according to that. Okay. Evidence is reasonably available. Then what are this is the keyboard. Then comes the mouse. What are the steps and procedures which are useful in accomplishing the verification purposes. You have the steps and procedure. Then comes the consider all the possibilities of error and coordinate with the procedures. This one thing was also there. You can write it to your book. Then these are all are very easy. This question you have from where auditor gets the audit evidence, he gets from documentary examination, physical examination, very easy. Then now we look at the advantages and disadvantages of the program. Advantages. What are the advantages of the program? It's a swift spa. Like spa is what we call a car wash. For car, the spa is called a car wash. You take a Swift and went into the spa. That is, you take a Swift and went into the car wash. You have a Swift, you take it to the car wash. Swift, S means selection of the assistants for the job will become very, very easy. When you have a proper audit program, you know what instructions to be followed. So depending on that, you can easily select the staff. Imagine in an audit, asset verification is more important. So people who have a experience in asset verification, you can take them in your audit team. So selecting of assistants will become easier. S. Then W. Without a written audit program, what will happen? Everything will be a mental plan. When it is written, you will have a proper plan. So written audit program is written. Then I. I means it provides a clear set of instructions. It provides a clear set of instructions on what work to be done. Then S, I, S, W, F, I, F. It's a guide for future audits. Next year, like last year, if you have a program, current year before starting audit, you can see what is a program and make a new program, right? So it's the guide for future audit. So SWIF. S means selection of assistants is easy. W means written audit program. I means it's a set of instructions. SWIF, guide for future audits. T means it is essential to provide total. It will give a total perspective of work to be done. What work to be done? The total perspective it will give. Total perspective. T. S means selection of assistant is easy. W means written audit program. Then I means instruction, set of instructions. Good. Then F means future audits. It is a guide. Then T means it gives a total perspective. Then Swift SPA. By putting a signature on the program, assistants accept the responsibility. Because I am auditing fixed. I am the article and I am working on the one audit. And in the audit program, my responsibility is fixed asset verification. So I will sign there. I will sign. That is my program given to me. I will sign. So now I take the responsibility. I have the responsibility for that. So responsibility on the test. So now I will be more serious. So that is one thing. SPA. S, P. Now principal can easily control the progress of the various audits with that. SPA. Audit program serves as an evidence. Future any program. Someone is saying you have not done the audit procedure. You can show the program and make them understand. Advantages. Then disadvantage is Hari is mine. Hari, you know one Hari. No, don't think about that. So there is a person called Hari. Hari is mine. Okay, Hari. HA. Disadvantages. HA means this one. A hard and fast audit program will kill the initiative of efficient assistance. Some articles are so good. They have so much brain. So when they are given a proper instruction and said, follow this only. Now they are not using their brain there. So a hard and fast program will kill that urge to do more work. So HA, Hari, RI. Rigid and inflexible program. The program often tends to become rigid and inflexible. And the business may change its operation during the conduct, but old program may be still carried on. Rigid and inflexible. When a program is given, it's like, do follow that instructions like that. It's a rigid and inflexible. Sometimes company may change its policy in between. So the program will be obsolete. So that RI, Hari. HA means hard and fast program will kill the initiative of the assistants. RI means rigid program. Hari is, where is this? Is nothing is there. Then mine. Mine means work may become mechanical. For article also, they are new to using any brain. First step over that, second step is given, third step is given. So it's like a mechanical work. MINE. Inefficient assistants may take a shelter behind the program. Sometimes weak, like bad articles will be there. Like they are inefficient. They don't have the skills and they don't have the interest also in auditing. So what they'll do, they'll only do whatever is there in the program. They'll not keep an open mind or do anything beyond that. No. Beyond that you have to do, but after whatever is done in the program, then extra work, if there is another, you can do it. Keep your mind open. Any doubt you have, tell it to your seniors, like that. Then inefficient, if these inefficient articles, what they will do, they will take the shelter behind the program. That means if any serious issue came and auditor is saying, senior engagement partner is saying, Hari, not Hari, the article, why have you not properly checked the asset? He'll say, sir, that was not written in the program, but it is implied that he should do that. But he'll say that was not written in the program, like that. So Hari is mine. Hard and fast audit program will kill the initiative. RI, rigid and inflexible program. Is nothing is there. M means work will become mechanical. INE, inefficient assistance, take shelter. So Swift SPA, very easy. So second chapter is also done and dusted. Risk assessment and internal control. So we'll be going very quick. So after every topic, you just pause, try to process it inside, then play. That is how you need to learn. Like just don't simply sit and finish watching it. Things may not be processed into your head properly. So after every topic, pause it, try to process what we learned, then or take your books, all the material, any material you are referring, if it's my revised audit book, 120% good. Else also no problem, because any book, this will be the order if it is as per ICAI study material, right? So yeah, so first is, we have lot of topics in this chapter. It's basically, if you see, let's take 1 second, you hold with me. That is, where is this chapter starting? Yeah, topics in this chapter, if you see, risk assessment and internal control. First we have audit risk. Let's divide and conquer. This is one of the technical chapter. Like let's properly have a structure. I'll structure everything for you. Just hold on with me. So audit risk, then we will learn about SA 315, then we learn about materiality 320, then internal control, that's a separate topic. Automated environment is a separate topic. 330 is also a separate topic, but this and this are a bit related, not a bit. I'll explain everything. So don't worry. So first is audit risk. Same thing is there, what I'm showing in the chart, same thing is there in the book, or let's go get directly from the book itself. So it will be easy. So what do you mean by audit risk? Audit risk means auditor checked the entire financial statements and he is giving an inappropriate audit opinion. That is, financial statement had mistakes, but he is saying financial statements don't have mistakes. That is called audit risk. See, auditor giving an inappropriate audit opinion, that is unmodified opinion, when the financial statements are materially misstated. Financial statement has mistakes, but auditor saying that financial statements does not have mistake. That is called audit risk. Just understand, because for MCQ and understanding the questions nowadays ICAI is asking, you need to understand everything. Else you may not be able to comprehend and understand that question. You may know the answer, but you may not understand what answer to write for what question. Okay, so that is why audit clarity is important. Yeah. So next, let's go. Let's quickly go. This is a, I know this is a, you know, I believe you guys know this is a revision batch. So let's do that. So next is risk of material misstatement. What do we mean by risk of material misstatement? It simply means chance of mistakes. In a financial statement, there may be errors, there may be fraud. That chance, that a chance is there, right? A chance of error or fraud. That chance is what we call risk. That chance of material misstatement, that is, in a financial statement, imagine sales is 10 lakh. So there is a chance that sales, in sales there may be an error or a fraud, like figure may be wrong. That chance auditor is considering is called risk. So chance of mistake is what we call chance of material, risk of material misstatement, chance of bigger mistakes, that is risk of material misstatement. We learn what is material, everything. Okay. So this risk of material misstatement, two types are there. First of all is something that affects the entire financial statements. Imagine, let's take in a company, the accountant. Accountant is the one who makes all the journal entries and ledger, all these things, right? So imagine he is an inexperienced guy. He is inexperienced. So a lot of journal entries will be mistaken. So imagine an accountant is inexperienced. There is no senior, like a senior officer who is checking his checking the journal entries made by accountant daily. What happens? These wrong entries come to the books and the books will be mistaken. And based on the books, financial statements are made. So financial statements also will be mistaken. So these kinds of risk, any risk that affects the entire financial statement. When an accountant is inexperienced, lot of entries made by him will be mistake. So financial statements full mistake will be there. Those kinds of risk, that kind of chance. I'm going to audit, I am getting a financial statements for checking. So the chance of these kinds of mistakes in that financial statement is what we call a financial misstatement, a misstatement that affects the entire financial statements, like many assertions in the financial statements. Then there is something called assertion level risk. That means small mistakes. Small mistake. Imagine an expense like a miscellaneous or an office expense of 10,000 that got wrongly posted in rent or miscellaneous expense posted. Office expense of 10,000 got posted in miscellaneous expense. Same amount, but just the classification difference, right? So financial statements mistake is there in the head, but still it's just affecting one or two assertions, right? So that is called assertion level mistakes. Okay, just understand this much. Then we have two components at risk of material misstatement at assertion level has two components. One is inherent risk, second one is called control risk. So what do you mean by inherent risk? Inherent risk means whatever you do, even though the company has really good internal controls, really good security, everything, still there is a chance of material misstatement. These kinds of things are called inherent risk. Whatever you do, this risk is there in the company. Risk means a chance of mistake. This much chance of mistake is there in the company. Imagine company has the best internal controls, but still this kinds of misstatement will be there. That is, that this kinds of misstatement, there is a chance for these kinds of material misstatements. That is called inherent risk. Means susceptibility of an assertion that could become material before you even consider internal controls. That is, before you consider a control, there is a chance of mistake. That kinds of misstatement is called inherent risk. Then example I'll give you. Imagine a new accounting standard came, or there is a complex treatment for one accounting standard. Very complex treatment. Even chartered accountants, it's a bit difficult for CAs also. Just think. So company or accountant will be mostly like simple BCom graduates or all these people, right? So they may not be accountant and normal managers also. They may not be CAs or bigger people. So when that kind of an accounting standard is there, and imagine accounting standard, anything related to PPE, assets. Imagine the complex thing is there in that accounting standard. What happens when such kind of a complex accounting treatment is there? Obviously, there is a high chance that the accountant will make mistakes. So these kinds of things, like even if you keep the best control, these kinds of misstatements, the chance is there. Those kinds of things are called inherent risk. Next is control risk. Control risk means company put internal controls to catch any fraud or error, but that internal control not working properly. Because of that, a risk is happening. That is called control risk. That is, a control is weak. Imagine company put, imagine there are, one second guys. Imagine, just understand this. Imagine there are 3 accountants in a company, and this guy is a finance manager. So daily he will check all the entries made by these accountants. Daily he is checking. But imagine this guy is not very highly experienced or whatever is happening. Or not highly experienced, you don't take. Imagine this guy is not doing his work properly. So what will happen? These guys will make a lot of mistakes, and this guy will not be detecting that, and financial misstatements may come, right? So this control is not working properly. Any risk that is coming from these kinds of situations is what we call a control risk. But that should be only related to assertion, right? Not related to overall financial statements, because this is a part of risk of material misstatement at assertion level. So control is not working properly. Imagine company have a CCTV, and that CCTV is not working properly. So lot of people committed fraud from the warehouse. So that control is not working properly. Risk that a misstatement could occur in an assertion that could be material. That kind of a misstatement will not be prevented, detected and corrected by entity's internal control. Then see this. It means there is an inverse relationship between control risk and efficiency of internal control. Highly important for MCQ. Understand. If a company have really good internal controls, then control risk will be low. If a company have bad internal controls, control risk will be high. Company CCTV is a really good CCTV made by America. So it will not go bad during the year. So because the internal control is so good, control risk would be very low. But company's internal control is very weak. So control risk will be high. Understand. Okay. Then next is detection risk. Detection risk means auditor did the auditing procedures, but he was unable to detect a material misstatement. This is auditor order risk. These two are related to company. If these two are related to company's risk, but detection risk is auditor's risk. Okay. That is, a procedure performed by the auditor will not detect a misstatement that could be material. Simple. Then detection risk can come from 2 ways, that is sampling risk and non-sampling risk. Sampling risk means auditor's conclusion based on a sample may be different from the conclusion if entire population were subjected to same procedure. That is, auditor checked something based on sample and he got a conclusion, but that is actually wrong. If he would have tested the entire population, not taking the sample, he would have got another conclusion. So those kinds of risk is called sampling risk. He checked the things with sample and reached at a wrong conclusion. Then non-sampling risk. Any other risk other than sampling risk is non-sampling risk. Auditor reaches an erroneous conclusion for any reason not related to sampling. It is called non-sampling risk. Done. Then inherent other we learned. Then what is not included in audit risk? That is auditor's personal business risk. That is, auditor is someone who is outside the entity, right? He is not a part of the business. So any risk that auditor's business risk, his personal business risk, it is not included in audit risk. I am going to audit one company. that company audit risk will only come in audit risk. But I am the auditor, I have my personal business risk. That will not form part of company's audit risk. Imagine adverse publicity, loss of litigation. Imagine Byju's came to me and asked me to audit the Byju's. But if I audit Byju, what will happen? Sometimes future Vinny case will come and my reputation will go down. This is my personal risk, right? It is not in the audit risk of the company. It is my personal risk. It will not come in audit risk of the company. Then audit risk is divided into two: risk of material misstatement and detection risk. Risk of material misstatement has two levels: inherent risk, control risk. Detection risk is sampling risk and non-sampling risk. This equation you keep in mind. Simple. Then next is SA 315, that is identifying and assessing the risk of material misstatement. Take 1 minute to process what we learned. Pause it and process. Next is SA 315, that is identifying and assessing the risk of material misstatement. Very easy standard. Lot of people find this difficult. Just guys, just understand this much. Basic knowledge I'll give you. Audit procedures. Oh, this man. Or just understand. Basically, we have two things. That is SA 315 and SA 330. 315 and 330. 315 is what we call risk assessment procedures and 330 is what we call further audit procedures. So entire audit procedure, we learn audit procedure. Audit procedure means the steps, the process auditor do in auditing, do while doing the auditing. So this is some core thing which many students don't understand. Guys, just understand. Here we will perform basically normally 4 procedures, that is called inquiry. I'll explain why we are doing this, all this highly conceptual stuff. Inspection, analytical procedure and observation. That is, first of all, before I just guys, let me ask you. Let's take an example of a girlfriend and a boyfriend, like girlfriend and a boyfriend or a husband and a wife, whatever it is, like girl and a boy. So now I am a boy, so let me talk in boy's perspective. So if you are a girl, like vice versa, okay, just understand, okay. So understand, imagine I am looking for a girl to marry. I'm looking for a girl to marry. What will I do? First of all, what is the thing? Imagine I will identify, imagine like my parents brought me a girl, like this is the girl you have to marry, like we are going to meet that girl, arranged marriage. So what? First thing I will do is I will identify all the risk that is associated with that girl, right? Like imagine she is like the hypothetical example, don't take it to any political correctness level. I'm just saying for a hypothetical example for your understanding purpose. Imagine that girl, girl or boy, vice versa. I don't have any favor to any gender, keep in mind. So because nowadays we cannot say any like joke also, like people will take it very seriously. So just understand, vice versa. It can be boy or a girl, vice versa, understand. So imagine this girl is from, this girl has for the last 5 years, she is from Bangalore and she is having, like I went to her Instagram and she is having this kind of a party life. So, and imagine I'm like a very normal guy who have not done party. That is not the case, but just understand. So in that case, what will happen? I'll feel like, why should I marry her? Like she is living a different life, I'm living a different life. So that kind of a partyholic life of her is a risk for me. So I'll identify the risk first, right? Yeah. Similarly, before starting the auditing, before we do the actual audit procedures, we will understand what is the risk in that company. What are the chances of risk of material misstatements in financial statements? That is, we'll identify all this risk. I will go to the company. I will use inquiry. I will talk with a lot of people inside the company, employees, managers, everyone. I'll ask them a lot of questions. From that, I will get a lot of risk, company and then a risk chances there. These things I will identify through inquiry, through inspection. I will inspect all the documents, all these things. Analytical procedure, that is through comparison. What is analytical procedure? It's basically comparison. I will compare last 3, 4, 5 financial year statements, all these things. Or last year's sale was 10 crore. Before that year, it was 8 crore. And currently, the sale is suddenly jumped to 18 crore. Last every year, 2 crore was increasing, but suddenly current year 8 crore increase. What happened? There's some fraud chances there, right? So that is what we call risk. So sale is a risky item. There, like that, I will identify all the risky items. Last year, last 3, 4, 5 years, employees expenses like salary, everything was say average in the range of 8 to 10 lakh. But suddenly in the current year, it has jumped to 35 lakh. Like why should company pay suddenly this much salary? When I asked, no new employees were also there. So then that means salary amount, like there is a chance of error or fraud. So these kinds of through these procedures, I will identify all the risky items in the entire financial statements. What is my duty? Check everything in financial statements. I'll identify all these kinds of risky items. I will identify these risks, and then I will also assess this risk. Assess, that is how big of a risk it is. For sales, suddenly your 10 crore increase, or not 10 crore, like say 10, 20, 30% increase compared to last year. So it's like a high risky item. But expense say 2% increase. But that's not a high, that's not a very risky item, right? So I'll identify all the risky items, I'll identify all the risks, and from that then I'll assess how big and small those risks are. Then I'll write it in a piece of paper and keep it. That is what we call a risk assessment procedure. That is, just understand, SA 315, identifying and assessing the risk of material misstatement through understanding the entity and its environment. That is, I'll go to the company, I'll identify what are all the high risk possibilities are there. Then I'll make a list of all this risk. That is, I'll identify all this risk, identify and assess this. Okay. Once I identify all the risk, now I have a list of all the risk, list of all the things which I should detailedly check in the auditing. Then I will plan my further audit procedures. Like what are the other audit procedures that I need to use to check whether this risk actually exists. Like I told, sales there is risk, expense there is risk. Okay. So what are the audit procedures that I need to use to check these sales and this expense, so that I can identify whether that risk actually, whether that's an error, whether that's a fraud, or whether that's original. Here I am only identifying the risk. I am not saying everything is wrong. I am just identifying the risky item, and here I will check whether those risky items are actually a fraud or an error. So here I will use other procedures called test of controls, that is testing internal controls. Then substantive procedures. These are divided into two: test of details and substantive analytical procedure. These are just, I'll explain all of these things, don't worry. These are all the audit procedures which we will use to test the risk which we identified here. Okay, similarly, so now we'll go. I know some of you may have understood everything, but others, 50% some lag is there. Don't worry, once we move forward, you will understand. Once we reach SA 330, you will understand. Just hold on. This 1 hour, 1.5 hour is going to change your life on this chapter, guaranteed. Then for the purpose of identifying and assessing the risk of material misstatement, that is for this purpose, for identifying the risk. Now I'll tell why I told the example of that girl. Imagine I'm going to marry, like I told you. So in that case, understand this. First, that girl is a partyholic girl. Okay. So I'll identify the risk through the process of obtaining an understanding of the entity and environment. I will identify, I'll understand that girl through going through her Instagram, through inquiring to my mutual common friends, all this. By understanding her, I will identify all the risk that is associated with her. When I inquire to a lot of friends will say, she is like a partyholic girl, all these things. So I'll identify all the risk. This is vice versa, girl or boy, whatever, okay. Then once I identify the risk, then I assess the identified risks. Assess means, okay, I identified she is a partyholic guy from Instagram. Then now I'll go on a date with her. Then I'll ask her, like, how is your actual life? When I'm talking to her, I'm assessing her actually, like, okay, have you had any boyfriends in the past? Like by talking to her, and once I come back, I'll get a detailed info also. Here I identified this risk. She is a partyholic. Here I'm assessing her, like whether she's actually a partyholic guy or all these things. Then once I assess her, now I got a clear picture of her image and what she has actually, her character is. I told to her, right? Once that is done, then I will check whether relate to these identifier risks to what can go wrong at assertion level. That is, okay, then I will think, okay, she is this risky. If I marry her, what can go wrong in my life? She'll have to, like normally she'll not, I'm a guy who is coming home at like 9 p.m. She'll be coming home at 3 a.m. after partying. So that will disrupt our living things, right? So what can go wrong in my life? I'll identify that. Then I'll consider, if I marry her, what will happen? We'll end up in a divorce. That is, if I marry her, can I adjust? If I'm not able to adjust, will it end up in a divorce? This is so that you'll not forget this. Now we'll go and understand what this actually is. So so now you understood the picture, right? With that girl example. So it's vice versa, girl versus boy. I don't want to take the blame. If you are a girl, then think of these example as a boy. Okay. So first is like as per SA 315, what are you going to do? First, you will understand the business. First, you will understand that company. With that understanding, you will identify all the risk that is related to that company. Once you identified all the risk, then you assess these identified risks and evaluate whether they relate more pervasively to the financial statement as a whole. That is, whether those risks will affect the entire financial statements or not. Then relate this identifies what can go wrong at assertion level. That is, whether what is the impact of that risk, what this risk can make issues in the assertion level, what this risk can affect. Then consider whether that risk will lead to create a material misstatement. What is the chance of that risk becoming a material misstatement? Okay. Then next is understanding the entity and its environment. Very easy. How you understand the entity? Very easy. What is the relevant industry of that entity? Imagine, let's take a company called Mamaearth. Relevant industry in FMCG. Then like fast moving consumer goods. So what is the regulatory things applicable for that company? Then what are the other external factors? What is the financial reporting framework? Schedule 3, all this. Then what is the nature of the entity? That we'll learn now. Don't worry. That is nature of the entity. We have a lot of things. That is what is the operation of that entity? Mamaearth is selling goods on, shampoo and all these things on through directly to the consumer through Flipkart. So D2C is their operation, and B2C also through shops also they are selling. Then what is the ownership and governance structure? Who owns Mamaearth? Who is the CFO, CEO and all these things? Then type of investment that entity is planning to make. So when we talk with Mamaearth, we'll understand, okay, next year Mamaearth is planning to acquire Wow. Wow is a company, right? So what are the types of investment that company is planning to make? Then the way that entity is structured and how it is financed. Like what is the debt and equity ratio in that company? Debt means like debt and equity is what a company used to finance the company, right? So what is the debt in that company? What is equity in that company? All these things. Is the company running with debt or is the company running with equity? All these things. Simple. Then these are other same things. Then for understanding the entity, first we understood these two things. Then what are the selection and application of accounting policies, including recent to change? What are the accounting policies used in the entity? What is the depreciation method? What is their inventory valuation? Are they using straight line method, LIFO, FIFO, whatever? All these things. Then entities, objectives and strategies and those related business risk. What are entity strategies? How is Mamaearth planning to, Mamaearth strategies? Through influencer marketing, they are planning to reach the customers. So what are the strategies and objectives? Where is Mamaearth planning to reach in the next 10 years? All these things. Then measurement and review of entity's financial performance. That means measurement and review of entity's financial performance. That is, this is not, auditor is not going to measure and review financial performance. Here we are learning about the business will have a mechanism. Mamaearth has a mechanism to measure and review the financial performance of Mamaearth. Mamaearth, a lot of employees will be there, lot of things will be there. So Mamaearth will have a performance measure inside Mamaearth itself to measure their performance. They'll have a system to evaluate last 10 years or the sales, profit, all these things, all the ratios, and see whether company is performing current year good or not, right? So here, what is that performance measure used by Mamaearth? What performance measure is used by Mamaearth? As an auditor, I am just understanding that performance measure only. I am not measuring anything. I am understanding what performance measure is used by Mamaearth. Think, pause and think. Okay. So, an understanding of entity's performance measure. When I understand what performance measure they are using, that will help me in considering whether pressure to achieve performance target may result in management action that increase risk of material misstatement. That means in lot of companies, for example, Byju itself, we'll take. Byju's performance measure was, that is, Byju used to give targets to their salesmen. Like this month, every salesman has to bring in 100 customers, 100 clients. And Byju will say, if you are unable to bring 100 clients, your job is gone. But if you can bring 100 clients, then we'll give you incentive also, like that. So Byju is measuring the performance of their employees through this one target. But what is actually happening here? Byju has given a target. When Byju gives this kind of a target, employees, like imagine I am a salesman, I reached 95 clients at the end of the month, but if 100 is not there, my job is gone. So what I will do, I will influence the accountant and I will create some fake sales. So fraud is there. That is performance, they give performance target, and because of that target, because of those performance measures, fraud is coming or an error is coming. See, as an auditor, I have to understand the performance measure, to understand whether this pressure to achieve the target, by just giving pressure, whether that pressure will result in management action that increase risk of material mistake, whether that pressure will create fraud or error. So these are some of the performance measurement, key performance indicators and key ratios. All the ratios, everything they will check to see the performance. Then financial performance analysis, credit rating agencies reports, budgets, forecast, variance analysis. See, KFC budget. Everyone likes KFC. If you are a vegetarian, opposite, like any other thing. So here, just understand for this. This is KFC bucket, right? So KFC budget. K means key performance indicator. F means financial performance analysis. C means credit rating agency. Budget means this. Simple. Then understanding an entity is a continuous process. That is, when I understand a business, like through these procedures, like I told you, like a girl, if I am going to marry, I'll understand her. I'll see all the risk associated with her, right? Similarly, before starting the auditing, I will understand the business, understand my client, what business he is doing, what are the risks, all these things. So this is called understanding, identifying all these risks, right? So when I do this understanding, I can use that understanding for these things also. So when I understand someone, then I can use my understanding for these things also. When I understand a girl, I can decide, okay, I'm not going to marry her. And I can tell all my friends also, please don't marry her. Right? If her proposal is coming to all of my friends. So understanding has multiple benefits. Similarly, when I'm going to audit a company, I'll understand the company. It has a lot of benefits. So that understanding, I can use it for these things. See, Roma select codes. Roma is an actress, so she selected codes. Roma, assessing the risk of material misstatement, I can use that. Then determining materiality, that is ROMA, materiality. Then A means, A is materialities. Then selection and application of accounting policies. When I understand an entity, I can understand what accounting policies they are selecting and why, all these things. Then Roma select, that is select codes. CO, I'll understand special audit consideration. Where are the areas where I need to give more consideration during audit? Where are the areas I need to focus during audit? Then CODE. D means developing expectations for use when performing analytical procedures. Then S, that is sufficiency and appropriateness of audit evidence. Then risk assessment procedure, I told you what are included in risk assessment procedure: inquiry, inspection, observation, analytical procedure. Inquiry, I will talk to the management people and all these things. I ask them a lot of questions. Thereby, I will understand the entity. I'll identify the risks. Then inspection, I'll inspect all the things in the factory, documents, everything. Thereby, I'll understand all the risks. Then observation, I'll go to the factory, go to the office, just walk through there. I'll observe how transactions are happening in that company, how business is done. From there, I will identify what are all the risks that may come in the financial statements. Imagine I went to the office. I saw 10 accountants sitting and doing the work. That is observation. But no one is there to check their work. So obviously there is a chance of mistakes. These people are like very not highly educated, right? So through observation. Then analytical procedure. Analytical procedure means comparison. And many things are there which we learn in chapter number 4. Okay. Then inquiry. Inquiry to all these people. Inquiry to employees, in-house legal counsel, marketing, internal audit personnel, risk management function, information system. It's a question. So employees, MIN main risk info. MIN means employees, inquiry to employees. IN means in-house legal counsel. Main, MA means marketing or sales personnel. Then risk management function, IN means internal audit personnel. Then information system. That is, when you talk with employee, when you ask employees questions, you can identify all these things, how they are recording complex or unusual transactions, all these things. Then when you inquire with in-house legal counsel, when you talk with the legal team inside the company, you will identify what are the matters, what are the litigation cases against the company, whether company is complying with the rules. Because when you talk with these people only, you can identify all these things, right? These are risks. Then when you talk with the marketing team of the company, you can understand what are the marketing strategies, what are the sales trends. Based on that, you can identify the risk. Then when you talk with internal audit personnel, when you talk with risk management function, information system, you'll understand a lot of things. Analytical procedure, we learn it in chapter number 4, detailed. That is much better than learning it here. Then observation and inspection through observation, like I told you, simple. Now is called SA 320, that is materiality. It's a very deep, detailed, in-depth concept which we have discussed in our memorization batch and all these things. But here I'll give you a detailed idea, which is more than enough for you to appear in the examination. Okay. Yes, materiality will go very quick because and once that is done, you can join my Telegram channel, link is there in the description. You can join there, these notes will be there and a lot of other free resources, all these things are there. So materiality, so I'll quickly explain, you rewatch it again if you have a doubt. Okay. So SR 320, that is materiality in planning and planning and audit of financial statements. So guys, understand one thing. Materiality means auditor will set a limit or amount. He will set an amount. All the misstatements, or misstatements means mistakes, all the mistakes that are above this amount are called as material misstatements. All the mistakes that are below this level is called non-material misstatement. So if a financial statement has material misstatements, wherever the word is material misstatement, that is a misstatement that is more than this amount set by the auditor. If a mistake is more than that amount, then we can say financial statements are materially misstated. But financial statement has lot of misstatements, but that are below this amount, or total of that is below this amount, then we can say financial statements don't have material misstatements. Okay, so understand this. Misstatements are divided into two. Misstatement that affects the user's decision taken on the basis of financial statements. That is a user. Imagine I have 10 crore rupee with me. I wanted to invest in any company, Infosys. So I looked at Infosys financial statements, and there it is written profit is, imagine, hypothetically, 10 crore. Okay, I see our profit is 10 crore. I'm happy and I'm invested my money. But later I came to know that the actual profit is only like 8 crore or 9 crore. But if the profit was like 8 crore only, imagine 8 crore. 8 crore, if it was 8 crore, I would have not invested. So 8 crore and 10 crore, 2 crore difference is there, right? So because of that one mistake, actually it is 8 crore, but they showed it as 10 crore. Because of that one mistake, what happened? My decision changed. If it was 8 crore, I would have not invested. But if they showed it as 10 crore, that is why I invested. So here, because of that misstatement of 2 crore, user, my decision changed. If it is that kind of a misstatement, it is called as a material misstatement. Don't worry, I'll explain. Don't worry. Wait. Then misstatements that won't affect the user's decision is called immaterial misstatements. Example, Infosys profit was 10 crore. I invested. But if the actual profit was 9.5 crore, still I would have invested. It's 50 lakh is not a very big difference. But 2 crore is a very big difference, right? So here, any mistakes in that range which is not affecting my decision, that is called immaterial misstatements. Just understand. Misstatements are considered to be material if it affects the user's decision. Okay. Materiality and all these things leave. So materiality, I'll quickly say, auditor has a calculation. You don't have to worry, know too much about calculation and all. Just understand, based on the profit figure or based on the, where is it written? Sometimes based on the profit figure or based on the revenue figure or based on the asset figure, auditor will do a calculation and auditor will get, the detailed thing is a separate concept. So auditor will do all this calculation and he will arrive at a figure based on the profit, revenue, assets. It's auditor or judgment. It's auditor's judgment. Don't worry about all that. Auditor will reach at an amount. And any misstatement that is above that amount are material misstatement, then below that are called immaterial misstatements. Okay. So imagine and how to choose this item, which item auditor is relying. If auditor is taking profit before taxes, then it is called a benchmark in that case. If auditor is taking revenue and revenue at 10% or 5%, whatever is auditor is using as materiality, then it is called, revenue is called as a benchmark. Then if auditor is taking assets, then it is called a benchmark. Don't worry, you will understand. Don't worry. So first of all, benchmark. Materiality, that is that amount I told, it's a percentage of the benchmark. Then performance, we'll discuss later. Imagine a company had a profit of 150 crore. Company had a profit of 1. So the auditor order judgment, which to take in the profit or revenue assets, what to take in the auditor's judgment. So auditor took a profit as the figure, 150 crore. So then he decided a percentage. These are all our auditor order judgment. Don't think how this amount came from, where this came. Don't think. 150 crore is a profit. Auditor in that case planned to rely on the profit. So he took a profit and here he took a 10%. So 10% of the profit, that is 15 crore he put as a materiality amount. This amount of this calculation, all these things is auditor's judgment. Don't worry about that. Okay. So imagine 15 crore. Any misstatement that are above 15 crore are called individually material and is material misstatements. Then any misstatement that is below this is called a immaterial misstatement. Okay. So why is auditor arriving at this kinds of calculation? Because two things. First of all, he need an amount that, like in auditing opinion and all, we have said if financial statement has risk of material misstatement, then we'll give a modified opinion and all these things. Different things are there, right? So yeah. So Auditor will determine this level, that is whether it is 15 crore, 10 crore, whatever the amount it is, and all the items in the financial statements. Imagine all the items in the financial statement, has a lot of items, all the items in the financial statement, in the like sales, purchase, all these items, all the items that are above 15 crore, he will immediately check, because if there is a small mistake, because every item is above 15 crore, so if there is a mistake in that item, then obviously it is material material mistake, because it is above 15 crore. So he will take all the items that are above 15 crore, that are risky items, then he will check all that. Once that is done, okay, no misstatement is there, then he will go below that also. So first of all, to get a priority, which to check first, for that also we are using materiality. So then now auditor will put another thing called a performance materiality. Performance materiality means any level that is below the materiality. It is a level that is below the materiality. That is, imagine I am putting it as 15 crore materiality level. So sometimes there may be a mistake of like 14 crore. Still, that is a big amount, right? So not to miss all those things, he will put a somewhere a smaller amount below that called performance materiality. So once he finished checking all these items that are above this, like 100% checking, detail checking he may do. Once that is done, then he may identify mistake or not mistake, anything. Then once that is done, then he will go to this gap level. Then he will check all the things that are in this level, 9 crore to 15 crore level. Then once that is also done, then if he have time, he will go things below. So understand this, guys. Performance materiality means any misstatement that is falling under this range, any misstatement that is falling under this range, 1 or 2 or 3 or 4 mistakes, any number of mistakes, if the total of that mistake is crossing 15 crore, imagine I got a misstatement of say 13 crore, plus I got a misstatement from here of say 2 crore or like 3 crore. The total of that is crossing 15 crore. It's called material misstatement. Still financial statements are material. This is just a level that is below the, you don't have to overthink and over understand, just understand this much. If you have time, I would have taught you everything, normally the conceptual with all the practical stuff, all this, but YouTube, we don't have that much time, right? So understand this much. Materiality is an amount that is set by the auditor. Any mistake that is above this is called material misstatement. Any mistake that is below it is called immaterial misstatements. So performance materiality is another level that is set by the auditor, that is below the materiality level, just to be on a safe side, like not to miss any smaller misstatements that are just below 15 crore. So he will set another level. That is called performance materiality. So once he identify all the risk as per SA 315, then he check all the items that are in this level, this amount that are above this level, detail checking. Once that is done, then he will go to this level, materiality and performance material. Once that is also done, then he will go to below level, depending upon this time. So any mistake that is above this is 100% material. Any mistake that is below this, if the total of 2 or 3 or 4 mistakes that are below this level, if the total is above this level, still that is material. Okay. Then how this performance materiality and materiality is derived? Materiality is a percentage of benchmark. What is a benchmark? Benchmark is the item auditor takes for materiality. Now we will understand. Depending upon, if it's a new company, startups and all, he will take normally, this is a normal cases, he may take revenue, because initial phases in startups may not be having profit. So he'll take revenue of the startup and revenue out of the percentage. Industry, this is just industry trend. I don't have to study or understand. Revenues 1% he may take as materiality. That is revenue into like 1% he may take as materiality. Or if it's an established company, like a Reliance or all these things, which is profitable for last so many years, then he may take profit in that case. So which benchmark to take, what is a percentage to be applied, like which benchmark to take, what is a percentage, is all auditor's judgment. So there is no fixed rule for this. So understand, don't overthink on this. It's all auditor's judgment. Then that is materiality. Performance materiality means a percentage on the materiality level. That is materiality identified. Imagine you got materiality as 10 crore. So 10 crore into this percentage is called a performance materiality. Just understand. That is performance is 60% of materiality, that is 9 crore. Just understand this much. Then a lot of calculation, all these things are there, which we take in the normal memorization batch. Our exam is like 1 month. If you have time, only second group is there. If you want a clarity, you can go for that batch. Else both the groups is there, no time is there. Just go with the YouTube revision. This much is enough, bro. Because I know very few people teach like this depth. So materiality I have taken everything conceptually. So here you have to understand the meaning, definition and all. Then determination of materiality is a matter of professional judgment. That is when auditor is determining materiality. Auditor is determining, this guy, you know, like Rajinikanth understands Rema. Rema is an actress, Rajinikanth is You understand, Rama? So, understand this. So, determination of materiality is a matter of professional judgment, auditor's judgment. So, when determining this materiality, when doing that calculation, auditor can assume certain things. Because when I'm teaching you, what am I assuming? I'm assuming that you're sitting at your room, you have your book with you, and you're conceptually you're listening. Whatever you are not understanding, you're pausing, going back, understanding. When your brain is getting loads of info, you are pausing. These are all things I'm assuming. Similarly, when auditor is determining materiality, he will assume that the users, who are the users of financial statements, us, public, government, all these people, bankers, the users will know certain things. He will assume users will know certain things. He will assume that users have a reasonable knowledge about the business. Users understand that financial statements are prepared with the levels of materiality. He will understand users recognize the uncertainties in the measurement of amounts, and users will make reasonable economic decisions based on information. That is RK understands REMA, memorization technique. RK, R means, or Ranbir Kapoor understands REMA. If you are from north side, you can understand that. If you are from south side, you can understand Rajinikanth, RK. RK means reasonable knowledge, understands REMA, REMA, done. Then performance materiality, I told everything. Then use of benchmark. Benchmark, factors that may affect the identification of an appropriate benchmark. That is what benchmark to use. I showed you assets, profit, revenue and all these things. So which benchmark to use in which case? Which benchmark to use in which case? What are the factors depending on that? Based on which all factors he will take which benchmark in which case. So first, use reel naturally. Lot of people are watching reels these days. Right? Use it naturally. Use reel naturally. Use means where the attention of users will be focused. Imagine startups. Startups will users. Imagine I have 1 crore rupee with me and I wanted to invest in a startup. Like 1 or 2 years, new startup, like any Zomato, Zepto, all these things. Zomato is like a bit old, but Zepto, new startup, like 4 or 5 years. So Zepto, I want to invest my money in Zepto. I'll never look at the profitability of Zepto because I know Zepto may not be having profit because it's a startup company. Initially, they will spend so much money to capture the market. So company will be at loss. Once market is captured, then they will make profits. Like Jio, initially the 5 years Jio was giving things for free, loss, not profit. Similarly, so startup companies, I will look only at revenue. So where the users are focusing, based on that, auditor will take that for benchmark. For Zepto, auditor will take revenue as a benchmark. Understand? Then he will look the relative volatility of the benchmark. Volatility means changes. What is the changes? Like sales, it changes every year, tuck, 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 it goes high. So he will consider that also. Then elements of financial, like assets, revenue, everything all he'll check. Then nature of the entity, where the entity is at its life cycle. That is it a startup? Is it an established company like Reliance? All these things. So depending upon all these things, he will take a benchmark. Then choose a benchmark. These are the data you will consider for taking a benchmark. Very simple. BAP square. BL, simple, very easy thing. Then materiality for individual. This is also important, but nothing to read and understand. What are the cases in which you will revise materiality? Not that much. Materiality maybe need to be revised as a result of change in circumstances that occurred during the audit. Because before starting the audit, you will make all this materiality. But during audit, you got a bit of information that management is doing a fraud. Imagine while starting the audit, you thought management is a really good guy. So you put the materiality level as a 10 crore. But during the audit, you understood management is actually a fraud guy. So 10 crore, which I may miss a lot of misstatements below that. So I need to put the materiality down. You are revising the materiality because of information you got during audit. Then, if during the audit, actual financial results are likely to be substantially different from the anticipated period and financial results that were used initially to determine materiality. Means, you are appointed before the financial year end. Financial, like before 31st March, you are appointed as auditor for that year, right? So, the actual sale is not known because year end has not happened before your appointment. So, during audit planning, based on the budgeted sales, expected sales or expected profit, based on that you may derive a materiality. Imagine the company, and you are expecting the total sale for the year is 10 crore. Based on that, you determine the materiality. That is 10 crore into 1%. But actually year end sales was only 7 crore. So now you need to revise materiality. That is this simple. If auditor concludes lower materiality is better, depending on his judgment, he is thinking lower materiality is better. Reduce documenting materiality, all these things. Then internal control, easy peasy topic. What do you mean by actually internal control? It is basically just bookish knowledge leave. I'll tell you what actually is. It is either a system, like a computer system or something, or it can be a person also. anything that is set up by the company to prevent a fraud or error, like to protect its asset, to prevent any fraud or error or any problems in the transactions, balance sheet, anything. For example, in your home, you will keep CCTV, right? Why? To protect your home from like these thieves, right? Thieves or other gundas and all these people. Similarly, inside the company, warehouse is there, in the warehouse CCTV is there to protect the goods from not being stolen by the employees or anyone. Similarly, imagine a company has 3, 4, 5, 6, 7 accountants. These kinds of accountants are there. There will be a finance manager who is on top of him. He will check all the journal entries and all these entries posted by all these accountants every day or every week. Why is he doing that? Because he is checking whether there are any mistakes. So he is protecting the company, protecting the company's data from any fraud or an error. Fraud or error. These, anything like that is called as internal control. If you have a 10 lakh worth of a necklace or a gold, you will keep it in the bank locker or inside the room. You will keep it in a locker. Lock the key. That key and that lock is like internal control, which you are protecting your assets. Similarly, anything in the business like that, it is called internal control. A company kept a fingerprint access for the employees, or employees who have not employees, say when you are going for a coaching, the institute puts a fingerprint access or a face ID there, or those who have paid the fees can only get in. So that is an internal control. Okay, so preventing fraud for that company. So anything like that, internal control. So benefits and all this irrelevant stuff. We'll only focus on the important areas. We don't have to waste too much time, because your time is precious, my time is precious. But not too quick also. I can do this revision in 30 minutes also, but that won't be beneficial, because this is a memorization marathon revision, right? So limitation of internal control. First is, what are the limitations? Rahul colluded with Judge Lissy. Rahul is a guy and Lissy is a judge, like a very big court judge. Both of them colluded. Both of them together end up into doing any fraud or something. This for hypothetical exam purpose only, right? Judge we should not say like that, but for this, Rahul colluded with the Judge Lissy is a mnemonic. Rahul. That is reasonable. That is this one. Internal control can only provide a reasonable assurance. That is, even though you put the best internal control, best CCTV, still a fraud can happen. Someone can hack that. Simple. It can only provide a reasonable assurance. Rahul, HU. Human judgment in decision making. That is, human judgment may become faulty and breakdowns in internal control can occur because of human errors. Human errors, breakdown can internal control can happen. Then Rahul, L means lack of understanding the purpose. Lack of understanding the purpose means, like this one topic also I'll explain. Don't worry, it's an important area. Understand. Imagine inside a company. Company set up a system. If there is any error or a fraud, like any mistake in the journal entries or any mistake in sales assets, anything, this software system will automatically identify these mistakes and it will give a printout of all this mistake. Hypothetical understanding. Imagine it gives this kind of a hypothetical mistake, a list of all these mistakes, and this list is given to the finance manager. But finance manager is a person who has done dummy articleship in a CA, and he is not like a educated guy. He is educated but not practical knowledge. So when he get this report, he like, what should I do with this? Because he has done dummy articleship. You don't know what is wrong with these entries or anything. So he is not understanding the purpose of that. The company set up an internal control system to protect all the, like identify all the issues and all this and give a report. And that report is checked by this person. But this person don't know the purpose of what that is. That is lack of understanding the purpose. What to do with this, you don't know. That is called lack of understanding the purpose. That is, you put an internal control, but you are not able to understand, like not you, company put an internal control, but the people who is handling that is not able to understand the purpose of it. Individual responsible for reviewing that information does not understand the purpose and fail to take the action. He don't know what to do. That's it. You're understanding, getting the concept, right? Yeah, that's it. Then give it a thumbs up and comment down what you're feeling. Then collusion among people. You put a really good internal control. You put CCTV, best internal control, best CCTV, 1 crore CCTV. But what happened? A person who wanted to do fraud, employee, he became friends with the CCTV operator. He's also an employee. So both of them together colluded, and that guy turned off the CCTV for 1 minute. In that 1 minute, this guy got in and stole the assets of the company. So collusion among people can override internal control. Best internal control, even if it is there, still this can happen. Then judgments by the management. Similarly, management may make a lot of judgments on the nature and extent of controls and the nature and extent of risk it chooses to assume. Management judgments by management in putting internal control. Management thought, okay, this internal control would prevent this kind of fraud, but that judgment failed. That internal control was not able to. That's it, called this one. Then limitation. So Rahul, okay, Rahul you understood, R-A-H-U, then L. Rahul colluded with the Judge Lisi, L-I-S-E. Limitation in case of small entities, Lisi, L-I-S-E. Perfect mnemonic, right? You will never forget. So smaller entities often have fewer employees, due to which segregation of duties is not practically possible. That is, in smaller companies, this internal control, so much things will not be there. Everything will be performed by one person itself sometimes. Startups and all, very less number of employees will be there. They may be doing all the things by themselves. Bigger companies, you have proper people for proper work. So since in smaller companies, since very few people have the responsibility of multiple things, there is always a chance of, that's a limitation of internal control. Then what are the components of internal control? Hope you got the mnemonic here, right? Then what are the different components of internal control? First is control environment. I'm giving you the concept because we cannot sit and explain everything deeply, right? So that's a separate case, but still understand control environment. You will understand everything, pinpoint, guaranteed. So control environment means, imagine, let's take a school. In a school, the school has really good internal controls. Just understand, super CCTV is there, everything is there. Then fees from students, to vouch that, lot of other peoples are there, lot of registers, set of perfect internal controls are there. But one problem is there. The school principal is not strict. When the principal is not strict, teachers will also not be strict. Then the other staff will also not be strict. So even if you have a very good internal control, but if the control environment, inside that environment of the school, principal is not strict, so everyone is not strict. So people may not follow that internal controls. Imagine a company, lot of really good internal controls are there. But if the management is not strict in following this control, management has told the employees, yeah, you follow if whenever you want. If it is like that, people will not follow these internal controls. So that is what we call a control environment. Control environment means the environment of that company, the culture of that company. The company is having a really good strict culture and really good internal controls. Internal controls is a separate thing. Control environment means that environment in which internal control is there. If control environment is good, then internal controls obviously will be better. If in really good internal controls you have, but the control environment is bad, obviously there is no use of that internal control. People will still do fraud. That is called control environment. Then you will see obtaining an understanding of how good the company's control environment is. What is the culture? What is the attitude of people towards the company? In Byju's and all, in the last times, they were not paying salary to the employees. So employees were like angry against the management. So employees will itself override all these internal controls and do fraud. So control environment is bad there. Okay, but in Tata, salary and everything is paid on time. So the control environment is good. So and companies also, then when employees get money and really good work atmosphere, they will blindly follow what management says. So management has, auditor will check whether management has created and maintained a culture of honesty and ethical behavior and all these things. Then what is the strength in the control environment element and all these things. Then this is included in control environment, governance and management function, attitude, awareness and actions of TCWG and management. Then control environment sets the tone of the organization. That's the tone. If principal is strict, entire school will be strict. If principal is liberal, entire school will be liberal. Like that. Then what are the elements of control environment? Like this is a really good mnemonic. What are the elements of control environment? Means what all things are included in the control environment. I told you strict control environment, bad control environment. What is included in that? First of all, understand COCO, PM, Osama. COCO, PM, Osama. COCO. COCO means communication and enforcement of integrity and ethical values. Communication and enforcement of integrity and ethical values. It means the effectiveness of a control cannot rise above the integrity and ethical values of the people who create and administer and monitor them. That is communication and enforcement of integrity and ethical values. First, the company will tell to the employees, this is our internal control, this is our control environment, follow that. That is communicate that first. First company, when you join in a company, the HR will tell you, these are the rules of the company, this is how you need to follow the integrity and all these things. They will tell you everything. First, I will communicate. Once they communicate, imagine HR told you, okay, you have to come to the office every day at sharp 9 o'clock, punch in at 9, then leave only at 5. He'll say everything. First of all, communication. Once it is communicated, next day onwards, HR will check whether you are coming. If you are coming late, he will enforce you. He will call and scold you. Do it correctly. He'll say like that. That is, first of all, the communication and then the enforcement of integrity and ethical values. Inside the company, what are the ethical values that business need? If you are into Tata, Taj Hotels, their ethics is that you have to be that good to customers. That is their ethics. So first of all, they will tell all these ethics to you. Then they will enforce you, the management. Then here is written, this effectiveness of a control cannot rise above the integrity and ethical value of the people who created this. If a management is a fraud, if they are putting really good control, still it will not work well because management itself is doing the fraud. Then what is the point in putting controls? But if that is what is written here, if the effectiveness of control cannot rise above the integrity and value of people who created it. Who created it? What is their integrity? If their integrity is good, control will be good. If their integrity is bad, what is the point in having control? Then commitment to competence. That is, when a company is hiring someone and all these things, they will check what is the competence level required for a particular job. For a finance manager, what is the competence level? What are the skills required? He should be a CA, whatever it is, experience 5 years, all these things. Then participation by the TCWG. That is, attributes of TCWG are the independent from the management, their experience, stature, everything. Then what is management's philosophy and operating style? If you take a company like Reliance, they are like the dominant guys, or Baiju initial stage. They were dominant. They were buying all their competitors. That is their operating style. Their philosophy is buy every competitor and go. So what is management attitude and action towards financial reporting? Are the management itself having this in mind? Okay, we need to have a really good financial statements. We need to properly pay tax. Does the management have that kind of an attitude? Or is their attitude like, financial statements and all these things, it's just a fake thing? Is their attitude is like that? Then all these things. Then what is the management's approach towards business risk? Are the management like highly risk-taking people or low risk-taking? All this. Then what is the organization sector? That is, who is at the top, bottom and middle level of organization. Then assignment of authority and responsibility. How authority and responsibility for operating activities are assigned. Who has the responsibility for what in authority and responsibility? Who is responsible for what in the organization? What are the HR policies? Like what are the policies regarding recruitment, orientation, training of employees, all these things. So here it is, COCO PM or communication and enforcement of integrity and ethical and values, commitment to competence, P, participation by management, M means management philosophy, then OSAMA, organization structure, OSAMA, simple. Then next is existence of a satisfactory control environment is not an absolute deterrent to fraud. That means, it simply means that even if you have the best internal controls, still a chance of fraud is there. That is called this one. So you cannot say that since you have a really good internal control, the fraud will not occur. You cannot say like that. That is this point entire. Then in front of them, very easy points. Like I'll focus on the things which you cannot read and understand by yourself. Wherever you need the faculty itself, I'll focus there more rather than just focusing everywhere. These are all simple things. What are the control activities? Control activities like PIPs, performance review, information processing, physical control, segregation, nothing. Then monitoring of internal controls. That is, controls will be there. Lot of internal controls will be there in the company. I know your mind is going quick. Pause it, breathe, then listen. Okay, because I cannot pause because we have to keep the video, save time, right? So monitoring of controls. It simply means, save time means for you, not for me. Monitoring of controls. Obtaining an understanding of the activities that the entity uses to monitor the internal control. That is, company has CCTV. Who is monitoring that? A CCTV operator is there. Similarly, company has lot of other internal controls. There will be someone or some process to check whether these controls are operating effectively. Is it functioning good? There will be someone to monitor that, check that. That is called monitoring. So, monitoring of control is a process to assess the effectiveness of control, to check whether control is working good, assess the effectiveness on timely basis and take remedial action. All these are very easy. Then management accomplishes monitoring of control through ongoing activities or separate evaluation or a combination of two. It simply means management will check whether the controls are working fine. They have two types of checking. Either they will check normal in a routine basis. Company is working, employees are all this thing, daily operations are happening. Along with that, management will come and check whether controls are working. Someone, imagine one other guy is coming and the company is running its operations. Daily customers are coming, money is coming, all these things are happening. But along with that daily operations, this internal controls checking is also done by someone else. That is one goal. Second, separate evaluations. That is, he'll pause one thing like CCTV. He'll pause it and then he will evaluate how the things are working. Only for CCTV. Separator they may evaluate. So, or a combination of two things together can also happen. Okay. Like sometimes they may go along with ongoing basis, and along with that separate evaluation may also happen. Then using information from communication with external parties such as customer complaints and regular comments. That is, imagine Flipkart. Flipkart has a really good internal control system. Understand, if I applied for a return, I bought a product and I'm applying for a return, what happens? The moment that guy picks it up from me, I will get the refund in the next 2 hours. Imagine, in my wallet, I'll get the refund in 2 hours. That is their internal control system. The moment it is gone out, immediately I'll get the refund. But that is their system. Imagine the delivery guy took the return from me today. I have not got the return for not got the money for the next 2 days. So what will happen? I will message Flipkart customer service. Bro, I have not received the money. So based on my complaint, management will understand, okay, this internal control system is not working. That is, they set a system that the moment the goods is handed over, money should be credited. The system they have set, software they have set it, but I have not received the money. So I complained. So based on my complaint, management is understanding the system is not working well. That is this point. Okay. Then these are all things you have to study. Okay, are controls relevant to audit? Yes. What are the controls based on that? Everything. Then easy. Then very easy points you can understand by yourself. This is very important, but self-readly, because self-readly you can easily understand. In exercising judgment as to which risks are significant, auditor has to assess this risk. That is, risk of fraud is always significant. Like, lot of risk is there in the company. Which is the significant risk? Which is more important? To identify that, auditor will, these things he will consider to identify that. First, if it's a risk of fraud, it's obviously a significant risk. If the risk is related to recent significant economic, accounting or other developments, recent changes happened, new rule came in, new Indian government policy, new export policy came in. Because of that, any risk is there for company, then it's a significant risk. Like that, if the transactions are complex, very simple points. Then identifying significant risk, significant non-routine transactions or judgmental matters. Non-routine transaction means transaction that does not happen in a routine basis. Example, normal sales and all these things happening, but Jio bought Hotstar. So for Jio, normally lot of sales is happening. Customers are buying their SIM, they're recharging all these things, then all the other things. But that is a routine activity. But suddenly Jio bought a Hotstar. So that only, these kinds of buying only happens once in a while, right? So these are non-routine transactions. So significant non-routine transactions or judgmental matters. Any risk that is significant risk often related to these kinds of things. That means when Jio is buying Hotstar, they may do some fraud or error or some may happen inside that. So it's a non-routine transaction, but risk relating from that is significant risk. Then judgmental matters. Any cases where management has made a judgment. Imagine last 3-4 years company was following straight line method of depreciation or LIFO for inventory valuation. Current year management changed that. It's based on management's judgment. So there, it's a judgmental matter. So there a chance of a fraud or high, it's a significant risk. So I hope you understand. Non-routine transactions are transactions that are unusual due to their size or nature, or they occur infrequently. Once in a while only it will occur, or size or nature. Like imagine normally you take a company like Flipkart. Normal Flipkart or a sale value is anywhere from 1,000 rupees to or 1 lakh rupee, iPhone, Mac, computer, all these things. But suddenly in certain transaction there are 20 lakh rupees sales is happening. It's a non-routine transaction. Normally these kinds of things will not come. Once in a while, once in a month, or sometimes these kinds of bigger sales or bigger items will come. So those kinds of things auditor has to check deeply because there may be significant risks. High chance of fraud or error. Then judgmental matters. Development of accounting estimate. Selecting the accounting estimates, like provision for depreciation, what amount should be put, or provision for doubtful debts, what amount of provision should be put. It's management or a judgment. Okay, so there a lot of these kinds of things can happen. It's very easy. Then risk of material misstatement may be greater for significant non-routine transactions that is arising from greater management intervention. Management is intervening. In these kinds of cases, risk of greater for significant non-routine transaction. Then greater manual intervention for data collection. If it is arising from complex calculations or accounting principles, then the nature of non-routine transaction. Based on this, you will decide whether the risk is high or not. Then here also same thing. Then evaluation of system of internal control. Very easy. Benefits of evaluating system of internal control. Eric's internal auditing technique is weak. Eric's, that is, review of internal control will enable the auditor to know these things. Errors and frauds that are likely to be located. Simple. Eric, ER. IC. Adequate of internal control system. ICS. Internal control system. Internal auditing technique. Effective internal auditing department is operating. This is a benefit of evaluating internal control. When you check these internal controls, you will understand, you'll get these kinds of benefits. What is the first benefit? You will identify errors and frauds. Second benefit, you will know whether company's internal control system is good, whether internal control system is adequate and is operating perfectly. Then RICS, internal auditing, whether a company's internal audit department is operating. You will understand when you check internal controls. Then internal auditing technique. Where is the technique? What audit technique and appropriate audit procedures in given, what should be the appropriate audit technique and procedure in the given circumstances. When I check internal control, I will understand, okay, which procedure to use in which case, all these things. Then Eric's internal auditing technique, internal auditing, then technique, auditing technique. So same thing, auditing technique is weak. Weak means areas where the internal controls are weak. CCTV, warehouse CCTV is weak. So I'll understand, when I check all the internal controls, I'll understand where internal controls are weak, which area it is weak. All the then normally parlay G like that, safe G, safeguard. That is whether the controls adequately safeguard the assets, whether company's assets are protected by proper internal controls. I'll understand all these things when I evaluate internal control. Then what are the methods of evaluating? 4 methods are there. Narrative records, a written description, a complete and exhaustive description of the system by the auditor. Auditor will study, understand the internal controls. These are methods for evaluating internal control. That is, auditor wanted to check the internal controls. What test? He wanted to test whether all the controls are working perfectly. What are the methods he may use for such evaluation? Evaluation can methods he may use. First is narrative record. He will understand the internal controls and he will write about all the internal controls in detail. Narrative, written record. Written record he may put. That is a complete and exhaustive description of the system. Every internal control he will write description found in operation by the auditor. Actual testing and observation are necessary before such a record can be developed. He will test all the internal controls, then what he understood he will write it. That is narrative record. It is only suitable to small businesses, because large business, lot of internal controls will be there, it will not be suitable. Disadvantages: to comprehend the system is difficult. To understand the system and write about that, that is comprehend. Writing is very difficult. Then identify the weakness and gap is difficult. Then incorporate changes, because you wrote a very 50 pages of internal control record. And if you want to change anything, you cannot cut and write. That is called incorporate changing is difficult. Narrative record. Checklist means you have articles. I'm an auditor and I wanted to know about internal control. So what I will do, I will prepare a question list, like a list, like testing, like go to the factory, check the internal controls over the factory, check the internal controls over the purchases. Like that, I'll make a lot of checklists, things to be done to test the internal control. How to test the internal control? I'll write everything. It's a set of procedures. Then I'll give it to my article. Article will go to the company. He will do all these procedures and test all the internal controls. When he finishes, he will tick like that. That is called a checklist. Here it is given by auditor to article. Okay. Checklist. A series of instructions or questions which a member of the auditing staff must follow and answer. When he completes this instruction, he initials a space against his answer can be yes, no, or not applicable. Like this. Are tenders called before placing order? Are purchase made on the basis of written order? These are all things which auditor wanted to know to test his internal control. These are things which he need to do in his audit procedure. He will write all these things, give it to article. Article will go to the company, check all these things. Once he finishes this, he will put yes or no. Like that he will do. And article will give it back to the auditor. Now auditor will read it and auditor can evaluate the internal control, because he will write all the questions which he needed to get answers. So when he read that, he will know whether internal control is good. Then internal control questionnaire. Auditor will prepare a questionnaire about all his doubts, all things which he need to know about internal controls, and he will give it to the management here. Here auditor is giving to management, and management will answer all those things and give it back to the auditor. So now auditor can read that and understand and evaluate the control. Then next is the flow chart, a written like a graphical representation, simple. Then this is also testing internal controls through inspection, inquiry, performance. It's very easy. Then next, what is included in an automated environment? So what is an automated environment and all the questions related to automated environment? Because this is one chapter which I have seen. This is one topic in the chapter 3, which I have seen lot of CA inter students struggling. People try to memorize this without understanding and things will not be there in your brain. It won't retain. That is a problem with this topic. So in this video, we will decode everything line by line in this chapter, in this topic, so that you will understand everything properly. Then you will be able to memorize it. And I will also give you memorization techniques also. So this time you are investing in this video will be worth. And please don't learn automated environment without understanding everything. You will not be able to retain. So consider this time as an investment for you. So actually, what is an automated environment? Automated environment means it is basically a business environment. Let's take, for example, I'll explain through example. Let's take Amazon US, not Amazon India, Amazon US. The moment a customer places an order, immediately that order will go to the warehouse. The robot automatically, the AI systems automatically process the order. Immediately you will get the bill of the order that you placed, and then immediately that order will go to the warehouse. Immediately the perpetual inventory system will get updated. One stock will be reduced. Then the robots in US and all robots are there. They may pack all these things, and then immediately it is going to get delivered. So here what is actually happening? Here everything is automated. No human is involved there. Machine is doing all these things. That is, softwares and systems and processes are doing that. And nowadays, if you see Zepto or Blinkit or Flipkart or Amazon India, around 50 to 60% of their processes are automated. So they don't need a human to do a lot of tasks. So when you are auditing, going to audit such kind of a company, you are going to audit Blinkit, Zepto, Zomato, Flipkart, all this, where everything is automated, like at least 50-60% is automated, then you need to understand about the automated environment, the environment of Amazon, how things are working there. So now you got a clarity what I mean by automated environment. An environment in a business which most of the things are done by machines. That is automated environment. So what are the key features of automated environment? The fundamental principle of an automated environment is that the ability to carry out its business with less manual intervention. Okay, so these are like very easy point. Like enable faster business operation, accuracy in data processing, ability to process a large volume of data. This is very simple things. But the core, the tougher area comes when this one, right? Types of controls in an automated environment. This is where I'm pretty sure at least 70% of CA students don't understand what these three things are. And they're just simply memorizing it. So when a tough question comes or an MCQ comes, they are gone. So just I will explain the tougher areas now. This is one question which can come, which is very, very, very important, I would say. That is, what are the risks arising from use of IT systems? Company is here, I told you, in automated environment, company is basically using IT, softwares they are using, not humans. So what are the risks that will be applicable for the company? So what are the risks because IT, like you would have read this news, a robot was there in US which killed a labor in the warehouse automatically because it was wrongly programmed. So many kinds of risks are there. So we'll do that. So this is the most easiest mnemonic. This scene you would know that you would have seen Kaidi movie. This is Delhi. Delhi is there, and this is Access Scooter. Then this is FC Barcelona Football Club. So this is the thing. Delhi, DI, Directed Data Changes. It means in an automated environment, everything happens through software. Sometimes any person in the company can alter the software. He can directly access software and may change it if he knows the password. So that is a risk. Like in Indian movie, you would have seen when one chip is wrongly inserted, the entire robot gets malfunctioned. Similarly, in softwares, anything, if a code is changed, everything is gone. So direct data changes can come. Then L, lack of adequate segregation of duty, because maybe one software may be performing so many tasks. So when you are relying on one software for so many things, then it's a problem. That is, segregation of duty is not there. Then loss of data. Imagine a hacker comes in and the entire data may be lost. That is a risk of using IT system for the company. Then inaccurate processing of data or processing inaccurate data. That is another problem. Wrongly processing the data. So Delhi, DILLI, Delhi access. Access square is there. So two access is there. Unauthorized access to the data. Sometimes any person with the password can also enter the system and alter the data. That is, unauthorized access will be there. Then excessive access to the data. An employee in the packing or an employee in the accounting department, he is given access to the finance department's data also. That is, excessive access may be there because everything is IT. Just the password is needed for you to get in. Then failure to make necessary changes to systems and programs. If the systems and program software is not properly updated, it is a risk. A virus attack can come if the software is not updated. That is why your phone you are updating, right? So failure to make necessary changes to systems and programs, that is a risk. It's a problem. Then unauthorized changes to systems and programs. Sometimes any person can enter and change the code, change the systems or the code itself he may change. So that is also a problem. So these are the risks that are coming from using IT systems. Hope you understood. Now let's focus on what is the impact of this IT related risk. Like I told you, these are the risks that may come for the company. And since the risk is there for the company, for auditor also same risk is applicable because we are going to audit the company. So these are the risks that may come from using automated systems. So because of that risk, what is the impact for auditing? In auditing, what is the impact? This is a risk arising for company, but when we are doing the audit, what is the impact for us? If IT risk is not mitigated, that is, if these risks are not mitigated, that is, software is properly updated, then proper access is only given to proper person, like that, if the risk is not mitigated, it could have an impact on audit in different ways. Wait, just understand and move forward. Now I made you understood this and gave you the mnemonic. Similarly, everything we will do. Impact on substantive checking. Substantive checking means, I imagine I wanted to check the sales of Amazon or sales of Flipkart. So financial statements, the sale figure will be there, but I needed more data. So I asked the management. Management will print the data from the automated system, because nobody is sitting there and doing the manual journal entry. Nobody is doing that. And physical invoices, nothing is there. Everything is software based. Everything is automated. So if I want the sales register, it may also be automated. They may give me print out a PDF file of all their sales. That is coming from the software. Automated it is coming. So if that system which is generating the sales invoice or system that is accounting the sales invoice, if that system is not updated or system has a problem, then obviously that system, the sales data may become unreliable, because system problem if there, then sales data may be wrongly they may post some entries. So that is a problem. Impact on substantive checking. That is, substantive checking means when I'm doing the detailed checking, vouching and all these things, I'm taking the data from the system, but that system itself is not good. So obviously, how can I relay the data? I cannot trust that data which is given by a bad system. So that is a very big problem. So if IT risk is not mitigated, system will be bad and the data given from the system will also be bad. So I cannot rely on that. That is impact on substantive checking. Hope you are getting clarity. Like understand, like audit clarity first understand, then memorize. Then non-reliance of data, because I cannot rely on the data obtained from the system. In such a case, all information, data and reports would have to be tested thoroughly. Now I have to take all the data and test them one by one. It is a very big task for me, right? Yeah. Then it could lead to increased substantive checking. That is detailed checking. I need to go now and do the detailed checking. Sampling basis alone, I cannot go because I cannot trust the data. So every sale one by one, I have to check. That is a problem. So time, cost, all these things will improve. So first problem to me is impact on substantive checking. Next is impact on controls, because it can lead to non-reliance on automated controls, system calculations and accounting procedures built into applications. That is, inside the applications there are internal controls, which you will understand when we do this. Okay, just understand this much. Once this point is done, you will understand that it can lead to non-reliance on automated controls. In the IT system, there will be internal controls over them, which are also automated. Those controls also we cannot rely, because system problem is there. We cannot rely on them because that is a problem. If system has a problem, how can we trust that system? That is the thing they have mentioned here. System calculations may be wrong. Accounting procedures may be wrong. Built into applications may get wrong. So these are the problem. Impact on controls. We cannot trust the internal controls also. So we have to impact on substantive checking. We have to do detailed checking because of IT risk, and we cannot trust the internal controls also. Then impact on reporting. Reporting means my audit report, like what is impact? Due to regulatory requirements in respect of internal financial controls, in case of company, it may lead to modification of auditor's report, because I am unable to check everything deeply because IT system weak and the data given to me is bad. So I am unable to check the sales and I am unable to rely on internal controls also. So how can I do the audit properly? So I may not get audit evidence on lot of things. So I may modify my report. So connect these points together and then learn. Now you understood these 3 points, what they are. Any doubt is there, write in the comment box, I will explain, or you can text me personally. I want you to study this chapter. The next is types of controls in automated environment. My guarantee is that when you study and understand this, you will understand everything. Because this is the area where students suffers. So first thing is general IT control, application control, IT dependent control. What are these 3 things? Actually, what are they? Understand. Number 1, your mobile. If you take your mobile, this is your mobile phone. In your mobile phone, you will have a lock, right? How will a lock will come? Oh my god, lock is not coming. Face ID, let it go. I'll show it to you. This kind of a phone lock will be there for you. This phone lock is what we call a general IT control. And when you open this phone lock, you enter the password and open the phone lock. There are applications inside that, Instagram, WhatsApp, all these things. You will have a lock for the Instagram, WhatsApp, all these applications. That is called application control. Because general control means the entire phone, for the entire phone, that control is applicable. One main lock. Once you open the main lock, you can take each applications, and each applications will also have a control. So phone lock is what we call a general IT. This is just example to understand. I will explain deeply. Phone lock is what we call a general IT control, and the app lock is what we call an application control. Hope you got the clarity. IT dependent, I will explain. So general IT controls. So imagine a company with everything is automated, but still there are softwares, everything there. People are there, but computer system, everything is automated. Just understand. So lot of departments are there in a company, but all the departments has a computer and everything is software, everything is there. But every computer will have a password, and that may be common for every computer. Only those employees with proper their login ID and password can access the system. Be it any system inside the company, the original employees of that company who has the login ID and password can only access that. No one else can do that. So that is a control for the entire company. One control this company has set for the entire company, it is called the general IT control. So for accessing the computer itself, the employees should have their login ID and password. Only the people with this can enter the system. So once they enter the system, different applications will be there inside, the softwares will be there. So there will be controls inside the software. Imagine an employee entered the system, opened the computer and with the password, general IT control over. Now application control scheme. Now he is opening the billing software. Imagine billing software. In the billing software, inside that there may be a lot of controls. Imagine that guy is typing a bill. In the bill, if customer name is not entered, or amount is not entered, or GST is not entered properly, then you cannot print the bill. That is a level of control which would be kept inside that software. Inside that application, they have kept a control, and that control will prevent a wrong bill from coming out. That is, a bill without the name of the customer cannot be printed. If a customer name is not there and you're trying to put the print, it will show, no, you cannot print, put the customer name first. You would have seen in applications, like whenever you create a Facebook account or an Instagram account, in the email ID section, if you don't give anything, a star will be there. Mandatory, you will not be able to do that. That is application control, a control inside that. Okay, hope you understood. So first is general IT control. These are the policies and procedures that relate to many applications. These policies, these controls will control all the applications. Main control, if you open this lock only, you can enter into the system, right? So that is general IT control. These has policies and procedures. Not only lock, all the other things are there that may relate to many applications, and it support the effective functioning of application controls. Okay, it will have controls. Commonly include controls over the following. First is data center and network operations. The entire company's IT data, everything will be stored in a server inside the company. So imagine if that server, someone hacks the server or a fire occurred in the server, what will happen? The entire company's data is gone. So to prevent that, this general IT control, this thing will have a control over the data center and network operations. The data center room, the server room, they may put an AC so that it will not heat up and burn. They may put some fire extinguisher there so that if anything happens, fire extinguisher you can take and put. They may put some softwares or something there. If any problem is there in the data center, immediately warning may come. They may put some sort of softwares there. Or they may appoint a physical person there to check whether server is working properly or not. So all these things are basically controls to protect the data center. That is what we call general IT control. General IT controls are controls to protect the data center and then protect the network operations. The LAN, cable, wire, all this connection is going, that area may be there inside the company. They will have a control to check whether everything of this is proper. Else that will also be an issue. Then program change. So a lot of softwares and all these things inside the company will be there. Programs and all these things. If someone changes that program, or actually a program is actually updated, so there will be a control to make sure that this program is working fine. Program is updated, so there will be internal control to check whether this updated program is also working fine as the previous program. When you update the phone software, you will check, right, whether it is working like previously at least. That basically you are checking. Similarly, in a company, a software or person is checking. That is general IT control. Then access security, I'll explain what these things are. So first understand controls over the data center and network operations. What it actually is. It ensures that production systems are processed to meet the financial reporting objectives. Production systems in a software company like Infosys or TCS. What is their production system? In a manufacturing company, they may have machines and all these things. But in a software company, the softwares that they work in, that is our production system. From there, the software production is happening. In a manufacturing company, plant and machinery is their production system. So this controls, this general IT controls will ensure that these production systems in companies are properly working to meet the financial reporting objectives. That is, production systems are working to meet the financial reporting objectives. Okay. Then it will include activities will be inside this, such as overall management of computer operation. Whether the computer, everything is working fine. There will be controls, internal controls to check that. That is called controls over. General IT controls will have controls over data center and network operation. They may have controls to check whether every computer is working fine, no computer has any problem, no computer has a virus attack. All these things will be checked by the general IT control. Then preparing, scheduling and executing of batch jobs, all the jobs properly, batch jobs, everything. They will have controls to check whether the proper preparation, scheduling and execution of batch jobs are properly done. Monitoring, storage and retention of backups. All the data that is properly backed up, they will make sure every day the data is properly backed up. This controls this. Sometimes it can be a person, sometimes it can be software, which may check whether data backup is done properly, whether it is stored properly, whether we have proper safety security for that, whether we have 2 copies of that. All these things will be checked. Then performance monitoring of operating systems and all these things. Then next one is called a program change. Program change means it ensures that modified systems continue to meet financial reporting objectives. Modified system. A software was there and now the software is updated. So it is a modified system. The system changed, modified. So this modified system, modified software is also working fine. When you update iOS 10 to iOS 11, imagine. So when the update is over, you will check whether iOS 11 is working properly as iOS 10, Android system or Apple system. That is called, there will be an internal control to check whether the newly updated system, modified system is working properly. Modified system is meeting financial reporting objectives. It includes activities such as change management process. That is, it's not management process, it's change management. Change, when a change happened, change management process may be there. Then recording, managing and tracking change request. If someone wants to change something, then other change request will be there. So recording that, properly managing that and tracking that, whether the changes actually happened. Then making and testing the changes. So this general IT controls will have internal control. They will have controls over program change, whether a modified system is properly meeting its objectives. Then access security. Access security means no unauthorized person has access to the IT system. Computer's IT system will be there. Unauthorized persons don't have any access. So this general IT control will make sure that no person who is unauthorized will have an access to IT system. Only the authorized people with the proper ID, everything can enter. Imagine they put a general IT control. They put a fingerprint scanner. Password they may replicate, copy, but fingerprint it is very hard. Or retina scanner, eye. So, and retina scanner before the computer. The original employee, when he comes in, when he scans his eye, then only he can open the computer. That is a password. So, access security, access to the computer is properly secured. That is, that retina scanner, this thing is called a general IT control. It is controlling the security access. Then access to the programs and data, all the software's data and all these things is authenticated and authorized to meet financial reporting objectives. This general IT control will make sure that access to programs is properly authenticated and properly authorized. Then application system acquisition, development and maintenance. If company is generating an application system, like softwares or anything, adoda acquisition, its development, its maintenance, general IT controls will have controls to make sure that application system acquisition is proper, adoda development is proper, adoda maintenance is proper. So that is to ensure that systems are properly developed, configured and implemented to meet financial reporting objectives. That is, they will have proper systems to check that. They will have controls to make sure that all the softwares are properly developed in the right way without any, like all the coding, everything is proper, no fake coding, no fraud coding, nothing is there. They will have systems to ensure that, controls to make sure these things are not happening. Then what is application controls? Like I told you, controls lock inside the application, any control inside the application. If you open imagine Tally software you would have used. In Tally, when you're putting some journal entry, if you put the debit side and if you not putting the credit side, you will not be able to save that entry, because it will say put the credit side, then only you can save. Saving will not be done. Why? Because it is a control, it is a thing inside that application which is preventing you from doing that. That is what we call controls inside the application controls. It can be either automated or manual, that operate at a business process level. Okay. Example, checking the validation of input data, sequence number of checks, a mandatory field. Like this in Tally, all input data are properly validated before saving the entry. Example, proper if invoice number is not in the order, you are putting invoice number 1, 2, 3, like now, and you are now till 8 you have put, and next entry if you are putting 10 without 9, immediately it will show up. Your invoice number is wrong, it will not be saved. So that is a control inside that application. That is application control. Then IT dependent control, it is very easy. It simply means that IT dependent controls are basically manual controls that make use of some form of data or report produced by the IT system. Imagine there is a finance manager inside the company. So Amazon or these kinds of companies where everything is automated. So automatically the software records the journal entries, records the ledger entry, automatically software will make the report and give it to the finance manager. Finance manager don't have to do anything. Software itself, based on the journal entries, they will make the report and give to you. Monthly report, a monthly performance analysis report, everything software will make and give. But still, the data, the report is given by the software. And this finance manager will again just recheck whether the report is correct. So he is a manual person. He is getting the data from the IT system. So he is dependent on IT. IT gives him the data, and now he is checking whether that data is correct. That is called IT dependent control. That person is called IT dependent control because he is dependent on IT for data. Okay, then this all things are easy. Auditor has to check the design and effectiveness of such a controls. That controls design, everything is proper, the auditor has to check. General IT versus control versus application control, very easy. Both of them are interrelated. General IT controls are needed to support the functioning of application controls, very easy. Then what are the testing methods in automated environment? How an auditor will check the automated environment? How will he test it? Simple. 4 types of audit test that should be used. That is inquiry, observation, inspection, reperformance. He may inquire, he may ask the manager, what is your automated system, how it is functioning. Like that, he may ask questions and get the information. He may observe, he may go to that factory one day and sit and see how automated system is processing everything, how the properly packaging is done, how invoices are generated, how the journal entries are made, all these things he will sit and observe. Then inspect, he may inspect all these things. Then he may reperform whatever work has been done by automated environment. Example, when a customer places the order, sale bill is generated, all these things. He may sometimes reperform some of this process, which is practically possible, and see whether the result he is from his doing is similar to that what is automated is doing, to check it whether it is correct. So inquiry is most efficient audit test, but it also gives the least audit evidence, because just with inquiry you won't be able to getting any audit evidence, right? So it should be used in combination with any of the other testing. That is, you should not use inquiry alone. Inquiry plus something you need to use. Then reperformance is the most effective. That is, that automated environment, whatever work that automated environment is doing, auditor can sit there and just reperform it and see. If automated environment is giving a monthly sales report, just auditor do that sales report or bank reconciliation and just see it once. Automated environment gives the proper bank reconciliation or GST reconciliation. Auditor can sit and reperform it and see whether both the answers are matching. So reperformance is the most effective audit test and can gives the best audit evidence. But it is very time consuming and least efficient most of the time, because auditor don't have time to do that. That is a problem. If he has time, then it would be a good thing. So what is the best thing? Inquiry in combination with inspection gives the most effective audit evidence. This is really good, but it is time consuming. So practically, you can only inquire and you can do the inspection because you may not be an expert in IT. Okay. So, however, which audit test to use? From this, which test to use? Either inquiry, observation, inspection. Which one to use? It's purely dependent upon auditor's professional judgment. Then, then these things are easy. And an entity system of internal control contains manual elements will be there, automated elements will be there. These are just easy. What are controls in manual system? Approvals and review transactions. That is inside the automated environment itself. A company having automated environment. Inside that also you may have manual systems and IT systems. Manually a person sitting and giving the approval, review everything, reconciliations, everything. Then combination of automated controls and manual also you may do. This is not that important, but still it's easy. Manual elements versus automated elements in entities internal control. That is, in an automated environment, like a company like Amazon and all these things, they can either put a manual controls or they can put automated controls. Environment is automated, everything is done automatically by the company, machine. but to check whether that things are working properly, to check whether the automated systems are working properly, there should be controls over that. Internal controls to check whether the software, the invoice, think everything is working properly. So those controls can either become manual or can be automated. Imagine a person can sit there and check whether the company software systems, everything is working fine, or another software can be installed to check whether other softwares are working fine. Both the things. So manual kind of controls will be more suitable in these cases. You have to study this. In these cases, putting manual internal controls will be better. What are the cases? If there are large transactions, like bigger value items, large things, bigger number, not number of transactions, large amount items and all these things, it's better to trust a human being than a IT system. Automated control rather than automated control. Then unusual transactions are happening or non-recurring transactions are happening in Flipkart. In Flipkart, imagine normal sales is in the range of 1,000 rupees to 1 lakh rupees. But suddenly a sale comes over around 10 lakh rupees. So an IT system, that automated control may not identify this as a problem, but manually when a person see, he may identify that 10 lakh, oh my god, that may be a fraud or some issue may be there. Manually that person may identify. Software is programmed, it may not identify that. So in such unusual situations or non-recurring situations, manual control is better. Then circumstances where errors are difficult to define or anticipate or predict. Automated controls mean you are feeding a software, like in these cases, show the error. But there may be sometimes errors which are difficult to define or anticipate or predict. That kind of errors may be there. So in those situations, manual controls are better. Then in changing circumstances that require a control response outside the scope of existing control, because company has automated control to check whether everything is working fine or the system is everything is working fine. But there may be certain situations in which the circumstances may change. Because of those reasons, this automated control may not give a good control response. Some tough situations comes. It was not being coded in the system. So the automated control may not be identifying that things or not. On those kinds of changing circumstances, a manual control is better. Then in monitoring the effectiveness of automated controls, whether automated system is there, and above that automated controls are also there to check these systems. And to check the automated control, whether this automated control is working fine, you can put a manual control. So these are the 4 cases in which a manual control will be better. Then manual controls are not suitable or less suitable in these cases. Example, high volume or recurring transactions is high volume or recurring transactions. That is, large number of sales are coming. Example like Flipkart or Amazon, per day, lakhs of sales are coming. So it is humanly impossible for someone to sit and check whether all the sales are correct. No. So it can only be done by a software or a system. So in those cases, large number, volume is high, that cannot be checked by a human internal control. So in those cases, automated controls are better. Or there are situations where errors can be anticipated or predicted and can be prevented by a control. That is errors, like all the errors which can be easily predicted by a automated software. Like imagine you know all the errors that may happen in your company. So you can create a software which may prevent all those errors, which may identify all those errors, and only those errors will come. So then in that cases, automated control is better. But you are unable to predict what kind of a fraud or an error will come in your company. So you cannot feed an automated system like that. So in that case, manual is better. So if you can predict all the kinds of mistakes, frauds, errors happening in your company, then you can put an automated control over that. Because it's a software which is fed, it will do that. Then control activities where specific ways to perform the control can be adequately automated. It is simple. Then data analytics. Data analytics is very easy. Data analytics simply means I'm going to audit Flipkart. So Flipkart's lakhs of sales will be there, and they are giving me sale data like that, this much. How can I check that humanly? Or if I put it in Excel, how can I check that much data in Excel? So I may need some software to do that, right? To analyze that data, to identify the problem sales or all these things from the data. I cannot do it myself with a normal thing. So I need some software. So I may use some softwares called data analytics softwares are there, where I will put this data into that software, and that software can process lakhs or crores of data. And when I use these kinds of softwares for data analysis, I'm the auditor. When I use it for data analysis, it is called data analytics for audit. Simple. That is to understand and analyze huge volume of data. Auditor may use data analytics software. It's that simple. So it is basically data analytics can be used in testing of electronic records and data residing in IT systems, or to perform the following. That is, you can use this data analytics for checking the completeness of data and population. That is, entire data you put it and you can see whether the entire data is full, the entire data is actually complete. With that software can help you identify that. Then selecting the audit samples from a 10 crore or 10 lakh sales bill. Normally human cannot sit and pick samples. So this data analytics software can help you in picking the samples. Then like random sampling, systematic sampling, you just feed the data, feed it the input you need, output you need, it will give you the input, output. So the thing is, Serena is a complete fraud. Serena is a girl and she is a complete fraud. So that is the mnemonic for learning this. SC means selection of audit sample, RE, recomputation of balances, you can use that software. Then SC, RE, second RE, re-performance of mathematical calculations. In that data you put into the software, if you just wanted to make sure whether the total of sales, everything is correct, you can ask that data analytics software to recalculate that. So recalculation or re-performance of mathematical. So two re is there, recomputation and re-performance. So SC, selection of audit sample, RE, recomputation of balances, re-performance of mathematical calculation. This balances can be recomputed, all these things. Then Seri Na. Basically Na means it's actually AN. I just put it in the reverse order. That is why I put this. So you will not forget this. The Madhuri writer you would have not seen. So AN means analysis of journal entries. Analysis of journal entries. Journal entries can be analyzed by that software. Fraud investigation, for that you can use. Evaluating impact of control deficiencies. If there are any control issues, this data analytics software can identify that. For this you can use data analytics. So when that auditor uses these kinds of softwares for auditing, that is, it's called CAT, computer assisted auditing techniques. These are things when auditor uses data analytics. The tools and techniques that auditor may use in the principles of data analytics are called CAT. Then digital audit, they basically auditor using all these things and doing the audit digitally. It's very simple. Auditor using AI, data analytics and all these things and doing the audit. Normally earlier auditor is not using that, but now when auditor, for auditing we may use artificial intelligence like some chat GPT or something, or data analytics. So when auditor uses digital tools for audit, it is called digitally auditing, digital audit. Then this one point is, this is very easy. Then this one point is a very important question. You may miss it, lot of students. So when an auditor finishes an audit, at the conclusion of audit, of an automated environment, like an IT system company, you did that audit completely. So now you got a basic idea about companies' internal controls, automated controls, companies, all the automated software, everything. You got a basic idea when you finish auditing. Then once you finish auditing, you need to make a report about all of these controls, like whether the automated everything is working properly, is there any weakness in controls, all these things. You need to make a report and give it to the management and TCWG. That is what we call here. At the conclusion of each audit, there will be certain findings in the IT environment. After audit, you may find a lot of things in the IT environment, some weak controls, some good controls, everything you will find. Areas where it is a problem, IT controls, whichever area is weak, all this. That need to be assessed and reported to the management and TCWG. After finishing auditing, whatever info you get about the IT system controls, you will give a report to the management TCWG. So what are the points you will consider? Are there any weakness in the IT controls? Is there any problems? Is the control software, everything working fine? What are the impact of this weakness? If there is a weakness, what is the impact of that in the company? Report deficiencies to the manager. What are all the deficiencies? Internal control memo or management letter. Then communicate in writing any significant deficiencies to TCW. If there are any significant problems in any controls or environment, tell it to the TCWG. Done and dusted. So now you have the conceptual clarity. Watch this video once more along with the book. if you want, and write it onto your side what are the meaning of all these things. Then use the mnemonics I gave you and then memorize. So once you understand and then memorize, that is what we call conceptual clarity, and then memorizing, you will get full marks in automated environment. Guys, next is essay 330, response to the assessed risk. Like I told you yesterday, like not yesterday, like I'm recording videos in 2 days, like yesterday, whatever we learned on essay 315, we will identify, I told you, we will identify the risk through essay 315. The chart is not there. Okay. Then audit procedures are divided into two. First is essay 315, that is called a risk assessment procedure, and essay 330 is called a further audit procedure. So here we will identify all the risk, we will assess all the risk, we will go to the, before starting, like in the initial stage of auditing, we will go to the factory, identify what are the risky areas, go to the office, what are the risky areas there, their financial statements, what are the risky areas, like sales is a risky area, or sometimes assets, it may be a risky area. Company has purchased a lot of assets current year, company has sold a lot of assets, so asset is a risky area. Company has taken a lot of properties on rent in the current year, so rent expense is a risky area. Like that, we may determine which are all the risky areas in the business. So then risks, all the risks, like which are the where there is a chance of error or fraud, only the risk we will identify in 315. Then we'll have a list of all the risk we'll make. So then it is now our risk of here it is a risk means a chance of material misstatements. Wherever there is a chance of important bigger misstatements, wherever there is a risk, that is what we call a risk, chance of misstatements. We'll identify it here. Once we identify the list, everything here, then we will decide the audit procedures to detailedly check this item to make sure whether that risk is actually a misstatement or not. So here we will identify all the, here we'll have a basically kind of list of all the risks where there is a chance, where there is a chance of material misstatement, like a chance items we'll pick. So for example, sales and all. Then we will design how to do the detailed checking of that in further audit procedure. For example, sale is a risky area. For sale is a risky area. So for that, company, we need to do a detailed checking in sales. So we will do a test of details in sales using some sampling also. Vouching and verification. So then we will do a detailed checking of all the sales. Once the detailed checking is done, we can identify whether there is any issue or not. Whether this risk is an actual material misstatement or not, we will identify by doing this detailed checking. Once the detailed checking is over, then we will identify, we can know whichever areas is actual misstatement is there, actual problem is there. Then based on what we identify here, we can form an audit opinion. So essay 330 is a response to the risk. That is the name of this, a response to assess the risk. Whatever risk we identified here and assessed here, we are creating a response to that risk here. So I didn't understand that. Something is biting me. What is that? Mosquito. I don't know mosquito here. So essay 330, auditor's response to assess the risk. So first there is something called a test of controls. We will check all the internal controls. Companies, whatever internal control you learned right now, right? Internal controls, what it is. We will check all of that. Test, not all, depending on whichever is important, we will do with that. Auditor's judgment. Then comes the substantive procedure. Substantive procedure means detailed checking procedures. Substantive, checking the substance, detailed checking. So substantive procedure is divided into two. Test of details is what we call a detailed checking. For that, we will test all the transactions. P&L items we will be checking. That is called a vouching. P&L items we will check through vouching. We will take the whatever is there in the books of accounts, that is financial statements. Then we will cross check it with other invoice and all these things. So vouching is there. Then balance sheet items we will do the verification, detailed verification. If PP is there, we'll go and verify whatever it is. So that is called a test of details. Then some other procedure is called a substantive analytical procedure, which you will learn in few minutes. Okay, guess guys understand. So here by doing this, we can know whether the risk we identified here is actually a misstatement or not. So now this is very easy. So these are all very things which you can read. Whatever I've mentioned right now, those are this mentioned here. Same things. You can easily read and understand. Then what are the matters the auditor may consider in determining the extent of test of controls? Like test of controls I showed you. Auditor is going to test all the controls. What are the matters he will think about in determining which all controls to test and how deep he should test? That is the extent of test of controls. Extend, to what extent he need to check the controls. He will consider these matters. Then he will decide which all controls to test and to what extent he need to test. First is called E-Road has a lot of free Rolls Royce. E-Road is a state in Tamil Nadu, not a state like a area, a place in Tamil Nadu. So Erode is a place, imagine Erode is a place of all the rich people. So Erode has lot of free Rolls Royces. So RR means Rolls Royce. Erode. Erode means expected rate of deviation from a control. Internal control you are checking. What is the rate of deviation, expected rate of deviation from that? What is the chance that that control may go wrong? Expected rate of deviation from that. Erode. Erode has nothing is there. Lot of length of time auditor is planning to rely on that control. If there is an internal control like this, imagine these are 5 accountants. They are basic accountant, BCom graduates. So, but they may know all the journal entries and all, but basically they may commit a lot of mistakes. So basically we have a supervisor who is an MB or a chartered accountant or something. Some senior supervisor is there. He is a finance manager. So what this guy do is he's an internal control. What he does daily, whatever journal entries, everything accounting made by these 5 people, evening he will sit for 2-3 hours and check all these journal entries and all the entries made by them. So he is basically preventing, detecting or correcting a material misstatement. So he is a internal control. So guys, auditor has 2 options. Auditor, when doing the auditing, first of all, he need to check all the journal entries which are made by these people. Imagine there are 1 lakh journal entries in a year. Company like Flipkart, lot of journal entries will be there. So what auditor will do? Anyways, it is not possible to check 1 lakh journal entries proper, straight, everything. No. So first thing he will do is whether this person is doing his job properly. Internal control, he will test him. He will test whether this person's work, everything is proper. If this person is proper and a good guy, he has good experience, then he itself would have identified all the issues made by them. So obviously, then less checking is needed here. So first option is either he can check all the 1 lakh transaction. Rather than that, what he would do, he will test this internal control. He will test this control means whatever work has been done by this person, checking everything. So 1 day's transaction, 1 day whatever journal entry has been made by them, he'll pick any random 1 day auditor. Then auditor will check all the journal entries made by him. Imagine in that 3 or 4 is wrong, and he will check whether what was this financial manager's conclusion on this. That is, financial manager also would have checked all this journal entry, that day's journal entry. He will check whether financial manager has also identified those 4 mistakes. If yes, then financial manager is a good guy. He's a good guy. So he can trust this financial manager. So he will test this financial manager. And if the everything is good, financial manager, proper good experience and knowledge, then he will say, financial manager is a good guy and I am going to rely on him. Rely on the internal control means he is trusting this control and he is only performing less procedures here. In that 1 lakh transaction, auditor may check for 1,000 transactions, less procedure. That is length of time. Imagine it's a sale transaction. Sales are the entry made by them. So sale is something which is needed throughout the audit. So entire audit, the sales, all the journal entries are needed. So basically, auditor, during the entire audit, auditor has to rely on this internal control because all the journal entries, sale, purchase, expense, assets, everything are made by these people. So entire audit, auditor needed to check all of this thing again and again and again. So auditor, better than that, auditor will rely on this internal control. So length of time during the entire audit period, length of audit time means imagine 2 months is audit, 2 months he is relying on him. So what is the length of time? If the length of time he is going to rely is more, then more testing should be done. Similarly, if the expected rate of deviation is more, then more testing of that control. Here we are talking about test of control, him. So if length of time auditor planning to rely on him is more, then more testing should be done. Hope you got the conceptual clarity of this. Nobody's tell you the conceptual clarity of this length. Everyone just memorizes and go. Then, like students normally, they don't focus on too much on concepts. They'll just memorize what it is there. Then it is a problem. Then frequency of the performance of the control by entity during the period. During the period, how much time this control was performed. He was checking every single day. So 365 year the control was performed. So the frequency is more, then the control checking will be more. But imagine there is some another internal control which or some guy who will check the sales or something only every month. So frequency is only 12. So less checking is needed like that. Then extend less or more, it depends upon the auditor's judgment. Extent to which audit evidence obtained from the test of other controls related to this assertion. Like imagine there is some other person also who is an internal control who checks all of these people. So an auditor, when checking this test of control, he got a good evidence that this guy is good. So less okay. So that is evidence he got from testing other controls. Then relevance and reliability of the audit evidence obtained regarding that. If the relevance and reliability is more checking. Relevance is more, then more checking he will do. So this is what we call extent of test of control. Erode has a lot of free resources. Expected rate of deviation from the control, deviation DE. Then length of time auditor is planning to relay. Length of time, Then FRE, frequency is planning to rely on the frequency at which the controllers perform during the year. Then E, evidence. Then RR, reliability and relevance. Simple. Then using audit evidence obtained in the previous audits. Last year auditor tested all the controls. Imagine last year I had so much time. So during audit, I tested all of the controls detailed. I tested. So can I use that audit evidence in the current year? What are the things auditor has to consider? The following: the effectiveness of other elements of internal control he will check. Then he will check the risk arising from the characteristics of the control. Imagine that control here. Like I told you, he is a human being, that finance manager. So risk is high. Some days he may be tired, some days he may be in a fight, so he may not have done the detailed checking, like that. If it's a machine, some software, so the risk is less. But IT risk is there, like that. Then effectiveness of the general IT controls. Then you know what is general IT control. We learned it now, right? Properly. Then effectiveness of other controls. Then whether there is a lack of change in a particular control, then risk of material misstatement. So here the mnemonic is this, not the mnemonic, you use better use this one. That is effectiveness of other elements, effectiveness of general IT control, effectiveness of control and its application. Done. Effectiveness is 3.5 point only we need. Then risk arising, sun arising. So risk arising from characteristics. Then lack of change will possess a risk. Then risk of material misstatement and extent of reliance. Done. Then don't use this mnemonic. This is I asked someone to write. I'm going to put the mnemonic. It's not good. Then now it is done. Substantive audit procedure. Then nature and extent of substantive procedure is very easy. When you read, you will understand. That is, auditor will determine based on his professional judgment which procedure to use. Should he use a test of details or should he use a substantive? With this, auditor will decide which to check which assertion, which audit procedure is needed. You will learn more of that in chapter number 5 when we check the financial statement items. So hope chapter number 3 is crystal and clear. Very most technical chapter. We have touched upon all the conceptual areas. I've given you all the mnemonics, all the things and all the concepts for you. If you like it, just give it a thumbs up and let me know what is your opinion till now. What you have watched the marathon till now, what is your opinion? Let me know in the comment box. I'm happy to do that, and always write to me on my Telegram or somewhere. Yeah, I just want to know how you guys are feeling. Is it becoming valuable? All those things. Now it is chapter number 4. So guys, we'll start with the revision of chapter number 4, that is audit evidence, and literally very easy chapter, nothing complex is there. So we'll touch upon the important concepts which you are unable to understand through your own reading. So first, basic audit evidence means any information that is used by the auditor at conclusions or to arriving at the conclusions on which auditor's opinion is based. It can include information like accounting records and other informations also. So anything like police gets evidence, auditor also need evidence for, because what is our duty? To check all the items in financial statements. So for checking all the items, to make sure every item is risk-free, every item doesn't have any misstatement, we need audit evidences. Okay. So first of all, understand types of audit evidence depending upon the nature and depending upon the source. Visual evidence, observing, like physical inventory verification, all these things. Oral evidence, discussion, like words which the manager speaks, you can consider that as evidence. Then documentary evidences. Then depending upon the source, internal evidences that is generated within the organization. That is sales bill. Sales bill is something which the company itself generates, client itself generates. Then external evidence that originates outside the client's organization. Example, purchase bill. Purchase bill is generated by that person, the seller. Okay, so that is coming, that purchase bill is an audit evidence for checking purchases, and that is generated from external sources, not from inside the entity. Okay. Now we will focus on the relevance and reliability of audit evidence. Very, very important. Relevance and reliability of audit evidence. Relevance means a logical connection with the purpose of audit procedure and the assertion under consideration. So understand this, guys. Don't just simply memorize it. Relevance means what is the logical connection between the audit procedure you are doing and the assertion you are checking. Imagine in the plant and machinery, in the balance sheet, there is some item called plant and machinery. So you need to check the existence assertion now. Imagine you are going to check the existence. That is whether the plant and machinery actually exist. That is something auditor has to do. So that is the checking the assertion under consideration is existence of plant and machinery. Okay. For checking plant and machinery's existence, what audit procedure you will use? You will go to the company and physically verify it. That is the only way to check the existence, whether the plant and machinery exists there. The only ways you can go and check. So that is a audit procedure. Physical verification is the audit procedure you are doing. Audit procedure is physical verification, and assertion under consideration is existence. To check the existence, the relevant audit procedure is physical verification. Imagine you are using some other thing like substantive analytical or analytical procedure for checking existence of machinery. Is it a relevant procedure? No, because to check the existence, you have to go and physically verify. That is the only way. Inquiry, like observation, all these things are not observation. Like physical verification will come. So, what is the connection between the audit procedure you are using to check the assertion? So that should be relevant. That is, for checking one assertion, you should use a relevant audit procedure. That is not the other audit procedure. Okay, hope you understood what is meant by relevance. Relevant audit procedure, that is a connection between audit procedure and the assertion you are checking. Logical, it should be logical. For checking something, you need to have the right audit procedure. Then next is reliability. Reliability means, can you trust the audit evidence? So this is, you need to use a relevant audit procedure to get the audit evidence. Similarly, reliability means, is the audit evidence you get reliable? Sales bill is audit evidence. So is it reliable? Is it fake? Imagine management is kind of a fraud kind of a guy. So the sales bills generated then may be fake. So this is what you have to check. But can I trust the audit evidence? Reliability. Okay. Reliability is influenced by the source, nature, and circumstances. Source. If audit evidence, sales bill is something that is generated internally, and purchase bill is something generated outside. So purchase bill is always, the source is coming from outside. So it is much more reliable. Like that. That is called reliability. Then there are certain generalizations about the reliability. This is a descriptive question which you need to understand. So for that, we have a mnemonic called mnemonic, because memorization is needed, right? DO doctor. What is DO doctor? Okay. So, yeah. First of all, I'll say how it works. The reliability of audit evidence is increased if it is obtained from independent sources outside the entity. Any audit evidence which you get from outside the entity is much more reliable if it is independent. Okay, if that is not related to the entity, that is independent sources outside the entity. Outside, O is the DO. Oh, you got it, right? The reliability of audit evidence that is generated internally is increased when the related controls over it is good. That is, if the internal controls are good, then the audit evidence generated internally will be good. If internal controls are bad, audit evidence generated internally will be bad. It is not trustable. That is generated internally, I, or you can say internally or I, or internal controls or I. That is I. Then DO, O means obtained directly by the auditor. Any audit evidence that auditor obtains directly, like external confirmation, he obtains it directly from the confirming party. So it is much more reliable. Oh, that is DI. So hope you got DI, directly by the auditor. 1 second. Yeah, directly. D, you got it. So D is directly, DO's D is directly, I is internally generated, O is obtained from outside the sources of the entity. DO, doctor, a doctor coming in a DO scooter. Okay, then doc. Doc means audit evidence in the documentary form is much more reliable. Doc. This is doc. Audit evidence in the documentary form. Anything that is said orally, that is not that much reliable. If it is in the documentary form, it is much more reliable. So that is another thing you have to keep. Then audit evidence obtained as original documents. Original documents is more reliable than original documents is much more reliable than photocopies and all these things. Original document is much more reliable than photocopy. Hope you got it. So this is OR. So DO doctor. T is chumma given. It's based. Simply I just put it. So DO doctor. Doctor coming in DO. D means audit evidence that is directly obtained by the auditor. Audit evidence that is directly obtained by the auditor. D, directly obtained by the auditor. I means generated internally. Internally generated audit evidence is much more reliable. So directly obtained, internally generated. O means obtained from outside the sources of entity is much more reliable. Then doctor, DOC, doc, documentary form is much more reliable. Or originally, original documents are much more reliable. Hope you got the mnemonic. It's very easy, right? Then next is sufficiency and appropriateness of audit evidence. Is the audit evidence sufficient and appropriate? Sufficient is measure of quantity. Whatever audit evidence you have obtained, is the quantity is sufficient. Imagine some kind of a high risk item is there in the financial statements. Imagine plant and machinery is highly risky. You got some information that the company is doing some fraud in the plant and machinery. So it's a kind of high risky item. So for a high risky item, 1 or 2 audit evidence may not be sufficient. You need much more evidences. So that is what we call sufficiency, quantity. Imagine some high profile murder case happened. For that, police need to furnish lot of evidences. Then only People also, media, they should also make the media and the people also believe, not just the court only, right? So high profile things, more audit evidence, more evidence may be needed by police officers. Similarly, in certain situations, if high risk items are there in financial statements, we need much more evidences. Quantity may be good, needed. And appropriateness refers to the quality of audit evidence. Imagine a crime happened, one person killed another person. Two types of audit evidence, I'll say, or not two types of evidences. Imagine, number one is a CCTV visual is there, one person killing another person, CCTV is there. That one audit evidence is much more sufficient. Nothing else is needed because clear cut visual is there. So in that case, one may be needed. Appropriate, it is only one. But at the same time, imagine a CCTV is not there. Only circumstantial evidences are there. Like some person has witnessed this killer going there, but not seen him killing the other person. No. But only these kinds of, or we got some sort of any things, any ring of the killer on the that place. All these are circumstantial evidences. It is not a perfect evidence. So in that case, you may need much more quantity. So appropriateness refers to the quality. If the quality of audit evidence which you got is really good, then only one or two may be sufficient. Like CCTV footage, perfect quality, one is enough. Appropriate quality of that evidence is high, much more valuable than all the other circumstantial evidences. That is what we call quality. Similarly, in audit, imagine sales or debtors checking. Debtors checking, you get external confirmation. One evidence is enough to check that it is, because it is of high quality. But if you don't get external confirmation, you need to find some other audit evidences, which 2 or 3 may be needed to reach the conclusion. That is quality. Sufficiency refers to the quantity. Both of them are related. If the quality of audit evidence which you are getting is not that much good, that is, the appropriateness is not good, then you may need much more sufficiency to increase to reach the conclusion. So sufficiency refers to the quantity and appropriateness refers to the quality. So sufficiency is a measure of quantity of audit evidence. Quantity of evidence is affected by the auditor's assessment of risk of misstatement. That means material items. If there is a high risky material, not high risky, highly material items like bigger amounts or bigger valuable items, all these things are there in the financial statements. Imagine a sale of normal sales or everything is just say around at the range of 1 lakh to 10 lakh, but there is one sale of 1 crore. So it is obviously a material item. So for that, you need much more audit evidences. Materiality. So less evidence would be required if assertions are less material. More evidence is required if the assertions are more material. Whatever assertion you are checking, existence of plant and machinery, if it is a material item, then you need more evidences. So just understand this much, enough. Highly material, more audit evidence. Less material, less evidence. This much, done. Then risk of material misstatement. This you learned in chapter number 3. So just understand this. If the risk is high, auditor assessed the lower risk of material misstatement. Low risk, less audit evidence. High risky items, more audit evidence. That's it, simple. Then size and characteristics of a population. Lesser, that is the number of items included in the population. Imagine sales or any other expenses. Anything in that, imagine all the sales are almost in the same range, in the range of say 8 lakh to 10 lakh. All the sales are there. So it is a kind of homogeneous population. All the sales are in between 8 to 10 lakh rupees, all the sale bills. So it's a homogeneous population. So you need only less evidence because everything is in the same range. But if it is a heterogeneous population, like lot of sales are there, like 10 rupee sales are also there, 10 lakh sales are also there, 1 crore sales are also there. It's a heterogeneous population. So you need much more evidences in each category wise, you need to pick evidences, right? So if less evidence would be required in case of smaller, more homogeneous population. If the population is homogeneous and lesser number is only there, less evidence is required. But more evidence would be required in case of larger but more heterogeneous population, like I told you. Okay. So hope you got the meaning, the conceptual clarity of these things. So these 3 things you have to write if they ask: sufficiency and appropriateness. And these are just other points regarding audit appropriate, not appropriateness, audit evidence. Just read it. Then audit procedure for obtaining audit evidences. Audit procedure for what are the different audit procedures for obtaining evidences? Guys, basically understand this is what we call the audit procedures. So first is risk assessment procedure. Like I said in chapter number 3, you will use these procedures to understand the entity. In the initial stage of audit, you will go to the company, you will use these procedures to understand what business they are doing, what are the risky areas. Before you start the audit, you just understand how the company is before you start the actual procedures. So here you, with the procedures, you will use inquiry, observation, inspection, and analytical procedures. These are the 4 procedures which you use at this stage. You will go to the company, inquire, talk to the people regarding the company and the financial statement. So you will get a lot of information. Like that, basically you are understanding the entity, and when you talk with the employees management, you will identify what are the risky areas in the financial statements where they may do a fraud, all these things. Then observation, you will go to the company and observe how the processes are doing in the company. Then inspection, you will inspect the documents and all these things of the company. Then analytical procedure, you may compare companies last year sales with current year sales, current year budgeted sales with the actual sales, current year financial with the previous year financial, all these things, and you will identify. Imagine last year, last all the 3 4 5 years financial statements you took. Every year the expenses was in the range of, every year 2 lakh, 2 lakh, 2 lakh expense was increasing. First year it was 10 lakh, then it was 13 lakh or 12 lakh, then it was 14 lakh, like that it was going. But current year, suddenly the expense increased to 60 lakhs. So that you understood that by comparing the financial statement. That is what we call analytical procedure, comparing. So that means some kind of a risk is there in the expenses. Imagine, be it any expense, some kind of a risk. You will conclude, okay, in this, imagine it was rent expense. Rent expense, why there is a sudden increase? Why there is a sudden increase? So it can either be because of an error, accounting error, or it can be because of fraud practically, right? So there is a chance of a mistake in that. So let me take rent as a material, like important item, which I need to check. So that these procedures you will use first, and you will understand the entity, and you will identify what this procedure is all about. You will identify the risk of material mistake, wherever identify the chances of material misstatements, where all items, in which all items in the financial statements there is a risk of material mistake. You are identifying and assessing that in this stage. So once you perform this procedure, you will have a list of all the areas where the mistake or the fraud or error can happen, right? Once you have that list, then you will detailedly test it through, test whether there's actual fraud or error. You have to detailedly test. Now only you get a basic idea. Now you need to open that item and you need to check it deeply. That checking happens through further audit procedure. You will test the control, test the internal controls for that, or you will use detailed checking procedures like substantive procedures. This is where you will test those transactions or balances. For that, you have two ways. Number one is test of details. That is detailed checking. All the sale bill you are taking, and you are checking, or like vouching. That is testing of transactions, vouching, or testing of balances, balance sheet items. You will be checking. This is P&L item, balance sheet items. Checking P&L item, checking balance sheet item. You can check it through vouching. Take the sale, whatever is the general ledger sales, all the journal entries, and take the sales bills and compare whether same amount, same sales bill is there. Okay, tick. Then another sale, same amount, same bill is there. Tick. Like that, you can vouch and go. That is what we call test of details. Then there is substantive analytical procedure, which I will explain to you in SA 520, which is very, very critical. Understanding it is important. Don't just memorize it and go. Okay. So this is what the audit procedures are all about. So these are the total audit procedures. From this, basically, we are using inspection, observation, analytical procedure, and inquiry as risk assessment procedures, and other things, external confirmation, recalculation, reperformance, etc. in other phases of audit also. So these are just a list of all the audit procedures, basic audit procedures we are doing. Okay. Inspection, I told you, examining the records and documents, very easy, you can read and understand. Observation, external confirmation, this we will revise in 505. Recalculation means auditors checking the mathematical accuracy of the documents. That is, recalculation may be performed manually or electronically. All the data given to the auditor, he will recheck the mathematical accuracy, whether the total everything is correct, whether the multiplication, division, all these things are correct, calculation, interest rate calculation, everything is correct. And that procedure checking is called recalculation. Reperformance means auditor will perform the procedures already done by the management. Imagine management has made a bank reconciliation statement or a GST reconciliation. So auditor has to know whether that is correct, right? So auditor may sometimes on a sample basis take some procedures and he will reperform it again from scratch, zero. And just to see whether total answer, auditor's answer is matching with management's answer, like bank reconciliation, GST reconciliation, anything. That is called this one. Auditor's independent execution of procedures or controls that were originally performed by entity's internal control. Entity's internal control performed that. And still auditors just reperforming it just to check whether that things are correct. If it is correct, then entity's internal control is assumed to be good. Then analytical procedure, we learned it in SA 520. Then inquiry, obviously it is very easy. You can easily know. Then risk assessment we did. Then next is what we call assertions. Assertions simply means, just understand the basic. Like, it is a big topic to explain, but just understand the basic thing. Anything what the management is saying to you is what we call kind of an assertion. Example, if you take a balance sheet, if you take a balance sheet, imagine you take a balance sheet or P&L, anything. In here, land and building is written as 10 lakhs. So what do you understand from this? What are here management has written this? What do you basically understand with assertion means representations made by the management, right? So what do you understand from this? That there exists a plant and machinery, right? In the company's balance sheet, if plant and machinery is like not land and building, let's put it plant and machinery. There exists a plant and machinery. Company has a plant and machinery, right? That is what we understand. First thing, company owns a plant and machinery, right? Then rights and obligations. That is, that plant and machinery is in the company's name. Then only they will include it in their balance sheet. This is one thing you are understanding. Then the value of that is the value of the land and building is 10 lakhs. That is what they have written here. This is also what you are understanding. So this is what we call assertions. What is management actually trying to say to you when they put an item in balance sheet or P&L? What are they trying to say to you? If they put a sales as 10 lakhs, what is the meaning? Company current year has done sales of 10 lakhs, sales has occurred, and sales of the value is 10 lakh. All these things they are trying to say to you, right? This is what we call assertions. And in auditor's point of view, our duty is to check all the items in P&L and all the items in balance sheet, all the important items, major items. So when you pick an item for checking, imagine when you pick plant and machinery for checking, first thing you have to check all the assertions related with plant and machinery. It's not just like plant and machinery. I just check plant and machinery. It's not like that. To check plant and machinery, first check all the assertions related to plant and machinery. When all the assertions are checked, then you will understand, okay, plant and machinery is final, complete. So example, when I take the example, you will understand. So plant and machinery, imagine we are checking. First thing we will be checking is, okay, existence assertion of plant and machinery. That means whether the plant and machinery actually exist. You will go to the company and see whether it actually exists. That is called existence assertion. Then rights and obligation. You need to know whether, because company put plant and machinery in their balance sheet. So now it is your duty to know whether company actually owns this plant and machinery. Is the plant and machinery's ownership in the name of the company? That is what we call rights checking. If it is a liability, then it is called obligation checking. So rights we will check. We will check the plant and machinery certificate, like buying purchase bill or certificate, whether it is in the name of the company. Rights, whether company has ownership over it. Then we will check the completeness. Completeness is another thing, because that is how we check every item in balance sheet. Imagine plant and machinery is written 10 lakhs. So it doesn't mean like they only have one plant and machinery. No, they may have lot of plant and machineries. Imagine 5 plant and machineries are there. First plant and machinery's value is 2 lakh. Second plant and machinery's value is 50,000. Third plant and machinery's value is 1.5 lakhs. So the total of all these things, 4 and 5, comes to 10 lakhs. So now it is our duty. Company may have lot of plant and machinery. So now we need to go to the factory and check whether all the plant and machinery is included in the balance sheet. That is, all the plant and machinery's total amount is 10 lakh. Imagine company has 5. Company has shown in the balance sheet 5 plant and machinery. Now we have to go and check whether that 5 plant and machinery exists there and only 5 exists there. Sometimes 7 or 8 may be there. They would have missed it to show it. So you have to check. That is whether it is complete, whether everything is complete. So this assertion also you will check. Then you will check the valuation and allocation, whether the value of whatever is shown, 10 lakh they have shown as value, whether the value is correct. So when you check all these 4 assertions, then what is actually happening? You have completely checked the plant and machinery, everything related to plant and machinery. So here you will check whether the depreciation calculation is correct, whether there is any revaluation, all these things you will check here. So this is how you check every item in balance sheet and P&L in audit. Every item, if it's a balance sheet item, any item you are picking, check these things. Every item just check what is existence is correct, then check the rights and obligation, then check completeness, then check valuation. Almost everything is done, checked. Now take the other item, another asset, check it like this. This is how we check things. This is what we call assertion. What management is trying to say to us, so we will check everything like that. That is what we call assertion. Hope you got a really good clarity in assertion like you have never got before. Then next is about class of transactions and events. This is assertions about P&L items. So for all the balance sheet items, you will use this. For all the P&L items, you are using this assertion. That is occurrence. Imagine the P&L item, there is a rent expense of say 10,000. So now you have to check the rent expense. First thing what you will check, whether the rent has actually occurred in the current year. Current year or rent, like whether the rent is original, actually occurred, that you will check the first thing. So that is done. Then secondly, what you will check, completeness, whether all the rent I paid during there is included in the 10,000. Total 10,000. That you will check. Then you will check the accuracy, whether the 10,000 amount is correct. Amount there is no mistake or error. That you will check. Then you will check the cutoff. That is only current year's rent. That is 23 April 2023 to March 2024. Only rent of that 12 months is included. Not of any other 1 month extra is included. No, only the rent of current year. Cutoff means this opening period to closing period. Only this period the rent is included. That is cut off. Then classification, whether it is done under the proper heads and all these things. Proper accounts, heading head proper. So that is what we call. So P&L items, every item you are checking, you will check like this. To check every item, any item you pick in P&L, like sales, any other things, first you will check the occurrence of sales, then you will check the completeness of sales, then you will check the accuracy of sales, cut off of sales, classification of sales. Done. So the sale item is completed. Now you will check the other thing. Like that, you go checking. Balance sheet, you will use this. Then disclosures, you will use this. Very easy. So this example, when you read, you will understand. Very easy. Then next is what we call audit trial. Audit trial means it is basically a kind of a feature in this accounting softwares, SAP and all this high-end Tally softwares. They will have a accounting feature called audit trial. Because guys, understand, in companies, sometimes accountant may be putting the correct journal entry and all these things. But there was another staff in the company who did some fraud. Imagine a staff in the warehouse who stole some inventory from the warehouse. So he will know if because in the accounting they will identify that this inventory is missing, so it will become a issue for him. So imagine if he has an access. Chumma I'm saying, in smaller companies, imagine if he can enter into accountant's room when accountant is on leave, he can open the tally and he can put a journal entry that imagine he took 5 inventory as like stolen 5 inventory. So that 5 inventory he is chumma showing us sales and putting an entry, so that he will be safe. So imagine he is doing like this. So what is actually happening? Accountant will tomorrow he will come and accountant may not know this kind of an entry is put in the software. So there is a problem. So because of that and all of these kinds of things, there is something that is just one example I told, and other many kinds of things are there. So there is a feature called audit trial. Audit trial means in an accounting software, imagine some accountant put any journal entry. If someone changed that entry or someone put any additional entry, all the journal entries, all the entries you put in the software, it can be known that who put that entry at what date, at what time. Because of if you turn the audit trial feature, you will know if someone has edited the entry, his name, all the details will come, employee ID, all these things will come, date time will come. That feature is called audit trial. So that what is the best benefit of this feature? When the auditor is auditing, if he want to know what is the back like if he wants to track a transaction to who put this entry at what date or what time, he can turn on the feature line, he can go back and check. That is what we call the benefit of having an audit trial feature. So like financial statements comes from trial balance, right? Trial balance comes from ledger comes from journal comes from invoices. So any item in financial statement, if auditor has a doubt, he can, with the audit trial feature, he can go back like this, like who put the journal entry at what date, if someone has did any fraud, anything, we can find it out. So an audit trial is a documented flow of a transaction, or a transaction of flow he is documenting like this. Who put journal entry at what time, at what date, who made this thing, everything will be there. It is used to investigate how a source document, that is an invoice, was translated into an accounting entry, and from there whether it was inserted to a financial statement. This is what we call the audit trial. So this picture you draw it, you will get an idea. It is used as audit evidence to establish authentication and integrity of a transaction. Then it helps in maintaining a system of and user acted all by things. All these things you will read, you will understand. So how audit trial helps auditor? This is the question. It's very easy. Then relying on the work of a management expert. Management expert means any person, be it any person who is an expert in any field. Imagine management wanted to revalue their land or their any other assets. So they need a registered valuer. So registered valuer is someone who is outside the business, and management is just making him come for some fees. That guy will come, do the valuation, he will give a valuation report, management will pay the fees and he will go. So that guy is called a registered valuer. Imagine an engineer, or imagine an like an ERP implementation expert. These are people coming from outside the business to help the business. These are called management experts, who are experts in any other field, who are contracted by the management. Okay, like actuary, all these people. It's an individual, it may be an individual or an organization possessing some expertise in any field other than accounting. Or accounting or auditing, we are the experts, CS. So when a management expert comes, you have to evaluate the competence, capability, and objectivity of that expert. Whether that expert is actually competent, do he has his skills, what is his capability, what is his objectivity, understand what work he has done. This is auditor's duty. Then evaluate the appropriateness of using that work as audit evidence. Imagine we need to check the value of land and building, like valuation assertion. So for that, there was a registered valuer who came to the company and revalued the land. Can we trust that valuer's report? That is basically we need to know the value. So what are we doing? We are not registered valuers, we are auditors. So can we trust that valuation report given by the valuer? Can we use it as audit evidence? For that, we need to check whether he is competent, whether do he have capability, is he independent, what is his objectivity, then understand the objectivity means he should be free from bias and influence, then understand what work he is doing, all this. And then finally conclude, is his work, can I use it as audit evidence? So now I am giving you clarity so that you can easily memorize it. Then next is information to be used as audit evidence. If you are using a work of management expert as audit evidence, then nature, timing, and audit procedure may be affected by these matters. That is called a narrow check, mnemonic. Narrow check. Narrow means nature and complexity of matters to which the management expert relates. This you can easily use this with same in your textbook. Also, same thing will be there. Narrow check. Very easy. Nothing too complicated. Nothing complicated there. Then selecting items for testing to obtain audit evidence. 1 second, guys. Okay, done. Then selecting items for testing to obtain audit evidences. Like we wanted to check sales. Lot of sales are there. Like any bigger company, you take the thousands of 10,000 lakhs or crores of sale may be there. That number of sales will be there. Bigger company, you take Flipkart. Per day, minimum 1 lakh transaction will be happening. So into 365, how much crore transaction, how much crore sales will be there in a year? 36.5 crore, something. Sales, number of sales will be here. So you cannot anyways test all the transactions, right? You cannot anyways test all the, imagine even if there is 1 lakh sales, it won't be able for you to test all these things. So we have 3 methods for testing something and getting audit evidences. First is you can select all the items, that is 100% examination, 100% sales you are examining, or any expenses, anything. Second is picking specific items from that. 1 lakh sales are there. From that, you are purposefully picking specific items. It is not sampling. Sampling, you are just unknowingly, randomly picking items. You are not, but like in the item to pick that, you don't have an idea in your mind. That is, if you are randomly you are picking, it is sampling. But this is your purposefully picking. That is picking all the sales that are above 50,000. It's purposeful. All the sales above 50,000 you are picking, or all the sales that are in the range of 50,000 to 60,000 you are picking. So you are purposefully picking something. That is picking some specific items. It can be a high value item or a key item, most important items like that you may be picking. You are knowingly picking here. Here you are unknowingly picking. Sampling means unknowingly picking. So 3 ways are there. Either you can test 100% items, or you can purposefully pick some items, knowingly pick some items and test, or you can unknowingly pick some items and test. That is sampling. Okay. So when will you test all the transactions? 100% examination is actually unlikely in the case of test of control. For testing internal controls, it is unlikely. However, it is more common for test of details. That is transaction checking, balance checking the P&L items and checking the balance sheet items. 100% examination is likely. We can do that. But for testing internal controls, we will not do that. 100% examination may be appropriate. When? In which all cases it will be appropriate? When the population constitutes a small number of large value items. If the number of items or number of sales are high, 1 lakh sales are there, how can we do the 100% examination? No. But take a company like Flipkart, I told you 1 lakh, 10 lakh, 50 lakh sales will be there. It's very hard to check everything. But take a company like Boeing or Airbus, which is making this aeroplane. In a year, how many aeroplanes they may be making? Just imagine. Just hypothetically, I'm saying, I don't know the exact number. Anyways, it's a bigger thing and it takes a lot of time to make an aircraft. So imagine they may be making 10,000 aeroplanes. So only 10,000 bills will be there, or 5,000 aeroplanes in a year. Only 5,000 bills will be there for checking sales. So 5,000 bills, if you want, you can do the 100% examination if you want. Or only 1,000 aircraft they made in a year. So 1,000 bills are only there. So that you can easily do the 100% examination. So when the population consists of small number of items should be small, number of sales should be small, but large value items, one aircraft or one bill itself will be in millions, billions. So that is, in that cases, you can do 100% examination. Then there is a significant risk and other means do not provide audit evidence. Imagine you have a significant, you know that there is a sales is a high risky item. There is no other way to examine other than 100% examination. In that case also you can use it. Then repetitive nature, that is basically 100% examination is cost effective. If you think rather than sampling or other methods, 100% examination is cost effective and can be done quickly, then you can do that. 3 cases you will use 100% examination, study it, important. Then selecting specific items, that is purposefully you are picking specific items, you are knowingly picking. So there are specific items. The judgmental selection of the specific items is subject to non-sampling risk. Specific items selected may include either you may be picking high value or key items. High value, like sales are there in the range of 10,000 to 10 lakh rupees. You want to check all the sales practically, but it is impractical. So what you will do, you will only pick the high value sales. That is all the sales that are above 8.5 lakhs I will check. Other sales I am not checking. Like that you can purposefully pick and select. Then all items over a certain amount, same thing that I told you. Then high value items, then items to obtain information. If you wanted to obtain some specific information, you can check the specific item only. Like that you can do. Okay, so these 3 things are there. Understand it. I'm giving you an understanding now. And whatever like tough areas, I'm giving you the mnemonic also. Then next is audit sampling. You know that we learned it in SF530. Then using the work of internal audit. That's a very important essay. It seems less important, but it is actually important. 1 second. Yeah. Using the work of internal auditors, that is SS610. So first, internal audit function. I'm hoping you know internal audit. Internal audit is a function of the entity that performs the assurance and consulting activities designed to evaluate the improve the effectiveness of companies, governance, risk management, and internal control process. These are basically auditors itself, chartered accountants itself, or other accountants are also possible to do the internal audit. They can come, they'll just like statutory audit itself, but in a much more detailed way you are doing internal audit. Statutory audit you will do only one in a year, but internal audit you can do multiple times in a year. Internal audit means that normally companies will have an internal auditor inside them. A chartered accountant who is their employee. He is not independent, he is their employee. He will sit inside the company. His duty is to do the internal audit. Every 3 months, every 6 months, he will just check all the transactions, everything done by the management, whether it is correct. He will check whether all the internal controls inside the company are correct. He will check the risk management team. Are they properly managing our risk? All these things. That is his duty. That is internal audit team. So what is the objective and scope of internal audit function? Objective and scope. And this dog, you know, if you're a dog lover, this dog is called Corgi. The breed, the name is there. So Corgi. C. So C stands for, will come from the last. Review of compliance with the laws and regulations. It is internal auditor's duty to check whether the company is properly complying with the laws and regulations, whether the company is properly paying tax and all these things. That is what they are required here. So compliance is C. Compliance with the laws and regulations. Memorize with me, along with me, sit and memorize. Then O. He will review the operating activities, whether the operating activities, sales, purchase, or expense, all these things are done properly, whether they are done at E cube, whether the operating activities are done with E cube, that is economy, efficiency, and effectiveness, E cube. Operating activities are done like that. Then COR. R means he will examine the activities related. R is here. He will activities relating to risk management. Whether company is properly evaluating the risk management. That is identifying and evaluating the significant exposures to risk. Whether company is properly doing that. That he will check. So C means he will check the compliance of laws and regulations. Compliance. O means he will check the operating activities. R means he will check the risk management function. Risk management. So compliance with laws and regulations. O means operating activity, R means risk management, CORG. He will check the activities related to governance, whether the company is properly being governed. That is, whether the company is properly in accomplishment of its objectives relating to ethics, values, performance, all these things. Whether the objectives related to these things are properly being done. That is also he will check. So CORG, compliance with laws and regulations. O, operational activities he will check. R, risk management function he will check. G, governance he will check. I means internal control he will check. Activities relating to internal control he will check. And last is E. What is E? Examining the financial and operating information also he will do. Corgi, you will got it. Then this is very easy. Then I'll focus on the areas where the question comes. So what are the factors that may affect the external auditor's evaluation in relation to objectivity? That is, I am the external auditor. I am going to do the statutory audit of a company. And the company had an internal auditor also. So what I will do, sometimes lot of procedures which I am going to perform in the audit, same procedure would have already been performed by the internal auditor itself. Because he is a CA, I am also CA. So sometimes without performing something deep, I may rely on the work done by him. Like he would have done the work and he had an audit evidence. So instead of doing the work myself as a statutory auditor myself, I will trust his work and I'll take the audit evidence he obtained. Like that I may do. That is, I will not, rather than checking it myself, I won't check it. I will trust him that he has already checked it, so I will use his audit evidence. So that is a possibility. So, but before that, there is one thing. First of all, I need to check whether that guy is actually an independent guy. Is he also included in the management fraud and all these things? I need to check whether he is free of bias. He is not unbiased in all these things. I need to check. And he has a good position in the company. Like he has a good value in the company, status in the company. Then only I can trust him. Imagine internal audit is there and he found out some fraud. If he tells to management and management is saying, shut up, go out. If management is saying that to internal auditor, there is no value for internal auditor. He's just a dummy kept there. That is that internal auditor has no objectivity. Objectivity means he is not free from bias. He is under the influence of management because anyways they are paying salary. So first, if I wanted to trust him and I wanted to use the work done by him, I need to check his objectivity. That is whether he is free from bias. He is not influenced. I need to check that. For that, I will check what is the organizational status of internal auditor function. That is inside the company, whether the internal auditor has any value. What is his status in the organization? Because status we'll say, right? What is his status? Does he have any value? If he says something, are the company giving a value to him? Organization status, that is whether it supports the ability of the function to be free from bias, conflict of interest, and undue influence. That is what whether do they have the objectivity to act without influence. That is what they're checking. What is the status of them in the organization? Are they free from bias? Are they having conflict of interest? Are they under the influence of anyone? All these things. Then whether TCWG oversee the employment decisions of internal audit function. That is, if management itself is appointing the internal auditor, then that auditor will be like a dummy of the management. Management are the guy who may do a fraud or error. Then they itself appointed internal auditor. Then if internal auditor cannot complain to anyone because their job is in the hands of management, right? So that time internal auditor won't have any objectivity. But at the same time, if internal auditor is appointed by the TCWG, Board of Directors Audit Committee, those people, then management will be afraid of internal auditor. That is, internal auditor will directly, if any issues of management is found, internal auditor will call the TCWG and complain. So that we need to check who has actually appointed the internal auditor. Does TCWG oversee the employment? Normally management appoints it, but TCWG oversee it. So we need to check whether the TCWG oversee this decision. Then only internal auditor will have any objectivity. Then whether there are any constraints or restrictions placed on internal auditor by the management of TCWG. Whether the management of TCWG has told the internal auditor that is you should not do any deep checking. Company like that, if they have said anything, internal auditor don't have any objectivity. That also we need to check. Then whether internal auditor function is free from any conflicting responsibilities. That is, some companies, to cut the cost, they will appoint an internal auditor. What is the duty of internal auditor is do the internal audit. But extra than that, other than that, company may give him some extra responsibilities or some other work also. So he may not get time to do the internal audit. That is, conflicting responsibilities will be given to him. Is it something like that? Then his objectivity is compromised. So we will check these 4 things to check whether the internal auditor's objectivity is good. If his objectivity is good, then I can use his work in auditing and I can also take the help of him while doing the stat audit. So for that, we will do this. So understand this. Don't memorize, understand it. Then memorize. Then factors that may affect the external auditor's determination in relation to competence. That is, whether the internal auditor is actually competent. Do he have the skill? I need to check that. What are the factors I will check? That is RTP required. R, whether internal auditor function is adequately and appropriately resourced related to the size of the organization. That is, size of the organization. If the organization is a big organization, you need bigger internal auditing. Lot of internal auditors are needed. So depending upon the size of the organization, whether the company has that similar sized internal audit team is there. Size is very big, but the company only has 2 internal auditors. Then it is not good, right? So that is what we call competence. Competence checking, we'll check whether company order size like do we have an internal auditing? That is this one. Resourced. Whether the R is resourced. That is whether the internal audit team is resourced in relation to the size of the organization. Then whether internal auditors have adequate technical proficiency. Do they have technical proficiency? Skills RTP. Established policies. Whether the company has really good policies for hiring, training and all these things. That is proper policy. Then RTP required. Whether the internal auditor has the required knowledge. Very easy. Then all these things are easy. These things and all we can, same things what we learned about. What are the circumstances when you cannot use the internal auditor's work? When If the internal auditor's objectivity is compromised, you cannot use this work. I said above, same thing. That is, external auditor shall not use the work of internal auditor function. That is, if his organizational status and policies and procedure does not support his objectivity. That he has a bad organization, no status is there, policies and procedures, everything does not support the objectivity. That is, he is not free from bias and conflict of interest. Then the function lacks sufficient competence. If the function is not, internal auditors don't having any competence, that is, these points are not there. Internal auditor is not having any competence, so don't trust him for the work. That's it. Then the function does not apply a systematic and disciplined approach. Their approach in internal audit is not good, then don't trust them. Similarly, these things you can read and understand yourself. Using the worker, I learned what I told you, same thing. Then discussion and coordination with the internal audit function. While doing the stat audit, I will do some discussions and coordinations with the internal audit team also. I will take some help from them, all these things, and I will suggest them something. They will suggest me, not suggest, they will help me with something, all these things. So in discussing the planned use of work of internal audit function, when I'm planning to use internal auditors work for my audit purpose, when I'm planning to use that as a basis for coordinating the respective, it may be useful to address the following. I need to consider these things when I'm planning to use their work. What is it? Timing of such work. Tina madam recovered. Imagine there is a madam called Tina and she was having some health issues. So Tina madam recovered. That is her mnemonic. Very easy to remember, Tina madam. So TI means timing. Timing of such work. At what time those work was done. In the time it was done. That is timing. That is at which part of the year they have done the work. Internal auditors. Because we are planning to use internal auditors audit work. Other evidences we are planning to use. So at what time of the year did they do that work? That we need to know. Then nature of the work performed. What was the nature of the work they have performed? Then materiality for the financial statement as a whole, and what is the performance materiality and what is the materiality. So TINA, TI timing, NA nature, MA materiality and performance. Just the keywords is needed. You will be able to write them. So TINA madam, MA materiality, then DO, documentation of the work performed. Whatever work they have performed, see the documentation of that, audit documentation. Then M means what are the methods, proposed methods for item selection and sample size. For sampling, what are the method they have used. Tina madam recovered. RE, review and reporting procedures and covered extent of audit coverage. Very easy, right? Yeah, do that. Then this is very easy. Then these things are important. Like what are the factors auditor will consider in thinking about the error assistance. But when you read it, you will understand because I told you explained all the things. All these things I explained. So next is SA 501 audit evidence specific considerations for selected items. Guys, SA 500 is also audit evidence. 501 is also audit evidence. So what is the difference between both? It is very simple. 500 is basically audit evidence generally applicable for all the cases, and 501, this standard is only applicable for audit evidence relating to inventory, litigations and claims and segment information. If in the question, if anything related to inventory or this is given and audit evidence, you have to answer anything related to that, you have to mention SA 501. All the other cases, it is SA 500 is the SA for standard for audit revision, audit evidence. So what is the objective of auditor as per SA 501? Very easy. Check the existence and condition of inventory. Regarding inventory, this is the objective. Inventory which is there in the balance sheet, he has to check the existence, whether that inventory actually exists and what is the condition of the inventory. Is it in a good condition for sale? If it's a good condition only, you can show the full value in the full amount in the balance sheet. Else, you have to show down to the realizable value. Then completeness of the litigations and claims involving the entity. All the cases filed against the entity, cases filed by the entity, that is litigations and claims. So all these things, claims and litigations, you have to check the completeness. That is all the litigation, legal cases against the entity and filed by the entity should be shown. I thought that's effect should be coming in the balance sheet, like whether contingent liability or like that. Then it should be disclosed properly if it is something material. Then presentation and disclosure of segment information. If there are different segments can be two types. It can be either related to geography, that is Nike India, Nike US, Nike Europe. This different countries are geographical segments, or it can be segment based on product. That is Nike's different products like t-shirts and clothing is one sector, accessories is another sector, footwear is another segment. Like that also you can divide. We will touch upon that now. Then now we will focus on inventory only, that is relating to inventory. So the objective is find the existence and condition of inventory. When inventory is material, if inventory is a material item, obviously mostly yes. If inventory is material to the financial statements, auditor has to obtain audit evidence regarding the existence and condition of inventory. How will he get audit evidence? By doing these things. By first what? By attending the physical inventory counting. Company will be doing a physical inventory counting mostly at the end of the year, 31st March, they will be doing a physical inventory counting. Auditor will go there. So there he can see whether total inventory with the amount in the books, that much inventory is existing there, and he can also examine the condition of inventory. For that, he will attend the physical inventory counting. Well, unless impracticable, okay. Two, why is he attending physical inventory counting? To evaluate management's instructions and procedures for recording and controlling the results of entity counting. What is management's instructions? How management is counting? What are management's procedures? All these things he will understand when he will attend this counting. Then observe management count procedure. How management is actually counting the inventory. Are they counting from left to right, right to left, top to bottom, bottom to top? Like in what order they are counting, what method they are using for that. That all things auditor will understand. Then inspect the inventory. He can inspect the inventory. So by doing this too, he can check the existence of inventory. Then by inspecting the inventory, he can check the condition of the inventory, and he can also perform test counts. So this is what is all about. Then second point related, this is the first point. He can obtain audit evidence by attending physical inventory counting. And second point is perform the audit procedure over entities' final inventory records to determine whether they accurately reflect actual inventory count result. That is, whatever is actual counting, one result will come. Total amount of this much, total inventory quantity this much, total amount this much. Whether the same amount is shown in the books also, we can compare. Then this is very easy. Then what are the matters that are relevant in planning the attendance at physical inventory counting? Auditor is going to attend physical inventory counting tomorrow. What are the matters he need to plan before attending that? Many things you need to plan. Before attempting an exam, you will have a plan. Similarly, what are the plan auditor need to have? First, what are the matters he need to plan? What all things he need to plan? First, you see just this mnemonic itself is enough. What is the nature of the inventory? What kind of a product it is? If you are going to attend physical inventory counting of boat earphone company, what is the nature of inventory, nature of products? It can be earphone, Bluetooth speakers, smart watches, all these things. That is the nature of the inventory. Then you need to look at the nature of the internal control systems over the inventory. Nature of internal controls over the inventory. What are the controls over the inventory? Do they have a security guard? Do they have a fingerprint scanner or to enter the warehouse? Do they have a CCTV? What are the inventory internal controls over the inventory? You have to check. So nature of inventory and nature of internal control system. Pictographically remember this mnemonic, you will be easy. Then what are the stages of completion of work in progress? Work in progress will be there as part of inventory. How much stage it has been completed? Is it at the 40% stage or 70% stage? All those things. Then he have to look at the timing of the physical inventory counting and what time they are doing it. At what time? Timing of the counting, because he is going to attend it tomorrow. Then he need to check. Then Palar. Palar means P only, this much only you need, because 5 points we needed. 1, 2 we got, 3 here, 4 here. Then P. Palar. Whether company is maintaining a perpetual inventory system. Perpetual inventory system means the stock will be updated on a real-time basis. Whenever the stock is updated, it will be updated on a real-time basis. When, like on Flipkart, when one product is sold, immediately in inventory that one product is less of that second itself. That is called perpetual inventory records. But in normal, in your kirana shops, lot of local grocery shops, if you go, they are not updating the inventory. 1 weekly they'll see, okay, but okay, onion is finished, so let me get some onion. Like that, they may be doing it. They don't have a perpetual inventory. So these things you need to check. Then other things, where the location of the inventory is held, all these things, what are the risk of material misstatement related to inventory, you can use. Very clear, right? Then physical inventory counting conducted at other than the date of the financial statements. Normally it will be done on 31st March, but if it is done on any other date, imagine it is done on 25th March. Company had some busy date on 31st March, so they plan to do it on 25th March. So what should the auditor do? Perform, because if they're performing it on 25th March, all the stock till 25th March only will be calculated. Then the next 5 days will not come. So what is auditor's duty? Auditor has to check, perform the audit procedure to get the evidence about whether the changes in inventory between the count date 25th March and the date of financial statements are properly recorded. So 25th March when they finished the counting, the total inventory value is at 25 lakhs. But in the books of accounts, financial statements, they have shown it as 30 lakhs. So this 5 days is there in gap. So auditor has to perform audit procedure to ensure that these days order inventory has been properly adjusted here. So that is what he has to do. Then, what are the relevant matters for considering whether designing audit procedure to obtain audit evidence about whether change in the inventory amount between count date and the date of final records are properly recorded? I told you it is his duty to check whether these dates, that is 25th March to 31st March, these dates or inventory, whatever the figure, the sales, the purchase by all this of inventory is properly adjusted in the closing figure. So for that, what all procedures he need to do to check that? First thing is whether the perpetual inventories records are properly adjusted. First thing he need to check that. Then he need to check reliability of entities perpetual inventory records. Is that system, perpetual inventory system, software system updating the inventory, is it reliable? Is it a good system? Then reason for significant difference between information obtained during the physical inventory count and perpetual inventory records. Physical inventory counting, the closing stock comes to be 25 lakh plus adjusted comes to 30 lakhs. But in the perpetual inventory records, inventory register, perpetual inventory records, it is only 29 lakhs. So 1 lakh difference is there. What was the difference? He need to get reason for that. Hope you got it. Then if auditor is unable to attend the counting due to unforeseen circumstances, because on 25th March it is auditor's wedding, so he was on, or 31st March inventory counting is happening, that day his wedding is happening, so he is unable to attend it. It's a genuine reason, right? In that case, what should he do? He need to do some physical count on an alternative date. Let him go on April 1st or something and do a counting on an alternative date. Let do some counting and perform the audit procedure on intervening transactions. Counting happened, imagine, on 25th March. He was unable to attend. So he went there on April 2nd, did some test counting, and or 25th March, whatever is there, and first he did it on 2nd April. So all these between days order, inventory purchase, he need to add a sales, he need to less, like that, he need to arrive at the 31st March order correct figure and ensure balance sheet same figure is there. He need to perform an alternate count. He need to perform count on an alternative date. He need to perform count and perform audit procedure on intervening transaction. Physical inventory counting date to auditors test counting date. That date's order inventory he need to adjust. Then if attendance at physical inventory counting becomes impractical, he is unable to attend the inventory counting because it became impractical. Imagine I am a supplier, I am a company in Kerala. I'm selling apples, like produced apples I'm packing and I'm selling. That is my business. So all my stock is there in the Kashmir Pahalgam, where the attack happened, Pakistan, that attack happened. It is there in the Pahalgam, terrorist attack. So if auditor go there to do the physical inventory counting, it will be a threat to the life of the auditor. So auditor, it is actually a valid reason for not to go there, right? So in such kind of cases, he'll never be able to go there for the next 5 months. So what should the auditor do? He need to, because anyways going there and attending the counting is impractical. It is a threat to the auditor, and government has also prohibited visitors to that area. So auditor shall perform alternate audit procedure. He need to perform some other procedure to get the audit evidence rather than physical inventory counting. Perform some other procedures like these are the other procedure. First is inspecting documentation of subsequent sale. Management is saying that they have 30 lakh inventory on 31st March. So to check that, anyways, you cannot go and attend the count. So what you can do, subsequent sale, that is check the sales of April. They're saying March 31st, they are having inventory of say 30 lakhs. So in April, no purchase of inventory was happened, but sale of almost 25 to 30 lakh happened. So that means if no purchase was happened, no production, nothing was done, then obviously this sale will be from the inventory in hand. So whatever inventory, if 30 lakh inventory is there and almost 30 lakh sale has also happened, we can make sure, okay, this sale is from the inventory, so no need to check the inventory. Like that subsequent sale, whether the inventory they are saying whether it has been sold actually. When you check that and compare the figure, you will get it. So that is an alternative procedure. If this procedure is also not possible, and he can also perform some other procedure, whatever he want to. If no other procedure, if no this kind of procedure is unable to be performed, or it is not accurately coming, so auditor has no other way. Physical inventory counting not possible, other procedure also not possible. So what can he do? He have to modify the opinion. He need to give a modified opinion telling that he was unable to get audit evidence. He was unable to get sufficient appropriate audit evidence, so he gave a modified opinion. So he need to perform alternate audit procedure and to check the existence and condition of inventory. If that is not possible, modify the opinion. Simple. Then in actual cases, in some cases, attendance at physical inventory counting may become impracticable. This may be due to factors such as nature and location of the inventory. like I told you, Pahalgam, then location of the inventory is in a very high risky area. You cannot go and check that. Or imagine the nature of inventory. Imagine a company is a chemical factory and chemical is their inventory. So if a auditor goes to there and he may get the breathe in that air where the chemical is there, his life is at threat. So he is not ready to go and check those chemicals. So that is the nature of inventory. Because of the nature or because of the location, if it becomes impracticable, then he need to perform this procedure. But it should be genuine. Like simpler, he should not say, if imagine Pahalgam attack never happened in Kashmir. So what is the problem in going to Kashmir and inspecting the inventory? He can go. But he cannot say that general inconvenience. I don't want to travel. That is just a general inconvenience. Or you can say, sometimes auditor may say, you hear from Kerala to Kashmir, flight ticket is 10,000 rupees. Why should I bear? Or like, why should the company bear? Like that, cost or time, I don't have time to go there. Cost or time involved or general inconvenience of auditor is not a valid reason. He cannot say, because of these reasons, I did not attend the physical inventory counting and I'm modifying the opinion. No, he should not say that. That is not a valid reason. If it's a valid reason, he can perform alternate procedure. If invalid reason are that, it is not possible. Matter of general inconvenience to the auditor is not a sufficient decision. Sufficient decision by the auditor is not sufficient to support a decision by the auditor that physical inventory counting is impractical. That he cannot say. As per say 200, matter of difficulty, time or cost involved is not a valid reason. I told you to omit an audit procedure which does not have any alternate procedure. Then if inventory is under the custody and control of a third party, I am a company and my inventory, I have imagine 30 lakh worth of inventory. And in this 30 lakh, I have worth of 30 lakh inventory. And in this 30 lakh, 10 lakh is, 20 lakh is with me. And the 10 lakh worth of inventory is with a third party. That is, I have pledged this inventory to someone and I have taken some money from him. I have given this as a security. So this inventory is now lying with the third party. That is first option. Second option is also there. Imagine a company may have a franchisee or something, which is a separate kind of a business. So my inventory may be there at their place, not in the company's hand. It may be at some different place. Not like a franchisee, not a franchisee, a separate outlet. Let's take a company like Snitch. Imagine Snitch or not Snitch. Boat itself will take. Lot of inventory of the boat may be at Reliance Digital. They may not have sold it to Reliance Digital or Chroma or all these kinds of like Saravana stores, Chroma, Reliance Digital, Lulu Hypermarket. All these are supermarkets where boat company will put their Bluetooth speaker, all these things in the supermarket. They are not selling it to the supermarket. They may put it in the supermarket, and so the inventory is now lying with the third party. Boat's inventory is now lying with the third party. Boat had 30 lakh worth of inventory. 20 lakh inventory is there in the boat's go down, and 10 lakh inventory is in the different supermarkets hands. Supermarkets warehouse, this is written. Boat has not sold it to supermarket, just kept it there, and when the sale happened, boat will get the money and supermarket gets a commission. Imagine it's that kind of an arrangement. So now the inventory is lying with the third party, not with boat. And boat's auditor has to come and check the inventory. Boat has shown 30 lakh in financial statements, but in the boat warehouse only 20 lakh is there. So how will we get the evidence for existence and condition of this inventory? That is inventory lying with the under custody and control of the third party. What will the auditor do? He can request a confirmation from the third party to the quantity and condition. I will send a mail. I am the auditor. I will send a mail to the supermarkets. I am board's auditor, or this if I have board has pledged the inventory to that person, anyone who has the control of inventory. I'll send a mail and I'll ask them, bro, please confirm whether board this much quantity of inventory is with you. Then they may confirm and say what is the condition, that is existence and condition. I will send a confirmation. Then they will reply to me, then I can take that as audit evidence. So that audit evidence is coming under SA 501 audit evidence. Then perform inspection or other audit procedures also I can perform. If it is possible, I can go to their shore and do the inspection. Other audit procedures may include inspecting the documents regarding inventory held by third party. For example, warehouse receipt. When board gives this inventory, the other party, supermarket, will have a warehouse receipt. There the quantity of inventory given will be mentioned. I can check that. Then requesting confirmation from other party where inventory has been pledged as a collateral. If it is pledged as a collateral, request confirmation from them. Attending or arranging another auditor to attend to the third party's physical inventory counting. Third party, that supermarket will have a inventory count. That time, either you can go and attend or you can ask that auditor or any other auditor to go and attend. And from there you can get the evidence. Then obtaining another auditor's report or service auditor's report on adequacy of third party's internal control to ensure that inventory is properly counted and adequately safeguarded. Third party will have an internal control. Third party will have an inventory counting. Third party. And that party will have internal controls over the inventory. So I will get that third party's auditor's report. I will get to check whether that third party have a really good internal control. If third party's internal control is good, all the inventory in the third party store will be properly managed and properly counted. And my inventory is included in that. So third parties what is the status of third party's internal control over inventory? So to check that, I will obtain the third party auditor's report. And the report, it will be mentioned how good the third party's internal control is. So that means how good the third party's imagine third party's internal control is good. That means third party's inventory counting will be good, and third party whatever info they are giving to us will be correct. So for that, I will obtain that auditor's report. Then next is litigations and claims. So hope you understood inventory. Next is litigations and claims. That is all the cases and claims against the company and filed by the company. So for that, for checking the litigations and claims, auditor will first seek a direct communication with entity's external legal counsel. Every kind of these companies will have a advocates as their external legal counsel. Advocate team will be there for bigger companies. So company may have a lot of cases against and in favor of company. So auditor will talk to, that is through a mail, auditor will send a mail to these advocates saying, I am the auditor of this company and I need to have a list and all the things of all the cases against the company and all these things. So I will seek a direct communication with them. For seeking a direct communication, I will send a letter of inquiry. In a mail, it's a letter of inquiry. I will say I am the auditor and I need details about all the cases in the name of the company. I will send a letter of inquiry to them. And then they will reply and I will get an audit evidence. That is a way. So, but sometimes because the advocate, the bar council or their laws of advocate, that body's laws, sometimes that laws will say you should not reply to an auditor. Imagine something is there like that in the advocate's law. If something is there, if this kind of a law, something prohibit the advocate to communicate with me, that is because of this law, advocate cannot communicate with me. I send a letter of inquiry, but they are unable to communicate with me. Then you have to perform some alternative audit procedures. Okay. Then, if it is considered unlikely, that is, first I send a letter of inquiry. This letter of inquiry is called a letter of general inquiry. Like I am asking, sir, I am the auditor of this company. Give me a list of all the cases against the company. So that's a generally you are asking. You are not specifically mentioning any case number or not. No, you are not specifically asking anything. You are generally asking. So sometimes when you send this letter of general inquiry, if you think that other person will not respond, that advocates will not respond, why? Like he may be thinking like, oh, lot of cases are there. Why should I put all this in? Lot of things to respond. Like it will be a bigger message and he don't want to write it. Sometimes he may not respond. So in that case, you can send something called a letter of specific inquiry. It's another letter in which you mention, I am the auditor of this company and I want details of this case, like 2-3 cases, number and details you will mention. And for that cases, you want to get a info from the legal counsel, which specifically you are asking which case, which all those things. So it is high chance that they may respond. Company may have 100 cases against the company. So even you send a general inquiry, they will not respond. But specifically when you are asking 2 or 3 cases details, they may explain. So that is letter of general and letter of specific inquiry, very important. Then what all are included in specific inquiry? A letter of specific inquiry includes, in that letter, what will you mention? A list of the litigations and claims against for which you needed information. That or a list you will mention of that legal case number, all these things. Then where available, management's assessment of the outcome of each case and financial implication. Means below you will mention the case numbers and details, whatever info you want. Then below that you will mention management is thinking on this case, management will win and management will get a compensation from that other person of 10 lakh. This is management's assessment of outcome of the case, whether the case management will win or lose. Management, what is management thinking? That you will write there. And what is the financial implication? Whether management is thinking management will lose the case and we'll have to pay a penalty of 50 lakh. Like whatever it is, you will mention that. Then you will ask, sir, management is saying like this. Ask the advocate of management, what is your opinion? Your opinion of this case. What is your assessment whether we will win the case or lose the case? You are going to present it in the court. What is your assessment? First, we will say management is thinking like this. Then what are you thinking? We'll ask to the advocates in that case. So 3 things will be included. And we will also ask them, sir, what do you think? Management is saying like this. Do you agree to this or do you not agree? Then reason. Like that, we'll ask them. That is a request that the entity's external counsel please confirm the reasonableness of management's assessment. That is, whatever is management thinking, is it correct or not? Is it reasonable? Please, I'll ask the counsel to confirm, external legal counsel, advocates, with the further information. If the list is considered by the entity's external legal counsel to be incomplete or incorrect, if this list anything is there, please give extra information needed. So these things. Then cases where auditor may meet external legal counsel. In these cases, here auditor is just sending an email. Here he will go and meet the external legal counsel. What all cases? If a matter is a significant risk, if there is a significant risk, Byju's company may going concern is getting affected, going concern is affected, so it's going to be a serious case. Government may order for a liquidation. So it's a very big complicated matter. There letter of inquiry on them is not possible. You have to go and meet the counsel. Lot of people has filed a case against Byju. So matter is a significant risk matter, so go and meet them. Then if matter is complex, that is you are not understanding it by yourself. If it's a complex matter, go and meet them. Then there is a disagreement between management and entities external legal counsel. That is, management is saying we will win the case. Advocates are saying we will lose the case. So based on an assumption, we need to take a judgment, right? Disclosures and all, whether going concern will be there, all these things. So for that, they are having a disagreement. So go and meet the counsel in person and ask their reasons. 3-6. Then in case of non-response, that is, you send a mail to the external legal counsel. They are not responding. Case 1. Or you ask the management, bro, I need the email ID of your advocates. I need to send a mail. And management is saying, no, I won't let you communicate. In these two cases, first, you are asking management and management is saying, don't communicate to my advocates. First, management is refusing you. Second, management gave you the email ID, but when you send the mail, external legal counsel is not responding. In these two cases, if management refuses or entity's legal counsel does not respond, refuses to respond, in that case, auditor is and because of that reason, because of in the reasons, auditor is unable to get audit evidence by performing alternate procedure also. When these two things happen, he need to try another way. He need to perform alternate audit procedure. He did that also, but he is not getting any audit evidence. He is unable to get audit evidence. Management is not responding. They are also not responding. Another audit procedure is also not working. In that case, he need to modify the opinion. Very easy. Then segment information, like I told you, 3 segments are like 2 ways you can divide the segments based on geography or based on products and services. Geography means Nike, taking company, Nike India, Nike US, Nike Europe, different country ways. Geographically, you can divide segments, or you can say it like Nike India is one segment, Nike US is another segment, like that. Or you can divide it through Nike's product basis. Nike or the clothing line is one segment, footwear line is another segment, accessories is another segment, like that. So segment information refers to information about different types of products and services and its operations in different geographical areas. So obtaining audit evidence regarding the presentation and disclosure of segment information, whether segment information has been properly presented and disclosed. You need to get audit evidence for that. How will you check? First, understand the method used by management determining segment information. What method management is? Lot of different complicated methods are there. You don't have to understand that. Just understand this point. What are the methods used by the management to find the segments? Are they dividing it in this way or that way? What method they are finding different segments, and what method they are allocating assets to one segment, like that. Then evaluate whether such methods are likely to result in the disclosure as per financial reporting framework. As per Ind AS and accounting standard and all these things, you have to disclosure. You have to disclose about the operating segments. So if management is using one method, whether that method proper disclosure as per the AS and Ind AS is coming. That is only our concern. Management, let them use any method. Whatever method they are using, our only concern is when they are using that method, finally the disclosure in the financial statement should be as per financial reporting framework, as per accounting standards. We just need to check that. Then where appropriate, test the application of such methods. Whether just if it's possible, just try that method, what they're doing, and test it once. Simple. Then perform analytical procedure, or that is comparison, or other audit procedure appropriate in the circumstances, whatever. And auditor's responsibility, we don't have a responsibility to report on segment information. No. Segment information is something that comes in the balance sheet. We just need to report on that only. We just need to get audit evidence regarding that only. We don't need to give a separate report on segment information. That is written here. Auditor is not required to perform audit procedure to express an opinion on segment. We don't need to express any opinion. We just need to report on whether it is audit evidence is correct or not, or like whether it is proper or not. That's it. Then understanding the method used by the management, right? This method. For understanding the method, you will have for understanding the method, what are the things you will do? You will check the sales, transfers, and charges between segments, elimination of intersegments and amounts. Just understand, learn this. Sales. SABU allocated assets consistently. That is a mnemonic. SABU. SABU. SABU, very easy. Allocated assets. Allocation of assets consistently. You will not forget it. Very easy. So sales, you need to check the sales, transfer and charges between segments and elimination of inter-segment amounts. Nike India sold the goods, some shoes to Nike US. Nike US has an asset and Nike, it let India to use that asset. So inter-segment things will be there. Inter-segment sales, transfer, charges between segments will be there. You have to check that first. Then comparison with the budgets and other expected results. That is, there will be expectation, like budget will be there. Nike India will produce this much sales current year. That is a budget, whether they have actually produced, compare with that. Comparison with budget. So sales are budgets. Then allocation of assets and cost among segments. Nike US have a, imagine some technical patent or something. So, and that patent is used by Nike India, Nike Europe, everyone is using that patent. So it's an asset is basically allocated to different segments. You check whether that is proper or not. Don't need to overcomplicate. It's a theory paper, not a practical. So understand that much. Consistency with the prior periods and adequacy of the disclosure with respect to inconsistencies. All the accounting policies, everything were consistently applied and all these things. Consistency. Whether the segment classification is consistent. Last year they were classified, they used one method and classified it in one way. Current year whether they are using the same method and classifying it in same way. All those things. So SABU allocated, assessed consistently. Very easy, done and dusted. SA501. Hope you liked it. So next one is guys 505, that is external confirmation. External confirmation basically mostly it is used for debtors. Balance sheet debtors amount is there, say 10 lakh and 5, 6, 7 debtors are there. So auditor need to check whether this debtor figure is correct. So auditor will send frame an email where he'll write, I am the auditor of this company, and in the company's balance sheet your name is shown as a debtor for 5 lakh rupees. Is it correct or not? We'll send a confirmation request. And that person who is receiving the mail, he will, if it is correct, he will say yes. If it is not correct, he will say no. And what is the actual amount, he will give it to us. So that is what we call external confirmation. So whatever reply which we get from the mail, we can use that as an audit evidence. So external confirmation for debtors basically. It is a direct written response to the auditor from the third party. He is directly sending me the mail. Company will give me the email ID and I am sending the mail. So definitions of terms, positive confirmation request. If I am sending a PCR, positive confirmation request, when I send it, I will tell him reply if you agree or disagree. Agree or disagree, in both the cases reply. Negative confirmation request means I will tell him reply only if you disagree. In the thing I have written, your balance is a 5 lakh in my company's bank balance sheet. If it is correct, you don't need to reply. If it is not correct, only reply. That is negative confirmation request. Reply only if disagrees. Then non-response means when you send a confirmation request and the other person is not responding, that is what we call the non-response. When you send mostly a positive confirmation request. Then exception means that is there is a difference in the information requested to be confirmed and what they have confirmed. You are asking them to confirm whether the amount is 5 lakh or not, debtors amount. Then he is saying, so no sir, it is not 5 lakh, it is 3 lakh. So that is an exception. 2 lakh exception is coming there. That is what we call exception. Then external confirmation procedures adopted by the auditor to obtain audit evidence. What is the actual procedure auditor follows to send this email, to send this confirmation request? What is the procedure steps he is doing? First, he will select the confirming party. First, he will select the information to be confirmed. What information he want to confirm? Which debtor? Like what is that information? Basically, debtors or amount, everything he has to confirm. That is the information. Then second, select the appropriate confirming party to whom it need to be sent. Select his email and all these things. Then design the confirmation request. Draft that confirmation request in the Word, type all the request. Then send the request and send the follow-up request. That is, you send the request, he is not responding, send a follow-up email also. Then this is a breakup of this is written here. Determining the information, that's very easy. All these things are easy. Then designing the confirmation request. The third point is a bit you have to learn, memorize. So then the breakup of what we learned here is given here. Okay. So firstly, we will take the designing of confirmation request. The third point, other two are easy. Designing the confirmation request. What are the factors the auditor should consider when designing the confirmation request? What all factors he need to consider? First thing he need to do is, these are the things. So the mnemonic is Asla's prime time was with Abil M.A. That is a mnemonic. Asla is a girl. Her prime time in her life was when she was with Abil M.A. Abil M.A. was her boyfriend. So when Asla and Abil M.A. was together, that was Asla's prime time. Imagine Asla is some social media influencer or something. So when she was with Abil M.A., they were putting all the contents and she was having the prime time. Then they broke up and Abil M.A. went. Okay. So Asila's prime time was with Abilemme. That is a mnemonic. Asila, what are the assertions being addressed? What assertion you wanted to check? In case of debtors, you want to first check the, I told you in that chapter 4 earlier, assertion means you want to check the existence of debtors, or you want to check the value of debtors. Whatever you want to check, tell it first. Assertion, what thing you have to check. Then specific identified risk of material misstatement, including fraud risk. So these are the things you will consider. What are the risks? Is that debtor going to be a fraud? Do you think it's a fake debtor? All that. Then layout and presentation of the request, proper format, everything. Then that is ASLA. ASLA. Then prior experience with the on the audit of similar engagements or similar engagements. Last year also I did the audit of same company and I sent confirmation request. What was my experience back then? That I will consider. That is ASLA PRIME. Method of communication. In what method I am going to send? Is it a paper, letter, or email? Whatever it is. As well as prime time. Time is just chumma given. Time was with ABIL. ABIL. Ability. ABIL. Ability of the internet confirming party to confirm. Whether he will confirm actually. What is it? Is he having the ability to confirm to my request? Then if he is not using any email, that he is that kind of a guy. He don't have the ability to confirm to my request like that. Then what? Then Asla Abil MA. Then MA. MA means this one. This one, management's authorization. MA. What is management's authorization or encouragement to the confirming party to respond to the auditor? That is, sometimes when an auditor is sending a request to confirming party, they may not respond. Only if because they don't know their auditor, they only know that management, the company only they will know, the client only they will know. So management will also give an authorization. Like management will sometimes call the person and say that please, my auditor has sent a mail, please respond. Or inside my mail itself, some management's authorization letter may be kept. That thing. So these are the things you need to consider. Asila's prime time was with Abileme, easy mnemonic, right? And you will never forget that also. Next is this one, that is positive confirmation request. It is literally very easy. That is, in the positive confirmation request, there is one problem. Because I am asking the confirming party to respond if he agrees or disagree. So when I send a mail, when he sees the mail, like debtor amount of 5 lakh, is it correct or not? So he may not sometimes open his books of accounts and check what is the correct amount and then reply. No, if he may be using the mail from his mobile, he'll say, 5 lakh, yes. Chumma, he may, without even checking, without even searching whether the amount is correct, the confirming party may put a yes or no. So to avoid that, we need to get the exact amount, right? In the company's book, what is the amount? He need to confirm that exact amount. So we don't know whether he's confirming with proper consciousness or not. So for that reason, what we will do is that we will send a blank confirmation request. We will not put the amount. We will say, sir, I am the auditor of the company. Can you please confirm the amount in your books regarding this company? You are the debtor. What is the actual amount you are owing to pay? So what he need to do, he cannot put a yes or no. Now he need to open his books of accounts and see what is the actual amount and then confirm. So we are making him actually confirm, making him do the work and give, so that we will get the correct amount. So that one request we can give. That is called a blank confirmation request. But there is a problem of the blank confirmation request, that when you say send it without the amount, sometimes it is a tiring process for him. Like he don't want to open his books of accounts again, and then sometimes he may not respond. That is a problem also for the blank confirmation request. Then make sure the email address, everything is properly correct. Then follow up and request, it's very easy. Then management's refusal to allow the auditor to send a confirmation request. That is, sometimes you may ask the management, bro, I need to check the your debtors. For that, give me the email ID or the address of all the debtors. Sometimes management may say, imagine if some fake debtors are there. Management may say, no, we are not going to give you any mail. That is not possible. We don't want you to communicate to our debtors. They may give some excuses, this management. In that case, what you need to do? First, see what is the reason for refusal. Why management is saying that? If the reason is valid, genuine reason or not genuine reason. Then see what is the implication of management's refusal. That is, when management is saying, management is refusing us, now we need to see, because of that, we won't get external confirmation. Now we need to perform some other audit procedures. So that is what is management's implication. So is there a chance of fraud? Why is management refusing? That all things you can consider. Then after that, you perform some alternative audit procedure, because anyways you wanted to check debtor, you are not getting the balance from management. So now you perform an alternative audit procedure. Perform some alternative audit procedure. That's it. So, and if you find out that this reason given by the management is unreasonable, that is, if you are thinking it is unreasonable, then auditor concludes that management's refusal is basically unreasonable, and auditor is unable to obtain audit evidence through any other method also. We asked the management and they are saying no. and we tried other methods to obtain audit evidence, that is also not possible. So in that case, communicate with the TCWG as per 260. That is, tell TCWG, bro, like not bro, always call them sir. Management refused me to send the confirmation request. I was unable to perform any other audit procedure also. So there is no other way. So I am going to modify my opinion. That is, whatever opinion you are going to give, tell that to TCWG. Then reasonableness of management's refusal. That is, audit is required to inquire as to what is the reason for management's refusal. I told you, we'll check the reason. So sometimes a common reason is that, imagine there is a dispute, a legal case or something is happening between the management and that debtor. Some issue is happening with them. So sometimes management may not allow you to send a confirmation request at that time because management and debtor is having some issue. So at that time, management don't want an auditor to send some confirmation request because it's like a bad name for the management. It's not a good thing for management. So management may not allow. So that is a genuine reason, no problem, because a legal issue is happening. That is written here. So valid reasons, it's okay. Invalid reasons, it is problem. Then we told auditor need to perform alternate audit procedure. What are the alternate audit procedure he can do? For checking the accounts receivable balance, you can use this confirmation request for checking debtors, creditors, and some other cases also you can use it. Mostly it is for debtors and creditors. So if you want to check debtors, accounts receivable balance, what are the alternative procedures other than confirmation? You can check the subsequent cash receipt or shipping documentation on sales near the period end. That is subsequent cash receipt. Imagine we are unable to check the debtor on 31st March. They are saying a debtor named Arun is outstanding, like say 30 lakh is outstanding. So now you can see we don't have the email ID or he is not responding to external confirmation. Now we need to use some other technique. That technique is this is outstanding on 31st March. So just check the money received on April, May or June, whatever time is there. Just check the money received on the next month, April, May or June, like money received. If any money has come from this guy, imagine 30 lakh receipt has come from Arun. So that means this amount is correct, this amount was correct. If only 20 lakh was come, so there is some problem in that. So to check the debtors whether the same amount has been received by the company in the subsequent months in the next accounting period, auditor can check that. Then another way is shipping documentation. They are saying debtor is 20 lakhs. Okay, now go and see whether actual goods has been shipped to that debtor. If the debtor is origin, when a sale is done, then debtor comes, right? So to check the debtor, just check whether the goods has been shipped to that debtor. Simple. Then similarly for account payable balance, you can check the subsequent cash disbursement. Here cash receipt, here cash disbursement, whether company has paid in the subsequent months. Or then correspondence, any other communication from the parties, all these things you can check. Then negative confirmation, that is a confirmation request in which you will respond, or the confirming party will respond only if he disagrees. If he disagrees only, he will respond. So now what to do? See, negative confirmation request, a very big problem is there. Guys, sometimes I send a mail to a confirming party. He may not have seen the mail. He may not have opened the Gmail. But I am assuming he agreed because he will reply only if he disagreed, but he has not replied. So I am assuming he agreed. But sometimes that person has not even seen the mail also. That is also possible. It went into his spam or junk folder, whatever. So that is a problem, right? So that is why we are saying positive confirmation request is much better audit evidence than negative confirmation request. Negative confirmation request is a less persuasive audit evidence. So you should not use negative confirmation request as a sole substantive procedure. That only procedure you should not use. No, normal cases. But you can use it as a sole substantive procedure. So sole audit procedure, you can use it in these cases. If these conditions are present, these 4 conditions are there. If these 4 conditions are present, you can use negative confirmation request alone. Else, use a positive confirmation request. So what are the 4 conditions? It's a question. First, audit, the assessed risk of material misstatement is low. That is, debtors and auditor is thinking no risk is there. It's like no problem, no fraud. Auditor is not suspecting anything. Risk is very low. So that timely he can use negative confirmation. Then population of the items subjected to negative confirmation comprise of large number of small homogeneous items. Whatever debtors we are sending this negative confirmation, make sure the amount is small and basically it is homogeneous items. There is similar amounts or similar items are there. So you can send it. Small number of lower amounts on all these things. So it's not a very big problem. Then a very low exception rate is expected. That is, exception means a difference in the amount you asked him to confirm and what is his confirming. So that is exception. You are expecting a very low exception rate. That means you are not thinking that he will disagree to what information. So in that case, normally you will send this thing. And one more thing, audit is not aware about the circumstances in which he would disregard such a request. We don't know in what all cases he may not reply all those things, because we don't know that guy. If auditor is aware, because if we know that in these situations he will not reply, then don't send him. So to send a negative confirmation request, you should not be aware about in what all circumstances he will not reply. Okay. Then this thing I told you. Then evaluating the audit evidences obtained. So when you send a confirmation request, you will get the reply you will get, that is an audit evidence. So now how will you evaluate? That is so for so many people you would have sent a confirmation request. Some people would have replied. Some people would have not replied. Some people, whoever has replied, they may have agreed. Some people would have disagreed. Lot of these kinds of reply you will get. So now you need to categorize that into different terms. That is, auditor may categorize the reply received as a response indicating agreement with the information. The first settler he would have sent 100 mails and he would have received a reply of almost 70 mails. Imagine he sent 100 emails to 100 letters and he received 70 replies. So basically, first thing he will check, okay, 30 has not replied. 30 not replied. This is one category he can keep. 30 people has not replied. Whoever has not replied, one category, separate. Then out of the 70 replies, how much people has agreed to the information requested? I told their amount. How much has they agreed? Imagine agreed was say 40 people has agreed. How much has not agreed? That is exception. Not agreed, like they are giving another amount. They are stating their company books is wrong. So imagine 30 has not agreed. So this is category number 1. This is, you can put category number 2. This is category number 3. C. This is information to agreed. Then response deemed unreliable. That is some response you received that you are thinking it is not genuine. You are thinking some problem is there. That you can put as another category. Then a non-response. A lot of people who has not replied. That you can put as another category. Then a response indicating exception. That's also you can put it as another category. So category 1, 2, 3 and one more. That is fourth category, a response which is deemed unreliable, which you don't believe it is correct. So this is all about SA 505, and 510 is basically an easy standard which you can easily revise it by yourself. Nothing is there. When you're doing the audit for the first time, for opening balances, make sure the things are consistently applied. Like you have to check the opening balance, like last year or closing balance is properly carried forward to the current year in the opening balance. First thing you have to check. Second thing, last year whatever accounting policies you have followed, make sure same company is following the same accounting policies current year. Last year they used the LIFO method for inventory valuation. Make sure current year also they are using it. If there is a change, whether that has been properly disclosed, all these things you have to check. That is all about SA 510, which you can easily learn and understand. Next is SA 550, that is basically related party. So I'm assuming you know what is a related party. You would have studied in law, accounts and all these things, similar things. So a related party is either the related party as defined in the financial reporting framework as per the standards and all these things, or these are what we call related parties. A person with, like, if our company, any person having control or significant influence in our company, he is a related party. And to the opposite, if our company is having a control or significant influence in any other area, that is also a related party. I'll say what is control and significant influence in audit. Then another entity that is under the common control. Our entity is there, and we are controlling two entities. So both are related parties. Or one common entity is there on top, and that is controlling us, and another company is also there. So we both are also related parties. Simple. Under the common control, though having common controlling ownership or owners who are close family members, then it is a related party. Then common key management, very easy, related parties. They're not going to ask you like who is a related party in the question. No, the auditing area, the question will come. However, entities that are under the common control by the state government, like any state government is controlling, like all the local government, state government companies are not related party, are not considered to be related unless they engage in significant transactions or share resources. One state government company and another state government company are normally, they are not related parties, but if they are doing any business together or sharing any resources, then it becomes a business related party. Then what do you mean by control and significant influence? Very easy. Control simply means the power to govern the financial and operating policy. That is one person, that is one thing, our company or one person can control us, like more than 50% stake is there, he can control us, then that is what we call control. Then significant influence means I don't have the power to control, not 50% stake or nothing is there, but I have a right to vote I am a shareholder, so I have a right to vote is there, or right to participate in the decisions. So here I to participate in the financial or operating policy decisions. This is what we call significant influence. So this is the presence of control or significant influence. It comes through direct or indirect equity shareholding or financial interest. You are a shareholder, obviously you will become a related party. Then entity in company is holding shares or equity in the other company, or financial interest in other company, then both of us will become a related party. A TCWG or key management is obviously related party to the company. Close family members of any person referred in subparagraph 3, that is, these family members of these two people are also related parties. Then one company having a significant business relationship with another company, both are related parties. Then what is dominant influence? Dominant influence, guys, some people will be there. Imagine, I'm hypothetical example. My father is my father had a company, and my father was running the company. So after he became old, he gave all of that shares, everything to me. So now he is not having any share. He is completely out of the company. He's old aged. He's sitting on retirement at home. But still, when I take all the major decisions, I would go to him and he would advise me. Then only I'll take the decision. So basically, he is controlling still the company. So he is, without even any share, he is likely to have that dominant influence in the company. So such a kind of situation, sometimes without share or anything, some person may have a dominant influence over the company. That is what we call dominant influence. He can control the company. Then meaning of special purpose entities as related parties. Special purpose entities means a company, example DLF builders. They may create a separate DLF or a separate company for just holding the assets of the company. One company is there, they may create another special purpose company just to hold the assets of this company or something. So for any separate purposes, companies may create another company. So they are also called related parties, special purpose entities. The nature of related party transactions and relationships. What is the nature? So normally, sometimes in normal course of business, you may be having a related party transaction. That is just normal. It's not a very high risk of material misstatements. One company and another subsidiary is there, they are having normal business relationship. That is okay, no problem. But when these situations are there, one company, one party and another party, related parties, if they are doing the normal business, there is not high risk. But if they are having any these kinds of situations in the related party relationship, then it becomes a significant risky item. So what are the matters or what are the circumstances that give rise to higher risk of material misstatements? These are the circumstances. It can be a descriptive question. So first, when they engage into complex range of relationships. The relationship is complex. That is, one company owns another company, and this company owns another company, that company owns another company, and indirectly, and this company is doing transactions with that company. So indirectly, complicated relationship they have formed, and they're doing that kind of transaction. So then it becomes a high risky area. Then information system is not effective. That is, company's information system is not effective in identifying what are related parties, what are non-related party transactions. Then it is a risky area, because company cannot in IT system cannot identify the related party transactions. So it's a very risky thing. Then related party transactions are not normally under the market terms, but if they are not under the market terms, may not be conducted under market terms. Normally, when a company, I am selling my steel to another company for like 1 lakh rupee per kg or something, not per kg, but just 1 lakh. But for related parties, I'm selling it not under the market terms. I'm selling it for like 70,000 or something. So if there is something like that, it is not under the market terms, things are being happened, then it is a significant thing. These three things you have to keep in mind. Then it's very easy. How do you understand the entities, related party relationships and transactions? I'm an auditor. I'm going to audit one company. First of all, what all things I should look to understand who are the related parties? Because I don't know who are the related parties. So what are the first things I need to do to understand what are the related parties of that company? First thing, identify entities, related parties, their name, details, etc. Ask the company itself first. Who are your related parties? Who are the companies in which you own share? And through examining the records and documents, I can first step is identify the related parties, their name, their details, all these things. Then understand how the related party relationship was formed. What is the nature of relationships? How a relationship formed? That is it because of family relationships? Also, is it because of shareholding? Or is it because of any patent sharing? What or business relationship? Because of what reason the related party relationship came? The relationship became related party. That is nature. Then you have to check what is the type and purpose of their transactions. They may be related parties, may be doing transactions. What type of transactions are they doing, and what is the purpose of those transactions? How they are getting benefited? Then these are very easy. Then consideration specific to smaller entities by the auditor. TCWG may not include an outside member or a role, and the role of governance may be undertaken directly by the owner manager where no other owner exists. That is sometimes in these smaller companies and all, there might not be a very big structure like TCWG management, nothing. Management itself will be like acting like the TCWG, all these things. So in those cases, control activities in the smaller entities are likely to be less formal and may not have a documented process. Company may not have a good internal control activities and all these things. Smaller companies, one person may be doing multiple tasks, no proper internal controls, everything will be there. Everything will not be there. So an owner manager may mitigate the risk arising from related party transactions or potentially may increase those risks also. So this person, he's doing everything. So he unknowingly sometimes get into related party relationships and problems, or sometimes he may find ways to reduce the risk. Sometimes he may find ways to increase the risk. Nothing, just read and understand. Nothing is there, not anything complicated. Then how can an auditor verify the existence of related party relationships and transactions? How can he verify the existence? Like, how can he find out related parties from of company? Company may say only 10 related parties named to us, but actually they may have 15 related parties. So how can we identify them? Just look at these documents. First, look at the company's IT return, then information supplied to regulatory authorities. What are they? Just 5-6 points keep in mind, very easy. Then look at the life insurance policies acquired by the entity. If company has a very big serious related party, they may take a life insurance policy for them also. So when you observe this, you can find out who are related parties. Then look at the internal auditor's report. Internal auditor would have flagged who are related parties. Look at the documents of securities regulator and all these things. Simple area. Done. So hope you had understood what is actually related party relationships and transactions. It's very easy. So guys, next is SA 520 analytical procedure. So understand, yeah, the interrelated party view was over. So next is analytical procedure. So here I am going very quick on analytical procedure because analytical procedure SA 520 and SA 530, sampling and analytical procedure, both of them, I believe you need a very big, deeper conceptual clarity, more than like just in 10 minutes, 15 minutes, it's hard to explain. But here I'll explain, just give you a brief, and like whatever is important for the exam, I'll make you understand that. But 530, I'll upload it in my channel. You can go and watch it there. Then 520 will be here, because 530 revision will take around 1 hour itself, just for that one small standard, because it cannot be revised in a quick manner. Even if I revise in a quick manner, I can say things from outside only, which is not even useful for you, because you will not understand anything conceptually, because there is a tolerable rate of deviation, tolerable rate of misstatement. Line by line, every item we have to explain. So please watch it there. In 2 days, I'll upload that video there. Then 520 also detailed video, I'll upload one there also. So you can go watch it there. 520 and 530, two standards. Then because else this will take another 1.5 hours more just for this one standard. This two standards itself, it will take you 2 hours. Then SA 520 analytical procedure. So what do you mean by analytical procedure? It means analytical procedure, it is basically comparison of financial information and consideration of relationship. A simple example I'm saying you, company during audit process, auditor will, what he will do, current year financial statement he will take, previous year financial statement he will take, both of them he will compare. Last 2-3 years financial statements he will take. Then sales. Imagine sales figure is like this. This is the year 20. Imagine it is 21, 22, then 22, 23, then 24. I mean 23, 24. Then current year. Imagine this is a current year. Current year is next year, 24, 25. Sales. When you just see, I'm talking about the concept of this. Just the concept we'll explain it here. Line by line I'll explain it there. Okay. Then SA 20 solution 21, 22. Imagine the sale was 10. Here the sale was 12 lakh. Here the sale was 14 lakh. So you will have an expectation that here the sale will be all average in the range of 15.5 lakh to 17 lakh, 16 lakh. This will be your expectation. This is your expectation. Current year sale should be like this, at least when you follow the trend. Then you will see what is the actual current year sale. The actual current year sale comes down to, imagine, 22 lakhs. Then so you are comparing all the financial information of many years. So you understood current year, as per the trend, 16 lakh should come. Okay, 17, okay, 18 okay. How 22? So some fraud may be there in the risk, there in the sales. You understood? This is called analytical procedure. You just compared and you reach the conclusion something. Then what you will do? You will do the detailed testing of sales to identify whether there is any fraud. So this comparison is we call analytical procedure. So this basic comparison what we are using, we will be using this basic comparisons in essay 315. There is analytical procedure 315 for inquiry, inspection, observation, analytical procedure. There we are doing these kinds of basic comparisons. Then one more thing, imagine sales. So when the imagine the actual sale is say whatever is enough, that much is enough. Then one more thing I'll say, consideration of relationship. I told you this is comparison of financial information is what we showed here. So now let's remove all these years right now. For a simple example, I'm showing it to you. Last 2 years only. Imagine last year's sale was 10 lakh. And current year sale when you are seeing is 20 lakh. When you are just seeing these two things, you can say, happy, company is doing really well. But when you put this for one figure, quantity of goods sold, quantity of goods sold, here it was 5,000 units and here it is 13,000 units. Now tell me whether the 14,000 units. Now tell me whether company is doing good or not. No, because 5,000 units last year company got 10 lakh profit. So here to take 20 lakh profit, 10,000 unit was correct. But company sold 14,000 units and only got 20 lakh sales. What is that? So sometimes some sale may be not recorded, omitted, missed. Some sales and invoices may not be recorded in this, or sometimes some inventory may be stolen. Anything can be possible. So here what are you doing? You are comparing sales only first, but now you are considering the relationship of a sale with the quantity of goods sold. So this is what we call this one, a consideration of relationship. So analytical procedure is comparison of financial information plus consideration of relationship. Two things are there. See, it's a comparison of financial information plus consideration of relationship plus some other procedures which you are doing. So see, same example I've seen with the rent and all these things which you can see. And definition of analytical procedure, see, a lot of people find it difficult. Evaluation of the financial information through analyzing the plausible relationship between financial and non-financial data. So guys, what did you did here? You were evaluating financial information. You need to check the sales. So evaluate sale is a financial information, rupee were right. So you are evaluating this financial information. How are you evaluating? By analyzing the plausible relationship. Plausible means logical relationship. Logical relationship between these two. You looked at the relationship between these two. When quantity is this much, sale should be this much. Then quantity, what should be this much, sale should be more than this. So you were analyzing this financial information by, you are evaluating this financial information by analyzing the relationship between these two. Between if this one is a financial information and this is a non-financial information. Quantity is not an amount. Or a financial and financial can also happen. So you can understand basic things. Example of comparison, comparable information. You can compare current year with the previous years, or you can compare current year sales with the current year budgeted expected sales, or you can compare similar industry, Zomato sales versus Swiggy sales. So you can compare to get this. Detailed, I'll explain there. Then examples of analytical procedure having consideration of relationships are there. Then objective is VC. Then what a timing of analytical procedure. When you are performing analytical procedure at the planning phase, say 315, basic analytical, like basic comparisons and all, that is analytical performed at the planning phase. When you're doing it at the testing phase for detailed checking or the completion phase, it is called a substantive analytical procedure. Okay. Then these are analytical planning phase, I told you. Then substantive, I told you. Then what are the factors to be considered for substantive audit process? What are the factors you need to consider? It is not one mnemonic we made. So you can see Sandeep. Sandeep is one mnemonic. Sandeep, SANDIP. Other than this, I made one mnemonic. Let me see. One really good mnemonic we made. In the class, in the memorization batch, not in memorization, not in the power prep batch, we made some mnemonic on this. Let me see what it is. It is not there in this book. Then what booklet is there? Let me see. In this booklet, is it there? Swapna in Addis Ababa. You know what is the capital of Ethiopia? It is Addis Ababa. So Swapna is a girl, travel blogger. She went to Addis Ababa, Ethiopia. Okay, Swapna in Addis Ababa. SO means source, P means predictability, NA means nature of assessment. Swapna in Addis Ababa. Addisa, A. Availability of data, A square is there. Second A is account type. A, DISA. Disaggregation, DISA, Baba. Baba is not there, nothing is there. Then in means, Swapna in means inherent risk. Very good mnemonic, right? You will never forget Swapna. You know someone like Swapna. Then available for part of the factors he will consider for substantive audit procedure, not only for analytical or for test of detail also. Substantive audit procedure is divided into two: test of details, analytical procedure. So what are the data you will consider for that? First, availability of data, whether you have proper level and reliable data for this comparison purposes, do you have a good reliable data? Then disaggregation, that the degree of breakup that is available in the data. Then what account type you want to check. These three things are related on one term, predictability. Account type, like P&L items normally have a pattern. They tend to be predictable over time. Sale, last 3 years sales, if you get current year sale, you can predict. That is P&L items, P&L account type, it is more. Income statements, analytical procedure is easy to use. Then, but balance sheet item, if you see debtors, last 3 or assets, last 3 years asset you got. Current year asset, can you predict? No, asset is not following a pattern. Last 3 year company would have bought some asset. Current year they would have not bought some assets. Current year sometimes they would have sold some assets. So there is no, for balance sheet items, analytical procedure is not that much useful. But there is something which I'll say. Then source, if it is, see here also predictability basis. Then predictability, same thing. If for P&L items, predictable items, you will use analytical procedure. Nature of assertion you are checking. As analytical procedure through, you can only check, mostly, you cannot check. Imagine you want to check the rights and obligations of a PPE. That is the ownership of a PPE. How will you compare and check anything? No, for that checking, you need to get the certificate, ownership certificate. For physical verification, you have to go and verify it. Their analytical procedure cannot be used. So you cannot get evidence of rights and obligation or anything by using analytical procedure. No. But completeness or valuation you can get. Assertions, completeness, whether all the sale is included in the current year. When you compare current year sale with the previous year sale, if current year sale is very low, not following the trend, so that means some issues there. Now we will do the detailed checking, you will see some sales were missed. So you can get completion assertion and valuation assertion, you can get evidences. Inherent risk, when inherent risk is higher, test of details performing is much better. Then what are the techniques available for substantive analytical procedure? What are the different techniques? Trend analysis you can do by substantive analytical procedure. Last 3-4 years trend basis, like current year trend you can predict. Then ratios of previous years also you can, previous years or current year budgeted versus actual, or current our company with the competitor company, ratios you can analyze, like growth rate, revenue growth rate, all these things. Then reasonableness test, based on this you can check whether things are reasonable. For example, I'll see reasonableness test means if you have loan in a company, you checked the loan item, you checked. So loan, it is written loan at the rate of 10%, 10 lakh is taken. So you will know when you check the loan with this thing, you can check in the P&L interest will be there. P&L, inside the P&L interest will be written, interest expense. And the company has written, imagine interest expenses, say some 70,000 interest expenses they have written. So now you can easily check it through analytical procedure. Like considering the relationship here, there is a relationship between loan and interest. This percentage into this is the interest, right? So 10 lakh into 10%, 1 lakh should be the interest expense. But they have only written 70,000. So you immediately you can identify this interest is wrong. They would have not paid some, they have not missed some expenses. So this is called a reasonableness test. You can check the reasonableness of items in basically P&L by comparing, by using analytical procedure. This is also analytical procedure. You are comparing you are considering the relation between loan and interest. Based on that, you are getting the amount. Or you have, if you wanted to check the wages, in the balance sheet, the P&L wages is written as 10 lakh. First option for you to check is either you can go to check all the total wage list, which all the payments, which you can compare and check, but that will take you 5 days to check the wages. Imagine there are 1,000 employees. But rather than that, the easy ways to check is get from the company what are the number of employees you got, then into what is their average salary. Like not just normal calculation, we won't do it through equations and all in computer. Imagine just for example, average salary, bonus, average salary, say you got average salary. If you multiply this with and into 360 into 12 months, if you are getting an amount in the range of 9.5 lakh to almost 11 lakh, almost you are getting similar to 10 lakh. So it is like you can say, it is correct. Rather than doing the complete checking, here you got a basic idea whether this amount will be correct. Chinna misstatements are okay. We are only focusing on material misstatements. So here you can check the reasonableness of wage by analytical procedure. What are you doing here? You are considering the relationship between number of employees and average salary and their salary. Then you will get the wage like that. Okay. Then structure modeling, it is a modeling tool that they create from all the trends to predict the current account balance. Then analytical procedure used as a substantive test. You can, what is auditor actually doing in analytical procedure? What is he actually doing? First, determine the suitability of assertion to be suitability of particular substantive analytical procedure for given assertion. You wanted to check some assertion. What is the most suitable analytical procedure? First, he will decide that. Then he will evaluate the reliability of data from which he can do that. Then he will check the reliability of data for using analytical procedure data. Then he will develop an expectation of recorded amounts or ratios. Expectation means here I told you. Here we are having an expectation, like based on the loan amount at the rate 10%, actual interest should be 1 lakh. Like this, you have an expectation. When you compare last 3 years sales, current year sale, what it should come, you should have an expectation. Then you compare that figure with the actual figure. Then only you will know whether there is any problem. So you can generate that kind of expectation, then determine the amount of difference in same thing. Then these same things are detailedly explained here. How to check the suitability of particular assertion, like this. Then reliability of data they have written based on the source comparability nature. Then evaluation of whether the expectation is sufficiently precise. 4 things are there. Then amount of difference that is acceptable. If the assertion, that thing you are checking is high risky item, then less difference is acceptable. Less risky item are the more difference between your expectation, that you are expecting the interest amount to be 1 lakh. Actual figure is say 70,000. So now what happens? Now 1 lakh and 70,000. So imagine the interest is a material item, like materiality on a material item are the. It's a now for interest, if the company is a very small company, then this is a very big difference. So you will not accept this. But imagine the company is like a Reliance. Interest is 1 lakh and actual interest they have written, interest to come is sorry, your expectation was 1 lakh and they have only shown 70,000. So but for a Reliance where 30,000 difference is nothing, it's not a materiality, material amount on the. So for Reliance you may ignore it. Okay, it's fine. But if it's a small company, it's a big mistake. So you will take it. That is called amount of difference acceptable. So yeah, then investigating rules. If you found any fluctuation, tell it to inquire to the management and perform other audit procedure to solve it. Done. So fourth chapter we have done. So in this, say 530 we have not touched. I'll make a dedicated video for 530 in the next 2 days and upload it in my YouTube channel. You can go there and see it. It is tagged here. CS Sudarshan. So there, because 530 is a very big standard, like it's only a part of the chapter number 4, but still to understand 530 in quick motion, if you go, you will not understand anything. So just 530, I will upload it in the channel, and 520, I will make a dedicated detailed video for 520 with all the concepts and questions, and I'll upload it in the channel. Because 530 and 520, let's see some questions also, which I'll upload it in 2 days. So my channel link is there. You can go and join there and click the bell icon and be alert. The moment I upload, you will get it. It will be, and there are a lot of other motivation videos. All these things are there. Just check it out. Then one more thing. Yeah, different entity, audit of items of different entity also I'll make and upload it in the channel, so it will be useful because that is also a bigger thing. Yeah, so now chapter number 4 is also over. We'll go with chapter number 5, financial statements. Don't miss it. It's going to be very easy. I'll give you a chart also. This is the super quick revision of audit of items of financial statements, where we are touching upon all the complicated points in this chapter, and I will have a chart note with me where everything is written clean and crystal clear, which is visible for you. And this chart I'm giving it for free. Everything is there. You can take it from the Telegram channel. The link is down in the description. Please take it and please be there. Like I'll upload these kinds of short notes for all the chapters. So like see revenue, cash, trade receivable, everything is there. So you can take it, you can zoom it, and you can study it from your phone or take printout, whatever it is, you can do that. So let's go directly start with this chapter. We are focusing on the important areas of this chapter. So if you are planning to, if you had a plan to skip this chapter or you are not understanding this chapter, study it here, because from your book, if you study, it is just written not in the structured format. Here I have structured it through lines like charts so that you can easily understand. And ICA's language in the book is very complex. Here I have used the same language, but I've put the preposition so that it will be very easy for you to understand everything, and I've put the memory techniques for whatever things possible, all these things. So without wasting any time, let's directly go to the first topic, that is share capital. Don't just think that you can take a screenshot of this and notes and study yourself, because a lot of areas I have used small abbreviations. So just watch this video in 1.5x and then you can you'll know wherever these abbreviations are. So first is, so you are going to audit a company, and the company's balance sheet, there is share capital. So how to audit share capital? What are the general audit procedures? Generally, these procedures you will follow. First thing you need to do is tally. Tally the year-end share capital balance, current year's end share capital balance with the previous year's share capital balance, audited financial statements balance. So last year's closing and current year's closing, if there is any change in the share capital, that means current year if a new share is issued or old share buyback or anything is there, for that you have to check. So first tally, both are the same. If there is a change, if no change, first of all, if no change is there, like last year's closing, current year's closing, no problem, share capital, no change, then obtain a written representation from the company secretary that no share issue, nothing, share buyback or anything has happened in the current year. Just obtain a written representation. Then next, if there is any change, verify whether the current year and paid up share capital is within the limits of authorized share capital. Current year paid up share capital is within the limits of, it is below the authorized share capital. Then next is C, that is certified copy. C, obtain certified copy of the resolution, board resolution, shareholders resolution, authorizing an increase or decrease in the authorized share capital or paid up share capital. If they are increasing in a share capital, decreasing in share capital, they will have a resolution. They, in a meeting, they will decide we are going to increase the share capital or we are going to decrease the share capital. So in that, they will decide and pass it with a resolution. So obtain a copy of that resolution. Then next is, if any F for fresh issue. So you have to pictographically remember this thing, easy mnemonic. If in case of any fresh issue is there in the current year new shares has been issued. New shares, that is freshly issued, not the old shares not resold again. It's the fresh issue of shares is happening in the current year. Check the compliance with the Companies Act. Companies Act with the compliance regarding minimum subscription amount, minimum application amount, all these things, like whether all these things are fulfilled. Check compliance with the Companies Act. Then next, if shares are issued, no shares are issued at a discount. Make sure no shares are issued at a discount. What is their nominal value? They are not issued at their discount. Any amount below that. Make sure. Check if shares issued for cash or consideration other than cash. See whether current yearly any shares has been issued for cash or consideration other than cash. These are the audit procedures you have to check. Then SEBI, check the compliance with the SEBI regulations and guidelines. If it is a listed company and they are issuing shares, they have to follow SEBI regulations. So make sure if company has issued any shares, buyback anything, they have followed the SEBI regulations. Then MCA, Ministry of Corporate Affairs, verify the forms filed with the MCA. If company is issuing any share, they have to file certain forms with the MCA. Make sure they have filed it. Then increase in the share capital. If there is any increase in the share capital increase is there, verify whether company has accurately calculated the fee, stamp duty, all these things payable to MCA. Increase in share capital, when company increases share capital, they have to pay certain fees to the MCA and all, stamp duty and all this. Make sure that has been properly calculated and paid. So these are the general audit procedures you have to follow when you are auditing a share capital. Make sure this can be a 5 marks question. So at least 6 points keep in mind. Then in specific cases, and now we are going into specific cases. For example, if shares are issued at a premium, nominal value is 10 rupee, they are issued for 15 rupee, 20 rupee, whatever it is, premium money, securities premium. In that case, what should the auditor do? Make sure transfer the amount to securities premium account. That is that premium amount, make sure it is transferred to securities premium account. Then state the purpose to which such amount can be applied. That is, what are the purposes? There are certain purposes for which that securities premium amount can be applied. So you have to check whether that money is only used for that purposes only. So what are the purposes? Securities premium can be applied for following purposes. A question can come where a company issued shares and securities premium has been got and they have used it for certain purposes. And is it correct like that? So you have to check whether it is falling in these purposes, then it is correct, else it is wrong. Like that you have to state. So you have to remember all of this. So securities premium can be only used for these purposes. What are they? For issuing of unissued shares to the members as fully paid bonus shares. If there are unissued shares, issuing them to the existing members itself as bonus shares. For that purpose, you can put the entries on, take the things from the securities premium account. Then to write off the preliminary expenses of the company. Company may have some preliminary expenses. To write off that, you can use amounts in the securities premium account. Then to write off the expenses, commission or discount on issue of shares or debentures. When you issue shares or debentures, there may be some certain expenses you have to pay, or some commission you have to pay, or some discount you issued, all these things. To write off that things, you can use securities premium account. That is, securities premium account, whatever amount is there, you can debit that amount and credit you can put this and write it off. Then to provide premium payable on redemption of redeemable preference share, redeemable debentures. If there are redeemable debentures, redeemable preference shares, when you redeem them, you may, if you are paying any premium, extra money if you are paying, you can take it from the securities premium account, whatever premium you got from issue of shares, that is securities premium. Then for buyback purposes also, that is purchasing own shares, you can use it. Then what is auditor's duty in this? First auditor's duty is to check whether they have utilized this for whatever money is there in the securities premium. Like if they have issued shares, make sure securities premium account is first transferred to this. Second thing he has to check, they have only utilized that money for this thing. So auditor has to vary whether premium is transferred to securities premium account. Then application of this is only as per this purposes. Very easy. Hope you got the clarity. Next is, if shares are issued at a discount, you can get this notes from my Telegram channel. It is there. Go and take it. Then shares issued at a discount. That is, if shares or a nominal value is 10 rupee, they have issued it for 9 rupee, 8 rupee. That is what we call discount. Normally, they cannot do that for all the cases. Like that is what he have said. No shares are issued at discount, we have to check. But there are certain specific cases
in which a company may issue shares at discount. So company shall not issue shares at discount except as sweat equity shares, SES. To directly take this script, print and try to read it yourself, you may not understand what I've put the abbreviation. So I'm explaining all of these things, so it is very easy. So company shall not issue shares at discount except as sweat equity shares only. There are sweat equity shares, that are shares that are issued to the directors, employees of the company, those people. Those are called as sweat equity shares that a company can issue at a discount, smaller price. So company shall not issue shares at discount except as sweat equity shares. If company issue shares at discount in other cases, it will be void. Except one more exception is there, that is when debt of the creditors are converted to shares as per RBI direction. Company has lot of creditors. Company is unable to pay them. So RBI directed to convert that debt to shares. In that case, when debt of creditors are converted to shares, you can issue it at a discount. So basically, two cases are there here, but here only as per the RBI direction. Then penalty, that is if company issued any shares at discount other than those cases, penalty will be there. Amount raised through the issue of shares at discount, whatever money company raised through issuing shares at discount, or 5 lakh, whichever is lower, company has to pay as penalty. Plus, company has to also do one thing, refund all the money is received plus interest at the rate of 12% from the date of such issue. Also, company has to pay us. That is, whatever money company has received, they have to refund all that money plus at the rate of to that person at the rate of 12% interest also he have to give for that money received from the date of such issue. So this one you have to keep in mind. MCQ calculations may come. Then what is auditor's duty? Auditor need to verify the movement in share capital during the current year. Shares increase or decrease, all this movement he need to check. Then that no such shares are issued at a discount by reading minutes of meetings of shareholders or director meeting. He has to make sure no shares are issued at discount. And how will he make sure that? By reading the minutes of shareholders and directors meeting. So only two cases they can do. All the other cases he need to check. Whether company issued any shares at discount to creditors on debt conversion, all this thing. Like whether company has issued any shares to the creditors like this, he has to check that. Three things. Hope you got the clarity of shares issued at discount. So when you study from this chart, mind that this entire share capital gets structured in one page like this. Pictographically, it will be easy for you to remember. But you study from in your book or study material, it is scattered everywhere. You will not be able to recall. That is a problem with this chapter. You may think I'll listen to this and study from something else, bro. It is very hard. It's to retain that. That is why I made this chart. It took me hours to do this. Okay, then not hours, days actually. Then issue of a sweat equity shares. Here we learned about sweat equity shares. That is another cases. Sweat equity share. These are 5 cases. General procedure, premium, discount, sweat equity share, reduction of capital. Then issue of a sweat equity shares. Shares issued by the company to director or employees at a discount or for consideration other than cash are called as sweat equity shares. So auditor has to verify two things. Whether sweat equity shares issued belong to the same class of shares already issued. Whatever company has issued, like whether it is equity share, preference share, whatever, whether it belong, this sweat equity share belong to that same class itself. The auditor has to check. Then whether following conditions are satisfied. This also he has to check. That is, whether the issue is authorized by a special resolution. Sweat equity shares can be issued only by special resolution. So make sure special resolution is authorized or not. Then and whether now you have to see whether this special resolution specifies the number of shares to be issued, current market price of the share, consideration received, then classes of employees or directors. Whether this special resolution specifies these things, you have to keep in mind. Then listed shares. See if the issue is as per the SEBI regulations. If it is listed share, make sure if the sweat equity share issue is as per SEBI guidelines. So whatever SEBI rules is there, make sure it is properly followed. If not listed, then as per the prescribed rules. Simple. Then reduction of capital, that is company had this much amount of capital and current year company is thinking, okay, it's like a lot of shareholders are there, let's cut down the capital now, let's take some shares back. That is reducing the capital. It occurs due to accumulated business losses are there, or doubtful asset getting bad, or company having excess paid up share capital than required. All these things. Excess paid up share capital is there, then they may reduce it. Or if company has a lot of business losses or doubtful assets are getting bad, in all these situations, company may reduce the share capital. So what are the audit procedure to do that? First, verify the meeting of shareholders to pass special resolution was being held. That is to reduce the share capital. All the shareholders need to sit and do the meeting. In that meeting, they will decide we are going to reduce the share capital and they need to pass it through a special resolution. Make sure that meeting has been properly convened, properly it is held. Verify that first, such a meeting held or not. Then AOA, Article of Association, authorizes the reduction in share capital. Make sure in AOA it allows you to reduce the share capital. Make sure MOA, after the reduction, MOA is suitably altered. In the MOA you have to alter and write now the share capital has been reduced from this to this. That thing you have to mention. Then examine the tribunal's order confirming reduction and verify the copy of order or minutes is registered and filed with the registrar. So if company is reducing the share capital because of any tribunal's order, tribunal has ordered the company to reduce the share capital. So in that case, examine that tribunal's order confirming reduction and that reduction. Examine the tribunal's order confirming reduction. Then and verify the copy of order plus minutes, and verify that the copy of this order plus the minutes of the meeting in which they decided, that minutes is registered and filed with the ROC, registrar of companies. Make sure this minutes plus that order is filed with the ROC. Then examine that no default is there in the repayment of deposits or payment of interest. So this is regarding exam. So now itself you got 5 points. 1, 2, 3, 4, 5 points. Verify, examine. Then these are 5 points, separate points. I just wrote it this way too for pictographically to keep in mind. Then confirm that whether the revaluation of asset is disclosed in the balance sheet. Then confirm the words and reduced is added to the name of the company if required by tribunal order. Sometimes if tribunal says to reduce the capital, company reduce the capital. Then one more guideline is there. If company is reducing the capital like that because of the tribunal's order, sometimes in tribunal's order, tribunal may also mention you have to add the words the company Infosys Limited. Inside to that you have to add and reduced also. This one word also you have to add because your share capital has been reduced, so that people let them understand. So whether make sure something like that is there, then whether it is done or not. Then check the compliance with the terms and conditions imposed by the tribunal on reduction of capital. Whatever terms tribunal has said, make sure it is complied. Check the registrar's certificate. Simple. Then vouch accounting entries recorded to reduce the capital and write down the assets. Reduce the capital, you will put journal entries right and to writing down the assets. So make sure that account journal entries everything is correct. So this is all about is share capital. Very easy, right? Then we have the reserves and surplus. Reserves and surplus is very easy. There are basically two types of reserves, revenue reserve and capital reserve. Revenue reserves are the profits. Basically, reserve is coming from the profit amount, right? So revenue reserves are the profits that are available for distribution to the shareholders or for below purposes. Revenue reserves are either for distributing it to the shareholders or for using for the below purposes. What are the purposes? To supplement the divisible profits, then to finance an extension of business. Business company wanted to expand. So for that, they can use this money. Then for augmenting the working capital, that is for working capital needs, that can use it to strengthen the financial position of the company. Then capital reserve, it is not free for distribution to shareholders. This reserve you can freely give to the shareholders, but this reserve you have set apart for certain purposes. From your profit, you set apart this for certain purposes. So it can be utilized only for certain limited purposes. Writing down the fictitious assets, you can use it for that. Then issuing bonus shares also, you can use it. An example of capital reserve, securities premium account, capital redemption reserve, all this can be utilized for the purposes specified in section 58 to 55 of the Act. So now you wanted to check the reserves. How will you check the reserves? In the balance sheet, an item is there called reserve. How will you check? What are the audit procedure? Very easy. Tally the opening balance of reserves and surplus to previous year financial statements. Current year opening balance, make sure previous year closing balance is the same. It is done to check the existence of reserves and surplus at the year end. Then trace the movement to surplus or deficit as per the P&L account. That is, check if current year P&L is added to the retained earnings, reserves. Basically, current year's whatever extra money is there, make sure that is surplus or deficit, that is properly added to the reserves. Whatever is there from the P&L, it is added to the reserve. The trace, the movement is correct. From the P&L, the extra reserve, extra money what we have from the profit, it is added to the reserves. Then trace the movement in statement of equity, SOE, statement of equity also. It is ensure it's reflected in the statement of equity also. That is, say this same thing. Whatever that extra money, make sure this thing is reflected in the statement of equity also. That is, this extra profit from the current year which we are taking into reserves. First thing we are checking whether it is taken to the retained earnings properly. Then we will also check whether that entry is coming in the statement of equity also. Then verify the board resolution regarding recommendation of dividend. To pay the dividend, board will pass a board resolution, the recommendation, how much dividend to pay. Verify that. Verify the shareholder resolution regarding declaring the dividend. So board resolution for recommendation of dividend, shareholder resolution for declaring dividend. Then securities premium, confirm whether company issued any shares above nominal value, that is at premium. If so, verify the board resolution. Then ensure that the securities premium account is utilized only for that limited purposes. Very easy, done and dusted. Now we'll move into cash and cash equivalents. How to check cash? In the balance sheet, there is an item called cash and cash equivalents. How do you check that? Very easy. First, we need to check the existence and completeness assertion. That is all the whatever cash is there, it is in the cash in hand, 10,000 is written. Make sure that 10,000 is there in the company, in the hands of the company. So that is checking the existence and completion, then valuation amount is correct. So first thing for that we will do is called a surprise check. Surprise check, that is on that closing date, surprise we are going and checking. That is not only on the last day we may do that, but not only on the last day of the year, check again after the close of the year also without giving a notice of auditor's visit. That is on 31st March, you may go and check whatever cash in hand they are saying 10,000, make sure 10,000 is there in their thing also, drawer also. But they know that we will be anyways coming and checking on 31st March. So you can do it on some other days also. Just surprisingly, you do a surprise visit and tell the cashier, give me your cash book. So in the cash book, the balance, cash in hand is written is 8,000. So open the row and count and see whether 8,000 is there or not. That is surprise check. Then if more than one cash balance is maintained, sometimes a company has a lot of laborers, lot of petty cash expenses. So different cash books may be maintained sometimes. One person may be handling some cash, other person may be handling another cash for different purposes. So if more than one cash balance is there, then that is example petty cash balance, or branch has a separate cash balance, or impress balances, then check all of them simultaneously. So shortage in one is not made good by transfer from other. That is, if company has same branch itself, imagine one cash book for normal things and one cash book for some other purposes. So simultaneously use one article to check this, at the same time check the other, or use other article to check the other cash book also. So that else what will happen, if here 10,000 is written in the book and here properly 10,000 amount is also there, but there sometimes 8,000 is written in the book but 8,000 may not be there. So if you check here, then you are going there, by the time this guy will call him and tell, and here they will whatever from some money from here they will transport it to there, and there they will adjust it. So to prevent that, check all of them simultaneously. Then cashier has to be present when counting, else he will hold the auditor responsible. So when you are counting the cash, checking the cash, the cashier should also be there. Else in the book it is written 10,000 and when you count only 9,000 is coming. So if he is not present, he will say, auditor stole 1,000 rupees. He will put it on the blame on the auditor. So make sure he is present there. Then if rough cash book is kept, test it with the normal cash book and prove entries in both are correct. Sometimes rough book will be there, so test both together. Then obtain bank reconciliation statement of all the bank accounts and understand the client's process and periodicity of bank reconciliation. If all the company has 3 bank accounts, get a bank reconciliation statement of all the accounts, and at different what all periods they are doing this bank reconciliation, like monthly or yearly or quarterly or whatever it is. Then ensure bank reconciliation statement is signed by the authorized person, finance manager, whoever it is. Then to check the valuation of cash, all the procedures you performed till now, whatever procedures here, all those procedures you have to do it there also, plus all the account holding the foreign currency is restated at a closing exchange rate. All the accounts which are holding foreign currency, company has some foreign currency with them, so all the company which are holding foreign currency on 31st March, make sure it is restated at the closing exchange rate. They may be holding the foreign currency as on 25th March. So like $10 are there. It is received on 25th March. So 25th March the rate was 65 rupees per dollar. So $10 into 65, 650 rupees may be shown. But on 31st March, the dollar price increased to 68 rupees. So actually the money should come, you should convert that 650, instead of 650, it should come as 680. $10 into 60. So make sure that is restated at the closing exchange rate. Company has done that. Then something called a direct confirmation procedure is also there for checking the cash balances. Directly you can confirm, like external confirmations you do. Similar here, you can do some direct confirmation procedures. Let's see what are they. So contact the bank and ask to confirm the amounts held in the current account, deposit account, etc. Do this for all the accounts at the year end. That is company's closing balance. In the balance sheet, in the bank account, they have written 18,000 as the bank's 31st March closing balance. You can contact that ICICI bank, whatever bank is, and tell I am the auditor and I need the confirmation. Like normally you will tell the management and management will tell the bank and bank will give you the closing balance confirmation, something like that. Then you can trust that. For that, you have to do that for not only savings account, current account, FD account, all the any other deposit account, overdraft, anything is there, you can do that. Do this for all the accounts. So here you are directly confirming. That is called direct confirmation. You are getting that confirmation. Bank is giving that confirmation to you, like external confirmation and debtors. If there is any discrepancy in this, ask the company to investigate it. Ask the company to investigate it. Ask the company to investigate it and reconcile it. That is, if any difference, company balance sheet it is written as 10,000 and bank confirmation it is written as 9,000. So any discrepancy is there, ask the company why is it, investigate it and proper reconciliation, give it to me and change the balance. Then auditor should emphasize for the confirmation of 100% bank account balance. All the bank account balance, he need confirmation. If no reply is received, that bank has not received replied for confirmation, then perform additional testing of balances, like agree the balance in the books of account to bank statement you will have. They are not giving separate confirmation. So, but bank statement like the closing balance, 31st March balance you will get. You check the books of accounts, financial statements balance with the bank statement also. Additional procedure. Normally here DCP means direct confirmation. You are getting confirmation from the bank directly. But if bank is not replying, then you can check it through with a bank statement. Then send the audit team member to the audit team member plus company or personal to the bank branch to obtain confirmation directly. So normally you may call or you may send a mail to get the confirmation, but they are not replying. So first thing you can check is with the bank statement. If that is also not possible, then you are auditing one article plus company is one employee. Both of them send them to the bank account and let them go physically go there, get the balances confirmation and come. So this is what all about cash and cash equivalents checking, cash and bank checking. So it is inventory. Inventory is actually a very easy thing, but majority of it consider that as a very tough thing only because you guys are lacking the structure in that. Oh, some background noises. Oh my god. Yeah, whatever. So you guys are lacking a structure in that. That is why you are considering inventory. So let's go with inventory. So inventory basically understand we have this much. We have to learn about the existence, then we have to learn about the completeness, then rights, then valuation. 4 assertions. Okay. So balance sheet there is an item called inventory. So now you have to check the existence of inventory, whether that inventory is actually existing. So what audit procedures you are going to do to check whether that inventory is actually existing? They are saying 10 lakh inventory is there. So you have to go to the company and check whether 10 lakh inventory is actually there. So what are these kinds of procedures you will do in that? First thing you will do is you'll check what is entity's plan for inventory counting. How are they planning to do the inventory counting? On which date or on what procedures what they're planning to follow? Oh, this background noise is too much. Yeah. So then next you will check the consigned goods to be segregated. That is in that inventory, 10 lakh worth of inventory, 1000 units of inventory. In that there will be certain goods which are consigned. So that you will segregate and keep it on the other side. Okay. 1 second. Charge is not there. Yeah. Then next you will participate in the inventory counting. Then you can check whether they are saying 10 lakh inventory is there, 10 lakh worth. So in the inventory counting, you can see whether 10 lakh inventory is actually existing. So these things you are checking to check whether that inventory actually exists or not. Then you can do the test counting. You can do the test counting, and test counting includes, because this alone they may ask us a question. That is why I'm saying test counting includes observing. This is observing. I with the observe, right? Observing the employees, whether the employees follow the agreed plan. Because for test counting, there will be a plan given to the employees for counting. Make sure that employees are following that. That is, observe whether employees are following that plan, counting in that order. Then you have to see whether there is a supervision on the count procedures. When they are counting, imagine ensure that there is proper supervision is there on the counting procedures. Then make sure that all items of inventory are properly tagged. This is hashtag, right? I'm use this thing to make you remember it. So make sure that all the items in the inventory all the items of inventory are properly tagged. That is, imagine there is a mobile phone, not mobile phone. Imagine it's a bottle company. This kind of a bottle is there. So make sure this bottle has a tag. Like see, here one tag is there, right? Similarly, inventory also there will be a tag where the quantity, the weight, the price, everything will be mentioned. Make sure that tag is there. Then make sure that amount is there on the tags, the value, the price, everything is there on the tag. Then be alert at all times during the counting time. Be alert at all the times and make sure and search for empty boxes if there is any. They're saying 10 units, 10 boxes of inventory is there, but total value is 10 lakh. So one box is 1 lakh. But when you checked that box, only 8 boxes actually filled. 9th box is half filled and 1 box is actually empty. They have put some stone in that. And just saying that inventory is there, and just to get more valuation, like to balance sheet, like to show more value in inventory. So that is why they're doing that. So make sure you be alert at all times and check for empty boxes. This is empty box, empty, nothing is there. Then you have to, if company is following periodic inventory system, then you have to do the counting at the end. Then if the company is following perpetual inventory system, then it happens at the interim dates. Because not your counting, they may be also be counting periodic counting, they may be counting at the end, and perpetual, then it happens at the interim dates. Then investigate the third party, investigate the inventory lying with the third party, investigate the entity and inventory lying with the third party. Yeah, then that things are over, existence is over. Now you have to check the completeness, that is 10, the company is saying 10 lakh 10,000 units of inventory is there, and the total amount of that is 10 lakh. In the balance sheet 10 lakh is shown, 1,000 units. So now you have to check whether entire inventory, sometimes company may be some 1,005 inventory may be there, 1,005 units may be there, but 5 units they have missed. So it is your duty to make sure that all the inventory company has is actually is there in the shown in the balance sheet. So you have to check the completeness, whether all the inventory of the company is actually recorded. For that, you have to perform analytical procedures, and you have to perform purchase and sale cut-off test. Cut-off test means all the purchases and sales in the current period is only getting in the inventory, because when you purchase, the inventory will increase, and when you sell, the inventory will decrease. Only those purchases and sales of the current year is getting applied on the inventory. Make sure that. Then you have to reconcile the physical inventory with the perpetual records. Physical what is there with the records, you have just reconcile. Then reconcile the physical count with the general ledger. There will be a general ledger in that a closing balance of inventory is there. You have to reconcile that with the physical counting. Physical counting, what is the actual inventory you saw, and whether make sure that is there in the books also. Then inventory of the client held by the third party also you will have to reconcile. How much inventory is with the third party? Is it correct? And in the client's book, they are saying 300 units are with the third party. Like sometimes some of your inventory will be held in some other person's hand. That is what we call third party. So in your books, they are saying 300 units is there in the third party. But when you inquire to the third party, he is saying only 280 units are there. So that is what we call reconciliation. Then examine the non-financial informations also. That is the weight, everything of the inventory. Okay, that is how you check the completeness. Okay, now you need to check the rights of the inventory. That is all the inventory that you are showing in your balance sheet. You itself own those inventory, right? That is what we call right. You have the ownership and you have the rights over that inventory. How will the auditor check whether the inventory is actually owned by the company itself? The rights is there on the company itself. For that, what procedures he will use? That is what here. So vouch the purchases recorded to documents. All the purchases to the documents, invoices, everything you can vouch. Then evaluate the consigned goods. Then check the existence of collateral agreements. Whether there are any collateral agreements are there, you have to check, evaluate its existence. That is sometimes inventory you would have pledged somewhere and taken some loan or something. That is called collateral. Have you put the inventory as a collateral somewhere? Then review the consignment agreements. All the inventories that are consigned, review the consignment agreements. Then examine the evidence of ownership. That is when company bought 500 units of inventory from someone. We are the buyer, they are the supplier. So when the supplier in the bill, if our name, company's name is coming, then that means company is the owner. So check that. Examine the evidence of ownership. That is invoice in the name of the entity itself. Invoice entity's name is there or not. Then if inventory is held by the third party, obtain declaration from the third party or their legal heir, and it should be signed by the authorized personnel, confirming that inventory belong to the entity and are held by the third party. Imagine some of company's goods is with the third party. What is the procedure you have to follow? Call the third party and tell, I am the auditor, I need a declaration. Or call the company and ask the company to do this, because sometimes when you call third party may not respond. So through the company route, you can inform the third party, that is, I am the auditor and I need a declaration that 300 units of this company's inventory is with you. So if it is actually correct, third party will take a paper and write, yeah, I am this party and that company's inventory is lying with me, and 300 units of there at the value of this much, and the condition of inventory is good. Like that, they will give a declaration certificate. So that is your audit evidence. So either it can be from a third party or it's legal heir and signed by the authorized personnel. Okay. Yeah. Over there. Oh, this is not legal heir. Sorry. This is actually letterhead. Letterhead. What is a legal heir? This is letterhead. Okay. There is something called legal heir in another chapter. I missed it with it. Okay. Then you have to check the valuation. That is the amount of inventory is correct. That is, they are showing 10,000 units of inventory. Total is 10 lakh. You are checking that 10 lakh, whether that rupee amount is correct. What are the procedures you need to follow? So how will you check the value of raw materials? How will you check the value of work in progress? How will you check the value of finished goods? So how will you check the value of raw material? Ascertain that what elements of costs are included in the raw material. What elements of cost? When you buy a raw material, along with the purchase price, you will include the carriage, the transportation charges, all these things. So these are different elements of cost that are included in the purchase price. So when they are showing raw material is worth 1,000 rupees, in that 1,000 rupees, how much is carriage, how much is transportation? You check what are the elements coming inside that. So that is how you check the total amount correct. Then if standard, they are using standard cost, then how it is compared with the actual cost and how variances are treated. This one thing you have to check. If they are using standard cost, how the standard cost is compared with the actual cost, and if any difference is there, how it is being treated. You have to check that. Then test to check the cost price with the purchase invoice. Inventory you are purchasing 1,000 units for 500 rupees. That cost price you have to check with the purchase invoice. Cost price and purchase invoice. Books same you have to check. Then if there is any obsolete or damaged inventory noted during physical inventory counting. When you are attending the physical inventory counting, there were 1,000 units were there, 900 units are in good condition, but 100 units, still some water damage is there. Imagine the inventory is like watch company, so watch is there. So 100 units of watch, water damage is there. So those inventory are basically damaged, or if any obsolete inventory is there, what should you check? Bro, 1,000 units are there, 900 units are good. So 900 units, you can show it at the sale value itself, like whatever the value. Stock, you will show it at the stock value itself, like whatever the total cost of that, you can show that. But 100 units is actually gone, like half destroyed. So now that units is not even worth the cost. So for those 100 units, you will have to show at the realizable value. When it is sold in the market, you will get only half the price. So half price, because it is damaged. So half price only should come. So for those damaged goods, make sure it is written down to the realistic and net realizable value. Netly, if they sell that damaged good in the market, it will, the cost of the good is say 300 rupees per inventory. But that is the cost itself is 300. So normally that cost figure it will come in closing stock. But since our inventory is damaged, if you sell it in the market now, you will get only 160 rupees. So show it at that 160 rupees. Make sure that is shown at that 160 rupees. So these things we are checking, because value, we are checking the value, whether the 10 lakh total amount is correct. Amount is correct. For raw materials, you have to check this much. Then for work in progress, what are the things you have to check? Ascertain how stages of production or value additions are measured. That is for work in progress. An inventory is put in the production and it has not reached the final good stage also. So at 31st March, there will be a lot of things like that, work in progress. So you have to check at which all stages of production, how much of our value is added. At the raw material value is 300 rupees per 1 unit. So when it goes to the second stage, raw material plus some other labor and all these things are added. So 300 rupees order value becomes 350 because labor's cost or some other materials you added to it. So that good sort of work in progress state. So for second stage, the value of that becomes 350. Third stage of production, when it goes, some other things are assembled. Imagine a car. First stage, just the steel body is there, not the steel, whatever metal body is there. But second stage, when it goes, tire comes. So tire order value is also added. Firstly, it was only 300. Then tires value 50 added. Then the third stage, engine is added. So engine order value is added. So like that, which all stages value additions are measured, that thing you have to check for work in progress. That is, understand the basis of such estimates. How management is saying that in second stage, the cost becomes 350, third stage, it becomes a 370. How management is saying, how this 50, tire 50 than actual value, all these things you have to check. Then, what elements of costs are included? In different stages, what are the different elements of cost? Are they including tires value, engines value? What are the different types of things they are adding to it? Then ensure that material cost exclude abnormal wastage factors. If there are any abnormal wastage, that should not be reduced from the material cost. Normal wastage, okay, but abnormal wastage should not be reduced. You have to check that. Then for finished goods, how will you check? Finished goods, inquire what costs are included in the finished goods. When an item becomes finished, what all costs are included, you have to check. So check whether the overheads included are determined based on the normal cost and they are reasonable. Overheads are reasonable. You have to check. Overheads included in the finished goods. Then ensure that inventory is valued at a net realizable value if it is likely to fetch a value lower than the cost. That is, if you are thinking company, imagine there is a company. Let's take the case of Nokia. On like 2010, 12, that time, or 15, Nokia manufactured 10,000 old type keypad mobile phones. And it is still in stock. But now everyone shifted to touch phones. So that stock is basically obsolete. Nobody is going to buy that stock. So for that stock, you cannot show it at the cost itself was 5,000 rupees for one mobile phone, but you cannot show it at cost. Now, if you sell it in the market, people are ready to buy it only for like 2,000 rupees. So make sure such kinds of things are written down. That is, ensure that inventory is valued at a net realizable value if it is likely to fetch a value lower than cost. Then ascertain the net realizable value of obsolete or damaged inventories. So such kinds of damaged inventories, you have to ascertain its net realizable value. When it's sell in the market, what value it may likely fetch. So that net realizable value, company may put a net realizable value as 2,000. Now you have to check whether that 2,000 is correct or not. For that purpose, how will you value the obsolete or damaged inventory? Valuation of obsolete or damaged inventory. This is another separate question. Okay. So compare the recorded cost with the replacement cost. You have to check. Then examine the vendor's price list to see whether any recorded cost is lesser than the current price. See whether the cost is less than the current market price. Then calculate the inventory turnover ratio. Inventory turnover ratio you have to calculate. Obsolete inventory is revalued. It's again revalued if inventory turnover ratio is lower. You calculate the ITR, inventory turnover ratio. If it is lower, then you have to revalue this obsolete inventory once more to recheck its valuation. Then verify the correct application of lowering the cost or NRV principle. Is make sure that this cost cutting, or that is this value cutting or NRV, like it is written down. Make sure that application is properly done. So you don't have to overthink for over concept on this. Just understand these are the procedures. There is no concept on this. This is just procedures things. They are saying about procedure on this cases. If you are in the balance sheet, inventory is written, to audit that, you have to follow this procedure. That's it. In our class, in the memorization batch or all the other batches, where we detailedly we take it. In the normal batches, regular batches, we sit and take this concept very detailed, where it takes around like 10-15 hours for this one topic itself, financial statements. So, but this is a quick revision for just for your exam purposes, I'm doing it. So now let's focus on the borrowings now. Let's take borrowings. Yeah, borrowings. So how to check the existence of borrowings? Company has borrowed 10 lakh rupee from a bank. How to check whether, and in the balance sheet it is shown in the loan side, borrowings 10 lakh from ICICI Bank. So now it is your duty to check whether that borrowing actually exists or not. So for that, what purposes you will do? First, you will review the board minutes for approval of the new lending agreements ensured is authorized. That is, if company wanted to take a loan, company will do the board meeting, and the board meeting, all the directors will agree to that, and they will pass a board resolution. Or in the board level, when they discuss the board minutes, they may, in the meeting, whatever they discuss, it will be there in the board minutes. So when you read the board minutes, you can understand like this loan was been properly authorized by all the directors, all these things you can understand. Make sure the new loans you have taken are authorized. You can check that through board minutes. Then obtain independent balance confirmation for all the borrowings. Company has 10 loans from different banks and different people. You have to, for all the 10 loans, you have to obtain independent, like individual balance confirmations you have to get from that lender. Ask the lender, I am the company's auditor, I need a balance confirmation. So they will write it in a piece of paper that the closing balance on 31st March for outstanding balance of this loan is say 13 lakhs. So make sure that whatever is written in the confirmation is there in the financial statements, and same figure is there for each loan. Each loan wise you have to check. Then obtain written representation that all liabilities recorded are valid claims. Whatever liability is recorded, make sure all of them are actually valid. No fake liabilities recorded. Then agree the details of loans recorded with the loan agreement. Whatever loan is recorded, other interest, all these things, make sure it is actually what is actually written in the loan agreement and what is actually there in the loan records, both of the same. Okay. Then agree the details of lease and hire purchase creditors recorded with their agreements and contracts. When you enter into a lease, an agreement will be there, and there it will be written 10 years lease, per month this much money you have to pay. Make sure that is actually what is being done. Actually, per month the same money is whatever is there in the agreement is being paid. Same thing. Same thing with the loan also. Interest loan agreement, it is written 8% interest, and actually 8% interest are being charged, or less or more. You have to check that. That is what you're checking here and here. Then for debentures, if company has any debentures, examine the trust deed for terms and date of redemption. Trust deed you have to check if company has debentures. When the debt is retired, ensure discharge of secured asset is received. Company took a loan by pledging its land and building. Land and building pledged and 50 lakh loan took. And now after 2 years, company repaid that loan also. So when you repay the loan, that is, you took the loan by securing your asset. You gave your asset, land and building, as a security to the bank. So when you finish repaying the loan, they should give back that security, right? That is what we call discharge of secured asset. That secured asset is discharged. There is no charge on that by the bank now. Once you repay the loan, make sure that. Then completeness. Completeness means all the loans in the current year. Current year company has taken, imagine 15 loans. Make sure that 15 loans are also there in the balance sheet. That is checking the complete. All the loans, whatever the company has taken, it is coming in the balance sheet. Not all the loans, all the borrowings. So how will you check that? Very easy. Obtain the short-term and long-term borrowing schedule. Ask the company, bro, give me a schedule of your short-term loans and your long-term loans. All the short-term loans in one thing and all the long-term loans in one thing. And then schedule of borrowing means in that it will be written per month, how much EMI is there and how much is paid, what is outstanding, everything will be properly written. That schedule you have to ask from the company and then perform this procedures. Perform these procedures. What are the procedures? Consider any evidence of additional debt obtained through minutes, contracts, etc. That when you checked these minutes, all these things, sometimes you may know about some extra loans company has taken, but sometimes they may not have shown that in the financial statements. So make sure, consider if you have got any such kind of evidence that in the minutes you have there, they have talked about some loan, but you don't know whether they have actually taken that or not. But in the meeting it was talked, so it was there in the minutes. So you got an evidence that some loan they have taken. So consider such a kind of evidences for any additional loan obtained, and you get that evidences through minutes or contracts. Then check the closing balance as per the schedule to the general ledger. So in this schedule, one closing balance will be there. Normally bank will give you this borrowing schedule. It's not the company. When you ask the company, company will ask the bank and bank will give it to you. So whatever is there in the schedule, one loan is there taken from ICICI. Other schedule closing balance is 10 lakh. Make sure ledger balance is also 10 lakh. Okay. Then review the subsequent transaction after the end of reporting period, after 31st March, to determine if there are any unrecorded liability, that is any fresh loan taken near to the balance sheet date. When you check the subsequent transactions, that is 31st March where only normal we'll check. But you are checking April 10th or April 5th, just to check April 15 or whatever transaction is there. So sometimes you may see some loan company received on April 1st, but that loan should be actually included in 31st March. Company sanctioned, the bank sanctioned it in 31st March itself, but the money received only on 1st April. Some condition is there because of which that should actually come in this 31st March. So check the subsequent transaction. April, just first 1 week transaction you check to see whether any fresh loan something is there taken near to the balance sheet date, which should be coming in current year or which should have some effect. Just check that. Then what are the direct confirmation procedures? Directly confirm. That is loan amount 50 lakh is written in the balance sheet. Now, how to confirm that loan amount is correct? Loan amount from ICICI, 50 lakh is written. How to confirm? Just to call ICICI and ask. They will give you this balance confirmation. ICICI bank will give. That is, this company has taken this much loan, this much principal, all this paid. Current year, like closing balance on 31st March in bank book is 50 lakh. And see whether that 50 lakh is there in the company's financial statement also. So, that is direct confirmation procedure. So, see whether confirmation ask for all the information related to the test of debt and interest. In the confirmation, when you're asking, ask for all the interest detail, the detailed things also you can ask. Then interest rate, due date, everything you can ask, not just the closing balance. Then send a reminder for non-reply. That is, you send asked for confirmation, bank is not responding, send one more reminder. Then compare the balance as per the confirmation with the books of accounts. Confirmation balance, books of accounts balance, check whether it is correct. And if any difference is there, ask the company for any reconciliations and supporting documents. Simple. Then valuation, that is whether the amount shown in the loan amount is correct or not. How will you check the valuation? Determine whether accounting policies and methods of recording the debt are appropriate and consistently applied. What is the accounting policy company uses to record the debt? Make sure it is proper, and second, it is last year whatever policy they are using, current year also they are properly using. Consistently it is applied and you have to check. Then agree the loan balance and the loan payable to the loan agreement. Whatever loan balance outstanding payable is there, make sure check it with the loan agreement to see whether everything is correct in the terms. Then compute the interest and discount or premium on redemption, you compute and see. Then check the computation of the amortization of discount or premium. If there is any discount or premium, check the computation of its amortization. Then examine the due date of loan for proper classification of short term and long term. Check the due dates of the loan, in which date it should be actually paid, to see whether it is properly classified as long term or short term. If it is payable for more than 1 year, long term, else short term. That thing, for that you check the due date. Then review the borrowings from the personnel and ensure compliance with the AS 18 and Ind AS 24. That is, Review the borrowings from the related parties. Company has taken some loan from related parties. So check that borrowings and see whether it is properly complying Ind AS accounting standard 18 or Ind AS 24. So borrowing is also done and dusted. So it is trade receivables next, and very easy, very easy. Trade receivable the same, everything just opposite is trade payable. Trade payable I'm not taking, I'll show you the chart also. So I'll give you the chart so that you can, when you understand trade receivable, same thing, opposite thinking is trade payable, that's it. So trade receivable is important, which is how to check the existence of trade receivable. That is whether the debtors amount is shown in the balance sheet. In the balance sheet, debtors amount will be shown. How to check whether that debtor actually exists? Is it a fake debtor or not? Whether he actually exists, how will we check? That is checking the existence. So check whether the controls are in place, proper internal controls are there to ensure that the invoices are not recorded more than once and receivable balance are auto recorded in the general ledger. That is, company will have proper internal controls, proper softwares or people to double check that one sale bill is not entered more than once. So make sure company has proper internal controls like that. Else what will happen? One sale, if it is automatically 2 times it is entered, it's like double entry. So double 2 times it is getting entered. So the debtor's value will get double. So that you have to check whether such internal controls, that is a point, controls. Then ask the account receivable aging report period end and trace balance as per the report to the general ledger. That is, tell the company, bro, you have 30 debtors. Okay, give me the aging report of these 30 debtors. Aging report means in the report they will give how old these debtors are. Some debtors may be 2 years old, 2 years before one sale happened, and debtor is 2 year old. Some debtor may be 6 months old. That is that aging report, age of the debtors. That we need to check. And whatever is there in that aging report as a closing balance, make sure that balance is there in the general ledger also. Then check whether realization is recorded invoice wise or not. So whatever money you are getting from the debtors, make sure it is recorded invoice wise, or if they are recording it some other way, make sure whatever it is. One amount, many bills, sometimes that you don't have to check. This one point you cut, no problem. And overthink. Then if there are any large balance of debtors for a long time, ask the reasons. If there are any large balance of debtors for the long time, ask the reasons. This is debtors. Because my handwriting is bad, I made one person to write this so that, and here debtors it's actually. So understand this one point you can cut and this one point debtors. Okay. Then direct confirmation procedure, this same procedure you are using for trade payable. So cut, copy, paste here and there. So once you run trade receivable, it's automatically you have learned like trade payable. So direct confirmation procedure, DCP. That is, how will you directly go to the debtor and confirm that the balance is correct? So you just send him a mail, simple. Contact the customers directly and ask them to confirm the amount. This has to be done for all the significant account balances. That is, debtor's email. Ask the company to give me the debtor's email. Then send a confirmation request. That is, I'm the auditor of this company and this company's balance sheet. Your amount is showing as 10 lakh you owe to the company. Is it correct? Is it 10 lakh, or if there is any change in the amount? Ask him. Do this for all the bigger, significant amount account balance, like significant debtors, important debtors, bigger debtors. Then do direct confirmation procedure with the consent of the entity. If management says no, ask the valid grounds. That is, you can send this mail only after telling the entity that I'm company that I'm going to send the mail for your debtors. Ask their permission first, get their consent first. Normally they will give the consent. If they're saying no, that you can send a confirmation to all the 8 debtors, but those 2 debtors please don't send. Then ask them what is a valid reason. Then trade receivable requested to confirm the balance at the balance sheet date or date close to the balance sheet date. That is, this when you send this receivable request, confirmation request, ask them to confirm the balance as on 31st March or any date close to the balance sheet date. Then don't reveal the method of selecting the trade receivables to company till the trial balance or trade receivable ledger is given to the auditor. That is, out of that, imagine company has 100 debtors. Out of the 100 debtors, how are you picking the material debtors, important debtors? You will have a auditor will have a strategy that all the debtors above 6 lakh rupees we are considering as material, others immaterial. So auditor will have a strategy like that. Don't tell this strategy to the company first, because then company will do the fake adjustments in debtors and give it to you. If there is a bigger debtor of 13 lakhs, or he may split it as three debtors as of 3 lakh, 4 lakh, and one other amount, so that it will not be above your 6 lakh limit. So don't tell your method of checking the debtors to the company before they give you the trial balance or trade receivable. So once they give you this, then you can say, because automatically they have given. So now they cannot change. Okay. If any related party receivables are there, like related party who was yet to give some money, then review their collectability and whether they were properly authorized, and value also make sure it is at the arm's length price. So related parties sometimes will not pay because they are like related party close people. So make sure whether those debtors are actually collectible. Will we actually receive money from them? What is the chance? Make sure that, and check whether they are properly authorized. That is, to related parties we may be selling at some discount and all. So make sure all those things are properly authorized. Then you also have to check whether the transaction to the related party has been done at a arm's length price. That is, a company sell its products to the normal public at 30 rupees per product, but your related party they may be selling at some 25 rupees. So make sure whether they are selling at the arm's length price itself, that is 30 rupees itself. Make sure. If it is not, also no problem. Make sure, just check that. That's it. This is how you will check the existence of debtors and direct confirmation procedure. Then how will you check the completeness of debtors? Company had 1,000 debtors in a year, and whether this 1,000 debtors has actually been included in the balance sheet, other total is coming. That is, you have to check the completeness. That is, all debtors in the current year has been included. So to check, auditor need to satisfy himself of the cutoff procedure. So perform the following cutoff procedure. Auditor has to satisfy himself of cutoff. That is, all the debtors from April 1st to 31st March has been entered. That is cutoff procedure. All the debtors in that period should be entered. So for that, he need to perform some cutoff procedure. That is this procedure. For all the invoices issued in the last 5 days of the year, that is 26th March onwards, last 5 days of the year, are included in debtors. Check whether the goods are actually dispatched. Sometimes to show some fake sales, fake income, to get some valuation, they may, in the year end, the company may create some fictitious fake debtors they may create. So last 5 days of the year, 26 March, you have to check whether all the debtors, all the sale that happened after 26th March, make sure the goods are actually dispatched. So when sale happens, original sale, the goods will automatically go. Similarly, if it's a fake sale, goods will not be sent. So when you check whether goods are actually sent to that customer, then obviously it's an original debtor. So do that for the last 5 days. And payables, like small differences there here, which you can read and understand by yourself. Very simple. Then all the goods dispatched prior to the year end have been invoiced and included in the debtors. You have to check that. All the goods, all here it is, all the goods that are sent before 31st March. If company will send the goods only after the sale is happened, so make sure if all the goods that has been sent, make sure all other invoices has actually been entered. Then no goods are dispatched after the year end is included in the current year debtors. After 31st March, whatever is dispatched, make sure it is not included in the no goods dispatched after the year end, it's included in the current year debtor, except it is the sale is in current year. Then test the invoices listed in the receivables report. Test all the invoices shown in the receivable report. There will be something called the receivables report, debtors report. In that, whatever invoices have been shown, test that. So test the invoices. Select the invoices from the accounts receivable aging report and compare it to the supporting documents. Then you have to do that. Then match all the invoices to the shipping or dispatch log. Match the invoice dates to shipment dates to see sales are recorded in the correct accounting period. Invoice, what is the date? And when the goods are shipped, what is the date? Shipment bill will be there. In that, what is the date? And corresponding invoice, what is the date? You can match that and see whether that sale is actually of the current accounting period or not. Then assess the bill and hold sales. Examine the supporting documents. Here it is OU. It has been written by someone who is not from CA background. So some writing issues will be there, but we'll correct. Okay. Assess the bill and hold sales. Bill and hold sales means sometimes some customer will say, imagine I purchased one goods from the company and I am saying, okay, I'll pay the money also now. No, I'll not pay the money like debtor, it will be there, credit sale. And I'll say to them, imagine I purchased it on March 15th. And I'm saying it to them, bro, deliver that goods only to me on May because I will be available only on May. So I purchased, that is billed, but the sale has been hold. So assess all those things. When the purchase is happened, but the customer is saying, deliver to me the goods only after 2 months or something like that. Check that and examine its supporting document. Supporting document means it's invoices, all these things like bank receipt ticket, whatever the money received or not. Money received will not be there because else it will not come in debtor. Then review the process of giving the discounts and check whether they were as per the company's policy. For some customers, company may give a discount. Review the process for that. Like for example, in any case, like in our THARUN'S Brainery, when on our audit lectures and all, sometimes in puja days or something like that, we may give some discount, festive discounts. But this discount can only be authorized, it cannot be authorized by me or any other person. It should be authorized by the management. Like we have a management and everyone discusses and then the discount is given, right? So that thing you have to check. Review the process of giving discounts and check whether they are as per company's policy. Company's policy is there, we can only give discounts of up to 10%, whatever festival it is. So make sure company has not given any discount over 10%. That is above company's policy, nothing has happened. So these are the things you have to check for completeness. And how to check the valuation, whether the amount of these debtors are correct. So review the process followed by the company to derive the allowances for doubtful debts. That is, it includes a consistency comparison with the previous year method. What process company is following to derive the allowances for doubtful debts? Imagine a provision or any other allowance they are keeping. What process they are doing that? What is their process? Like imagine a debtor is not paid for the last 4 months. Company has a policy. All the debtors that have not been paid for more, outstanding for more than 6 months, we will put a provision of 10%. All the other debtors which are outstanding more than 1 year, we will put a provision of 50%. Like on what basis, what process they are following? You have to check that. On what basis they are saying. Then like in the financial statements, there will be provision for doubtful debts will be there. On what basis they are putting this provision? That you have to check. Like 6 months old debtors, then other like that. Then obtain the aging report of the trade receivables. Obtain the list of debtors under the litigation and compare with the previous year. List of debtors under litigation. Some debtors will purchase from us and they will file a case against us, like customer cheating, like Byju's and all. You would have seen this case. Lot of people purchase their courses and file a case because class is not good or some issues there. So obtain the list of all the debtors which are under the case, all the debtors which case is happened. So that is why they have not paid the money, all those things. And compare it to the previous year, whether compared to last year, current year, if litigation, the cases, etc. is increased, that means company is in a bad stage. So to check that. Then check if the provisions are made at appropriate rates considering the recoverability of amounts due. Check if the provisions are made at appropriate rates. That is, all the provisions are put at the correct rate considering the recoverability. All the provisions or rate, everything is correct. Then identify the debtors which appear doubtful and discuss with the management the reasons as to why it is not included in provision for debtors. Sometimes an auditor checks, he may identify some debtors which are outstanding for more than 1 year, but management has not put a provision. So we can ask him, bro, this debtor is outstanding for more than 1 year, you have not put a provision, why? That reason you can ask. Then check whether write-off of trade receivable is approved by the proper authority. To write off a trade receivable, management directly cannot do that. So proper authorization, permission from the top management is needed. So all the write-offs are properly authorized. This is also you have to check. Hope you got a clarity in trade receivable. Same thing is there for the trade payable. I'll put the chart also along with this, so you can get it from the Telegram channel. Next is PPE. PPE, one of the most important thing here which you have to study. Then how to check the existence of PPE? Literally very easy. Review the entity's plan for physical verification. That is, in the balance sheet it is written PPE is equal to 50 lakhs. So how will you check whether that PPE actually exists or not? That is checking the existence assertion. So first you will do it through physical verification. So what is entity's plan for physical verification? That is, normally you will go and do the physical verification first, and entity also should do a physical verification for their inventory, PPE, whether everything is correct or all these things. So physical verification, are they doing it by own staff or by third party, and are they doing it annually or once in 2 years? Like that you have to check, once in 2 years or 3 years, whatever it is. Then examine the evidence of supervision of those performing physical verification. Whoever is performing the physical verification, once they finish the physical verification, during the physical verification, there should be someone to supervise whether everything. So you have to get the audit evidence that there was someone to supervise and get the evidence of that supervision for physical verification. Then obtain the PP's physical verification report backed by the working sheet and perform the following. When you do the physical verification, you will get that, during the physical verification, you will have the working sheet, and once you finish it, you will have a physical verification report. When entity do the physical verification, obtain that and then perform the following. Assess if all the PPs are properly tagged and has identification marks. Make sure if company has 15 property, plant and equipment, make sure all of them are been properly tagged and has identification marks with the like number or something written to the PP in machinery 1, machinery 2, like that. Or do they have a properly tag with other weight, other years, all these things. Then reconcile the PPE, that is physically verified with the physically verify with the fixed asset register. That is physically you can go and verify. So here, till here, all the verification was done by the management. We are checking what our management has verified and all the reports from that. But here you can also, auditor can go and physically verify with the fixed. You can do the physical reconcile PP, that is physical verification with the fixed asset register. When you do the physical verification, you can have the fixed asset register in your hand, and whatever is shown in that, whether it is there physically, you can go and verify. So verify the PP's addition till the physical verification date is updated in the fixed asset register. Verify that PP is addition till the physical verification date is updated in the fixed asset register. So verify here, just verify that PP is addition. All the new physical PP, all the new PPs that was bought in the current year, make sure all of them has been added to the fixed asset register. That is it. Then verify any discrepancies found in the physical verification and see the manner in which they are dealt in the books of accounts and financial statements. Verify any, if during the physical verification, the fixed asset register, it was written 10 machinery, but when you verified only 9 machineries there. So a discrepancy you found. So verify any discrepancies found in physical verification and see how they are dealt in the books of accounts. It's if it is you doing or management has done the physical verification, in that they found out any discrepancy, see how it is properly accounted in the books of accounts, whether that verification have they reduced that one asset or like whatever it is. Then how will you check the rights and obligations of PP? That is all the PP which is shown in the balance sheet should be in the name of the company. That is, company should own that. Then only it can come in the balance sheet. So how will you check that rights and obligations? All the PP purchase invoices are in the name of the entity. Check that. This is check that all the PP purchase invoices, check all the PP purchase invoices, purchase bills you take of the machinery, and see that it is in the name of the company that entitles the legal right of ownership to the entity. Entity's name it should be, and it should, so that it will give the ownership right to the entity. Then for additions to land and building, that is new additions bought in the current year, check the sale deed to verify whether entity is the legal owner. For all the things land and building we have bought, the sale deed will be there. So check that to see that it is in our name itself, company's name itself. Then for all the immovable property held at the balance sheet date, verify the original title deeds. Land and building we hear, on all the other things, see the title deeds of that, immovable properties. Then immovable property given as security for borrowing and original title deed is not yet available. There are some, the company has 10 land and building. Out of that, 2 land and building company has given as a security to the bank. The title deed is with the bank and company has taken a loan. So in that case, how will you check? Request the management to obtain a confirmation from the lender. Tell the manager, bro, I need to check these 2 PPs which you have given as security. So go to the bank, obtain a confirmation from them. That is, in the bank's letter pad, ask them to write and give that this PP is with them. That is, obtain the confirmation from the lender that they are holding the original title deeds as of immovable property as security. Ask the bank to give a confirmation that they have the original title deeds of these 2 properties and it is in the name of the company itself. Then verify the register of charges to assess whether any charge is created against the PP. When you verify the register of charges, you studied in law, right? That thing, you will get whether any charge is created against the PP. Then how will you check the valuation of PP, whether the amount is correct? Auditor should verify that entity has charged the depreciation on all the PP except land. Make sure all the PP depreciation is charged. Then depreciation method used reflect the pattern in which assets future economic benefits are expected. That is, the depreciation. Imagine company is expecting that current year company bought a machinery, but future it is expecting every year the performance of machinery goes down. So slowly machinery's capacity, the ability, the function will go down. So use WDV method for that. But other cases, if every year it will function perfectly till then use straight line method. So make sure the depreciation method is as per the expected future economic benefit from the machinery. Then PP. Then whether management has done impairment assessment as per AS 28, also you have to check. Then how will you check the completeness? Whether all the PP, company has 50 PP, whether all of them has been come in the balance sheet, you have to check. How will you check the completeness? Verify the movement in PP schedule. That is, opening balance plus addition minus deletion is equal to closing balance. Make sure this one. That is, all the opening balances plus all the additions, new machineries bought in the current year, new PP, minus the machinery sold is equal to closing balance. Do this reconciliation and see. Then, that is, you can check. They would have already done that. Then check the arithmetical accuracy of PP schedule. That is, PP schedule, one thing will be there. Check all the, whether the calculations, all the things, depreciation calculation rate into 15%, all those things are correct. You have to check. So for checking that, For checking this arithmetical accuracy, first you have to tally the opening balance to the previous year's closing balance. Last year's whatever the PP's closing balance is, make sure first step for tallying this, first step you need to do is last year's closing balance, because here what I said, opening, addition minus deletion. So you are checking the arithmetical accuracy of that PP schedule. So first you verify the movement in PP schedule, for that is opening balance, all these things. So second step is check the arithmetical accuracy of this, that is whether this calculation everything is correct, and you have to check. For that, first calculation you need to check is previous year closing balance is correctly brought forward as current year opening balance. First thing you have to check. Then for addition, so opening balance is correct. Then for addition, how will you check? For deletion, how will you check? So opening balance we checked. So additions, what you will do? For material additions, like significant machineries, important high value machineries, verify if the expense meets the AS10 criteria. Then spare parts, standby equipments, standby tapo. Oh my god, this is what happens when you ask your wife to write the things. Okay. Spare parts and standby equipments and servicing equipments. I had this notes with me, but my handwriting is bad, so I asked her to rewrite. Okay. So then spare parts, spare parts and standby equipments and servicing equipments will be there. Company will have a machineries, lot of spare parts, then standby equipments, then servicing equipments, all these things will be there. So make sure for checking that, for checking the addition to that, you have to check for whether whether it is recognized as per AS10 when they meet the definition of PP, else it is inventory. If these things, spare parts, standby equipment, servicing equipment, if they meet the definition of PPE, then you have to recognize it as per AS10, else it is recognized as per inventory. Then ensure the day-to-day servicing cost is not recognized as PPE. Day-to-day servicing cost of machinery will be there. Don't recognize that, capitalize that, don't capitalize that. Then those costs are not added as additions. Then to verify the date of addition, on which date the addition happened, you need to check that. For that, you can check the purchase invoice or you can check the installation certificate. Then verify whether PP's additions are approved by authorized personnel. That is, new PP bought is as per the proper permission of the top management. Then verify whether proper internal process were followed to finalize the vendor for procuring PP. Company wanted to buy a machinery. So normally, what company should do? Company should invite tender from all the suppliers, and whichever the lowest quote we are getting, lowest discount, the best quality, we need to buy from them. So that thing you have to check, verify such kind of a proper process was followed to finalize the vendor. Because in some companies, imagine I am the management. What I will do, I have my friend who is running this machinery shop. So I will buy the machinery from him. Even though it is at high price, I'll buy it from him because he is my friend, or sometimes I'll get a commission. So to avoid that, auditor has to check whether management has properly invited all the tenders, quotes, everything, and only the lowest thing is they have taken, or the best quality. Then for deletion, so here in the PP schedule, first we need to check the movement in that. That is, what was the opening balance, what was the closing, additions, all this. Then you need to check the arithmetical accuracy of PP schedule. So for that, first opening balance we checked, tally it with the previous year. Addition now we checked, now deletion we are checking. So here you are getting the structure proper in your head, so you will not forget. For deletions, understand the reason for deletion and the manner of disposal. Why that machinery has been deleted. Last year, one machinery was there. Current year, it is not in the balance sheet or register. Why it has been deleted? Is it because it got damaged, or what is the reason? Understand the reason and how it has been disposed of, whether it has been sold to someone or whether it has been like completely dismantled and scrapped. All these things you have to check. Then obtain management's approval and discard note authorizing the disposal. Company has a 10 machineries. If a company want to discard one, remove one machinery, then proper management approval should be there. And they gave this approval through a discard note. Approval you have to check, and after that, that machinery you are selling it out, or you are dismantling and removing it out on scrap. So discard note will also be given. You have to check that. Then verify the process for sale of discarded PP. If discarded PP is being sold, and in what process we are selling it. Sometimes company has a PP and the useful life is 10 years, but they used it for 5 years. So now the realizable value, if you sell it in market, you may get to 5 lakh rupee. But company sold it to someone for 2 lakh rupee. Sometimes that may be managers, father-in-law or something, kind of a fraud. So to avoid that, in what process they are selling it, you have to check. Proper oil or wherever they are putting it, and proper high price itself, actual value, selling value, second-hand value they are selling, you have to check. Then verify management has accurately recorded the deletion of PPE, gain and loss in books of accounts. All the gain and loss when you sell PPE, make sure it is properly recorded. So PPE is also done and dusted. And in PPE and other chapters also, guys, in your study material, this chart is just if you're planning to skip it or all these things, you are studying it. But Along with that, you have to refer with whatever material also you are using. Just basic 16 marks when a paper is coming, at least 10 marks paper you will get it from this chart itself, or at least 8 to 10 marks you will get. But other marks, it may come from all the disclosures you have to see it from your book. Disclosure you have to study, like the disclosures are there, which you can see it from your book. But study with the chart first, then if time is there, then only study the disclosures. Disclosures also a 4-mark question can come. Then disclosures plus all the other things, I have put everything in the chart, but except a few things which you can search with your book, that is for like trade receivable, these things, following points. This one point you can check. This is very easy. When you read, you will understand. I've made the tough points on the chart, which is very tough for you to understand. So learn all those tough points from the chart, and other things, if there is extra something, you can learn it from the book. Like all the disclosures, you can learn it from the book. Then in case of PP, only I'll show one thing, which you have to learn from the book. This one. That is a measurement and recognition. That is a cost of an item of PP recognized assets only if the future economic benefits will come. You learned it in the accounting standard, right? That is why I have not put in. Then what are the elements of cost? The purchase price, import duties, all these things. These two topics you have to learn from the book. Okay. Then it is going to be intangible asset. Intangible asset, the software, all these things. So existence, how will you check the existence of intangible asset? Verify whether the intangible asset is in active use for production or supply. Company has some intangible asset. Make sure company is actually using that intangible. Company has a patent. Imagine Maruti or Kia and Hyundai. I think Hyundai has the patent of Kia, or Kia has the patent of Hyundai for their design and all these things. So those designs whichever they are having, make sure they are actually using that design for their production. Is it in active use? Those things. Then for intangible asset, not in active use, if you are not using that, then deletion recorded in the books of accounts and amortization ceased beyond the date of deletion. You have to check. If they are actually not using it, make sure the deletion is there in the books of account, deleting that asset, and its amortization has stopped after the date of deletion. You have to check, because in PPE it is called depreciation, and intangible assets it is called amortization. It is opposite. Then for checking the existence of software is an asset, right? You can verify whether that software is actively used. The company has a software, whether they're actively using it. Verify the sale of related goods and services in which such software is used. For what purpose? Imagine I am a cloth manufacturer and I have a software for designing the clothes. So what? Check whether I am actively using it, and also see what are the goods and services I am selling with the help of software. Like from software I'm designing and I'm selling my clothes, that are the goods. I can check that. Verify the sale of that. Verify the sale of that goods. Then that shirt, whose design I have created with that software. Then only I can know whether that I'm using that software. I created one design with the software, and same design I printed one shirt and sold. So when I verify the sale of that shirt, then I can understand, okay, this shirt has been sold 1,000 units, and this design was made by this software. So this software is in active use. Like that I can conclude. Then existence of design and drawings. For that, verify the production data to see if products for which design or drawings were purchased are actually produced and sold by the entity. I am a clothing manufacturer and I need some designs. So I purchase some designs from some people, external people. So that design is an intangible asset for me. So now I need to check whether I am actually using that design in my production. Simple. Then how will you check the completeness of intangible assets? Company has a lot of intangible assets. So we have to check whether every intangible asset is there in the books of account, in the financial statements. How will you check that? Verify the movement in intangible asset schedule. Like PP asset schedule, PP register, we'll have a intangible asset schedule. So verify the movement. That is opening balance, like how many intangible assets we had, what is opening balance, check its additions, check its deletions, same like we learned about, same thing. Then tally the closing balance to the books of accounts. Then check the arithmetic, same point we learned here, same point. Intangible asset schedule, check the arithmetical accuracy, then addition, deletion, everything is there, same, cut, copy, paste. Check the arithmetical accuracy of movement in intangible assets, calculation. So for that, first opening balance, we are doing this. Then additions, for material additions, verify whether expense meet the criteria of AS 26. Then no intangible asset arising from research is recognized. Expense on research should be recognized as expense when it is actually incurred. That there is any intangible asset arising from research is no intangible asset which is coming from research is recognized. Make sure that. Then expense on research should be recognized as expense when it is actually incurred, because company will spend research expenditure to create some designs or research to find designs. Then verify the date of use of intangible asset. Check the certificate or the report. On from which date you are charging intangible asset, you have to check the certificate or report. This is for amortization purposes. Then verify whether additions are approved by the appropriate personnel. additions, new intangible assets are authorized by appropriate personnel. Then verify whether proper internal process is being followed to finalize vendor for procuring intangible asset. You wanted to buy a design, so don't just buy it normally. Just invite the tender. Lot of designers, let them give the design, whichever the best design, whichever is the lowest cost you need to buy. That is a process for finalizing the vendor, the seller. So make sure such kind of a process is followed. Not like company or friend they buy a design. No. Then for deletions, how will you check? Obtain the management's approval and disposal, not authorizing the disposal. That is one intangible asset is deleted, then management need to approve it and they need to give a disposal note. That there it was discard note, it was here it is disposal note. Verify what is the process for selling that intangible asset, discarded asset, how they are selling it. What is the process they are following? Are they listing on OLX or are they showing ad or what is the process? Then verify the management has accurately recorded the deletion and gain and loss. Same thing. They obtain management's approval, discard note, here there it was disposal note. Then what is management's process for deletion? Same process here also. Then verify management has accurately recognized a loss or gain on deletion. When you sell the intangible asset, you may get a gain or loss. Make sure that is properly recorded. That is here also it is said. Then how will you check the valuation of intangible assets, whether the value of intangible assets is correct? Verify that the amortization is charged on all intangible assets. Make sure, like depreciation on PP, make sure amortization is charged on all intangible assets. Then amortization method used to reflects the future pattern of future economic benefit. Like there I told you, we need to give WDV if we are expecting the benefit to go down, asset or the benefit to go down, and if we are expecting same benefit every year, then straight line method. Similarly, do that for amortizing intangible assets based on their expectation of future economic benefit. Then whether management did impairment assessment to determine whether intangible asset is impaired, whether they have done the impairment assessment. Then how will you check the rights and obligations? Verify that all the expenses and invoices and purchased contracts are in the name of the entity that entitles ownership. Same rights and obligation, how will you check? All the intangible assets which company are showing in the assets, make sure that is in the name of the company itself, the ownership, similar to PP. So now we are done and dusted with intangible assets also. So hope you got a clarity on all the balance sheet captions. Now only to like provisions or loan is there, which is very easy. You can learn it directly from whatever material. When you read, you'll get. But these are the complicated areas which we explained, all the important areas we explained. And then P&L captions are also there, which I'll upload one more video soon itself, so that I don't think P&L is very tough. Normally people easily read and understand, because now when I taught you all these things, you got an idea about what IC is meaning with their sentences, right? How to read their sentences, how to vouch everything. So when you read the P&L captions yourself itself, you will get the idea. But anyways, I'll also upload one video in the soon, like this week itself, I'll upload one more video for P&L captions also, which will be, if you want, you can watch, but that is not needed, bro. Directly, when you understand this much, when you read it from the book, you will understand easily. So guys, chapter number 7, completion and review. The first area is SA 570 going concern. These notes are there in the Telegram channel. You can please go and take it. So first of all, guys, the most important thing you need to understand is basically in going concern, basically there are 3 phases in going concern. 3 phases. Without understanding this concept, you won't understand this essay. You may think going concern very easy. No, it is not that easy, because here audit opinion forming areas are there. See where it is. Which audit opinion to give in which situation is asked. So this one thing you cannot understand without understanding this. So that is why I would advise, which is this way. This is 501. Okay. So 570 SA 570 going concern, 3 phases. First phase is called as uncertainty. Second is material uncertainty. Third is going concern getting affected. So these are stages before a company gets into very big trouble. Imagine 2020 or 21 when Byju's downfall started. Initial time it was uncertainty. Byju was still performing decently, but still uncertainty was there. Then by 2022, uncertainty became very, very serious and it became a material uncertainty. Still going concern is there. Then 2023, 2024, going concern gets affected and company gets shut down. These are the 3 phases. So understand, uncertainty is normal for every business. These are just the normal doubts about the company's future. Normal doubts. Company sold a goods of 1 lakh or 1 crore to someone, and whether he will repay back. That is now a doubt whether the money will be received. Normally, everyone will have. This is just normal uncertainty. Financial statements you can prepare in going concern itself. But next is material uncertainty. That is a bad phase. That is, there are issues that creates a significant doubt about company's ability to continue as going concern. Significant doubt. That is Byju. Lot of customers started initial phase, not now. lot of customers started complaining against Byju's. So many people started to go to court and file cases against Byju's. So that phase is called basically Byju may be thinking, oh my god, now I'm getting into very big trouble, but still company is not getting that much like into going concern. It is not yet affected, but still if it go like this, going concern gets affected. That like kind of a serious issue just to face before the going concern are getting affected. That is significant doubt whether we'll be able to revive back. So in a significant doubt only, not 100%. It's just a significant doubt only. 100% it is not going concern getting affected. So management still believes company is a going concern and company can prepare the financial statements on a going concern basis. Example, everything is there in the chart. The next is going concern getting affected. So company stopped its operation. Government ordered a liquidation of Byju, or Byju itself planned to liquidate the company. So that is company's operation completely gets stopped. That is going concern gets affected and is under the liquidation. No plans to revive into the future. So here financial statement should be prepared on liquidation basis. Here it is going concern basis. Here also going concern basis itself. See, going concern basis itself. But in this case, material uncertainty case, even though financial statement is preparing in going concern basis, you need to add a material uncertainty paragraph in the audit report. In the audit report, give a heading material uncertainty and about material company is facing some bigger issues, all those things. In this case, in material uncertainty case, you need to give. Here, not that needed, but here company is entirely financial statement prepared on liquidation basis. So as an auditor, when you're going to audit a company, see first of all in the initial stage itself, see whether company is having any material uncertainty or company is going concern is affected or not. If going concern is affected, they should prepare financial statements on liquidation basis. They would have prepared it in normal going concern and given it to you. So entire financial statement is wrong. So that thing you have to understand before starting the audit. Liquidation basis means assets are written down to the realizable value, liabilities are written down at the settlement value. Then going concern means entity, other things you will know. Then what is management's responsibility in going concern? Not auditors, management's responsibility. Management has a responsibility to assess entity's ability to continue as going concern. That is at the financial year end, before making financial statements, they need to think, okay, are we actually a going concern? Is there any significant issues which is affecting us? Is there any uncertainty? Is there any material uncertainty? And is that material uncertainty affecting our going concern? So they need to do a preliminary assessment, an assessment to identify whether a company is a going concern or not. Then only if company is a going concern, they need to prepare financial statements on going concern basis, else on liquidation basis. So before preparing, they need to do that assessment, entity's ability to continue as going concern. Do our entity is able to continue its business as going concern? They need to do that assessment. So what are the factors that management considers in making this judgment? That is whether our company is a going concern or not. To reach that judgment, manager may consider certain factors. Those factors are called DESI judgment. DESI judgment. DESI judgment. DESI judgment. What is the degree of uncertainty? That is outcome of any event. If any case is there, what may be the outcome? They may think, okay, we may fail the case, or we may need to shut down. So in that case, going concern gets affected. So like that, they may think, oh, in a case we will win the case, so going concern is not affected. Like that. Then what is the size and complexity of the entity and nature and condition of the business? How big our business is, how big those problems will affect our business, all those things he will consider. Then any judgment about the future is based on the information available at the time at which that judgment is made. Management makes a judgment on the financial year end. So at that time, what information is available to them? They make judgment based on that only, right? They cannot know the future. So that also, they see judgment. Then mnemonic. Then auditor's responsibility and objectives of the auditor. It was management's responsibility. Here it is auditor's responsibility. What should the auditor do? Obtain sufficient appropriate audit evidence regarding appropriateness of management's use of going concern and conclude whether a material uncertainty exists. That is, do the audit procedure. Get the audit evidence that company is actually a going concern or not. First of all, identify that, and that is whether management is properly using the going concern. Company going concern, then are they following the going concern assumption or not? All those things you need to check. Is it appropriately management is using going concern assumption? That is, they are actually going concern assumption or not, going concern or not. And see whether any material uncertainty exists. That is, whether any serious issues are there. Then report as per the SA 570. Whatever is written, we'll learn about the reporting. That is auditor's objective. Then auditor cannot predict the future events and conditions. So absence of reference to material uncertainty about entity's ability to continue as going concern in audit report cannot be viewed as a guarantee to entity's ability to continue as going concern. Means we don't know what is the future. So sometimes on auditing date, we only have information till then. So we may think, okay, company is a going concern and we may do. But next month, sometimes company may get affected and shut down. So nobody can blame us, okay, for that, because we are We don't know the future. The next is risk assessment procedures in relation to SA 570. What are the risk assessment procedure you need to do? In SA 315, I told you, risk assessment means you are doing some procedures to identify the risk. You are doing some audit procedures to identify the risk, identify the chance of issues. So, when performing a risk assessment procedure as per SA 315, auditor has to consider whether any events or conditions are there, like any case against Baiju, like cases are there against the company, or where any serious fire or any other issue has happened in the company's factory. So going concern is getting affected. Something like that. Now take the case of Ola scooters. Everyone is filing the case against Ola. Ola is like in verge of like getting affected. So it kind of a material uncertainty state Ola Electric is facing now. So such a kind of whether any events like customer complaints, customers going to court, such kind of any events or conditions exist, auditor has to identify. So in doing this assessment, see whether management has performed a preliminary assessment of going concern. That is, before making financial statements, have they done the preliminary assessment? Auditor has to check that. If preliminary assessment is performed, the manager has performed a preliminary assessment, discuss with the management and determine whether management has identified the events that may cast a significant doubt. If so, what are management's plans to address them? If management has done this preliminary assessment, then ask the manager, bro, have you did the preliminary assessment? Manager will say yes. Okay. Have you identified any events that are affecting your entity? Any other the events are there? They will ask. So management may say yes. Obviously, they may say yes. So when they say yes, ask the manager, okay, bro, how are you going to deal with that? Like to Allah, Bhavesh Agarwal, the CEO, imagine I am the auditor, I am asking, bro, is there any, have you done the preliminary assessment? He will say yes. And have you identified an issue? He'll say yes. Like customers are complaining against that, all these things. So I will ask him, okay, how are you planning to solve this issue? If this issue is unresolved, it will affect your going concern. So he may give me some, like we'll take money from the Ola cabs and put it here and do the things like that, he may say. So if preliminary assessment is performed, do this. If preliminary assessment management has not performed before making financial statements, they have not done the preliminary assessment of whether company is a going concern or not. They have not done that assessment. Then ask the management, bro, you have not done the preliminary assessment. Then how the hell did you know your company is a going concern, and how the hell, on what basis have you made the financial statements in going concern? Without doing the preliminary assessment, how will the management itself know whether company is a going concern or not? So without doing the preliminary assessment, they cannot make the financial statements on a going concern basis. But the management has made that. So ask the management, bro, what is their basis of intended use of going concern basis of accounting? How, without making preliminary assessment, how did you concluded you are a going concern, and how did you prepare the financial statements in going concern? Ask them and inquire the management whether events or conditions may some issues are there which may affect the entity's ability. Then auditor has to remain alert throughout the audit for such kinds of events. Then what are the additional audit procedures when events or conditions are identified? If some issue, customer complaints against Ola, all these things are identified. What are the additional audit procedures auditor need to do? If events or conditions are identified that affects going concern, that cast a significant doubt on going concern, auditor has to get audit evidence to determine whether a material uncertainty exists. That is, whether these events and conditions are creating, whether those events like customer complaints, whether are they creating just a normal uncertainty or are they creating a material uncertainty? That thing, if are they creating this or are they creating this, that auditor has to identify. For identifying that, auditor will do these procedures. This can be question, understanding, conceptually I'm putting it into your head. So if that assessment has not been performed by the management, ask the manager, please do that assessment now. Then that is your first procedure. Second procedure, evaluate management's plans for future action. Now management did this assessment. Now ask the manager, bro, events are identified. How are you planning? Like customer complaints are there. How are you planning to solve it? What is your plan for the future action? What is your future action to solve these customer complaints and issues? Is it feasible? Will outcome of these plans improve situation? Ask them that. We are asking Bhavesh Agarwal, bro, your scooter, lot of customer complaints issues are there, lot of people are going to court, what you will do? So now Bhavesh Agarwal CEO may say to me, bro, we are raising money, we may get some money, so we will refund the money to the people, all these things. So now I'll ask him, bro, is it actually feasible? Lakhs of customers are complaining. Is it actually feasible? Can you actually provide that? He may say yes or no. Then I will ask, okay, you are planning like this. Will it actually improve the situation? Even if you give the refund, still nobody is going to buy Ola. So what you will do? Like that I will ask. The next, if entity has prepared a cash flow forecast, if company cash flow forecast, future predicting the future cash flows, if they have done that, Then analyze it, how they are how they are expecting the future cash flows, inflows and outflows. Then whether any additional info or facts are available, then after the date of assessment, management did the assessment on one date, and after that whether any additional info is available, check that. Then request a written representation from management that they are, what are their future plans and all these things. Then example of audit procedure: when events or conditions are identified that may cast a significant doubt, analyze and discuss the cash flow or profit oriented forecast. In latest interim financial statements you can analyze. Then read the terms of debentures and terms of loan agreements, see whether any terms have been breached. Then read the minutes of meetings of shareholders and all these things. Then inquire the external legal counsel regarding the existence of litigations and claims. This is easy, you will understand yourself. That is why I quickly went through. So everything in the study material I have put it here. So don't worry, this note is more than sufficient for SA 570. Everything is there. Why should I say more than sufficient? 100% sufficient. Everything is there. Then this is the core area you have to study. That is implications for auditor's report. If company's going concern is affected, not affected, material uncertainty is there, in all these situations, which audit opinion you need to give. I'm hoping you know SA, like in the 700 series, you have a basic knowledge, but still I'll say. So 3 situations are there. That is, if going concern basis of accounting is inappropriate, that is, company is not a going concern. Imagine Baiju is not a going concern, but they have prepared the financial statements on a going concern basis. So going concern basis of accounting is inappropriate, and they are giving that statement to you to audit. So you will give a adverse opinion, the baddest opinion. Then if going concern basis is appropriate, that is, company is in the material uncertainty phase, the second phase, just to get affected, that phase they are sitting. That is, going concern is still there. That is, going concern is appropriate, but a material uncertainty exists, like the Ola Electrics case right now. In that case, what should the auditor do? If material uncertainty is adequately disclosed in the financial statements, that is, company is a going concern, but material uncertainty is there, and they have disclosed that material uncertainty properly in the financial statement. That is, like whatever problem is there, they have said that in the financial statements. So management is perfect on their part, everything they have done. In that case, give an unmodified opinion. Give an unmodified opinion in that case, and in audit report, include a separate section with the heading material uncertainty relating to going concern. Give an unmodified opinion, and in your audit report, include a separate section with the heading material uncertainty to draw attention to the note, all these things. This is very simple, you will understand. Like earlier I told you that. Then, if this material uncertainty is not properly disclosed, that is, company's going concern is there, company is a going concern, but material uncertainty is there, they have disclosed it in this case, but this case they have not disclosed it. Management is trying to hide it. In that case, give a qualified opinion or adverse opinion, depending on auditor's judgment. So in the basis for qualified or adverse opinion section, state that a company has a material uncertainty and financial statement don't disclose it adequately. Tell it. Then management has not done the preliminary assessment. Third case, management here going concern is appropriate, but material uncertainty exists. Here going concern itself is gone, and they have put the financial statements in going concern. And imagine going concern is affected, and management prepared the financial statements. That is this case. That is, if going concern is affected and management prepared the financial statements in liquidation basis, so management, everything they are doing is correct. Company going concern affected, so they prepared financial statements on liquidation basis, they are correct. In that case, give unmodified opinion. If going concern is affected and they gave financial statements in going concern basis, give adverse opinion. That is this point. So every point I have covered. Going concern affected, not affected, then what all situations management has done, everything is there. So you just sit and try to recollect in your mind, in this situation what will come, everything is written in this chart. Take it from my Telegram channel. Then management have not done the preliminary assessment. They have not done the preliminary assessment, give a qualified opinion or disclaimer of opinion. Done and dusted. Hope you liked SA 570. So guys, the next one would be SA 560, that is subsequent events. I would strongly advise studying this one standard from this note itself. If like you can, if you want, you can rewrite this, or you can share it to ChatGPT, and ChatGPT will rewrite these things for you. So you'll get it in a note form. So why I would suggest like that is, in every book, be it institute's book, be it any note which you have, subsequent events are just written in the normal way. So it is, it's actually literally a bit hard to differentiate between what is actually events, what is actually facts. That differentiating factor is a bit tough. So that is why if you learn it from here, it will be more structured and you'll have much more clarity. So SA 560, that is subsequent events. So as an auditor, normally imagine we are auditing from 23-24, April 23 to March 2024 accounting period. So normally we'll only take those transactions which happened in that period. But if there are certain events which occurred after the March, after 31st March, certain things are there. Those are called as subsequent events, events which occurred after the date of financial statements. So those certain things are there which we needed to consider while auditing, while forming audit report also. What are the things that is written under SA 560, that is subsequent events. So what it is actually events and facts. You need to differentiate between both. Both are completely different. It's not events and facts are different. Lot of people get mistaked here. So events means events, it is actually divided into two. That is events occurring between the date of financial statements and the date of audit report. Events, some things that happened. Imagine a fire take place on April 5th. That is, date of financial statement is over, but before the date of audit report, a fire occurred. That is called an event. Something has actually happened. Fact is not that. Fact means a fraud has happened in March or February anywhere, but auditor came to know about this after date of financial statement. So that is not an event. It is an event has occurred earlier, but auditor is knowing about that only after date of financial statement. That is what we call a fact. Event means an actual occurrence of something. So see, if you consider this is the date of financial statement 31st March, and this is the date of audit report, say 31st July. So anything that occur in between these things is what we call events. Not anything. Here if events occurring between the date of financial statements and the date of audit report are only considered. Any event that occurs after the date of audit report, we are not considering. Then, so in case of events, all the events that occurred between this date are considered. Then second thing is facts. Facts which became facts known to the auditor after the date of audit report, but before the date of issue of financial statements or after the date of issue. Facts known at this stage we are not considering. Facts that are known, facts known at this stage we are not considering. We are not considering about facts. Facts means here audit report has not been given yet. So if an auditor comes to know about any fact here, he can consider that in audit report. That is not separately mentioned. All the events occurring in this phase is what we consider, and facts which occur after the date of audit report till this period, that is before the date of issue of financial statements, will be considered. Then all the facts that auditor came to know after the date of financial statement, after the date of issue of financial statement, will also be considered. Now structure it properly in your head. Events, only those events in this period before the date of audit report, and facts, only those facts after the date of audit report. Events and facts are different. Event means some actual occurrence of something. Some fire occurred, a flood occurred, all these things. Then facts means a fraud happened in the earlier, but auditor came to know about that after this date only. That is fact. Okay. Any fact that occurs in this period would automatically be considered by audit. It is not a subsequent event. Okay. Fact was occurred in this period. Facts. Okay. So hope you got the clarity. Else go and watch it back again once more. Then what are the different types? This is the clarity I'm giving. So listen to me. If you miss one word, you may lose the standard. It is actually literally easy, but you have to spend some time and focus. What are the different types of subsequent events? Condition, that is any event where the condition existed at the date of financial statements. On the date of financial statement, one condition was existing, and second is condition arose after the date of financial statement. Two things. Example, provision for legal case already put at the date of financial statement was rupees 20,000, but it was settled for rupees 17,000 after the date of financial statements before the date of audit report. It simply means on 31st March, before finalizing itself, company already have put a provision. That is, company had a legal case and company think that we will lose the case. So company has already put a provision. So in that case, this condition, that is legal case, that situation was already existing on 31st March. We know that we have a case and we are thinking we'll lose the case. So we have put a provision. Already we put a provision. And so we put a provision for 20,000 on 31st March. But it was settled for 17,000 after the date of financial statement. That is on April 5th, the case judgment came and it got settled for 17,000. So this is what we call as situation where the condition existed at the date of financial statements. And here what we need to do, it is basically kind of an adjusting event. So hence ask the management to remove the 20,000 because already audit report has not been finalized yet. So ask management, put the provision for 20,000. Tell the management, revise the provision to 17,000. That's it. Then understand this, guys. SA 560 is an auditing standard. It is not an accounting standard. So you don't have to overthink like the accounting treatment of all these things. No, don't overthink about the accounting treatment. Here we are just worried about the auditing procedures only. So keep that in mind. Then next, condition aroused after the date of financial statement. These are called a non-adjusting event. Example, a fire occurred after the date of financial statements and inventory of 10,000 destroyed. Here on 31st March, no condition was existing. Nobody knew that a fire will come. Situation, the condition was not known at 31st March. But this case, we knew the condition. Case we lose, we are thinking, and case already is there. So we condition existed. Provision was already put. But here we never knew about any situation like fire will occur or anything. So in that case, fire occurred. So no condition existed. So inventory of 10,000 gone. But condition was not existing on 31st March. So hence, only a disclosure is needed. Don't ask a management to put any like inventory, write down the inventory or something. No. Okay. So this is topic number 1. Then second is topic number 2. What are the objectives of the auditor as per say 560? Very easy. Obtain sufficient appropriate audit evidence or whether subsequent events requiring adjustments in the financial statements are done properly. Simple. Then respond appropriately to the facts known to the auditor. Simple. Then now we have the third topic. We will spend time on important areas. What are the audit procedure for events occurred between the date of financial statements and the date of audit report? That is events occurred. Events, we are talking about events. Forget about the facts now. Facts you forget. These things you forget. We are only talking about, that is why I draw a line, the chart everywhere. Conceptually, properly structured learning is required. So, events. What is the audit procedure for these events? A fire occurred in this date. What should auditor do? If a fire occurred in this date, auditor should completely ignore because it is after the date of audit report. We are not concerned about that. We are only concerned about events occurring at this phase. Okay, keep in mind. What should auditor do if a fire occurred? What should auditor, and 10,000 inventory is gone? Perform audit procedure to obtain audit evidence that all events occurring has been identified. So you have to do some audit procedure and you have to make sure that all the events that occurred between this phase, any fire, any natural calamity or anything, that all the events that occurred at this phase has been actually identified by the company. Has been actually, first step is make sure company itself identified those events. Then no need to do any additional audit procedure on matters where all the audit procedure was satisfactory. If you have done all audit procedure on the same thing, and if it is like that case I told you, if all the audit procedure is satisfactory, don't do anything. Then in determining the nature, timing and extent of audit procedure, auditor has to consider auditor's risk assessment. In which audit procedure, like here I told you, auditor has to perform audit procedure. So to decide which audit procedure to perform, in determining the nature, timing and extent of audit procedure, what audit procedure to use, at which time it should be used and how deeply it should use. That is what we call nature, timing and extent. What are the things audit need to consider regarding risk assessment? First, obtain an understanding of the management's procedures to ensure subsequent events are identified. What procedure management is using to make sure that all the subsequent events are identified? Obtain an understanding of that. Management, what they are using. Then inquiry to the management and TCWG. Ask whether any subsequent events have occurred that might affect financial statements. Go and talk to the management. Ask them, has any subsequent event occurred which affected the financial statements? So they may say, sir, yes, and fire happened and inventory was burned down. So inventory burned down means financial statement inventory figure is getting affected, right? So it is affecting the financial statement. Ask whether there are anything like that. Then read the minutes of meetings between owners and management and held after the date of financial statements and inquire about the matters disclosed in the meeting for which minutes of meetings are not yet available. It simply means if any event occurred after the date of financial statement, before the date of auditor, if it is some serious event, sometimes management may not tell it to the auditor. Sometimes if it's like an inventory event and if they have to write down the value or something, then they will not sometimes say like the provision of that case or anything. So or they may not say to my auditor. So what can auditor do? He can, in the minutes of meetings, management and shareholders or board of directors, when they are doing meeting, inside the meeting, they would have discussed about this. So it would be there in the minutes of meeting. So when we read the minutes of meeting, we'll get an idea what all things are there. Even if they don't tell it to us, still we can understand it from the minute of meetings. Then read entities' latest subsequent interim financial statements, if any. Imagine we are auditing on like June, July. So last 3 months financial subsequent interim financial statement may be released in some cases. So when you check the interim financial statement, that is financial statements of April, May, June, July or something, you will know if any subsequent event occurred, its effect may be there in that. So that you can observe. So 4 things you will observe. Hope you got the clarity. Then obtain a written representation from management that all subsequent events requiring adjustments and disclosure, etc. has been adjusted. Then 4th topic, so now we learned objectives, types, everything. So what we learned till now, types, what are different types we learned, what are the objectives of auditor as per SA 560, then what are the audit procedure in case of events. Now we are going to learn what are the audit procedure in case of this fact and this fact. Okay, auditor's responsibility for fact. Any fact which became known to the auditor after the date of audit report. Date of audit report took after, but before the issue of financial statement. That is, events we have completely forgot. Now, events we are removing, only facts. Facts which auditor came to know at this period, before date of audit report, after date of audit report, and before date of issue of financial statements. In that case, what does the auditor need to do? Example, a very serious fraud by the senior management has been known to auditor only after the date of audit report. So now financial statements need amendment. Guys, understand, you can take this note. Even if you're studying from your study material, keep this note with you. Just keep this note. So whenever you find a doubt, just listen to this note, read this note for the structure, proper clarity. You can study it from your material if you want. Here I have given simple examples to get it connected to your head. A very serious fraud done by the management during the financial year, but auditor came to know about that only after signing the audit report. So it is a fact. Event has occurred earlier, and a fact auditor is knowing only after the date of audit report. So that was something the financial statements need amendment. You need to amend the financial statement. Management actually on the fact. So auditor has no obligation to perform any audit procedure after the date of audit report. If we give audit report, we don't have any extra obligation to perform anything. But if auditor have known that fact earlier, like before signing the audit report, if auditor has known this fact that management did the fraud, if auditor has known this fact before signing audit report, if he would have amended his audit report, like if he would have modified his audit report because of that fact, then that is if auditor has known that fact before signing audit report, if he would have known that fact, then he would have modified his opinion. In that case, if he would have changed his opinion, if the munnadi he would have known, he would have changed his opinion, then he would have amended the audit report. Then, not modified, he would have amended, changed the audit report because of that fact. Then discuss that matter with the management and TCWG. Then determine whether financial statement need amendment. Tell it to TCWG whether financial statement needs amendment. Then inquire how management is planning to address that in the financial statements. Fraud occurred. Ask management, bro, what are you going to adjust? How are you going to adjust it in that previous year financial statement, that year's financial statement? Then, if management amended the financial statement, that is, they changed the financial statement, then that is, we are hired to do the audit or the financial statement. So financial statements, if financial statement is amended after finalization, still you need to do some extra procedures, even if it is amended, like if it is amended. So carry out the necessary audit procedure. When it is amended, we have to do like a re-auditing, not re-auditing just that area, we just need to do some extra things. So carry out the necessary audit procedure on that event, that fact which you came to know. Then extend the audit procedure to the date of new audit report. So now management amended the financial statement. Now they will give a new financial statement. So now you need to give a new audit report also. So in that case, whatever that extra, that issue was there, senior fraud thing, you just do some audit procedure on that and give a new audit report. Everything else is the same in the older things. And sometimes your opinion would have changed. So change the opinion. So that is, if they have amended the financial statement, do the necessary audit procedure, extend audit procedure to the date of new audit report, and provide a new audit report on the amended financial statements. Then this thing I'm not explaining, you can read and understand, or I'll explain. Wait. Sometimes if auditor don't want to do any audit procedure, no. If I explain this, it may get complicated. wait. So that you just, this point you just read and understand from this, because if I explain, you may get complicated. That is why I'm saying. Not that highly important, but still understand. This double dating thing is important. I'll explain that. Wait, before that, let's do this. If management does not amend the financial statement, then if audit report is not yet given to the entity, management does not amend the financial statement. We have signed the audit report, but we have not yet given it to the entity. In that case, modify the audit report, because you have not given to the entity. You have signed and kept. Okay, tear that and take that new printout and change the opinion to modified opinion and give. Then if already I have signed the audit report and given to the company, then notify the management and TCWG. Please tell them not to issue the financial statement. Please don't issue the financial statements to the third parties without the amendment. That is, without amending, please don't issue the financial statements and my audit report along with that. Please don't issue. If management has already issued the financial statements to third parties, first of all, if they have not issued the financial statements to the third party, tell them please don't issue it. But if they have already issued it to the third party, then take appropriate action to prevent the reliance on audit report. Simple. So you just have to understand in which all cases, which all things you need to write. In this case, if question is coming that a fraud has happened, the management has not amended the financial statements, what should the auditor do? And the financial statement has already been given to the third party. So in that case, you need to write these points. If they're saying management has amended the financial statement, in that case, you need to write these points. If they're saying management has not amended the financial statements, but auditor has not yet given the audit report to the entity, then this point. So you have to just structure it like this rather than studying from your book. It is highly complicated book. Then understand another case. I'll explain the remaining point. If the facts, for first we learned about the responsibility for fact which became known to the auditor at this date, before the date of, after the date of audit report, before the date of issue of financial statements. If auditor came to know about any fact after the date of issue of financial statement is issued also. We signed the, we audited, we signed the audit report, gave it to the company, and company issued the financial statements and our audit report publicly also. And after that only we are coming to know about any fraud or something committed by the management. Hearing. Fact is basically hearing. We are hearing. We are knowing about that at that time only. After the date of issue of financial statement. What should auditor do? Here the same procedure. He don't have any obligation. But if he would have known that fact earlier, if he would have modified the opinion, then he should do these things. Discuss the matter, determine whether financial statement need amendment, and ask the management how they are planning to address. Same things. And in that case, if management amended the financial statements after issuing, if they are re-amending the financial statements, then carry out the necessary audit procedure as per the circumstances. What steps? Review the steps taken by management to ensure that people who received the financial statements are informed of the situation. That is, actually, fraud has been done, but the financial statement has been signed and audit report has also been issued. So users may be using that financial statement and maybe investing in the company or something like that. So what step has the management taken to tell the users, bro, the financial statement in your hand is wrong. There is a problem. That is, I have amended a new financial statements. So for that, management need to tell it to all the users who uses the financial statements. What steps has management taken to inform the users? Review that step. Then, if management has not amended, does not amend the financial statement, and they are saying, no, fraud okay, but I'm not going to amend the financial statements, and does not ensure people who received the financial statements, the wrong financial statement, lot of people has received, and management is not amending it also, and management is not telling to those people also that your financial statement is wrong. In that case, what should the auditor do? Notify the management. I just tell the management that auditor is going to prevent the future reliance on audit report. That is, auditor is going to announce it publicly that please don't rely on my audit report. That is, auditor will seek to prevent the future reliance on audit report. That is, auditor will take legal action. He is going to take legal action for that. Then, even after, like, first of all, just tell them this. Just tell them we are going to take legal action, all these things. Like, you are not amending the financial statement and you have issued the wrong statement to the people. Fraud is there, but fraud effect is not in the financial statement. So how can you do that? Then first of all, try to threaten the management by saying this. It's not like threatening, a warning. If still management, sometimes after hearing this, they may amend it. But even after that, if they are not amending it, then even after this, if management and DGCWG does not take any necessary steps, then auditor will take action to prevent the reliance on audit report. Simple, done and dusted. That's it. Then these point is something different. That is, fact which became to the known to the auditor after the date of audit report, but before the date of issue of financial statements. In that case, and management amended the financial statement also. And guys, one thing which you have to understand here is that this is applicable in both the cases, but in different ways. So that sometimes a fact which came to the auditor's ears, that is, a fraud has been done by the management in February, and auditor is knowing about that only after the date of audit report. So the management is now amending the financial statements for that fraud. Whatever the amount, everything, management is adjusting that in the financial statement, reducing or increasing that. Then management is amending and issuing a new financial statements, right? So in the new financial statements, compared to the old, if they have just adjusted this one fraud's issue only, nothing extra adjustment is there, just this frauds one issue only is management adjusting. That is, law is telling management that if you want to amend the financial statements, when you are amending and giving, you are making that extra adjustment of that frauds issue only, then in that case, auditor only need to do the extra auditing of that one fraud only. That one frauds thing, whether they have corrected it properly, then only we are checking. That is, if law, regulation, financial reporting framework allow the management to restrict the amendment only to that one subsequent unit. They are amending only that one subsequent unit. Old financial statement is there. From that, they are amending and making new financial statements. But just the difference is only this one frauds thing they are doing, and no extra other thing they are adding. In that case, the auditor can also restrict his audit procedure only to that one subsequent event. He need to do that extra procedure only for that frauds thing, subsequent event, that one event only. That one thing only. Then he don't need to perform audit procedure on all the events that occurred between these. No, he only need to perform that. If management is amending only for that, he need to perform audit procedure only for that. Just understand that much. Don't overthink and complicate. In that case, auditor has two options. All these cases may be asked in MCQs. That is where the problem is. If they're asking descriptively, it is easy. But MCQ, if they're giving a case and telling what should the auditor do, they are giving this option, they may give this option, you have to pick. That is where the problem lies. So then auditor has two options. He can amend the audit report, old audit report amended, and new report audit he can give, because management has already amended the financial statement. So he can also amend the audit report and issue a new audit report. Amend the audit report, and here he is not issuing a new audit report, old report itself. Management amended and issued a financial statements, but auditor amended his old audit report, but he is not issuing a new audit report. Old report itself, he may change, edit, and issue that itself. That is the first option. Second option, he may issue a new audit report. Old audit report, let it go. New Pudu audit report he will issue. First case, first option to him is amend that old audit report. That is, and put an, so old audit report, already an audit report signed date is there. Now he is amending that. So below that date, a new signing date will come. So double date will be there, double dating. That is called double dating. So he is amending the old audit report and issuing the same audit report itself, amending and issuing it same, and by putting an extra additional date to that, that is new audit report's date, that is new date. So two dates will be there in the audit report. So date of old audit report and new audit report will be there. It indicates that audit procedure is restricted only to that one subsequent event. So that is the two dates. The second date is indicating we have only did the audit procedure for extra, that one thing only extra. So that is called a double dating. Understand this one term. Second option for him is he can amend the old audit report and he can issue a new audit report, complete a new audit report, Pudu audit report, only with one date will be there, that is new audit report date will be there. And he can put an emphasis on matter paragraph or additional matter paragraph and state that audit procedure is done only to that one subsequent event. He has two options, understand that. Here also it is there. So here same thing, if management is amending and management is doing the audit procedure only, management is doing the amendment only for that one subsequent event, then in that case auditor has to do audit procedure only for that one subsequent event, extend the audit procedure to date of new audit report, and date of new audit report should not be earlier than the date of approval of financial statements, and provide a new audit report on the amended financial statements. Give a new audit report itself. Here double dating is not there, issue a new audit report itself, and include an emphasis on matter paragraph or other. Here this is coming. Okay. So hope you got the conceptual clarity. This note is there in the Telegram channel. Please go take it. Whatever material you're using, side refer it this along with that. So when this chart format it is coming, you will get the structure properly in your head. Else you will not be able to answer the MCQs. It is very tough from the normal materials. Okay. So that's it, guys. Let's move on to the next topic. So next is, guys, basically audit report, chapter number 8, one of the easiest chapters. Nothing is there to worry on this. Just understand the audit opinion giving. Everything else, when you read it by yourself itself, you can understand. So like I said in the starting itself, let's focus on the important areas. So first I'll give you a brief idea about audit documentation. So the audit report. So first is SA 700. SA 700 basically is the basic essay. It deals with auditor's responsibility to form an opinion on financial statements. Auditor's responsibility to form an opinion on financial statements. Okay. And the contents of the audit report. These are the two things SA 700 deals with. So to form this opinion, so all the content in the audit report, everything is mentioned in SA 700. And the responsibility to form an opinion is also mentioned in SA 700. So to form this opinion, auditor has to obtain a reasonable assurance about whether financial statements are free from material misstatements. Okay. So for that, auditor need to check few things. First, he need to check whether audit evidence has been obtained. To give the report, he need to get all the audit evidences right. First thing. Second, see whether the uncorrected misstatements are material. That is, during the audit, auditor will find lot of mistakes. He will tell it to the management. Please correct it. So management, sometimes if auditor communicated 50 mistakes, management may only correct to 43 mistakes. So 7 mistakes are uncorrected. So whether these uncorrected misstatements are material misstatements, then what is objective? See whether financial statements are free from material misstatements. That is objective of audit. So uncorrected misstatements material, then that will affect his opinion. So this also he need to check. Then the auditor will do some extra evaluations also. So in that evaluations, auditor will see whether financial statements are prepared as per the financial reporting framework. Then he will also check the qualitative aspects of entities accounting practices. Then he will also check some Specific evaluations will also be done. This will do it from the book. Then, what are the qualitative aspects of entities accounting practices? A descriptive question. Qualitative, that is, entity will have their own accounting practice, right? What are the aspects affecting the quality of that accounting practice? Because of what the quality of that accounting practices, like the moment when they recognize, when do they recognize revenue, when do they do the inventory valuation, all of accounting practices will be there. So what are the factors affecting its quality? So for that, he will check the management's judgments made by the management. He will check. Then SA 260, a lot of info regarding this is given, like how to communicate with 3CWG, all these things are given. Then possible management bias in judgment. That is, when management is making the judgment, they may have some personal bias. That also auditor will consider. Then SA 540 also he will consider, that is, address possible management bias in making accounting estimates. So this management bias, it comes from lack of neutrality plus uncorrected misstatements. That is, what is actually management bias? Imagine company bought an asset. The actual useful life of the asset is 10 years. But management need to get more depreciation, to get more expenses. So the management is saying that the asset's useful life is only 5 years. So more depreciation they will get. So that is a management bias. They are biased. They're doing something because of biased, they are changing the depreciation useful life. So from where does this bias comes from? First, it comes from lack of neutrality. That is, if they are neutral, being neutral means doing the right thing. They are not neutral. They are in favor of the company. They are doing things for their favor or company's favor. That is, doing some getting extra expenses and all these things. So the lack of neutrality, they are not neutral. Or it comes from uncorrected misstatements being material. So my auditor said to correct 10 misstatements and they are only correcting 7. So 3 they are not correcting. Why? Because they are not neutral. Because those 3 mistakes are maybe some fraud or something done by them. So they are not correcting. So that is also lack of neutrality. Management's bias. So management bias comes from these two things. These are there in a textbook. But to give you more clarity, I made it in the chart form. You will get it from my Telegram channel. Then lack of neutral. What are the indicators of lack of neutrality? Selective correction of misstatements. They are selectively correcting misstatements. Then possible management bias in accounting estimates. So you just learn it like this itself. So proper structurally it will be there in your head. Now I'll show you how it is there in the book. See, everything we said, evaluations by the auditor, qualitative aspects of entities, accounting practices, everything is there. Then lack of neutrality plus uncorrected, everything, same thing is exactly written here. Then what are the indicators of lack of neutrality? This is a question number 4. Then auditor will do some specific evaluations which you will read and you will easily understand. Then forming an opinion. This is auditor's report, the format of audit report. Because in this chapter we will quickly move forward because Caro is the toughest thing for you, right? So I made a Caro mnemonic, all the chart is there, which we will do. Then what was I thinking? Yeah, audit report format. Where is the format? Oh my god. One second. See, this is an audit report of Infosys Limited. This is a format. You just see title. This is the title. Then addressee. Then auditor's opinion comes here. Then basis for opinion. So whatever is there in your book, same thing. Like in the opinion section, what all things will come. You have to state that the financial statements are audited. See your book. Same sentence is written there. That is, see, they have stated we have audited the company. They are stated they have audited the financial statement. Then date of audit of date of financial statements, like till 31st March, that is written. They identify the entity's name need to be written. It is written, the Infosys Limited. Then title of each statements in financial statements, that is balance sheet, P&L, everything. See, everything is written. That is, see, it comprises of statement of changes in equity, statement of cash flows, a balance sheet, P&L, everything is written. Then refer to the notes and all these things. That is also written. Then which is opinion, unmodified opinion, that paragraph is written here. You can take this thing from my Telegram. Then basis for opinion. Then going concern, if it is there, they will mention it here. Going concern issue is there. Then key audit matters. Then other informations. Then reporting of management's responsibilities. It will come here. Auditor's responsibility comes here. Then everything, whatever point is there inside the auditor's responsibility, that in the textbook, lot of points are there. Same points. I will show you. Wait. This is question bank. Where is revise audit? See the auditor's opinion. See, identify the entity. Entity's name was there in Infosys State that audit financial statements are audited. Identify the title, balance sheet, P&L, all these things are there. Refer to the notes. Everything is there. Specify the period, 31st March was shown there. Everything. So learn it conceptually like this, how things are there in the audit report. So it will be easy for you to remember. Then opinion paragraph, I showed you. Basis for opinion, I showed you. Going concern, if it is there, I showed you. Key audit matters. Then responsibility of management, that I showed you there. Then responsibility of auditor. All these points that is written here, these are very simple. You can read and understand. So these things are exactly written there. Then all this place of sick play, that also I'll show. Where is it? So when you read it directly from an audit report, you'll get the idea. All these highlighted points are exact same sentences in your textbook. Then see, here is where we mention the caro. Caro, whatever you have to clause, that will be mentioned here. That is, it is shown like an annexure, extra annexure. We will mention it here. Then sign of the auditor comes here. Then the 12 sign of the auditor, that is a firm name, auditor's name, partner membership ID, UDIN, place, date, everything. So like this, an annexure to caro will be there. Annexure B, that is caro, will be here. So hope you got the clarity. Now let's move forward. UDIN, you know what it is. Then 705, modifications in the auditor's report. That is, in which all situations auditor modifies an opinion. 3 types of opinion are there: qualified, adverse, and disclaimer. That is, now understand. I'm quickly going. Basically understand, auditor does the audit of a company. If he got all the sufficient appropriate audit evidences, that company, no bigger problem is there. Or even if a company has some problem, some like error or something, company has disclosed that also. So everything, company side, everything is proper. Number one, company doesn't have a problem and auditor checked and still company don't have a problem. So there we will give a good opinion, unmodified opinion we will give. Second, company had some problems and company disclosed that problem so properly, truthfully, honestly in the financial statement. They have disclosed their problem. So then also auditor will give an unmodified opinion because company don't have a very big issue. Like company has an issue, but they have honestly disclosed it. Then next thing, company has some issue, but they have not disclosed, auditor identified. All those situations we give different opinions. I'll explain things. So first is qualified opinion. Qualified opinion. So first, if everything is going good, we'll give unmodified opinion. So 2 types of opinions are there. First is unmodified opinion. If everything is correct, we will give unmodified. We got all the audit evidences, we checked everything, no problem is there. No material misstatements are there. Like if material misstatements are there, we will give modified. If no material misstatements, unmodified opinion. Then modified opinion is divided into 3: qualified, adverse, disclaimer. Qualified means material misstatements are there inside the company. Company has material misstatements, but they are not pervasive. That is, they are not huge. Company has material misstatement. If they don't have material misstatement, we are giving this. But if company has material misstatements, but they are not very huge, small material misstatements are there, then we will give qualified opinion. That is, that material misstatements are not affecting the entire financial statements. Just one area only they are affecting. That is, it is not huge, so we will give qualified opinion. It's like, okay, adverse is the worst opinion. Adverse, like company has material misstatements, same thing. But it is pervasive. Pervasive means it is huge. It is affecting lot of areas. So we will give adverse. Then disclaimer, we are unable to get audit evidences, then we will give disclaimer. I will explain the cases. This is just an intro. So in which all cases we will give a qualified opinion. See guys, auditor got the audit evidences. Auditor, after getting all the audit evidences, that misstatements are there, that is material, but not pervasive. So auditor checked the financial statement. He got the audit evidence that company had material misstatements in the financial statements, but it is not pervasive. It is not pervasive. It is not huge. So material. So in first case, does he got audit evidences? Yes, he got audit evidences. And whether the misstatements are material? Yes, it is material, but it is not pervasive. In this situation, we will give a qualified opinion. So in your exam, when it comes, just remember this table. You are sorted. Then second case, qualified itself. You have not got audit evidences. Because of any reason, you did the audit procedures, but you haven't got any audit evidence. You never got an audit evidence. Management, imagine you checked the debtor, but you have not got the audit evidence whether the debtor is correct or not. But now you are thinking, okay, based on the possible effects of the undetected misstatements, you have not detected misstatements, you have not got audit evidence now, but still you are thinking that is actually a material misstatement. Imagine, like an example, I'll say police. Sometimes police know that this person is the culprit, that is, he is a criminal. Police know that, but sometimes police may not get evidence to produce in the court, so that the court may sometimes leave that criminal. That can happen. But police know that this person has killed that person, but police don't have any evidence. So in that case, but in the police mind, they know this person has killed that person. That is what we call this case. Auditor did the audit, but he has not got the audit evidence. But he thinks that the possible effects of the misstatements, financial statements has misstatements. He has not got audit evidence, but he's thinking the possible effect of that will be material. The possible effect of that will be material, but not pervasive. Material, but not pervasive. So here also material, but not pervasive. Here also material, but not pervasive. So in both the cases, first auditor got the audit evidence and thinks that got the audit evidence that misstatements are material and not pervasive. Second case, auditor has not got the audit evidence, but he is concluding that misstatements are material and pervasive. So in both the cases, whether he got the audit evidence, whether he has not got the audit evidence, if the misstatements are material but not pervasive, he will get qualified. In any question, there is material misstatements, but it is not pervasive. That is a situation, blindly give qualified opinion, because in both the cases are here. Second case, he got the audit evidence. Auditor, second case, he got the audit evidence. And the misstatements are material and pervasive. It is material misstatements and it is pervasive misstatements, huge misstatements affecting lot of area financial statements. That case give adverse opinion. See, auditor having got the audit evidence concludes that misstatements are material and pervasive. Here material, not pervasive. Here and pervasive. Pervasive means huge. Adverse opinion. Third case, disclaimer. Here auditor has not got the audit evidence, but he is concluding that misstatements are material and pervasive. So he disclaimer of opinion. Disclaim, I cannot give an audit opinion. That is what we call disclaimer of opinion. Auditor not giving an opinion, kind of like that. Disclaimer of opinion. So here, if he has not got audit evidence, but it is misstatement is material, not pervasive, give this. But has not got audit evidence, but misstatements are material and pervasive, give this disclaimer. So just this chart, take a screenshot and study it. Simple. These things are all easy. Now let's go to important area. Basis for opinion, everything you can easily read and understand. The core concepts I have explained. Then emphasis of matter paragraph, the basic thing I will explain. Emphasis of matter paragraph and other matter paragraph, 706. Very easy. 706 deals with additional communication in the auditor's report. Emphasis of matter paragraph. If financial statements during the audit, if there is something that is there in the financial statements and auditor after doing the audit and that thing, everything is properly there in the financial statement, but auditor thinks that thing should be a bit more detailedly explained. Imagine there is a company has purchased some asset or company has sold an asset in the current year. But actually that asset market value is say 10 lakh rupees it would have fetched. But company got only 7 lakh rupees. So imagine that kind of a sale is there in the current year. Or company has got only like 3 lakh rupees, very low. So when the users see the financial statements, when they see that asset has been sold and only 3 lakh is got, so users may think some issue may be there. Users may not get clarity. Why only 3 lakh is there? Some issue is there like that. So sometimes, so auditor need to give an extra explanation for that so that users will not get misguided. So to give a bit more detailed info to the users. For that, auditor will write a paragraph in the audit report. The item is already there in the financial statements. And same thing, auditor is just re-explaining giving some details about that same item in the financial, be it any item. Any item in the company had taken a loan of 10 crore in the current year. So regarding that, auditor may think like, okay, this loan is for this purposes, but users may not know what purpose the loan is for. So let me give the users, the people who read the financial statement, let me give them some extra info. For that, he may write about why the loan was given, all these things in his audit report. That is emphasizing a paragraph. Already that item is there in the financial statement. He's just emphasizing that. He's just giving more details to that. That is what we call emphasis of paragraph. To draw the attention, that is to draw. SS 706 deals with additional communication audit report when auditor considers it necessary to draw users' attention to a matter presented or disclosed in the financial statement. Matter is already there in the financial statements. Like loan taken or anything is already there in the financial statements. But he wants to give bit more info on that because he thinks that info is fundamental to users' understanding of financial statements. For users to understand that financial statements better, auditor thinks this info is needed extra. So he is giving that. So that is called emphasis of matter paragraph. Second is other matter paragraph. Same thing. If you need to give any info regarding an item which is not there in the financial statements, An item is not there in the financial statement, but he need to give some info regarding that. Then he will give other matter paragraph. Some companies' plans or anything like which they can disclose in the financial statements. They may do it in the audit report, which he will do it in the other matter paragraph. Same things, very very easy. Like you can just see these are just mnemonics, but a very very easy area. That is why I'm not explaining. Then 701, that is key audit matter. Communicating a key audit matter. What is the difference between emphasis of matter paragraph and other matter paragraph and key audit matter? Lot of people get confused. It's very easy, bro. Key emphasis of matter paragraph means an item is there in the financial statement. He is just giving some extra info regarding that item in the audit report for users better understand. That is emphasis of matter paragraph. Anything in the finance, he is just emphasizing it. But key audit matter means after finishing the audit, what is the most important matter as per auditor's judgment? During the audit, imagine company is the revenue recognition policy. That is a crucial thing, sales recognition, revenue recognition policy. So auditor is considering that as the most crucial thing which everyone need to know. Key audit matter. Audit level, what is the key matter, most important matter? That is key audit matter. Emphasis is just emphasizing, but this is the most crucial matter. He will write all his thought process, all these things about key audit matter in the audit report. That matter, that is called a key audit matter. Key audit matters are those matters that in auditor's judgment where the most significance in audit of financial statements of the current period. Key audit matters are selected from the matters communicated to the TCWG. Simple. Why are you communicating key audit matter? See, CVAIUE to enhance the communicative value, to give more audit report should have a much more communicative value. To enhance that, that is all. Users will get more clarity. So get more clarity regarding their company's audit, we are giving communicative value, key audit matter. Then what is the next purpose? To give additional information to intended users. Then next purpose, to understand the entity and significant areas where management has made judgment. For that purposes, you are giving key audit matters. Then determining key audit matters, which are the high risky matters will be there. Then significant auditor judgment related to areas that financial statements involve significant management judgments, which are the areas where management has made a lot of judgment. Imagine sometimes revenue recognition management has changed the policy. They are doing some judgment there. So they may take it as a key audit matter. All these things. Then communicating key audit matter is not a substitute for, very important, not a substitute for disclosures in the financial statement. That is related party transaction. So as per accounting standard, it should be properly disclosed in financial statements. Company has not done that. So doing in the key audit matter, we are writing related party transaction. That is not a substitute for disclosing. Company should have actually disclosed that. They have not disclosed, then report it in the audit report. Change your opinion accordingly. So that is not a substitute for disclosure. Then it is not a substitute for modified opinion. Auditor has not got the audit evidence, like we discussed earlier, 705. So he should actually modify the opinion, or he has got the audit evidence that material misstatements are there. So he should actually modify the opinion. But instead of modifying, he is putting a key audit matter and giving extra information and not modifying. That should not be done. Modification thing you should have to modify. Instead of that, key audit matter is not a substitute. You cannot escape like that. So it is not a substitute for that. Next, reporting in accordance with SA 570. If going concern is affected, you have to report as per 570. Don't just try to limit it by putting in the key audit matter. No. Then giving a separate opinion on individual matters. For that also, it is not a thing. Then 710, comparative information on corresponding figures. This seems to be very, very easy, but it is not that easy, guys. But I will give you the clarity. Once you get the clarity, then when you read it, all the things you will understand. Then in my channel, I have made a separate video on 710. You can go and watch that. I'll upload it. I think I would have uploaded it, or I'll upload it this week itself. 710 is very, very crucial. It is not that easy as it seems. If it comes in a case study or a case like descriptive question, you may suffer. It is not very, very easy. It is actually a tough thing. But I will give you the basic fundamental idea. So you will get more clarity and you will be able to solve the descriptive. So first of all, guys, let me see where the notes are. This is subsequent events. Where is 710? 710. That is comparative information, corresponding figures, and comparative financial statements. First of all, I will show what it is. Where is the comparative financial? I will actually show how the thing looks like. This is an international company, but I'm showing it to you. Or this is comparative financial, not this one. Where is info? One annual report was here.
I think I've lost it somewhere, but then I'll show at least this one, so you'll get the clarity. So, first of all, where is it actually? This is an international company's financial statement, but just consider this as Indian. So, this is 2019's data. This is how the actual financial statement looks like. So, I had one, I missed it somewhere. Infosys or someone's annual report was there. So, like, this is the actual year under audit 2920, 1920 or something, or 2019. So, but here the date etc is different because it's a outside company. But you would have seen in your accounting and all things, side you would put the previous year's financial information also. You would have seen that. So, in the actual financial statements, looks like this. Looks like this. Like, oh, it looks like this. Current year info will be there, but previous year info also you will give it on the side. This previous year item is what we call comparative information. And we are giving it for basic purposes. What is the purpose? Only current year is relevant. But still, imagine sales, assets, everything will be there. Otherwise, current year figure and previous year figure is there. But we are giving the previous year figure just for a quick comparison purposes, just for a read-only purposes. So here, if sales figure, current year sales is say, current year sales is at 12 lakh. Previous year sales were 10 lakh. So when you see this previous year figure, immediately we can, okay, company has performed well. So just for this purpose, we are giving this previous year data here. So this, whatever we given as previous year is just for comparison purposes. That is what we call comparative information. And comparative information is basically divided into two. Comparative information is divided into two. First is corresponding figures. In India, the side whatever info we are giving, I think I have a chart. Okay. Whatever info you are giving on the side. In India, you will be giving the current year. Okay, this is current year, this is previous year. In India, you will be giving all the financial statements you see. Here we are giving thing. This is called current like whatever this is called a comparative information, but this is actually divided into two. Corresponding figure and comparative financial statements. Corresponding figures means it is a system followed in India. Then in India, here we are just giving the outside amount only. In current year financial statements, we will give the notes to accounts, every breakup of every item, the disclosures, everything will be given for current year item. But for previous year, whatever we are showing, we will only show the heading kind of items only, like sales, main sales, like breakup of debtors or disclosures. All these things may not be there for the previous year. For current year, everything we will give, but sidely we are just putting the previous year figure for comparison. In India, we are following that. We are not giving details of previous year. We are just putting the main items only. Detailed breakup we are not putting. So that is what we call corresponding figures. But in abroad countries, like I told you, this is just for comparison. So in India, like detailed figures are not given. But in abroad countries, foreign countries, there is something called a comparative financial statement. So for current year, every detailed item will be given. For previous year also, they will give every detailed item. Like if current year, whatever disclosures, everything is there, for previous year, similarly, everything will be given. But in corresponding figures, previous year only main items will be given, the heading kind of items. No disclosures, no breakup. Just for read-only purposes, for comparison purposes, we are giving. That is corresponding figure. But in abroad countries, this previous year item, you will give lot of detailed info, like whatever for the current year, similarly for the previous year also you will give. That is a difference between these two. And one more thing, guys, in India, when imagine I am auditing current year, I will give audit opinion only for the current year. But that is in corresponding figures, only audit opinion for current year is given. But in comparative financial statements, that is this one, imagine I did the audit of previous year also, and current year also I am doing the audit. So the foreign country, I will give the audit opinion for current year and previous year. Both year I will give audit opinion. That is what we call corresponding comparative financial statement. So what is the difference between both? Just this figure only you need. Then when you read the things, you will easily understand. So this is followed in India. Corresponding figures are followed in India, and less info is given given about the previous year. Like just basic items are given. No detailed breakup, anything will not be given. Only for read-only purposes we are giving. Just for comparison only we are giving that in India. In India, we are following this. We don't need to study about this because this is not there in India. In our accounting framework, this is what we are following. We are not giving any audit opinion for the previous year, nothing. Then no audit opinion for the previous year also. Normally,
In corresponding figures, auditor won't refer to the previous year's opinion, but except in certain cases, we will refer. That when you read, you will understand. Then comparative financial statements. It is not followed in India. Then previous year financial statement is given exactly as it is. Full notes, the disclosure, everything will be given. Here, everything will be given. Auditor gives opinion about the both year, current year and previous year. That is the difference. Now let's, idellam very easy. You would have learned it in the law and all these things. 299 is very easy, nothing to memorize and understand. Then it is Caro 2020. Caro 2020 is the most complicated, like the most feared topic, right? I'll deeply we'll explain it. No work. This one video in less than 30 minutes, 100% guaranteed Caro will be yours. Because what is the problem with Caro? Memorization. You have to quote the clauses, exact number of clauses. That is the problem, right? Learning Caro is not a problem. Memorizing, quoting the right clause. How will you remember this much clause, 21 clauses? That is where I come up with this MCQ and not this MCQ, this mnemonic. And this has been highly successful in our memorization, audit memorization batch, which we took last month. So, and guys, before we begin, understand this. I want your pure concentration for the next 30 minutes. And once you listen the first 5 to 10 minutes, you may find it a bit complicated. But after that, you will understand everything. 100%. At the end of the video, you will 100% give it a thumbs up and you will comment. So, I am going to memorize, I'm going to make you memorize Caro, all the clauses, exact clause numbers, exact points, and even the sub clauses also, with just this one chart. And this chart and my the PDF session is there in my Telegram channel. The link is down in the description. Go take this chart and please stay with me for at least 5 to 10 minutes. Then only you will understand how good of a chart this is, to be honest. Yeah, because we got this kind of reviews. Like all of my students, they take printout of this chart and they're studying with it directly, not even referring to the textbook in Caro. So understand this. So first is, we have to have a mnemonic for the entire 21 clauses. How to remember 21 clauses? Just remember this one mnemonic. Just remember this one mnemonic. That is Nila. Nila is a girl. Didi. She is a Didi, like a sister. Nila Didi. Nila Didi must, normally MUST, but here for mnemonic we put it as MAST. Nila Didi must disclose what she wanted to disclose, loan and IPO. Nila Didi must disclose loan and IPO for what purpose? To report the fraud of Nitin Trilok. Nitin Trilok is a guy and Nila Didi is a elder lady. So Nila Didi must disclose loan and IPO to report the fraud of Nitin Trilok. Just this much. If you can memorize this one sentence, enter Caro sir, CA inter final whatever it is, done. And there is one more, Rema spend Rema. Simple. This much you have to remember exactly. Be with me, you will understand. Nila means N. N means non-current asset. This is your first clause. Whether proper records are maintained for we'll go for subclauses, everything that I'll teach you, don't worry. So N means non-current assets. I, Nilayoda I means inventory. Second clause is regarding inventory. Yes. Third clause is regarding LA. LA means loans, advance, guarantee, security, investments. Simple. See, LA means loans, advance, guarantee, security, investments. Simple. So Nila Didi, N means non-current assets, I means inventory, LA means loans, advance, guarantee, security. Done. Nila Didi, DI, loan given to director. See, loans given to director and investments by the company. DI, director. Then DE, deposits, acceptance of deposits, fifth clause. So Nila Didi, 5 clauses are done. N, non-current assets, I, inventory, LA, loans, advance, lags. LA means lags. Lags I, lags Z, loans, advance, guarantee, security and investments. Done. Nila Didi, DI, loan to director, DE, acceptance of deposits. Done. Just now try to recall, you will get it. You have to pause and try to recall. Once I teach you this much, pause there. What is Nila? Try to recall. What is Didi? Try to recall. Then go with the flow. Then next is, because in our memorization batch, we go very slow. But here I am giving you everything, hoping that you will pause at the videos and try to recall. Take the book of Caro, whichever faculty's book you are referring, take it and keep it with you. Then must, MA, maintenance of cost records. MA means maintenance of cost records. Simple. 6th clause is done. ST, statute reduce. 7th clause, done. Nila Didi must. N, non-current assets. I, inventories. LA, loans, lags. Loans, advance, guarantee, security, investments. Nila Didi, DI, loan to director. DE, deposits must. MA, maintenance of cost records. ST, statute reduce. Done. Nila Didi must disclose. Disclosure of unrecorded income. Disclose loan and IPO. Repayment of loan. IPO, utilization of IPO, FPO. I'll make you remember all these clauses. Nila Didi must disclose loan and IPO. For what? To report the fraud of Nila Didi must disclose loan and IPO. For what purpose? To report the fraud of Nitin Trilok. Report the fraud. Clause number 9, reporting of fraud. Nitin, NI, Nidhi company. Nitin, NIT, transaction with a related party. IN, internal audit system. Then T, non-cash transaction with director. Simple. This is also transaction. This is also transaction. This is transaction with related party. This is transaction, non-cash transaction with director. Then Nitin, NITIN, Nitin Trilog, TRE. RE means registration of company. Log, LO, cash losses. K, nothing is there. I put it there. So then Rema spend Rema, resignation of statutory auditor, material uncertainty, spend unspent CSR amount, Rema, qualification and adverse remarks, REMA. Just this clause, this one chart is enough for you to memorize every clause in order. So when in examination, if a question comes and that is related to statutory dues, how will you use this stat? Okay, you don't know what is a clause. You never have to remember 7 for statutory dues. No. When a question comes and is related to statutory dues, just think Nila Didi must. ST was statutory. So N, clause number 1, I, LA, DI, DE, must, MA, ST. ST is what? 7. So clause number 7. So like that, you can easily remember the clauses. It's as simple as that. So now let's go to the. So I'm hoping you understood the process. Now pause and try to get the clauses first. The learning, you don't learn the subclause initially. Just memorize this mnemonic and all the things against this. So obviously you will get all the clause numbers in order. That is the first step. Once you memorize that, then we'll go with the second step. That is, you see the book. In the book, it is written CARO. So for whom CARO is applicable? CARO is applicable to every company, including a foreign company also, but except these companies. It is very simple. You go and read. Simple, chumma. Easy. So next is, first is NILA. N means non-current assets, right? What is about non-current assets? Whether the company is maintaining proper records of PPE and intangible assets. Intangible assets is PPE. Whether company is maintaining proper records. Proper records is a keyword. Done. Whether this PPE has been physically verified by the management at reasonable intervals, and if there has been a material discrepancies noticed. Simple. Every month or every 6 months or every 1 year, whatever it is, reasonable intervals, every 6 months or every 3 months, whether the management has physically verified those assets, non-current assets. Simple. Then, so now when you come to here, you will get it. I'll do it from here itself. You keep your book along with you, everything you will understand. So, proper records. See, proper records. First clause is proper records. That is, whether the company has maintained proper records for PPE and intangible assets. Simple. The entire 3, 4, 5 pages of CARO we are putting in one page, and I'll tell you how this memorization works. You have to take this, go to Telegram channel, take this print, take a color print of this, stick it onto your wall. 2 copies you take, one in your hand and one into your wall. And first, you have to memorize all these clauses. So everything. So number, everything is done. Then you have to look at this and recall first. Look at the subclauses and then try to recall what it is. Then once that is done, then slowly, without looking at the subclause, try to recall. And that is how you remember CARO. And guys, this is 5 to 7 marks guaranteed in exam. So please wait, understand this. I told you, first 5 minutes you may not get all the clarity, the benefit. But after that, you will slowly get. See, proper records. Whether company has maintained proper records of the PPE and intangible assets. Done. Look at your book, same sentence is written there. Then physically verified. Whether management has physically verified, whether they have verified the non-current assets, PPE and intangible assets. Intangible assets, no possible. PPE at reasonable intervals have they verified. And whether they have they have noticed any material discrepancy. Done. Keep your book along with you. So it's very easy for you. Then see whether the title deeds of that immobile property, title deeds, whether the title deeds is in the name of the company, except if it's in a case of a lease. In case of a lease, it is not needed. All other cases, whether the title deed is in the name of the company. Done. Then what is next? Revaluation. Whether the company has done a revaluation of its PP or a revaluation have they done? If yes, whether it has been done by RV, registered valuer, whether a registered valuer has done that. Done. Then, if there has been a change of more than 10%, that is last year the value of PP was 1 lakh and current year you revalued. So now the value is 1,15,000, imagine. So the change, 15,000 change, it is more than 10%. 10% of 1 lakh was only 10,000. but 15%. So if there is a change more than 10%, then you have to report that. Done. Then Binami property, whether company is holding any property under Binami Property Act, whether company is holding any property, and against that, whether any proceeding is pending against the company, any case or anything is pending against the company, disclose it. Done. So just when you have this thing on your wall, you can also write all the sub clauses also. Clause number A, well, one you can use, but inside that 1A, 1B, 1C, 1B, like that also you can quote. Fixed mark in exam. Sub clauses also when you quote. Okay, so first N is done. Then I, inventory. Inventory is also very simple. I'm not taking the book. I'm hoping you are keeping your books along with you. Or you don't need books. Just listen to me, you will understand. Listen to me, you will understand. Because then next is inventory. Inventory, whether physical verification of the inventory has been done at RI, reasonable intervals. Every 3 months or every 2 months, whether physical verification of inventory has been done, and if discrepancy is greater than 10%. While doing the physical verification, have you noticed any discrepancies? Any discrepancies which, if it is more than 10%, then disclose it there. Then working capital, that is WC is working capital greater than 5 crore. That is whether company has taken any loan for working capital purposes. Whether company has taken any loan which is greater than 5 crore rupees. Whether company has taken a working capital loan which is greater than 5 crore rupees from any financial institution. In that case, if yes, then for getting this working capital loan, bank will give them the statement or quarterly returns. Statement to get the 5 crore loan, they will give the statements and quarterly returns. So whether those statements is in agreement with the books of accounts. Statement le whatever amount is there, whether that amount is exactly there in the books of accounts also. Done. Khatam. Next, LAGZ, loans, advance, guarantee, security, investment. LAGZ. Third clause, LAGZ. Loans, advance, guarantee, security. This is something given by the company. Loan given by the company. Advance given by the company. Guarantee given by the company. Security given by the company. Investments made by the company. Everything. So LAGZ, whether company has given any loans, advance, guarantee, security to subsidiary, joint venture or associate. SJA. Subsidiary, joint venture or associate, whether they have given any loan, guarantee, security. Then, if they have given it to subsidiaries, joint ventures or associates, or if they have given it to others also, other than subsidiary, joint venture and associates, in both the cases, disclose what is the aggregate amount. What is the amount? Disclose it there. Amount, disclose it there. Company has given 10 crore loan to subsidiary. Disclose that amount there. And disclose the amount and what is the balance outstanding. Company has given 10 crore loan and the balance outstanding is 9 crore. So 10 crore and 9 crore both you have to disclose. Done. Next point. What is the subclause 2? Subclause B. That is terms prejudicial. Terms prejudicial. That is, company had a policy. That is, all the loan given by the company will be at their interest rate of 10%. That is a company's policy decided by everyone. Board of directors, all these people. But for one loan, current year, like company has given loan at the rate of 8% to someone. So that is that terms. That is a term change, right? Term was 10%. Terms was 10%, but they have changed it to 8% for one person. In that case, the terms is against the company or policy. That is terms prejudicial to the interest, against the interest of company's policies. If there is any issue like that, then report it here. Then next, SOR, schedule of repayment. You keep your book along with you. Pause and look and see. Everything is pinpoint correct. Don't try to study it from the book exactly. You will forget, bro, how much. This one page is much more than enough. Then you study, you use it from here, then refer to the book. Whatever is needed, you can add it up. Then schedule of repayment. Whether the schedule of repayment, that is when company is giving a loan, mosquitoes, okay. Schedule of repayment, that is when company is giving a loan, they will mention, right? Okay, every month I need to get the EMI, or every 3 months I need to get the EMI. That schedule of repayment will be mentioned. Whether schedule of repayment has been stipulated, whether has been mentioned, and if yes, then whether it is regular, whether that person, people to whom we have given loan, are they giving the EMI everything on time? Is it regular? Then, if any loan, advance, guarantee, security you have given LAGZ, in that case, but they have not repaid you back. EMI proper they have not repaid. So if it is overdue for more than 90 days, then whether management has taken reasonable steps. This is step, right? Reasonable steps. Because we are doing it like this, so you'll never forget this reasonable step word. That is how our audit memorization batch is. Everything is pictographic or mnemonic. Conceptually, everything will be taught plus this one. So whether they have taken reasonable steps for the recovery. Overdue, management should take reasonable steps, right? Should attach their property or something, right? So whether they have taken reasonable steps. Then this one is a bit complicated, but it's very easy. Just understand whether any new loan, whether the company has given a loan to someone, whether company has renewed that loan in the current year. Terms whether they have changed or they have extended that loan, EX, or whether any fresh loan has been given to repay the existing loan. Existing loan, to repay the existing loan, company has given a fresh loan. But that is whether the loan is renewed, whether the loan is extended, whether any fresh loan has been given to repay the existing loan. In these three cases, mention what is the amount, rupee. Mention what is the amount and mention what is the percentage of change to total. Percentage of this to the total amount. Total amount of loan. That is, your total amount of loan given is 10 crore and renewed is say 1 crore. So percentage, what is the percentage? Mention that. Then that much complicated questions will not come, but just understand that much. Okay. Then whether company has given any loan which is repayable on demand. Repayable on demand, ROD. Company is given a loan and told that, okay, whenever I ask, then only you give it back. Like the repayable on demand, or whether company has given any loan without mentioning the terms. Without mentioning the terms, in both these cases, mention the rupees and percentage also. See, now I'll show everything what we learned is here in the revised audit book. See, inventory. Then inventory, whether physical verification of the inventory has been done at reasonable intervals, any discrepancy of greater than 10% or more. Then whether during at any point of time, whether the working capital limit is in excess of 5 crore rupees. Then quarterly returns and statements filed by the company are in agreement with books of accounts. Everything, LAGZ, loans made, aggregate amount, balance outstanding to subsidiaries, joint ventures and associates, aggregate amount, balance outstanding to other parties. Everything, terms are not prejudicial to the interest, schedule of repayment, whether it is stipulated and it is whether regular, amount of overdue, total amount overdue for more than 90 days, everything is mentioned. Pinpoint. So don't worry. Exactly we are saying. Then now it is very, very easy. Main points are over. So Nila, N, non-current assets, I, inventory, is LA, loans, LAGZ. Then the DI means loan given to director and investments made by the company. In that case, whether section 185 and 186 complied or not. This section is relating to this loan given to director and loan investments made by the company. Whether the provisions has been complied or not. If yes, mention that. If no, mention that. Then DE, acceptance of deposits. That is, when company is accepting deposits from someone, whether section 73 to 76, 73 to 76 has been complied or not. And similarly, if there has been any order or any order by the law or tribunal against the company, whether those has also been complied. If anything has not been complied, mention the nature of non-compliance and mention the contravention. How we have not complied, what is the reason, mention that in the caro. Then Nila Didi must, MA, maintenance of cost records for the company, whether cost records are mandatory. If yes, then whether company has maintained. If no, whether not maintained or not. Mention that. Simple. Then ST, statutory dues, very easy. Undisputed statutory dues, disputed statutory dues. Two things are there. Undisputed means government has told your GST output tax liability is 10 lakhs. Okay, we agree and we are ready to pay. That is undisputed. We are not getting into any dispute. Disputed statutory dues means government is saying your GST output tax liability is 10 lakh, and you are saying no, my output tax liability is only 8 lakh. So now you both entered into a conflict and you are filing, like you went into a case for that and it is having a dispute. That is disputed dues. Undisputed statutory dues means any money payable to the government. Okay. So in case of undisputed statutory dues, that is, you don't have any issue with the government. Those cases, whether the company is regular in depositing that, whether companies properly every month the GST, whether they're depositing on GST or all the things, whether they're depositing it on time. And are there any arrear which is older than 6 months? As on the date of balance sheet, are there any arrears which is older than 6 months? That is September time. From that time, is there anything that is in arrear? And for the case of disputed statutory dues, mention the rupees. Government told 10 lakh. I am saying 8 lakh only. So mention that rupees there, and where in which forum the dispute is pending, which tribunal or where the dispute is pending, you have to mention that. Simple. So Nila Didi must, NILA, the non-current assets, NI, LA LAGZ, DI loan to director, DA deposits, must maintenance of cost records, ST statutory dues. But disclosure of unrecorded income. Unrecorded income. That is any other previous 2, 3, 4 years back, 2, 3 years back, your company has not disclosed one income. And they have filed the IT return and all these things. So what happened? During the tax assessment of that previous year, imagine 22-23, That year a tax assessment is happening in current year. So during that time, the government, the tax authority found out some undisclosed income of you of that year, and whether such kind of any income is included in the current year. That is that year or undisclosed income, whether that is included in the current year. If there is something like that, that is undisclosed income discovered by the tax assessment, authority tax assessment, they have found out that if there is such kind of any income of that previous any year, whether that is included in the current year, such income of previous year found out by the tax authority, whether it is included in the current year, then mention that here. If no, also mention that no such thing is there. Then I will show you exactly how Caro report looks like, the format, everything. So don't worry. Then loan, repayment of loan, default, repayment of loan. Here the company has taken loan. In this case, company has given loan. Third point, here company has taken loan. Whether company has taken any loan, whether there is any default in repayment. Company has taken a 10 crore loan, and every month 1 lakh is the EMI. Whether company default has made any default. If company has made any default, what is the period of default? Last 3 months, the company is not paying. So mention that period and the amount in default. Then whether bank or any financial institution from which we have taken loan, have they gave a tag that we are a willful defaulter? That is, we have money but we are not paying. Whether the bank has given such kind of a tag to us. Then whatever loan we have taken, whether it is applied for the purpose for which the loan was taken. That is applied for purpose. We took a loan for buying an asset. Have we used that entire money for buying the asset? Exactly. What that we have to mention it here. Then short-term loans used for long-term purposes. You took a short-term loan for meeting some short-term requirement, but have you used it for some long-term purpose? If yes, if company has done that, an auditor has to mention it in this clause. Then fund raised for subsidiaries. F for subsidiary. You keep your book along with you, so it's easy for you to understand. Then if you are using my revised audit book, 120%, much more easier. So then fund for subsidiary, that is main company, holding company has taken a 10 crore rupee loan, and that 10 crore rupee is actually for the subsidiary. Subsidiary is having some issue. For subsidiary, I have taken a loan. If main company has taken a loan like this for subsidiary, then mention it here. Next, loan taken by pledging the subsidiary security. I'm holding shares in subsidiary, so I have that securities which I hold in subsidiary, and that security I, holding company, pledged it to a bank, and based on that security, I took a loan. So subsidiary company security I pledged there, and I took a loan, holding company. So if there is something like that, mention it here. Very simple. So see, Nila Didi must disclose loan and IPO. Loan wherein we went. So Nila, non-current assets, inventories. I means inventory, LA, LAG, loans, advance, guarantee, security, investment, must MA, maintenance of cost records, ST, statutory dues, must disclosure of unrecorded income, loan, repayment of loan, IPO, utilization of IPO, FPO. That is, company raised money through IPO or FPO. So in that case, U purpose R. That is, company took IPO. Whether that money has been utilized, U means utilized for the purpose for which it was raised. Company raised money from the stock market for any other like establishment purposes or expanding their business overseas. Whether that money has been used for such a purpose. Used for the purpose for which it was raised R. You need that exact line. That is why I mention it like this. Okay. Used for the purpose, UPR. Then whether company has done any preferential allotment or private placement in the current year. That is shares to given to the close people, only to those kinds of private people. Whether company has made any private allotment or private placement or preferential allotment. In that case, whether company has followed section 42 and 62. Done. And whether those money raised through this has been utilized for the purpose for which it was raised. UPR. Done. Then reporting of fraud by the company. That is, company has done a fraud. So in that case, what is the nature and amount? Fraud done by the company, fraud done against the company. In both the cases, auditor has to report what is the nature of fraud. So what kind of fraud happened? Whether the employee did the fraud, management did the fraud, what was the nature, what kind of a fraud that was. Report the nature here and the amount also. Then whether auditor has filed any ADT4 relating to that, mention that. Then whether auditor has considered any whistleblower. This is whistle, right? Whistleblower complaints. Any complaints is made by these internal people, directors or employees, whether auditor has considered any whistleblower complaints. Simple as that. Hope you understood this much very easily, right? Then next is Nidhi company. Nidhi company, NI. Net, if you are auditing a Nidhi company, then in that case, whether the net owned fund to deposits, net owned fund means they're paid up share capital reserves minus accumulated losses, depreciation, all these things. So, not depreciation, deferred revenue expenditure, something like that. So, whether the net owned fund to the deposit, if you're having 1 lakh as net owned fund, maximum deposit you can accept is 20, maximum. So, till 1920 you can accept, 21 you cannot do. So, net owned fund to the deposit, you are auditing a Nidhi company, whether the net owned fund to the deposit is in this ratio. You have to mention what is the exact ratio, what is the net owned fund, what is the deposits, what is the ratio relating to that, you have to mention here. If it is more than this, less than this, whatever it is mentioned. Then 10% unencumbered term deposits. 10% unencumbered term deposits. Very simple. It simply means that unencumbered term deposit means any deposit against which there is deposits that are free of any charge. Imagine you have 10 lakh rupee. You put 10 lakh rupee as a FD in a bank. And against that 10 lakh rupee, you took a loan of some money. So your FD is pledged there as a security. Against that, so it is called encumbered. You have encumbered that asset. I have a mobile phone here. I gave it to someone, pledged it, and I took a loan. So this asset is encumbered. So anything like that is encumbered. So when Nidhi company receives deposits, imagine Nidhi company receives 1 crore rupees deposits. So in that, at least 10% should be like Nidhi will invest those 1 crore in somewhere else. Somewhere else they will invest that money. So in that, at least 10% should be free of charge. Imagine Nidhi has 1 crore deposits. Till 90 crore rupees, 90 lakh rupees Nidhi can invest it somewhere, and against that also Nidhi can take a loan or something, no problem. But at least 10 lakh rupees should be kept as a safe FD, safe purpose. Against that, no loan, nothing should be taken. So at least 10% should be unencumbered term deposit. Safe you have to keep. Then default in any payment or principal or interest in repaying to the people from whom Nidhi has taken deposits or something, whether there is any default in the payment or interest. Then next is T, Nitin. NIT means transaction with a related party. Whether company has done any transaction with a related party, in that case mention whether section 77 and section 177 and 188 has been complied or not, and whether the details has been disclosed in the financial statements. Done. Next, that internal audit system, whether the company has a good internal audit system. Whether the company has a good internal audit system, IAS, commensurate to the size and nature of the company. Commensurate means whether the company, imagine a company like Reliance. Reliance is a very big company. So that much big internal audit team it needed. Imagine Reliance or internal audit team is say 3 internal auditors. So internal auditors size is not relatable to the size of the company. Company is big, so big internal audit system is needed. That is called commensurate. Is it relatable to that? Big company, big internal auditing. Smaller company, smaller auditor. So you are auditing a big company. Whether the internal audit team in that company, internal audit system in that company is as equal to the size of that company. That is size and nature of the internal audit system commensurate to the size and nature of the business. Then whether internal auditors report, IAS, IIR. Okay, IAS, IIR. Internal auditors report whether internal auditor has done the audit and the report is there. Whether internal auditor's report has been considered by the statutory auditor. If yes, then mention. No, mention. Done. Then non-cash transaction with director. Whether company has done any non-cash transaction with director, then whether section 192 has been complied or not. Done. Then registration of the company. Very easy. Going in a full flow. My mind is like, Aram se. 1 second. Let me take some breath, because I don't want to waste your time. Let's do it in a really good fashion, right? Really quicker fashion. I love it. And doing these kinds of revisions. Like next chapter, which chapter do you want next? You comment it down, and whichever chapter, whichever people are commenting, like whichever chapter, most number of comments I'm getting, I'll make a video. Don't worry. Then registration of the company. Registration of the company means whether company is required to get the registration under 45 IA. 45 IA of the RBI. 45 IA. That is, this is basically a registration required for these NBFCs and all. So if you are auditing a company and whether that company requires this kind of a registration, whether that company has taken it or not, mention that there. If your company you are auditing is not, this one is not applicable, mention like that there, no problem. Then whether the company you are auditing, whether that company has done any non-banking financial activity or housing financial activity, whether they have done any something like that without a certificate of registration, then mention that. Then whether the company you are auditing is a core investment company. Core investment company means, I'll tell you, it is imagine Tata Sons. there is some company called Tata Sun. This Tata Sun owns major shares in Tata Steel, Tata Motors, Tata, and all this Tata. Tata Sun is a major company, and this company, what a duty is, this Tata Sun is not producing any, they are not selling any products or services or anything. No, their only duty is their core investment company. They will have money. This company will put the money in different companies of Tata only, mostly Tata itself. So this company holds lot of shares in Tata Motors, Tata Steel, TCS, all the Tata Green, all these companies. This company holds share, and this Tata, imagine Tata Sun is holding 50% of Tata Motors. So from here dividend will be given to Tata Sons. So with that dividend money, Tata Sun may hold another 10% share in TCS, like that. So they will. So this company purpose is basically help their group companies. These are all Tata group companies. So this company purpose is help the group companies. Give money to whatever company which is required, and if TCS is working fine, TCS will give money to Tata Sun. Tata Sun will use that money to invest in Tata Motors, like that. So that is called a core investment company. Just an idea only I'm giving. I'm not getting into too much explanations. So whether the company you are auditing is a core investment company, then mention. Then if the company you are auditing, in that company, whether there are more than one, that is one plus core investment companies there in the group. Imagine you are auditing Tata. So are there more than one core investment company? So in Tata, only Tata Sun is there. So only one. If there is more than one, mention it there. Simple. Then cash losses, that is LO, losses. Whether the company in which you are auditing, whether that company had a cash loss in the current year or previous year, then mention that. Done. Then RE, resignation of the statutory auditor. Imagine you are the auditor current year, but current year itself there was an auditor before you, and he started the audit, then he resigned because of some issue, right? So if there is something like that, if there is any resignation of any statutory auditor like that, then you are the current auditor. Have you checked the issues, objections, and concerns? IOC raised by that statutory auditor. That is when you talk with him. Have you, like, what is the issue? Why have he resigned? That is the issue. What are the objections given by him? What are the concerns he raised? Have you considered this? If yes, mention. If no, also mention. Then material uncertainty. In your opinion, you are auditor, in your opinion, whether the company has any material uncertainty which will affect its going concern. Is there any serious problem that is going to affect its going concern? Not exact going concern. Is there any material uncertainty? That you learn in SA 570. I'll upload that video. Material uncertainty is there. If yes, mention. No, mention. Then unspent CSR amount. This is one of the easiest things. Unspent CSR amount. Imagine what is CSR? 2% of the average rent profits of the last 3 years. So imagine that amount is, say, 2 crore. CSR amount is 2 crore. Current year starting, we know, based on the previous 3 years of profits, 2 crore is the amount which we need to spend for CSR. In this 2 crore, company decided, okay, let's start a project. Let's do some project for CSR, like Vantara or something. Let's do some project for CSR activity. And company decided 1.5 crore we are going to spend. And 50 lakh is not needed. 50 lakh we will spend in any further year. This is basically what this amount is not even spent. And in this 1.5 crore, at the end of the current year, almost 1.3 crore has been spent and 20 lakhs has not spent. This is what an unspent amount, and this 50 lakh is also unspent amount. But this is what actually this is, and what is the difference between this 20 lakh and 5 lakh? This is for an ongoing project. The project is ongoing, but as at the year end only 1.3 crore is spent, but next 2 months you will spend this 20 lakh, 2 or 3 months. But this 50 lakh you have set apart. This is not for ongoing project. It is not for an ongoing project. So understand. So this unspent amount, this ongoing project unspent amount. What is ongoing project unspent amount? This amount you have to transfer to a special account within 30 days, I guess. You have to transfer it to a special account from the year end March. Within next 30 days, you have to transfer this amount to a special account, whether the company has done that or not. Auditor has to mention it in here, clause B. And another case, that is this amount. This amount the company has to transfer to another account. Schedule 7 one account is there. Company has to transfer to that account within 6 months. So whether the company has done that or not, this one you have to mention. These two things. Okay. I'm just not going into deep. I'm just showing it. Okay, this is just a quick revision. Then REMA, that is remarks. So RE means resignation of statutory auditor. MA means material uncertainty. Spent means unspent CSR amount. Then REMA, remarks. So qualification and adverse remarks. That is whether any qualification or adverse remarks is there in the subsidiary company's CARO report. That is, I am the holding company. I have a lot of subsidiary company. So in my subsidiary company, the auditor has done the audit of subsidiary company. So in that, whether that auditor has mentioned any qualification or adverse remarks in my subsidiary company's audit report. Subsidiary company's audit report, subsidiary company's auditor has mentioned any qualification or adverse remarks in that CARO report of the subsidiary company. If there is something like that, mention it here in clause 21. Done. This much is there. CARO. Very easy. So, Nila Didi, I just explained all the clauses also, everything. So, now just keep your book along with you. If you have watched till here, I thank you and I believe you would have understood everything in CARO in a quick manner. Now, take your book along also with you and let's read every point. Just see what I'm saying. Like that, you quickly, you can get everything. So, hope you like the video. And once more, let's recall all these things. Nila Didi must disclose the loan and IPO to report the fraud of Nitin Trilok. Then Rema spend Rema. Nila, NI, N, non-current assets. I means inventories. I mean inventory. LA, loans advance, LAGZ, loans advance guarantee security investments. Then DI, loan to director and investments by the company. DE, acceptance of deposits. Must, maintenance of cost records. ST, statutory dues. Must disclose, disclosure of unrecorded income. Loan, repayment of loan. IPO, utilization of IPO, FPO. Report fraud, reporting of fraud. NI, Nidhi company. T, transaction with related party. Nitin, NIT, IN, internal audit system. Then T, non-cash transaction with the director. RE, registration of the company. Nitin, Trilog, log, cash losses. Done. Then Rema, spend Rema. RE, resignation of statutory auditor. MA, material uncertainty. Spend, unspent CSR amount. REMA, remarks. Done. Khatam. So this is how we learn CARO. But in class, we'll take 2 hours because I used to spend the mnemonic and students used to recall along with me. So within the class itself, we learn this and go. Be it CA, inter, final, whatever it is. So same thing is applicable. I quickly revised everything. So some points would have been missed, something would have been there. So like mostly I would have covered everything. So keep your mostly like 99.5% I have covered. Some 0.5% is missing. Like quickly I've shared everything. So keep your book. Watch this video once more with your book. You will understand everything. And if you like this, like the mnemonic, just try it. Then only you will know whether you liked it or not. So this is a chapter that is bank audit, audit of banks. And in CA Inter, what I've observed is that a lot of students skip this chapter because they don't understand this chapter actually. So first of all, before beginning this chapter, let me say something, that is we should have an approach to all the chapter which we are studying. So for this one chapter, you should not learn this chapter like auditing. Around 70% of the portion of this chapter, it should not be learned like auditing. That is the first thing which you wanted to understand. You have to learn this chapter like DT, GST and law. Basically like tax, you have to learn this chapter. That is a core thing. If you switch your mind in that pattern, this chapter literally becomes very, very easy. And in this chapter, around 60% of the portions are actually literally easy. So that things are just like simple reading and you will understand that. But another portions are there which you will not understand, which I will simply show. Like see, these are all simple things which you will understand. But when it comes to just wait guys, we are doing a detailed revision of this. Advances. From here starts the important areas where the question comes for you. Imagine this mode of creation of security. Some students may not understand what is the difference between all this mortgage, hypothecation, assignment, setup. You just need to understand what that is. That's enough. Once you understand, then learning these things automatically comes to your mind. I'll give you memory techniques. I'll tell you what it actually is. Explain everything line by line. These kinds of complicated, complex stuff. Okay. Then this NPA, out of order, overdue. What is the difference between all of these things? What is this thing actually? How this is working in a bank? So when you understand that only, not just a normal revision video. This here I will explain everything how it is happening practically. Because in this one chapter, the question comes literally technical. To understand the question and give the right answer, you need to know what these things are. And once you know this becomes the easiest chapter. Trust me guys, bank audit, it is a tough chapter for you because you are not understanding. It's not because of the length. It is literally that easy. This one video will give you that confidence. I'm guaranteeing you. Only thing I request from you is don't watch it till like mid-half and say it is not easy. Like watch it till the end and then I want to know what you feel. Then if you are not confident, I will take responsibility for that. 100% you'll be confident. That is a guarantee that I have. like this, accounts regularized near balance sheet, what it actually is, how it is working in a bank, because question is asked like that. Then what is advances under consortium, what does it mean, what is consortium? So all those things you need to understand. Then all these are where the technical area. Then how to compute the drawing power, practical calculations, we'll do it with questions, don't worry. So we will focus on the core areas where it is very hard for you to understand, else this chapter revision will take 3 4 5 hours. So we will focus on only the important areas where question will come for next attempt, most high priority areas, plus all the areas where it is difficult for you to understand. Easy areas we'll just, that's simple reading English, you will learn and understand. Okay, so only thing, hold on to this video till the end. Take whatever material you are using, whatever material you are studying from, be it study material, any notes, take it. And if you don't have a material, this is my revised audit book. I'll give this one chapter's PDF in the Telegram channel. The link is down in the description. You can take it. And all the handwritten notes we are using here, I'll give to you for free. So this one chapter, because I want everyone listening to this video to learn this chapter. Bro, 5 marks directly, 5 to 7 marks directly you will get. Other chapter standards, complicated question come. This is literally easy. So let's focus. Yeah. So audit of banks. What are the different types of banks? It is literally very easy. Simple reading, you will understand. Then we'll go on to the important areas. So what is engagement team discussion? Before starting a bank audit, we will have an audit team where our audit staff, our like articles, chartered accountants articles, and other experts which are hired by our CF firm will be there. So these are the people who are going to audit the bank. So before auditing, they will have and they are called the engagement team, audit team. They will have a discussion. That is all personnel, all people performing an engagement, including the experts contracted by the firm. Imagine for doing bank audit, we don't know something, so we hired some experts also to do it. So those people, along with our team, we are called the engagement team. So the engagement team will do some discussion. So what are the discussions? These are the discussions. And once these things are discussed, then we need to document it for future reference. Whatever you are discussing, document it in a piece of paper. Simple. So what are included in this engagement team discussion? Whatever things are coming in engagement team discussion. See, what are they discussing about? First, they will discuss about errors that are likely to occur during the bank audit. What are the errors that may come when we are doing the audit? Then errors that are identified in the previous year. Last year, who did the audit? Imagine we did the audit. We itself did the audit. So last year when doing audit, what was the errors we identified? So that two things they will check. That is errors. So this is a descriptive area where you have to memorize. So here use just this pic to memorize. I'll give you this PDF, don't worry. So errors that are likely to occur, errors that are identified in previous year. Simple. Then need to maintain a professional skepticism. Professional skepticism means being alert to all the situations. That is having a questioning mind. During the audit, whenever some situation comes, we should have a questioning mind. CA will tell this to the articles and make them remember all these things. Then need to remain alert during the audit. Need to maintain professional skepticism through the audit. Need to remain alert for the informations or other conditions that may indicate a material misstatement. Then what are the methods by which fraud would have been perpetrated by the bank personnel? That is, when we are discussing, we'll discuss, okay, in which all methods bank people may do the fraud. We'll have an idea, like before checking itself, we'll have an idea in which all methods they may do it. So while checking it is easy. Then auditor's response to the engagement is pervasive risk and specific risk. It's that simple. So what do you actually mean by this? Because guys, we have to learn it like this. Engagement is pervasive risk, specific risk. What do you mean by this? That is my question. Engagement risk means any risk to the auditor's reputation. That is, imagine I'm going to audit Baiju. Baiju is a bad company now, so I will also lose my reputation. So similarly, if I'm going to audit a bank, will anything happen to my reputation because of that company, bad bank I'm auditing? That is engagement risk. Because of that engagement, what is the risk applicable to the auditor? Then pervasive risk. Pervasive risk means any risk that will affect the entire financial statements. That will affect many things in the financial statements. Example, company had a weak internal control. So when the internal control is weak, lot of mistakes or errors or fraud can happen, and company's financial statements, many areas it can go wrong. So such a kind of risk, such a kinds of errors, chances are called pervasive risk. Then specific risk. Specific risk means any risk that is tied to specific areas, like loan area. What is the risk tied to that? Those things. So just understand this much. Enough. So this is the pictographic way to remember this. Not use a mnemonic, just use this picture in mind. Then next, what are the advantages of such discussion? Very easy, just learn it, simple. Then This is what we learn to focus, like income recognition policy, we will learn it. So just I'll give you a brief. Income recognition policy, if it's a performing asset. Performing asset means what is an asset for a bank? What is the process of a bank? Bank will take deposits from customers, that is people, and they will pay say 7% interest, and they will lend this money to people for like 12 14 15% interest. So that interest gap is their income, main income. So this loan given by the bank, called the advances given by the bank, those are what we call an asset for the bank. It is an asset because it is helping bank generate income. So two things are there called performing assets and called non-performing assets. Performing assets means any loan given by a bank and the repayment is basically regular. Repayment every month, proper EMI is coming. So that is what we call a performing asset. What is called an NPA? If the repayments are not regular for 90 days plus, there is no receipt. Like last 3 months, I have given a loan, but that person has not repaid for the last 3 months. Basically 90 days he have not repaid. So then that account becomes, in the bank's booklet, that personal account becomes NPA. Simple as that. Okay. So in regular payments, if properly payment is you are getting like EMI, everything is coming proper, then income from that is the interest component you receive from that loan, that is recognized on accrual basis. That is whenever it becomes due, bank can recognize that as income. There is no need to wait for the receipt. Whenever on 15th of every month interest becomes due, 15th itself they can recognize the income. Then the money is received only on 20th, but still 15th itself they can recognize income. Learn it like this, then bank is easy. So because this is regular payment, every month is coming properly, so you can do like that. But if an account becomes NPA, you gave a loan, he is not repaying, so his account becomes NPA. In bank's booklet, we just classify it to NPA, that's it. Nothing else is there. So in that case, you will not recognize income on accrual basis because he is not even giving the money. So how can bank recognize income on accrual basis? No. So what will bank do? Bank will recognize income only when he is actually paying. That is when he receives 15th of every month interest is due, but bank will not recognize income on 15th. He will recognize it only on when the income is received, when that EMI is received. So that is the difference between performing and NPA. Then we will deep focus more on that later in the here itself. Then appointment of the auditor. First question, let me ask you something. Is SBI, State Bank of India, you know that, right? Is it a nationalized bank or not? Is it a nationalized bank or not? Everyone will say yes, but it is no. SBI, this is just a general info I am giving you. SBI is not a nationalized bank. So, because there were some rules, like it was started before nationalization, some other rules are there. Because of some reason, this SBI is basically not a nationalized bank. Then auditor of a banking company, that is companies which are banks like ICICI, HDFC, all these are basically companies. They are banks, but they are incorporated as companies. Their auditors are appointed at the AGM of the shareholders of the company. And approval of RBI is required for appointment. The auditor will be appointed at the AGM, then approval of RBI is also required. Then auditor of a nationalized bank like Indian Overseas Bank, Bank of Baroda, all these are nationalized bank, not SBI. Their auditor is appointed by the bank itself through its board of directors of the bank. Okay, approval of RBI is also required. Then regional rural banks, it is to be appointed by the bank concerned with the approval of central government. Okay, yeah. Then, remuneration of the auditor. Remuneration of auditor of a banking company, it is banking company, this one's, it is fixed as per the provisions of 142 of Companies Act, and remuneration of nationalized banks and SBI. If it was nationalized bank, why should we give it separately? It is fixed by RBI in consultation with central government. You have to keep. We are only focusing on important areas for question. If you just watch this revision and learn whatever I am saying, whatever I am teaching, 100% you will get the marks. So invest this time. Don't just think like, why should I invest my time? Invest your time, because then only you can get something. Anything that is big, bank audit is a big chapter. Learning it takes time. So invest the time. Then powers of auditor, you have to just very easy, chumma read and leave. Then auditor's report, this also is very easy, just read, but this kind of question can come, but it's very easy, I am not explaining. Then LFIR, just read LFIR it's just a report which should be given along with bank audit report, simple, just understand that much. So, all these things will be mentioned, and here statutory central auditors has to submit LFIR to the bank by 30th June every year. This date is an MCQ important. Then conducting an audit, lot of things are there. Bro, don't sit and try to memorize everything in this. That is not needed. Whatever I am saying, just study that. Okay. Initial audit considerations, MCQ chances and descriptive chances area, I will tell you. First is declaration of indebtedness. That is how to do a bank audit. Before starting the audit, before appointing the before accepting the appointment, auditor should submit something called declaration of indebtedness. That is, auditor should not be indebted to the bank in any way. He should not have taken any loan or anything from that bank. Then internal assignments by the statutory auditor. That is, internal auditor should not be statutory auditor. Same thing. Then planning is very easy. Then communication with the previous auditor, very, very important. It simply means communication with previous auditor. If I am going to be appointed as auditor of, imagine, Indian Overseas Bank, last year audit was done by another person. So current year I am the auditor. So before starting the audit, I need to communicate it with the previous auditor. I need to call the previous auditor or mail the previous auditor and say, sir, I am the auditor of current year. Do you have any objections? Because sometimes last year the auditor would have done the audit and bank would have not paid him the fees. So he has an objection, right? So similarly, any problem is there, because this one rule is kept to protect our CA community. Else the clients will not pay the fees or all these things. So we will call the previous auditor, tell him I am going to be the auditor. Do you have any problem? Do you have any objection? He'll say, no, sir, no objection. Everything was good. Then we'll say, sir, please give a NOC, non-objection certificate. That is, please write in a paper that you don't have any objection and give it to me, that you have received all the payments, everything. So he will give you an NOC. Very, very important. A descriptive question can also come. Communication with the previous auditor. A chartered accountant in practice cannot accept the position as auditor previously held by another chartered accountant without first communicating with him in writing. You have to do, not through a call, writing, you have to send him a mail or something that I am going to be the auditor. These things. Normally, you can give a call also if you have the number. He should get a new auditor, should get an NOC, non-objection certificate from the previous auditor through his communications and know whether he has any objections to such appointment made for any valid reason. Invalid reasons alone just ignore. Valid reason he is saying some objections, okay. You have to consider that. Then only start the audit or accept the appointment. Simple. Then all things are very, 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 very easy. The normal, you learn it in the first and second, third chapters. All these things very easy. 315 Chumma just read and leave. They are not gonna. I don't think they'll ask questions from that area. So this is another area where the question comes. Understanding the risk management process. Every bank is the most riskiest business, right? They are managing this much people's money. So when they are managing this much people's money, a hacker can hack into their system. So to protect that, they will have a risk management process. So this risk management, they will have a team or they will have some softwares to do this. So as an auditor, it is your responsibility before starting the audit or during the auditing, understand what are the risk management process of the bank. What is the risk management process? What are the softwares or people they are using to manage the risk? An effective risk management, bank management develops controls and uses performance indicators to aid in managing key business and financial risk. An effective risk management system in a bank generally require the following. For an effective risk management system, these things are needed in a bank. So as an auditor, just see all these things. Just understand bank's risk management process. So first, to make that risk management system effective, the risk management system should have a oversight and involvement in control process by the TCWG, those charged with the governance, board of directors, MD, all these people. It should approve the written risk management policies. That is all the risk management policy. The board of directors, those charged with the governance, those people should have an oversight. That is, they should have a supervision over these policies. Because don't let the management alone decide everything. No, these people should agree it. That is an oversight. Then that is O. O, ICMR. ICMR, you know, right? Indian Council of Medical Research. Simple. Then or you can think like O and I, oversight and involvement in the control process. Then by TCWG, O and I, OICPT, or you can learn it like this. Then identification, measurement and monitoring of the risk. That is, risk that could be significantly impact the achievement of bank's goal should be identified, measured, monitored as against the pre-approved limit and criteria. All the rest should be measured. IMM, identification, measurement, monitoring. Then all the control activities should be there in a bank. Bank should have proper internal controls and control activities to mitigate its risk, like giving segregation of duty. Every duty should not, all the power should not be given to one employee. You should give it to different employees, so that else this one employee itself will do the fraud. So give his duties to other people. Split the duties and give. That is called segregation of duties. All these things you need to have. Then monitoring activity should also be there. Risk management models and methodologies and assumptions used to measure and mitigate the risk should be regularly assessed and updated. That is, what are the monitoring techniques bank is using to measure its risk, to monitor whether the risk, everything is done properly. So the risk management models will be there, methodologies will be there, and assumptions will be there. You have to check whether they are properly assessed and updated. Then reliable information system. Bank requires reliable information system that provide adequate financial, operational and compliance information. This is literally a very just memorization point, the head points and with the keyword one point. So here nothing is there to understand, just study and leave. But the conceptual areas I'll explain, sit and explain in depth so that you need to understand. Next is this one, audit planning memorandum also you study. Then these things, yeah, 240 and like this, just read and leave. That's enough. Then this is one important thing, what is called stress testing. Stress testing is a software testing activity. So this stress testing means when you are testing a software, that is a software is saying it can handle only 1000. But you may put 1200 data and see whether it can actually handle that much stress. So even though they are saying the software can handle 1000, software may be able to handle a bit more extra. They would give that buffer, right? Same thing, same concept is called stress testing. That is bank's software testing. That is important softwares, mission critical softwares will be there in the bank. You will test that software whether it can handle more stress, that is more data at a time. So stress testing is a software testing activity that determines the robustness of the software by testing beyond the limits of normal operation. Normally that software can handle only 1000 data set, 1000 customers at a time. But we'll put 1200 customers just to see whether that can, any days if some extra demand comes, whether that software will collapse. To check that, we are just testing the stress of the software. How much stress, how much extra data can the software handle at a time? That's it. Simple. So it is basically done for the mission critical softwares. Simple. Then these things just read very, very easy. Then advances. Here starts the most important area of this chapter, that is advances. Advances are the more important area. We'll focus here more. So what are advances? Advances are basically money or credit given as a loan from a bank to another party. That is, any loan given by one bank to a customer is called advances, and it is an asset for the bank. Okay. What are the different types of advances? It is called funded advances and non-funded advances. Funded advances means money, actual money that you are giving to a bank, giving to a customer. Bank is giving a loan. Actually money is giving, that is called funded advance. Non-funded advance means here you are not giving any money to the bank, but it is basically like giving money. Example, you are giving a guarantee for a customer. Imagine I am a customer and I needed to buy 1000 units of raw materials from a supplier. So, and supplier is somewhere in the China supplier. Bank, that China supplier, we can call and tell him, sir, give me 1 month credit. This SBI bank is going to give you a guarantee. That is, even if I don't pay it in the next 1 month or 2 months, SBI bank will pay you. So bank is basically giving a guarantee. So China supplier should not trust us, but he can trust a bank because they are writing and giving to him. So that is called a bank guarantee. So the China supplier will give us on credit and within 2 months we will pay it. And if you don't pay, bank will pay and bank will recover it from us later. So this is called a non-funded. Here bank is not giving any fund to us, but basically it's just like giving the fund itself. It's just like giving us that loan itself. So that is called non-funded advances. Actual transfer of fund from the bank. This one, funded. Like here, which do not involve actual transfer of fund. Example, bank guarantee, giving letter of credit, all these things. Hope you are understanding. Okay. And whenever you are, like, we are going very quick. So whenever you find it over like too much in your head, just pause it, take your book, read it, then resume. Okay. Then what are the different kinds of advances? Different types of loans. Different types of loans, what are they? First is called term loans, which you give for a particular number of years. 5 year, 3 year, 10 year. The term is there. Fixed term is there. That is what we call a term loan. Then next is called cash credit, overdraft, and demand loans. This is basically for financing the working capital of a business. Bills discounted and purchased, participation on risk sharing basis. This is also another kind of a loan, that is another kind of advance that bank is giving to us. Then interest bearing staff loans, giving like loans given to the staff, with bank staff with interest. So these are things. Then disclosure, everything just read and leave. Then classification of advances. How can you classify the advances? Divided. That is through sector wise and through security wise. That is, imagine I am a bank and I am giving lot of loan. I can classify it based on sector. That is all the loans that are given to priority sectors like agriculture, education, etc. And all the loans that are given to companies which are not in the priority sector. You can classify it, all the loans, either like this, sector wise, or you can classify it based on the security wise. Security means all the loans, like when a bank gave you loan, you will give a security to the bank, either your property, land or building, other title deeds you will give. So all the loans that are given by the bank by taking a security, that's one set. Second set, all the loans that are given by bank without security. So you can either classify it like this or like this also. The nature of the security, different types of securities are there. First is called a primary security. Second is a collateral security. You are taking the loan for the first time. Imagine, I'll give you a hypothetical example. The difference between these two. I wanted a 50 lakh loan and I have one property. That property's value is say 70 lakhs. So I gave the title deeds of property to the bank and I took a 50 lakh loan. Done, no problem. Bank is happy. So that security is primary security. Now after 2-3 months, I needed another or 10 lakh loan. So then I approached the bank. I told the bank, sir, my 70 lakh property is with you. You have given me only 50. And can you give me extra 10 more lakhs with the same property? Bank will say, no, sir, because we need a safety margin. We don't know what will happen to your house and your house. So we cannot give you extra 10 more lakhs. We can give you maximum 5 lakhs. So if you want 10 lakhs, give me some other security also. So I will go, I'll have some gold or something with me. I will give that also to the bank. So, and I'll take the another 10 lakhs. So that is the extra security you are giving for the same loan. Extra security, that is called a collateral security, is additional security. Security can be in any form, tangible or intangible asset or movable or immovable asset. Okay. So the next is mode of creation of security. How do you create a mode of creation of security? For that, I will show you a chart. And I'll give all these things for free, don't worry. If you go to my Telegram channel, in the description, lot of these kinds of free notes are there regarding Caro. My previous video regarding Caro, in 20-30 minutes, entire Caro clauses in one mnemonic I have mentioned. Just go and watch that. Your Caro will be sorted 100%. You'll never forget the clause. So this is mode of creation of security. That is, how can a bank create security? First, through mortgage. Mortgage means you are taking a loan, pledging your security, right? So mortgage is something that is applicable for immovable property. If you are giving any immovable property like land or building as a security, that is what we call a mortgage. Using an immovable property as security for loan. So types, there are registered mortgage and something called equitable mortgage. Registered mortgage, you will sign a formal mortgage deed with the bank. Because here, equitable mortgage also I'll say, wait, registered mortgage, you will enter into an agreement with the bank. An agreement, the stamp paper, all these things will be there. In that, you will enter into a deed with the bank, and that is registered with the government. Registrarly, it is registered. That is called a registered mortgage. In that, so the bank will have the legal right. So that is called a registered mortgage. You are registering that loan, registering that mortgage, that is property you are pledging to bank. You are registering that in the bank's thing through that this stamp paper and all these things. That is registered mortgage. Equitable mortgage is the things which you have seen in the movies and all these things. Like no agreement, nothing is there. You have a home, you have like the title deeds with you. You will just go to a bank and give this title deeds. You take this title deeds, give me 10 lakh. When I repay it, give me the title deed back. Done. No agreement, nothing is there. So here you are just giving the title deed, but here you are lending through the agreement. Agreement through this registering. You are registering that agreement with the government through registrar. But here also, normally banks will take the title deed also. Actual practice, here registered, here the bank will also take the title deed also of you. Here basically it is actually in real practice, the title deeds will be there. Title deeds they will take you, plus they will enter into this stamp paper and all this registered will be there. Here only title deed is there, no register, nothing is there. Okay, no agreement, just give the title deed and take the money, old style thing, which you have seen in the movies. Okay. Yeah. So then next thing is called pledging. What is called pledge? Here I told you, we need to know the difference between each and everything. Because the question comes, you have to identify whether they are asking about mortgage, pledge, whatever it is. So for that, you need to understand what these things are. So mortgage is basically for immovable property. Pledge is for basically movable properties. See, borrower gives his goods to the bank as a security. Goods is a movable thing. That imagine I have a gold. I'll give the gold to the bank and taking loan. That is what we call pledge. Ownership is still with the pledger. I gave a gold to the bank, but still the ownership is with me, but the possession is with the bank. Okay. Bank has certain rights only, example, gold loan. Next is hypothecation. This is basically the car loan thing. That is, this is also a movable item. This is also movable. This is immovable. Okay. Here, in this case, you are giving your gold as a security. The possession is with the bank. But in hypothecation, possession is also with you. But bank will only have a right. Imagine you take a car loan and that car is actually yours. The car is with you. Possession is with you. Ownership is also with you. But bank has a right over it. That is what we call hypothecation. But in gold loan, the ownership is yours, but the possession is with the bank. That is what we call a pledge. So the ownership and possession is a differentiating factor. Similar to a pledge, but you don't give physical possession of the goods to the bank. You are not giving physical possession. Car is with you. Both the possession and ownership is with the borrower itself. Done. Example, car loan. Or example, stock hypothecated and overdraft taken. That is, I have some stock in my warehouse. I hypothecated it and I am taking some loan. Simple. Then next is assignment. Assignment means you have a right to receive something. Imagine you have a policy, life insurance policy or something. So that is your right to receive money on the maturity of the policy. So anyways, imagine you have a life insurance policy of 5 years and today is like next week it is maturing and you are going to get money. So now urgently today you need a 10 lakh rupee. The life insurance policy is of 10 lakh rupee. So what you will do? You will go to the bank, give the life insurance policy to the bank, and I will tell the bank, we'll assign the right to receive money. This was my right to receive money from the policy. I will assign that right. I'll give that right to the bank and tell the bank, you take the money, but now give me 9.5 lakhs. Like 50,000 you take it as your commission. Like the now giving me. Like that is what we call assignment. Transfer your rights in something to the bank and give loan. Bank will give you a loan. Or like, sorry, life insurance policy, that is another case. One more thing you can keep in mind. Like you wanted a loan and you have a life insurance policy with you. Life insurance policy is 10 lakh. You will go to the bank, give this life insurance policy to the bank, you will transfer that right to the bank and the bank will give you 9.5 lakh loan. 10 lakh policy you have given to the bank. Okay. So here at the maturity date, the life insurance policy will pay the money to the bank. So before that, if we repay the loan and we can take that life insurance policy back also. Before that, if we repay the loan. Okay. That is what we call assignment. That is life insurance policy transferred to the bank and taking loan from that. Normally, life insurance policy, okay, that you, what does it mean? Then next is called, what happened? Okay. Wait, Then next is what I call a set off. Set off means bank has a right to use your money to pay off your debts. That is, imagine you have an FD with the bank and you have taken a loan also, but you are not repaying the loan. Bank can set off that loan against your FD. They have that right. That is what we call setting off your debit towards your credit. You have any deposit. Then lien. Lien means legal right to keep someone's property in your possession until they have repaid. Imagine you are you have a car and the car is wanting a repair. You gave to the workshop and told the workshop guy to repair it. And the workshop guy repaired it and told 3 lakh rupees is the bill or 30,000 is the bill. So now till you pay him that 30,000, that workshop owner has the right, the lien to keep your car. That is what we call a lien. Okay. So your bank case, you can think your valuable documents are there in the locker. Now if you don't repay what you have owned, bank has a lien for that document. Simple. You have some valuable documents in your locker and you have taken some loan also. If you are not repaying, they have a right, they have a lien over that document. They can keep it till you repay. Practically how much happens difficult. It is different. Yeah. So understand, I hope you understood mode of creation of a security. So yeah, prudential norms on income recognition, asset classification and provisioning. So this is the most conceptual area of this one chapter. 1 second. Yeah. So the first thing you have to understand is NPA. What is non-performing asset? A loan given by a bank to a customer and the customer has not repaid to the bank for 90 plus days, it is termed as NPA. This is for a normal loan. Normal term loans. Other categories are also there. An asset becomes NPA when it ceases to generate income to the bank. When it stops to generate income. That is the point at which asset becomes NPA. When EMI is not receiving, bank is not getting interest. So that asset, that loan given, ceased to generate, stopped to generate income for the bank. So NPA for normal loans given, interest or installment of principal remain overdue for more than 90 days, this has not been received. That is what we call for normal loans. Then for overdraft and cash credits, accounts remains out of order in respect of overdraft or cash credit. What is out of order? Here it is. So for overdraft and cash credit, if the overdraft or cash credit account remains out of order, we learn what is out of order. When it becomes out of order, then automatically it is classified as NPA for overdraft. For loans, 90 days limit is there. Then for bills purchased by the bank has purchased a bill from someone and imagine that a receipt date is next month the 15th. So 90 days limit is there. Then for bills purchased by the bank has purchased a bill from someone and imagine that a receipt date is next month the 15th. So So the bill, if it is not received on the next month, 15th, the bank has not received that money, then that is it became overdue. Then if it is overdue for more than 90 days, then it is called as an NPA. Receipt date is 15th, and 15th it has not been received for the next 3 months also, 90 days also it is not received, then it is automatically called NPA for bills. For three things, classic different types are there. For loans, this is the limit. For ODCC, this is the thing, and for bills, this is the limit. So what do you mean by this out of order? Before that, let's see what is overdue means. Here, interest or installment remains overdue for more than 90 days, right? And here bills also overdue. What is this overdue? Overdue simply means on the date of payment, the money, on the date of actual money to be received, that date money has not been received. That is called overdue. Any amount due to the bank under any credit facility is overdue if it is not paid on the due date. Due date is 15th. If it is not received by the bank on 15th, it is called as overdue. And it is overdue for more than 90 days. That is not received for more than 90 days from that date, it becomes NPA. Then what is out of order? The outstanding balance remains continuously in excess of the sanctioned limit or drawing power. Imagine the sanctioned limit for the loan. We'll learn all these things. Sanctioned limit is say 10 lakh and drawing power is say 8 lakh, and they not 8 lakhs, let's put it 9 lakh, and the customer has withdrawn amount like say 8.5 lakhs he has withdrawn, but he has not repaid, so the interest everything accumulated, and now 8.5 lakh is almost like 9.8 lakh or 10 lakh or 11 lakh. So the outstanding balance is, imagine 11 lakh with the interest, all these things. This is now, this 11 lakh is more than sanctioned limit or drawing power, right? So then it is called as out of order. This is for cash credit and overdraft. They have purchased, they have taken the money, but if it is not, if the outstanding balance is in excess of overdraft and in excess of sanctioned limit or drawing power, it is called as out of order. So when it becomes an out of order, it is automatically called NPA. Imagine sanctioned limit is 10 lakh, drawing power is 8 lakhs, and the total the loan they took was 7.5 lakhs. So first case, outstanding balance is 8.2 lakhs. So outstanding balance is greater than drawing power is only 8 lakhs. Outstanding balance is 7.5 lakh plus all the interest everything accumulated, and now it became 8.2 lakhs. Outstanding balance is greater than drawing power, so it is classified as NPA. Second case, in cases where the outstanding balance in the principal operating account, outstanding balance, this one, is less than the sanctioned limit or drawing power, but there are no credits continuously for 90 days. That is second case is, this outstanding balance is less than drawing power and sanctioned limit. Imagine it is only 7.8 lakhs. So it is less than this two. But for the last 90 days, no credit, no receipt has been received from that loan given. No EMI, no interest, no principal, nothing is received. Then we call it as a out of order. So when it becomes out of order, this is only for cash credit and overdrafts. So when it becomes out of order, it is automatically classified as NPA. That is this one. No credit for the last 90 days. So you don't have to read this much. Just write this on your side. It's enough. You will understand. Then credits are there. This is the first case is this. In this case also it is NPA. If this case is also NPA and this case is also NPA. That is this case is out of order item. Then it becomes NPA. Credits are there, but not enough to cover the interest debited during the same period. Credits are there. That is, imagine outstanding balance is say 7.8 lakhs. Imagine. So, and in the last 2-3 months, payment has also been received. So, if outstanding balance is more than this, automatically out of order. If outstanding balance is less than this, but no credits for 90 days, still it's out of order. But if outstanding balance is less than this, but credits are there. Credits means the customer has paid some money, but that money is not even enough to recover the interest portion. Imagine this was the initial loan taken, and along with the interest, the outstanding balance became 7.8 lakhs. So this is less than this two. And the customer over the last 3 months paid amount almost 25,000 he paid. What is the interest component itself is 7.5 to 7.8 is 30,000. So the money the customer only paid this much. EMI was way more than this, but he only paid this much. Here the credit given by the customer is not even enough to meet the interest portion. Interest is 30k. It is not even enough. So in these three cases, we will call it as out of order. Credits are there, but are not enough to cover the interest debited. So hope you understand. 7.8 lakh was outstanding, repaid only 25,000 in the last 3 months. So interest itself is 30,000. This credit is not even enough to cover the interest. Done. Hope you are getting the clarity. That example they have written it here. Overdue we learned. Now we will focus on the categories of non-performing assets and provision. That is, for a bank, loan given is an asset. So when you are not receiving money from an asset, or when you know that that person who has taken the loan, he is not having any money, or he is having any bigger issues, if he is having some bigger issues, what is the thing? Bank has to put a provision, just like debtors. Normal for companies, debtors will put a provision. Similarly for bank also, if you think the money is not going to come, we need to put a provision. Okay, so we are learning about that provision now. So first is, if it is a substandard asset. Normally when a bank gives a loan to someone and the money is properly being repaid, it is called a standard asset. For standard asset, no provision is needed. In inter you are not learning, but finally it's like 0.4 general provision are there, leave it. So for, if the money everything is coming properly to you, properly everything is they are repaying it on time every month, no problem, no NPA, nothing, then it is called a standard asset. That loan is a standard asset and you don't need a provision for that. But if that asset became NPA, that is if that loan became NPA, and NPA, imagine the date they became NPA today, from that date till 12 months you are classifying that as substandard asset. You will classify it as substandard asset, and substandard assets require 15% provision. Then doubtful assets, if it is a doubtful asset, that is it remained in the substandard category for a period of 12 months plus, that is till first, the moment it become NPA, for the next 12 months it is called a substandard. The moment 12 months are over, from the next date is called as doubtful asset 1, D1. For that we will put a provision of 25%. If the loan is secured, that customer has given some security, in that case we will put 25% provision. If the loan is unsecured, no security is there, we will put 100% provision. Doubtful up to 1 to 3 years. 1 year and doubtful is also over. Then the next second year to third year onwards, you will put basically 2 to 3 years, you will put 40%. Unsecured 100% provision. And doubtful over, if the last 3 years our money has not been completely remained in NPA, 1 year has been over, so it became doubtful 1. Then 2-3 years are over. Then the third year, if it is more than 3 years of money has not been received, you will put 100% provision. Done. Hope you got it. So you need to know provisioning. So in the first year, if you are putting 15% provision, second year you need to put 25% provision, but already 15% has been put, so extra 10% extra only you need to put current year. Then next year you are putting 40% provision, but already 25% is done. 15% in there you put to and another 10% you put here extra. So now almost 25% provision has been put. In the third year, if you are putting 40% provision, that means another extra 15% you have to put in this year. Then in the third year, extra already 40% has been given in the previous year. So an extra 60% amount you put it here about the for the outstanding balance. Then loss asset. Loss has been identified by the bank or internal or external auditors or RBI inspection team, but the amount has not been written off fully. If it's a loss asset, that is, if the RBI has considered that advance as a loss asset, then you put 100% provision. Simple as that. For advances, for a loan given by a bank, 3 things are there. Income recognition. We need to learn the rules regarding income recognition. That is whether that asset becomes NPA, how to recognize income from the bank. That is on, if it becomes NPA, we need to recognize income only on accrual basis and only on receipt basis, I told you. Then asset classification. When that asset becomes an NPA, if that asset becomes NPA for less than 12 months, NPA item, but 12 months are not been over, you classify it as substandard. Then if it is more than 12 months, then like this. This is assets classification we are learning. Then we will also learn regarding the provision. That is, this provision depends on asset classification. When an asset is classified as substandard, this is a provision to give. Like that, provision also. 3 things we are learning regarding a loan. Understand, these are 3 separate things: income, asset classification, and provisioning. Okay. Then classification of NPA should be based on record of recovery. That is basically if you have not received the money for the next 90 days, last 90 days, then NPA. Then one more thing you have to keep. Imagine Adani or Ambani has taken a loan from a bank. So we know that a bank also know that Ambani and Adani are very rich people. They have a lot of money. They have given lot of guarantees and securities also for the loan. But if they have not repaid the loan for more than 90 days, still it becomes an NPA. How much ever rich they are, how much ever whatever they are, still if money is not received for 90 days, whatever guarantee they have given, it is still classified as NPA. Remember it for MCQ or descriptive questions. Another most important thing you have to understand is asset classification. That is asset classification. This one, classification should be borrower wise and not facility wise. That is, if I have taken 2 loans from a bank, a home loan and a car loan. Imagine I paid all the home loan EMIs on time. Every month perfectly I have paid. But car loan EMI I have not paid on time. So car loan EMI is like 90 days I have missed. I have not paid any EMI. So car loan account will become NPA? No. If car loan accounts becomes NPA, that person's all the account is treated as NPA. Even though he is paying home loan properly on time, still his home loan also becomes NPA. All his assets, all the assets means all his loans, that is for a bank it is asset, all his loan will become NPA. So, and classify all the loans based on this. Okay, so understand that is the example given. A car loan as well as a housing loan from XYZ Limited. He is regular in depositing housing loan EMI but not deposited the 4 EMIs of the car loan. That is 4 EMIs, 4 months missed, 3 months, 90 days mele. Then due to the positive funds. Hence, in this case, not only the car loan but the housing loan should also be treated as NPA, although it is going really good. So NPA classification is borrower wise, Mr. Remans, that person wise, not the facility, not the car loan or housing loan individual facility wise. Keep in mind, very, very, very important. So next is this one called accounts regularized near the balance sheet date. So here, guys, understand first thing. This NPA classification, bank does this NPA classification on a regular basis. That means imagine a bill on September, a customer started not paying. Customer is not paying from September onwards. So September, October, November, 90 days he has not been paid. So on November, his account becomes an NPA. In bank's book, from November onwards, that is imagine from November 30 or December 1st onwards, that account become NPA. 91st day onwards, it becomes NPA. And it is continuing to become NPA. Customer has not paid any money. Okay, November, December, January, February, March, it is becoming NPA. And at the closing, the balance sheet date, 31st March, that accounts, that customer's borrower's account will be classified as NPA. So, what these borrowers do is, if an account actually becomes NPA, imagine Adani is not paying and Adani's account become NPA, it is a very bad remark for Adani. Adani's credit rating will go down. He may not get another loans from other banks. All these issues are there. So on 31st March, Adani don't want his account to become an NPA, to be shown as an NPA. In the balance sheet, it will come Adani's account as NPA. So to avoid that, what Adani will do, just before 31st March, imagine 5 crore is the outstanding amount. 5 crore is the outstanding amount. If Adani pay 5 crore, imagine the total loan is there 15 crore. But if Adani pay 5 crore, 15 or 150 crore. But if Adani pay 5 crore, his account will be changed from NPA to normal regularly, it will go. So on this is 31st March. This is 31st March. Understand? This is 31st March. So just before this date, that is almost say March 15th or March month. What Adani will do is Adani will come to the bank and Adani will get money from somewhere else and Adani will put 5 crore rupees to the bank. So what happens immediately? NPA, the account of Adani which was NPA, now it changed to regular. So March 15th he put this money, March 15th or 25th he put this money. And what he will do, he has a good tie-up with the bank manager. So after this 31st March, that is April 1st week, the bank manager will give another 5 crore rupees to Adani, like a loan, another loan or something, he will give this 5 crore to Adani. So basically Adani put 5 crore from somewhere and after 31st March he is taking it out. So what is actually happening on 31st March on the balance sheet, Adani's account is not NPA. So Adani is saved. So these kinds of fraud kind of a thing, these borrowers and bank managers together, they may do these kinds of things. So to avoid this, as an auditor, it is because this is what we call account is, that is Adani's account is regularized. From NPA, it is shifted to regularized at the balance sheet date. Adani's account is regularized at the balance sheet date, not from escape. That is basically he escaped from becoming an NPA. He escaped from the NPA category on balance sheet date. So this is what we call account regularized near balance sheet date. So as an auditor, it is our duty to check while we are auditing a bank, we have to check whether these kinds of any fraud issue is there. That is what we call account regularized near balance sheet date. Asset classification of the borrower account where a solitary or a few credits are recorded before the balance sheet date should be handled with care without any scope for subjectivity. That is, solitary means one credit or a few credits, 3 or 4 more credits, money is coming to this. That is, this like money is coming. We have to check whether any money has just come before the balance sheet date and that same money is taken out after the balance sheet. If something is like that, then it may be to avoid escaping from the NPA classification. So these kinds of fraud, these borrowers and bank will do, we have to check that. So if an account indicates these kinds of an inherent weakness, it should be deemed as an NPA. Then auditor should check, he should take some accounts, like some accounts on sampling basis and check for these things. Okay, just to see that whether any money has come in and the same money has been reversed after the end of the financial year. Same thing is written. So understand these kinds of things like this, practically how is happening. So it will be very easy for you to remember and study also. Because there nothing. Now tell me, bro, is there anything to study? You understood everything in your mind. Now just with these keywords, that is sample transaction, he will take inherent weakness, then it should be classified as NPA, classification of borrower, that is solitary or few credits. Just these words you need. With this, you will be able to frame sentence because you know the concept. That is why this lecture is all about. Then government guaranteed advances. That is, any loan, I have taken some loan, and for me, government is giving a guarantee to the bank that if Sudarshan doesn't pay, government will pay. So in those kinds of loans, what should an auditor do? If it is guaranteed by the central government has given the guarantee. Okay, where guarantee is not invoked, that is, guarantee has not been taken back by the central government, or I'll simply say, if the guarantee is given by central government and it has not been taken back, the asset classification, and you are not paid the money. Imagine such kind of I have taken a loan from a bank, central government guaranteed, and I have not paid the money to the bank for more than 90 days. It becomes like an NPA, like 90 days I have not paid. In that case, what to do? If it is money, everything is proper, nothing, normal classification, you go. But if money I have not paid it for 90 days, what should do? Asset classification, you don't need to change it. Even though it became kind of NPA, you should not change the asset classification because central government is the guarantee. We can blindly trust, bank can blindly trust. If I don't pay, central government will pay. So asset classification, even though it becomes NPA, it should be standard itself. Then income recognition for that loan, for my loan I've taken from bank, income recognition, it is based on NPA wise itself. That is, if account becomes NPA, 90 days I have not paid, income should be recognized on normal receipt basis only, no accrual. But for provisioning, you don't have to put any provision also, because provision is dependent upon classification. Which classification comes? If the asset is substandard, then this provision comes. If it is doubtful, so this will come. So provision is dependent on asset classifications, right? Since here asset classification is not changing, even though asset becomes NPA, still it is standard, so no provision is also required. Then state government guaranteed advances. If the advance, I have taken a loan from a bank and state government has given the guarantee, this is just like how a normal loan will be. Nothing special treatment is there for state government. That is, if it becomes overdue for more than 90 days, asset classification will come. That is standard, substandard, doubtful, everything will come. And income recognition is just like normal. That is, if it becomes NPA, then income recognition on a receipt basis, then provisioning also will be required. That is, depending on the asset classification, you will put provisions. If it is substandard, then 15, doubtful one, then 25, D2, then whatever, the 40%, all these things. Okay. So next is advances under consortium. Advances under consortium. Consortium means a group of banks coming together and giving a lending. Imagine, like I'll give things with examples, so exam when question comes, it will be very easy for you. You will be able to write the answer. Advances under consortium means, imagine I am a businessman and I needed 1,000 crore rupees to construct a shopping mall. So when I went to SBI is saying, sir, we cannot give 1,000 crore rupee, maximum we can give is 300 crore rupee, 300 crore. So what can we do is, we will talk with ICICI and HDFC, and together we will form a consortium, and together we will give. I will give you 500 crore, ICICI will give you 300 crore, and HDFC will give you 200 crore. So these three banks forming a group, that is forming a consortium, and they are giving you loan. So three banks, small amounts they are giving us loan. For you need 1,000 crore, that is given by SBI 500 crore, HDFC 300 crore, and Bank of Baroda will give you 200 crore. This is what we call advances under consortium, giving loan by all the banks, by some banks forming a group, consortium. So here, SBI is the major loan giver. Bigger amount is given by him. So he is called the lead bank here. SBI is called the lead bank. And I will have my terms and talks with SBI more. Even though these people are included, initially after agreement everything, I will meet these people. But after that, my payment everything will be with SBI. Imagine the total EMI for this is say 5 crore per month. Imagine 5 crore is the EMI. What I will do, I will pay this 5 crore directly to SBI. And SBI will take their share, 50% share. That is 2.5 crore is their EMI. They will take that, and the remaining 2.5 crore, they will split it to these people in their ratio. So I am only in talks with SBI here, because that is a lead bank. Just understand that. You have to understand that concept, else it is literally going to be tough. 1 second, guys. Charge is not there. Yeah. So consortium advances means advancing loans to a borrower by two or more banks. Simple. So here a bank with a higher share is called as will lead the consortium. That is lead bank. Where remittances, one more thing. This sentence is very important. Right? This they can ask literally very tough questions from this. That is why I'm explaining like this. So imagine my monthly EMI is say 5 crore, and in this 5 crore basically 2.5 crore, the 50% is the ratio is applicable to SBI, And imagine, hypothetically, I'm saying something, I don't know the calculations we have not put. Imagine 1 crore and another 1.5 crore is given to HDFC, and another crore is applicable to Bank of Baroda. So this 5 crore total, I will give it to SBI, and SBI will take their share and split it to these people. I told you. So there is a very big problem in this. Sometimes SBI will not, sometimes SBI will not give this 1 crore to this HDFC or Bank of Baroda. It is SBI's duty to do that, but SBI sometimes will not do that. So, but SBI's book, I have paid the proper money, my asset classification will, everything will be proper. But these people have not received money. From my money, they have not received. In that case, in these people's books, my account will be turned as NPA if 90 days later they have not received any credit. It is not my problem. I have paid the money to SBI, but if they have not received, these people have not received the money, still they will classify my asset as NPA in their books. Understand this? It is basically not a good thing, but still they are doing it. Because it is this bank's responsibility is there to get the money from SBI. They need to form an agreement like that, and the SBI also has a responsibility to pay this bank. Okay, so keep that in mind. That is where it is written. Where remittances from the borrower under consortium are pooled with one bank, that we are giving every remittance to SBI, and where the bank receiving the remittances, SBI, is not giving their share to other member banks. They are not giving the share. The account should be treated as not serviced in the books of other member banks, and therefore it will be treated as NPA. Other banks. Okay, understood? This understanding is important. Like I told you, we are learning it like DT. Detail we are understanding. In this case, this tax will come, why this is coming, learning like that is what you need to learn. Don't memorize anything, it is very tough. Just understand like this, and you can write in your own language also with the red highlighted keywords. Then agreement, everything I told you. Then drawing of calculation and all these things, the everything, the responsibility of drawing power, the power, all these things relies with the lead bank. Lead bank will talk with other banks, and then they calculate. Lead bank may give a lower share of the drawing power. It's all these things simple. You will read and understand. Then accounts where there is an erosion in the value of security or fraud committed by the borrower. Very, very important. Understand. It simply means I needed a 70 lakh loan. I have a 50 lakh property. I gave it to the bank. So bank gave me 70 lakh loan. Okay, happy. But after this was a 10-year loan. But after 2 years, sudden earthquake or some flood happened in my area. And my area is now, it's like Chennai, some areas are there where flood happens. So when flood happens, that area's value will go down. Nobody is going to buy real estate in that area. So my property, which was worth 70 lakh, and I take a loan from bank for 50 lakh, but now that my property's value has gone down to 25 lakhs because of the flood affected area. So now that is what we call erosion in value of security. My property was bank security, and that's the property's value has been eroded. That has gone down from 70 lakh to 25 lakh. So the loan I took was, say, 50 lakh was the loan I took, and now I have repaid. Last 2-3 years were done. I have repaid almost 10 lakh. So outstanding balance loan amount still itself is like 40 lakh is still pending as balance. But my security, which was worth 70 lakh, went down to 25 lakh. So now bank is at risk. If I don't pay the money, what will bank do? Bank can recover from my security. They will only get 25 lakhs, but the loan outstanding is 40 lakhs. That is what we call erosion in value of security. First case. Second case, frauds committed by the borrower. Frauds committed by the borrower means my property is actually worth only 35 lakhs. But I hired some registered valuer, and I did some fake valuation and all these things, and I gave a fake valuation report, like 35 lakh of property. I valued it as 75 lakhs, and I submitted it to the bank, and bank's valuer also came. I also gave him some bribe and asked him to increase the value. So my property, which is only worth 35 lakh, I did fraud with the bank and showed them it is worth 70 lakhs, and I took a loan of 50 lakhs. So basically a fraud happened. The actual value of security is not that much. That is called the fraud committed by the borrowers. So in this case, what should an auditor do? Erosion means gradual destruction or diminution of value of something. It should be straight away classified as doubtful asset or loss asset as appropriate as follows. If there is an erosion value of security, that loan account should be classified as doubtful asset or loss asset based on this requirement. Or fraud, you have to do this. Then erosion in value of security can be shown as significant when realizable value of security is less than 50% of the value assessed by the bank. That is, at the first time, when bank gave me loan, they took my property, they valued my property at 75 lakh, and they gave me 50 lakh loan. So now, because of the flood, my value of the property became 25 lakhs. So initial value assessed was 70 lakhs. So now the value is only 25 lakhs. So it is more than 50%. More than 50% the value has come down. The 50% of 70 lakh is 35 lakh. My value is only 25 lakh now. 25 lakh. So more than 50% if the value has been gone. That is erosion value of security. If it is more than 50% of the value assessed by the bank, then it is called as a significant erosion. More than 50% if it comes down, it is called significant erosion. Such a thing should be, such NPAs may be straight away classified under doubtful category and provisioning should be made. That is, if I am not repaying the money, my securities value has already come down and I am not repaying the money for 90 days also. So my account becomes NPA. So if it is such a kind of account where the value of the security has come down and I am not paying the money also, that such NPAs should be no substandard category. Straight away from standard category, you need to classify it as doubtful category and provision need to be made. Doubtful 1, doubtful 2, doubtful 3. So understand, my value of the security come down and I am not paying to the bank also for last 90 days I have not paid the EMI. So the under condition it becomes an NPA. When it became an NPA, suddenly don't classify it as substandard, directly classify it as standard. So the moment it becomes NPA, normally it goes to substandard category for 12 months. No, directly go to doubtful because there is an erosion value of security or fraud committed by borrower. Then if realizable value of the security is less than 10%, imagine here 70 lakh was a property and because of an earthquake happened in my area, my building completely destroyed and that area land very less value, sir. So now the value is only like say 5 lakh is the value of this property. Bank initially assessed 7 lakh, but then now the value is only 5 lakh. That is less than 10% itself is 7 lakh. But like even though even lesser than 7 lakh it went. So in that case, that is if the realizable value of the security is less than 10% of the outstanding in the borrower accounts, or the existence of security should be ignored and asset should be straight away classified as loss asset. So one thing guys you have to keep in mind, sorry, one mistake I did. That is, once more I'll say, wait. That one point, it's very important. The calculation questions may come. That is why I'm saying. So the value of the property was 70 lakh and bank gave me 50 lakh loan. 2 years are over. I have paid almost 5 lakh repayment. I have paid almost 5 lakh repayment I have paid. So outstanding balance with interest, imagine, etc. is a 45 lakh is outstanding balance. And 70 lakh was my property's value. And now because of the earthquake, my property's value went down to say 3 lakhs. So if in the first case, you are comparing this 50% thing, 50% reduction in the value, you are comparing it with the 70 lakh. 70 lakh or 50%, is it less than 50% of this 70 lakh you are taking. But in second case, you are considering whether it is less than 10% of this 45 lakh outstanding balance. First case, 50% of the initial value assessed by the bank. The second case, 10% of the outstanding balance. Okay, so don't consider 10% of this. Okay, that is what is a difference. It is very, very crucial. Practical question may come in MCQ. You may commit a miss. 10% of the outstanding in the borrower accounts, 50% of the value assessed by the bank. So write this calculation in a sticky note on the side and keep it, because if they are making a tough question paper, this things can come in descriptive or MCQ as practicals. Practicals means a case based, they will include this. You have to write what classification it is. Then all these things are basically easy. Asset, NSC, KVFC, not be treated as NPA because adequate margin is there. Agriculture advances, like bank has given some agriculture loan to someone and a natural calamity happened, flood, something happened, agriculture is completely destroyed. In that case, NPA classification, everything, bank may decide their own relief measures. Bank can decide what to do there. Should they classify as NPA? What should they do? All these things. Bank has the power to decide. No fixed rule is there. Bank has, RBI has given the power to bank. Then advances to the staff. All the loan that is given to staff, this is very easy. You just read, you will understand. Then agricultural advances. Agricultural advances for long-term, long-duration crops and short-duration crops. Imagine mango. So only one season is there. In 1 year, only one season comes. That is called a long-duration crops. I am a bank. I have given a loan to a farmer who is doing mango business. Mango cultivation is doing the mango, and for producing mango, we have given him a loan. Mango is a long-duration crop. Okay. So for those things, if he has not paid the money, loan granted for a long duration crops will be treated as NPA if installment of principal or interest remains overdue for one crop season. One crop season, that is 1 year if it is overdue, one crop season if it is overdue, then only we will classify it as NPA. For long duration crops. For short duration crops like banana, if it is overdue for 2 crop seasons in a year, like 2 crop seasons, like one season is imagine 3 months, 6 months if it is overdue, then we will classify it as NPA. For long duration crops, only one season is there. So one season extra if it is overdue, we will classify it as NPA. Short duration crops, if it is overdue for more than 2 crop season, you will classify as NPA. So keep this in mind. Okay, keep the example in mind. Then computation of drawing power, literally very easy. So just understand simple thing, guys. Drawing power means stock given, because drawing power calculation is for this one, cash credit and overdraft facility. Basically for cash credit, you keep in mind. Cash credit, you wanted a working capital money for cash credit. You approached the bank and bank gave you working capital this loan. And bank told, we will give you this working capital loan, provided you should give us every 2 months, you need to submit your stock statement. Whatever is your stock, like 2 months end, what is your current stock in hand, other statements you have to submit to the bank. Every month we have to do that. Stock statement plus debtor statement also we have to give. Okay. So drawing power, how the bank calculates the drawing power? It is based on the stock statement we given. Stock statement plus the debtors order statement, whatever we give, minus creditors. That is creditors in the stock. Imagine you purchased a 10 lakh worth of stock. In that 7 lakh you purchased with cash and 3 lakh is credit. So that credit portion we will exclude from the stock. That portion, only 7 lakh will come. Okay. Stock minus debtors plus creditors is minus margin. Bank will keep a margin. That is, imagine they need a margin, right? Like for their safety. So that margin amount. When we do a practical, you will get understand. Drawing power is important in the calculation of cash credit facility. Drawing power is a limit up to which a firm or a company can withdraw from the working capital limit sanctioned. Okay. That is sanctioned limit. Imagine the sanctioned limit is at 10 lakh. The drawing power they will calculate every 3 months or 6 months. They will calculate the drawing power, and that may based on the stock statement. What is the stock statement given by the company or the borrower given stock statement? Based on that, bank will do the calculation like this, and we will get the drawing power. So now we are going to learn the calculation. Before calculation, just we'll do the calculation and see. Yeah, just this one question. Compute the drawing power for the cash credit account of Kripa Limited for the month of 20. I'll quickly go. You can you can take a screenshot of this also. Stock is 60,000. Debtors 55,000 is the total debtors. The one debtors that are old is there. Or debtors older than 3 months are ineligible for calculation of drawing power. They have given it. So this 15,000 we will exclude. This fully we will take. Debtors 40,000 only we will take. Sundry creditors 10,000. So 10,000. This 60,000 we have bought almost 10,000 rupees worth of credit. So this we will reduce. Sanctioned limit is 48,000. Wait. Margin on stock is 30%, and on the debtors they are keeping a margin of 40%. Okay. So first we will take the stocks. Stocks are 60,000 we took. Less sundry creditors. I told you stock you will reduce sundry creditors. You will get the paid stock. Stocks for which you have actually paid cash is 50,000. Okay. From that you will reduce the margin on stock is 30%. Into 30% is 15,000. You will reduce that and you will get 35,000 as stock item plus stock minus creditors plus debtors you have to include, plus debtors is 55,000. Then ineligible is there 15,000, that you will reduce, 40,000 you got, and margin on debtors is 40,000. So when you multiply 40,000 you will get 24,000 as remaining. So this is stock minus creditors is there, plus the debtors you add minus the margin also you have minus, you will get this figure. So stock we added, minus stock minus creditors we added, minus the margin we did, debtors also minus margin we did, this thing we will get this 59,000 as the figure. So 59,000 is a drawing power, but there is a problem. Drawing power will never be more than sanctioned limit. If the sanctioned limit is set 10 lakh and drawing power is say 8 lakh, the customer can withdraw only this much. This is the maximum. That is, whichever is lower, that is the maximum amount a customer can withdraw. If sanctioned limit is 10 lakh and the drawing power is, say, imagine because of the stock statement, based on the stock statement, when we calculate the drawing power came to 11 lakh, here also, even though the drawing power is 11 lakh, you can withdraw only whichever is lower. So up to 10 lakh only you can withdraw as money. That is, a borrower can withdraw as money from the bank. So the sanctioned limit given in the question is say 48,000 and drawing power is more here. In that case, the customer can only withdraw up to 48,000. Okay, sanctioned limit given in the question 48, whereas drawing power is 59. So drawing power would be restricted to the sanctioned limit rate, that is 48,000. So if it is more than sanctioned limit, then you will automatically cut down the drawing power to the sanctioned limit. That is, whichever is lower, that is the maximum amount will be the drawing power. Above that, you cannot draw. Hope you got a Clarity. Then auditor's concern. Stock statements, quarterly returns and other statements submitted by the borrower to the bank should be checked by the auditor. For all the cash credit facilities, you take some cash credit facilities on, like cash credit accounts of the customers on sample. All the stock statements, debtor statements, everything given by the customer, check that in a detail, some on sampling basis. Audited annual report submitted by the borrower should be scrutinized properly. All these things. Then computational drawing power we learned right now. It is basically the guidelines are formulated by the board of directors of the bank. For drawing power calculation, what are the things to be included, excluded, all these things, guidelines are placed by the board of directors and also agreed by the statutory auditors. So the board of directors of the bank plus the statutory auditors of the bank, both will sit and decide how to calculate the drawing power for the bank, the guidelines. Special consideration should be given to proper reporting of creditors for the purpose of calculating drawing power. I showed you, list. Then stock audit should be done. Stock audit, imagine I'm a bank and I have given a loan to a lot of people. Cash credit loan for working capital. So then they are giving me stock statements, all these things. How can I trust them? So I should do a periodical stock audit of them. They are giving me, they are saying that we have 10 lakh units worth of stock and they are giving a statement. We should go and check there with our eyes, right? Whether the 10 lakhs units is there. So it is bank's responsibility that if bank is giving a loan to someone for a cash credit loan, bank has to do a stock audit of that customer. And so bank will appoint an auditor. That auditor will go and check the stocks of that borrower and will report it to the bank. So, and this auditor's fees, everything is paid by that company itself, not by the bank, the borrower itself. Okay. That is what we call stock audit. Understand. Then now comes audit of advances, another crucial area of this chapter. That is very easy. All these things are very easy in carrying out the how to do the auditing of loan given by a bank, how to do the auditing. In carrying out the audit of advances, auditor is concerned with obtaining evidence about the following. That is, auditor has to obtain evidence about basis of valuation, what are the unrecorded, no unrecorded advances are there. Then what are the amount, advances only means amounts due to the bank only, not any other amounts are included in advances. Then amount included in the balance sheet in respect of advances are actually outstanding. Only outstanding balance is included in advances. Something that is not outstanding, chumma, that's not included in advances. Auditor has to check that. Then all the advances means the amount due to the bank and it is supported by loan documents. All the advances given by the bank, proper loan documents are there, auditor has to check. Then accounting policies and all these things, proper provision has also been put. So this is ban dosha provisions. Ban is there, dosha is there, provision is there. Ban means B. B means basis of valuation, you have to check. Then UN means unrecorded, no unrecorded advances are there. Memory technique. Dosha, the amount due to the bank, outstanding, supported by loan documents, accounting policies. Then ban dosha provisions, simple. Then idella a very easy point. Then also all those are easy. Then in evaluation of internal control over advances should include all these things. This is very easy. You will read and you will understand. So next is, guys, income of the bank, auditing the income of the bank. So income of the bank is divided into two things. Basically the most important income, that is the income from interest, which we learned how to recognize the income, all these things, like based on NPA. Like if it is an NPA, then recognize it on receipt basis only. Only when you receive, you can recognize. If it is not an NPA, then accrual basis. This is regarding interest. Then other incomes are there for the bank. Commissions they receive, brokerage they receive, all the charges they take. All these things are other income for the bank. Just read it once. You don't have to memorize anything. Profit on sale of investment, profit and loss or revaluation of assets, all these different commissions, brokerage, everything. Then how to audit the income? We'll focus on the important areas. RBI's direction. That is, if any income other than interest obviously we learn how to recognize. Other incomes, basically commissions, brokerage, all these incomes, if it exceed 1% of the total income of the bank, total income, total revenue is 1%, that is gross basis revenue, or 1% of the net profit before tax, if they are considering income as net of cost, that is profit basis, those incomes should be recorded on accrual basis. If there is any commission or other incomes like that, you can recognize it on accrual basis. Any income which exceeds 1% of total revenue or net profit, you can recognize it on accrual basis. If bank is considering total revenue as their income, then 1% of total revenue you have to check. If bank is considering net profit before tax as their income, then you have to consider net profit. Okay, 1% of net profit. When a credit facility is classified as non-performing for the first time when it becomes NPA. Imagine I took loan from the bank and I have not repaid. For the first time I am doing this, 90 days I have not repaid, it become NPA. For the first time when it becomes NPA, interest accrued and credited to the previous year, which has credited to the income account in the corresponding year, which has not been realized, should be reversed. That means I'll say, imagine let's take 3 months. Let's take 3 months. This is December, this is January, this is February, this is March. This is March 31st 3. Okay. Till here, till November, I have paid the money. Till November, I have paid the money. December, I have not paid. 1 month, 2 months, 3 months. 90 days are over here. Here, 90 days are over. So my account should become an NPA here. So, but these 3 months, it was not NPA. So these 3 months, it was not NPA. So these three, imagine the EMI, the interest component is 10,000, 10,000, 10,000, 10,000. Here also interest component is 10,000 every month. So here we have, since it was not an NPA, NPA became only from here onwards. So, but these three incomes also we have not received. Since it was not an NPA, we would have already recognized it on accrual basis. December, it was not an NPA. Since November, till November, I was paying everything properly. So, this income would have been recognized already on accrual basis. This was already recognized on accrual basis. This was also already recognized on accrual basis. But from here onwards, it will not be recognized because it became NPA. So, from here onwards, the receipt basis only you will record the income in the bank books. But so when it becomes NPA, any income which has been previously credited, that is these three incomes has been recorded as income, but that has not actually been received, which has been previously credited, but has not actually received. You need to reverse these three because these three has not been received and account becomes NPA. From here onwards, all the things you will record on receipt basis only, but these three things you have to reverse. It was shown as income, reverse it now. That is what they are saying. This will apply to government guaranteed advances also. We learned what is the provision, central government and state government guaranteed advances. Same thing. Then advances against securities. That is bank. Someone has given us this security. That is Indira Vikas Patra, National Savings Certificate. All this. I have a National Savings Certificate. I gave. Imagine it is worth something. I gave it to the bank, and against which I take a loan. So in those cases, if I am not repaying it to them, don't classify it as NPA because these things are immediately realizable. Bank can immediately fetch money by selling this. So for those things, you don't need to recognize as NPA, provided as adequate margin is available in the account. That is the value of the NSC that I gave, imagine is at 10 lakhs. And I took a loan from the bank for that of say 6 lakhs. So 4 lakh margin is there. The adequate margin depends upon bank's judgment. Right? It can be 1 lakh, 2 lakh, 3 lakh, 50,000, whatever. So now here is a good margin is there. My amount is only 6 lakh and together with interest, I have not paid it. Total accumulated to is like 6.5 lakh. So still adequate margin of margin is there. 3.5 lakh margin is there. So in this case, you don't need to recognize it as NPA. You can normally show it as normal thing itself, not NPA. Provided an adequate margin is there. This is only applicable for advanced against these securities. National Savings Certificate, Interest Vikas Patra, Kisan Vikas Patra and all these things. Then bills purchased, bills for collection. Very, very important. Bills purchased. What is actually bills purchased? Imagine I have a bills, imagine I have bills worth 50 lakh. And this is imagine on what date you can say for better calculation. Imagine it is on March 1st. I have a bills worth 50 lakh and it is to be collectible on, I am going to receive, it's a bill worth 50 lakh, 4 months of credit period, credit. So I am getting this on say June 1st, I will get this money. This is the bills I have with me. Imagine the value of it is 50 lakh. Now, but I need this money immediately. March 1st itself, I need this money. So what I will do, I will go to the bank, sell this bill to the bank and I'll get, bank may pay me 48 lakhs rupees or something. So 2 lakh rupees is bank's income. And what bank will do? Bank at the June month, bank will directly collect money from that borrower, that person, my debtor, he will directly collect money from like 50 lakhs bank will collect. So bank will get extra 2 lakhs. So bank is actually purchasing the bill. We have to think from bank's perspective. Bank is purchasing the bill here. Okay. So in that case, what should we do? So this 2 lakh is bank's income. Bank gave us only 48 lakh for the bills and bank is getting 50 lakh on June. Okay. So in case of bills purchased outstanding at the close of the year, the discount received thereon to the bank should be properly apportioned between the years. It simply means that March 1st, bank bought bill from me. So imagine, So 2 lakh is the income for the bank from bills. 2 lakh income bank will get extra. So 2 lakh income. So what is the duration? 4 months is there. So as on 31st March, when bank is preparing the accounts, only 1 month is over. So 1 month's income should only come in this year. Imagine the previous year is a 22-23 is the current year, financial year. So when you're preparing books of accounts for financial statements for 22-23, only for 2 lakh is the total income for the bank. But in this, only 50,000 is the income which bank has earned till now. March only income. March 1 to March 31st income is 50,000. Like 4 months are there. 2 lakh divided by 4, 50,000 each month. So 50,000 income bank has actually earned. He will be receiving it only on June, but still it has earned. Then rest 3 months, April, May, June, April, May, June, he will receive the things, right? That 1.5 lakh, he will, one calculation mistake. March, April, May, June 1st, here he will be receiving it on July 1st. Then 4 months. Okay. So those 4 months income, 3 months thing, 1.5 lakh rupees. This 1.5 lakh rupees should be recorded as income in 23-24 financial year only. Because this is the only income bank earned current year. That is what they're saying here. The unexpired discount, that is an unearned discount of 1.5 lakh or the rebate on bills discount, both the things are same. Where part of the receipt comprising discounts, it should be shown as other liability. That is 1.5 lakh, other liability. So you can show it. But is interest not earned till now. Income not earned till now. 1.5 lakh is not earned till now. Then the interest come. This is another thing. This is rediscounting of bills from the bank. That is, imagine I am a bank, not customer, bank. I have total bills worth of say 10 crore bills worth. Different customers, I have total bills worth of 10 crore. And now I think that I bank wanted immediately money. So bank, this is a total bill that bank has already have in their hand. So bank, what will they do? Bank, if they need some money urgently or something, bank will sell these bills to another bank. SBI will sell it to ICICI. And ICICI will pay this bank, SBI, 9.5 crore. So 50 lakh is ICICI's income, like this bank's income. So this is rediscounting of bills. Bank already purchased those bills for discounting. And now bank needed urgent money. Bills will be received, money will be received on next 2-3 months after. So bank will sell all the bills to another bank, rediscounting. So here 10 crore worth of bills was there. It was given to another bank, and this bank received 9.5 crore. The number bank received 9.5 crore. So this 9.5 crore, now our bank, imagine our bank was SBI and this is ICICI. Now SBI lost almost 50 lakh rupees. This is basically a loss on rediscounting of bill. They lost this much, right? So this is a loss, and bank would have earned so much money through bill discounting. This is some bill. Imagine banks are total bills with them with their hand is say 50 crore. In that 10 crore they are rediscounting. Another 40 crore bills are there with the SBI. This 40 crore bills, they would have earned so much income. That income is there, and this loss is also there. Don't net this income and this loss. So here, like here, 2 lakh income, 50,000 is current year. That is income of the bank. Don't net off this loss with that income. Show this as separate. Loss separately you have to show, income separately you have to show. That is what they're written here. Interest component paid by the bank or branch on rediscounting of bills from another financial is not netted off from the discount earned on bills discounted. Simple. So the next is bills for collection. So here bank is not purchasing any bills. Here bank is just an agent. That is, bank will, imagine I have a bills worth of 10 lakh bills. I'm a customer. I will give my bills to the bank and I'll tell my bank, please collect it on my behalf. So here bank is not purchasing any bill from you. Here bank is just an agent. So bank is not getting any discounting income. That discount they are not getting. Here their income is, I have a bill, I have a debtor, I have a bill, I gave the bill to the bank, and bank will collect money for me from that debtor. The debtor will pay money directly to the bank. Imagine debtor pays 10 lakh. Now bank will charge a small commission or fees from me. That is only bank's income here. Here no discounting income is there. So guys, understand, when I give my bill to the bank, in the bank's book, no journal entry is made. Bank will not make any journal entry at that point of time. They will make the journal entry only when that debtor pays money to the bank. That time, when debtor pays money to the bank, in the bank's book, bank has earned that fees. Imagine 2,000 rupees is the fees. So when debtor pays 10 lakh to the bank, it's like bank earned 2,000. So at that time, on accrual basis, they will put that journal entry, 2,000 rupees receivable. That like they will put the journal entry, and then after 1 week or 1 month, sometimes I'll pay that. Not sometimes I'll pay that 2,000 rupees. Or bank may take 2,000 rupees and give me that 9,98,000 rupees back. So that is the process of bills for collection. So here, see, The auditor should examine the procedure for crediting the party on whose behalf the bill has been collected. Like crediting me. First time when I give the bank the bills, no entry is coming. Only when the bank receives the money and gives it to me, that time will only journal entry, this crediting things will come. So auditor has to check whether that journal entries are correct. Then the procedure is usually such that the customer's account, my account in the bank, is credited only after the bill has actually been collected from the drawee. That time will only they will credit my account, and their income, that is their commission, will be only become receivable, becomes accrued only when they receive the money. That is, the commission of the branch becomes due only when the bill has actually been collected. Okay. Hope you understood these two complicated cases. Okay, understanding is needed, not memorizing. Then renegotiations. Renegotiations is very easy. That is just renegotiating the terms. The fees and commissions. Imagine I have a loan worth 10 lakh. I take a loan of 10 lakh from the bank, and the period is say 5 years. 5 years. Imagine the loan taken. I'm giving everything practical because this chapter is a practical kind of case they are asking for question. They can come. Let's learn everything like that. Theoretically also we'll learn, but once you understand it practically only, you will be able to memorize theoretically. That is a problem with here. So imagine I took a loan of 10 lakh and it is at the interest rate of say 10%, and the term is for 5 years. So imagine, hypothetical example, I'm not calculating anything. Imagine the EMI per month is say for 50,000. Just hypothetically imagine. So this is my loan. So first 2 years I paid money properly. But then after 2 years, I don't have the cash flow. My job got, I resigned from my job. I don't have money. So I'll go to the bank and tell bank, I cannot repay 50,000 EMI every month. Can you do some recalculation and make the EMI less than 25,000? I can pay 25,000 a month because I now don't have a job. So what bank will do? Bank will agree. Bank will give, so remaining, imagine 2 years I paid. So the remaining outstanding balance is 7 lakh. 7 lakh. Bank will increase the interest rate there, because bank is doing us a favor. Bank needs to get some extra money, right? Bank will increase interest rates to 12%, but remaining 3 years are there. So bank will increase the term also, they will increase to say 12 years, they will increase the term, or 10 years they will give us the term. So EMI will come down to 25,000. So here renegotiation happened in the terms. This was the first term, but since the customer was unable to pay, borrower was unable to pay, bank renegotiated the term. So for giving this renegotiation, bank will charge some fees or commissions. So that is what is mentioned here. Fees and commissions earned by the bank as a result of renegotiations or rescheduling of outstanding debt, it can be recognized on accrual basis over the period of time covered by the renegotiated or rescheduled extension. That is, here 2 years was already over. So another extra 10 years was given. So 12 years is the term. So how much term is left? 10 years left. So imagine we paid a bank 50,000 as renegotiation fees. This 50,000, the bank cannot immediately recognize it. Bank can recognize it on accrual basis, but over the entire period, over the 10 years, they can recognize this 50. Divided by every month, 10 years, they can recognize it. Just understand, no, nothing, don't even think too much practical. Just understand this thing, just basic practically for learning the theory. For learning the theory, you need to understand this basic practical. That's enough. You don't have to, they will not give you any practical question to solve this. No. Just for understanding, learn the practical side. Then test check the interest earned by the bank for the sample selected. Then test check the fees and commission, simple. Then reversal of income, another important area. If any income including the bills purchased and discounted becomes NPA, I told you we need to reverse 3 months. Where was it? Where was it? See, not this one. Like this example I showed you. Like account becomes NPA on this date. So these 3 months income was already credited. We need to reverse it when it becomes NPA. Same thing they are saying here. If any advance, including bills purchased or discounted, any advance, any loan, not a normal loan, bills purchased, discount, anything becomes an NPA, the entire interest accrued and credited to the income account in the past period, which should be reversed, which has not been received, you have to reverse it if the same is not realized, same is not received. This will apply to government guaranteed advance also. Same point we learned above. In respect of NPAs, fees, commissions, I'm going in a bit quick, so you can pause it, process it, then resume it. Okay. In respect of NPAs, fees, commission, all these kinds of income, similar income that have been accrued should cease to accrue if the current period and should reverse or provided for respect to the past periods if uncollected. Same point like here. So when it becomes an NPA here, from here onwards, you should not recognize it on accrual basis, only on receipt basis. That is what they are saying. Guys, then this point, that is current year. Imagine the current year is say financial year 22-23 and the next year is say financial year 23-24. So
there was one income of April. It was an actually interest income of April 2023's income of imagine 10,000. It unknowingly got included in 22-23's financial year. That is, it unknowingly got recorded in March 2023. So actually it should be coming in this year, but it unknowingly got in this year. In that case, what should you do? Anyways, 22-23 is over. We cannot do anything on that. So now two options are there. Either if this included 10,000 income is included in 23-24, the 10,000 income comes in 23-24 also. So it's like double recording. In that case, you have to reverse this 10,000. That is, you have to eliminate this 10,000 from 23-24's books of accounts because it is actually already recorded in the year once. That is the first option. Second option is that for better presentation purposes, because this is 23-24's income, right? So this you can include in 23-24, no problem. But at the same time, against this, an opposite provision you need to give, an expense kind of a provision you need to give for 10,000. So the net effect will become zero. Income is only recorded once. That are these two things you can do. So number one, that income got recorded in this year. So same amount if it is coming in this year, you can reverse that. That is, you can eliminate that, delete that. That is one option. Second option, if for better presentation you want that income to be shown in the income side in 23-24, you can do it. But at the same time, give an opposite provision to that in 23-24 itself, 10,000 rupees provision. So net effect will be zero. So this is what they have said here. In case which a bank has wrongly recognized income in the past, they should reverse the interest if it was recognized as income during the current year. If it is already recognized in current year, reverse it, or you can make a provision for a equivalent amount. If you want to show it in current year, okay, you show it, and oppositely you put a provision. Then on leased asset, the component of finance income on the leased asset which was accrued and credited to the income account before the asset became NPA and remaining unrealized should be reversed. Same like that. If any leased asset anything becomes NPA, all the income that is already received but already recorded but not received yet, accrual basis you recorded but account becomes an NPA here, all those things you need to reverse it. Same thing should be reversed or provided for in the current accounting period. Then takeout finance. What do you mean by takeout finance? It is literally very important. Just understand. Takeout finance means, imagine I wanted to construct a shopping mall. I'm a businessman. I wanted to construct a shopping mall. The money I need is say 1,000 crores. So 1,000 crores I went to SBI. Just like earlier we learned the same example. Similarly, I wanted 1,000 crores. I went to SBI. Now SBI is saying, bro, now you only have a land and the land order value say just 200 crore. So for that land, how can I give you 1,000 crores? Now you don't have the credibility. You don't have the security also. Now I cannot give you 1,000 crores now. You can do one thing. You can go to some other bank. Other IDBI, all these banks will give these kinds of loans. You can go to some other bank and you can take this 1,000 crores from them. They may charge you higher interest. Imagine SBI interest is very low because I need a tenure of say 50 years or 20 years or tenure I needed. No bank will give that, only SBI will give that. Understand? Hypothetically, I'm saying. So I went to SBI, asked 1,000 crores. They are saying, now since you don't have bigger security, I cannot give you 1,000 crores. You can do one thing. You can go to IDBI bank and take this loan. IDBI will give you this 1,000 crore. But IDBI's interest rate is very high. IDBI will only give you 10-year tenure maximum or 5-year tenure. But you go and take the 1,000 crore from IDBI. Take it for higher interest. Then what I will do, SBI is speaking. SBI will say, what I will do, with that 1,000 crore money that IDBI gave you, you construct the mall. So in 6 months, you can finish construction of a mall, or 1 year you can finish construction of a mall. So 1 year you pay interest everything to IDBI. Once your mall has been constructed, it is finished, now you have a land and you have a very big building also. Now you can come to me and now I will take over the loan. That is, SBI will say once the building is constructed, SBI will take over this loan from IDBI bank. So then SBI will give this borrower for me, like SBI will give a very long duration and very low interest rate. SBI will take it over. So till then we cannot give you that money. Then you can take it from IDBI. So basically I am a borrower. I need a loan from SBI because I'll get low interest rate and long tenure. But now for the time's sake I am taking it from IDBI bank, and SBI I have an agreement that SBI will take over this loan after 1 year once the construction is finished. Once certain conditions are fulfilled, they have an agreement with me and IDBI. That is called a takeover finance. SBI is taking over my loan from IDBI. So there are those high interest and less tenure. SBI is taking over because they'll give it to me for lower interest and longer tenure. Okay. So takeout finance, takeover, that is takeout.
Takeout loan is a method of financing where a loan that is procured later I am taking the loan from SBI, is used to replace the initial loan. Initially I am taking the loan from IDBI, and then futurely I will get the money from SBI. That is basically SBI will take over this loan, take out. More specifically, a takeout loan or takeout financing is a long-term financing that the lender promises to provide at a particular date. Lender, SBI will promise, SBI will say after 1 year I will take out the loan, or when a particular criteria is fulfilled. Either they will say after 1 year I will take out the loan, or SBI will say after you finish completion, that is one condition they will put, then I will take over the loan for the completion of a project are met. Okay, takeout loans are commonly used in property developments, buildings. Then in case of takeout finance, if based on the record of recovery, account is classified as NPA. Record of recovery means money has not been paid for 90 days. That is, recovery is not there. If it becomes NPA, it should recognize income unless realized from the borrower. Same thing. It should not recognize income unless realized from the borrower. Same thing what we learned above. What is the objective? Very easy, just learn it. So the next one is on partial recoveries of NPA. That is the partial recovery. It simply means that, let's look at this example. Total I have taken 6.5 lakh from the bank loan and I have not paid anything. So account becomes NPA and the total accumulated interest is 1.5 lakh. So total outstanding balance is 8 lakh. So I have to pay this much balance is pending. But I have paid only 1.8 lakh to the bank. That is partially some money I have paid it to the bank. So how to adjust this money? Should they adjust it to the principal? So normally with this 1.8 lakh, should they adjust it with this 1.35 lakh interest, or should they reduce this 1.8 lakh to the principal amount? So there should be a decision on this. So two things are there. If there is a clear agreement between me and the bank, that is while taking the loan there was an agreement. If I became NPA and if I then later if I pay the money, that is partial money if I pay, directly adjust it to the principal. If such kind of an agreement is there, then bank will follow that agreement and adjust the money accordingly. If there is no agreement between the borrower and the bank, then bank can frame a policy and bank can decide where to adjust it. So bank may have an internal policy. Bank directors, all these people will sit on partial recovery of NPA. We will only adjust this amount to the interest first. Then remaining, if anything, only we will adjust to principal. Thereby, bank may have these kinds of accounting policies. So first option, if there is a clear agreement between borrower and the bank, then the bank will follow that and adjust money accordingly. If there is no clear agreement, then bank will follow their own accounting policy, whatever the decision they have taken. That is on partial recovery of NPA. Same thing they have written it here. So normally in the absence of a clear agreement between bank and borrower for the purpose of appropriation of NPA, banks are required to adopt their accounting policy and follow like that. Appropriate policies recognize income as per AS9 when certainty attaches to realization and according amount reversely recognized or recognized in the past should be accounted. It's simple. Then this interest partially or fully realized in the NPA can be taken to income. That is whatever money I paid, this bank can consider that as income because actually it has been paid, not accrued. It has actually been realized. So even though account is NPA, they can still take that. Then however, it should be ensured that the credit towards this interest, whatever money I am paying, this 1.8 lakh should not be from any extra loan that bank has given to me. Because already my one loan is NPA and still bank gave me another loan and with that loan I am repaying this. That should not be there. That auditor should check. That is, it should not be out of any fresh or additional credit facility sanctioned to the borrower concerned. It's very simple. Then there is a memorandum account. Memorandum account means if I'm the bank, one borrower is there, he became an NPA last 6 months back. So last 6 months income I'm not recording anything because I have not received any money. But that 6 months interest, I should record it in a separate account. Like books of accounts normally it should not come. But separate account we will create for just calculation purposes. Separate account, separate book we will record that 6 months whatever interest is accrued but not received. Those interest we will record it there. Those 3 months interest we reversed. All those things we will record. Just for safety it will record and keep it there. But normal books it will not come. Normal books we will recognize it only when it is received. That separate book is called a memorandum account. Then next is income from investments. It is literally very easy. Interest income on investment. This include all the income derived from the government securities, bonds, debentures of corporates, all the things by way of interest and dividend, everything. That is interest income for the bank. Bank will have extra money and bank may invest it somewhere else. So whatever money, interest or dividend the bank is receiving, how should treat that? They can recognize that as income except income earned by of dividends, etc. from subsidiaries and joint ventures. If bank has a subsidiary joint venture, money received from them, they should not recognize as income. Other things they can recognize as income. Then broken period interest paid on securities purchased and amortization of premium on SLR investments is net off from the interest income on the, if there is any broken period interest or there is any amortization of premium on SLR investment, it should be netted off from the interest income on investments. It should be netted off.
So the next is auditing of expenses of a bank. So bank has basically three types of expenses: interest expense, operating expense, and provision and contingency. It is very easy. You can easily understand by reading, but still some complicated areas are there which I will explain. That is how to audit the interest expense of a bank. So interest expense means bank may accept FDs and other deposits from customers, and bank will pay them the interest. That is what we call interest expense. So first thing auditor has to check is, auditor is primarily concerned with assessing the overall reasonableness of the amount of interest expense. He has to check the overall reasonableness of interest expense. It simply means, imagine the bank's policy is their average interest rate is say 7%. 7% is the interest that they give on FD, and for senior citizens, imagine it is 8%. This is just hypothetical. Hypothetically, we will take it as 7%. So this is bank's policy that we will only give 7% interest. So what we need to do, we need to assess the reasonableness of all the interest paid by the bank. Sometimes imagine for some customers, bank has paid some extra interest. We don't know something. We need to check, right? So for that, we'll take the ratio of all the interest paid. Total amount of interest paid is say 10 crore. So 10 crore is to what is the total amount of deposits, total amount of FDs accepted by the bank? It is say 70 crore. So not say 70 crore, 10 crore is to, we can take it as 10 crore is to 100 crore is a total deposit. So what happened? The bank is saying their average FD interest rate is 7%. But here for 100 crore deposits are totally there. But for that 10 crore interest has been paid. So that is basically 10%. But bank is saying their FD interest rate is 7%. So how can this happen? So for that purpose, then we need to ask the bank, bro, you are saying 7% is your average interest rate, and now for 100 crore deposits, you have paid out almost total, for 100 crore deposits, you have paid total 10 crore interest. How can that happen? So it is basically 10%, right? So bank will need to give us the explanation. Like that, there will be some reason they will give. So now we need to analyze the reason and say whether it is reasonable or not. That is what this point is about, that we have to assess the overall reasonableness of the amount by analyzing the ratio of interest paid out ratio with the total liability is this one. That is first one. Second is that auditor need to obtain from the bank an analysis of the various types of deposits. Different types of deposits will be the savings deposit, fixed deposit, recurring deposits, all this. We have to obtain a breakup from them. That is, we have to obtain an analysis of the various reports of the deposits outstanding at the end of each quarter. From that, from all these deposits, FD, savings, recurring, all these things, we need to calculate a weighted average interest rate. We will calculate a WACC, weighted average interest rate we will calculate, and then compare this rate with the actual average rate paid. What is a weighted average interest rate? You don't need to look at the practical side, just understand, compare weighted average interest rate with the actual interest rate. Simple. So first point, we need to check the reasonableness of the interest paid. For that, we will take the ratio of interest paid to deposits and see whether it is reasonable. Second case, you have to compare weighted average interest rate with the actual average interest rate. Simple. And see whether any difference is there. Weighted average interest rate is coming to 10% and actual is only 7%. So it's a very big difference. 3 big differences there. If difference is material, ask the bank. If small differences, okay, no problem. Like that. Then auditor should compare the average rate of interest paid on the relevant deposits of the previous year. Current year interest with the previous year interest, just compare and see each account wise. Then he need to analyze a month-on-month cost analysis document and reasons, and document the reasons for the variances if anything is there. Cost analysis, like interest analysis, you can check. So these are the ways you need to audit the interest. So 3 points you can write from here. Then this 1 point alone you need to learn this much. So when a question comes, that 3 points plus this point also you can add. Auditor should test check the basis on a test check basis. On a test check basis, auditor need to verify the calculation of interest and need to ensure that interest has been provided for all the deposits, all the FDs and the things. Bank has given interest. There is no deposits in which bank has not missed interest. Like that, bank has missed an interest. Auditor has to check that. Interest rates are in accordance with the bank's internal regulations and RBI rules. Interest is paid only as per the bank's rules and RBI's rules. Interest on savings accounts are in accordance with the rules framed by the bank and RBI. This is on FD and this is on savings account also you have to check. Interest on inter-branch balance has been provided at rates prescribed by RBI. These things you have to write. Then these things are very easy. You just check it. That is, obtain an interest rate card and of various types of deposits and analyze interest. Like for savings deposit, 2% is interest. Recurring deposit, 5% is interest. Other things, FD is 8% is interest. Like that interest rate card you will get where it is written. So take that for all the deposits and analyze it. So all these things are very simple. Then examine the completeness that the interest has been accrued for all the things. Very easy. Then next is operating expenses. How will you audit the operating expenses? Very easy. Descriptive question it can come. Just study and keep the 4 points. Memorization. Study and evaluate the system of internal control relating to expenses. That is operating expenses. For running the bank may need some expenses, right? To pay the wages, to pay the electricity bill, all these operating expenses. So see the system of internal control relating to expenses, including the what is the authorization procedure. If bank need to spend 50,000 to buy an AC, or AC is not operating, so buy something. Bank need to buy 50,000 something like operating things for the thing, for the bank. How that authorization procedure is there in the bank, like who authorizes that? Does the bank manager signature is needed, or the accountant itself can authorize? Like that, you have to check here. Then examine whether there are any divergent trends in respect of major items of expenses, major operating expenses compared to the previous year, and see whether there is a sudden increase or sudden decrease. That is divergent trend. Then perform substantive analytical procedure for expenses. That is compare with the comparison. Then verify expenses comparison, and like you know what is SA 520. If you don't know, wait for the video. Next week I'll upload a video on SA 520. This is the most critical video because SA 520 analytical procedures, I'm 100% sure 80% of CA Inter students don't know that. Even if you have attended classes, majority of the students I have seen in my Power Prep batch, which is happening next week, there are a lot of students coming in, previous Power Prep batches, they don't know what is 520. They have know all the theory, but they don't know how what actually is substantive analytical. That takes a time to explain. I will explain it in the upcoming video. Stay connected for that. Then verify the expenses with reference to the supporting documents. All the expenses in electricity bill, show the bill. For electricity expenses, compare it with the supporting document. That is a bill. That is how you do this. Then provisions and contingencies, how will you audit? Very easy. Ensure that the compliances for various regulatory requirements for provisioning is done. Then obtaining an understanding of how the bank computes the provision, how the bank is putting provision. Are they following the correct provisioning requirements which we studied earlier? All those things. Then obtain a detailed breakup of the standard loans, NPAs, and agree the outstanding balance with the general ledger. Ask the bank, give me a breakup of all the loans, all the standard loans, all the NPA loans, all this, give a list of all those things, and I will compare it with the general ledger of the bank to look at the provision, or whether they have put the provision properly for NPA loans, and whether standard loans is 0.4%. It's not needed that much. You don't need to understand provision for this. Substandard, yes, you need to understand. Then examine the other, obtain the tax provision computation. Bank will have a tax provision computation. Ask the bank, give it to me from the bank, and verify the nature of items debited and credited to the P&L in that tax provision computation. Simple. Examine the other provisions for expenses via this. That is the circumstances warranting provisioning and adequacy of the same by discussing and obtaining explanations from bank manager. What are the circumstances in which you put provision? It's very simple. Other provision bank is putting for expenses. On what all situations bank is putting that. Discuss it with the bank. Simple. So these two things, it's okay. It seems still important, but I have anyways discussed. Anyways, we have touched upon all the major topics of this chapter, and I hope you liked this video. And I'm 100% sure we have touched on every complicated topics in this chapter in a very detailed way, like we do a normal revision.